Started to pick up into positive territory, and the FTSE 100 isn't far from positive territory right now. So a little bit of negativity coming through here, Lizzie, but we've seen this being paired a little bit, and I just wonder whether the fact that we've got slightly lower bond yields this morning, whether that is something that maybe reduces the panic stations when it comes to European reaction functions.
Well, in terms of some of the stocks to watch this morning, Anna, we can start with the impact of the Middle East war. We had, of course, Tehran over the weekend striking aluminium producers in Bahrain and the UAE, so we watch aluminium stocks here in Europe because we've seen futures on the LME surging nearly 6%, the most since 2024 this morning after those attacks. So keep an eye on the likes of Norsk Hydro and Grangers, as well as other miners involved in the metal like South 32. Also keep in mind European software stocks after that space tumbled on Friday, a particular focus on cybersecurity, and then Boohoo in your retail space. They had results out this morning exceeding guidance when it came to EBITDA, so keep an eye on that as well, Anna.
Yeah, a bit of stock-specific news there to focus in on, but the broader picture then, Lizzie, is perhaps a negative one for European stocks then this morning with those inputs of escalation and the negativity around US stocks on Friday. All of that setting us up for something a little bit weaker. Is that going to be cushioned by the fact we see those lower bond yields and the bond narrative pivoting from one where we're concerned almost exclusively about inflation to one where we're concerned also about growth? That means slightly lower yields, and does that change things for the banking sector perhaps here in Europe? So we wonder how the banking sector is going to perform with that in mind. European equity markets then are open, and either side of the flat line then, the FTSE 100 just into positive territory, up 0.1% or so. The Stock 600 more broadly down by 0.2%. The IBEX down by that kind of amount. The CAC 40 down by that kind of margin as well. So broadly a little bit of negativity still coming through as we watch those signs of escalation in the Middle East and a higher oil price as a result, Lizzie.
Well, let's turn to the breakdown sectorally. You have just under half of sectors in positive territory this morning. Basic resources leading the gains, up 0.9%. Energy not far behind, up 0.3%. But bottom of the basket, as you flagged, Anna, banks today down 0.8%, perhaps connected to those yield moves that we have been seeing, yields lower as concerns pivot from inflation to growth off the back of this conflict. We'd flagged that we should be watching the aluminium stocks this morning. Grangers is down 0.6%, waiting for Norsk Hydro to open. But in terms of the energy space, the likes of Total, BP and Shell all in the green at the moment. Just looking at some of the other miners this morning, BHP negative, Anglo-American negative, but Rio Tinto with that big aluminium connection up more than 3% as things stand. Just some of those other stocks to watch that we had been flagging. Boohoo up 5.25% right now. Telecom Italia down 0.25%, and in your software space, SAP indeed up 0.7% after the drop in European software over on Friday.
Yeah, it's interesting, the banking sector, isn't it? Because the fact we saw those higher yields coming through in recent weeks didn't support banks necessarily, because a lot of people said it was the wrong kind of inflation and that wasn't going to be positive for the banking sector. And now we see those yields weaker, and that's not great for the banking sector either, it would seem. And so that is the worst performing sector this morning. You mentioned basic resources. That is where we see the positivity, and so that speaks to the strengths of London, doesn't it? The the Brent price, interestingly enough, is actually a little stronger than it was just half an hour ago. So up by 3.5% on Brent, up over $116 a barrel again. And that is positive, of course, for some of the oil majors. And Norsk Hydro, with aluminum prices in mind, up by 4% this morning. So it is some of the basic resource and energy stocks that we see going higher. Let's talk to Richard Saldana, who's Global Equity Portfolio Manager at Aviva Investors, and joins us on set this morning. Richard, nice to have you with us. So another Monday where we're taking stock at the weekend, working out whether we've seen, to what extent we've seen escalation over the weekend. Oil prices are firmly higher this morning. How does the world look? The equities are your focus. So what does the equity market universe look like to you this Monday?
Yeah, it's interesting. I mean, we've had what feels like a number of manic Mondays so far, but actually the initial sort of market reaction, as you said, actually feels reasonably calm given what we've seen over the weekend. As you said, signs of further escalation, Houthis now entering the conflict, US troops mobilizing, as you highlighted. Look, I think from our perspective, just taking a step back, it feels like we are entering another phase now, particularly now we're 4 weeks into this conflict, no clear sign of an end in sight, and actually what does even an end game look like at this point? So look, I think obviously from the starting point where markets were pricing in a relatively short-term conflict in this, talking weeks here, I think now there is potential for this to extend for months now. The market is having to reflect on that. So I think as we start to enter that new phase for equity markets, this starts to shift in our mind from what we've seen so far, which has actually been, you could argue, a relatively ordered, more of a degrossing from an equity allocation perspective to more of a de-risking.
Yes. Tell me a bit more about that, because degrossing then, so reducing the size of positions rather than necessarily reducing the risk profile on those positions. So what does it look like to go from degrossing to de-risking? What should we expect to see more of?
Yeah, absolutely. So if you think about the degrossing phase, which is really what we've seen so far, that's been more about selling the recent winners and buying some of the recent losers, right? So if you think actually the recent winners actually coming into this conflict were actually sectors, sectors such as the consumer staples, healthcare, utilities, etc. More of those kind of, call it, old economy stocks. We saw that halo trade in February worked quite well when everyone was fearful about AI disruption, and actually some of the software names benefited in this degrossing phase that we saw so far. As we start to shift more from the degrossing to the de-risking, in our mind that becomes more of a beta trade, right? So you start to think about those more traditionally defensive sectors, i.e. staples, i.e. healthcare, that actually didn't perform quite so well or were not quite as defensive in the degrossing phase, actually we think start to become more defensive and resilient in the de-risking phase. And then on the flip side, it's going to be those more cyclical sectors. You've highlighted the banks so far this morning, clearly struggling somewhat, and those, call it more discretionary sectors, consumer discretionary sectors, industrial names, again, you think about the kind of raw material costs as well there. So again, we think that's probably what the playbook looks more like in a de-risking phase as opposed to degrossing.
How useful is the 2022 playbook? Evidently, the economic backdrops are completely different, but is there anything that you would copy and paste from then that is useful now?
Look, every single phase is different, right? And I think you're right. I think 2022, that window is instructive somewhat. I think, as you highlighted, some clear differences there, particularly when you think about the starting point where central banks were back in 2022, where rates arguably were pretty low levels, right? And then you think about where inflation was in 2022, actually at sort of relatively elevated levels compared to where we are now. So you could argue rates in a more kind of neutral perspective right now, inflation actually more relatively under control compared to where we were in 2022. But look, there's no doubt about it, a prolonged energy shock, i.e. oil prices above $100 for an extended period of time, i.e. months, 2022 does offer some insight, I think, where, again, when you think about some of those sectors, some of those more traditionally defensive sectors, whether it be utilities, telecoms, consumer staples, healthcare, etc., that perform well, obviously, as well as energy stocks that we have seen so far have performed well. And as I said, those more discretionary sectors struggling somewhat. So I think 2022 investors should have that somewhat in their mind, but as you highlighted, some clear differences in terms of the economic backdrop.
And would you have expected the FTSE 100 to outperform the Stock 600 more, given the exposure to energy? Or have you been surprised by how aligned they've been since the start of the conflict?
Look, somewhat. I think when you think about the composition, particularly the FTSE 100, you think about the big energy stocks, whether it be BP, Shell. You also think about actually some of the more traditionally defensive sectors, i.e. some of those big, healthcare names, whether it be the likes of AstraZeneca, consumer staples names. But I think it's been more, as I said, that degrossing phase where actually some of those sectors that are big heavyweights in the FTSE 100 have not actually proved so defensive. Now, we do think if we're shifting to a period of months for this, that actually starts to play more better. But also we have to factor in somewhat the UK also in a position of weakness. Clearly, if this is a prolonged conflict, and when that feeds through into inflation and obviously energy prices and the energy dependency of the UK clearly also comes under pressure somewhat as well.
Yeah, and maybe that shows up more in the 250 then than the 100 being more of a reflection of the UK economy. Thinking of 2022 and the extent to which that is a useful benchmark to look back at, we talked a lot then about pricing power, and actually stocks didn't do as bad as people thought they could do because of the amount of pricing power they have. Now, the inflation backdrop maybe is a little different this time around. Is that instructive? Is that something we need to think about?
No, I think you're absolutely right thinking about it in that pricing power terms. And to be fair, in 2022, particularly as we thought about coming out of those COVID, supply shocks, actually companies were in a pretty good place when it came to pricing power. So if you think about, obviously, the inflation impact was large when you think about it from a raw material input cost perspective. But actually, companies in 2022 were able to pass those on. So actually, what you saw, if you think about European equities in 2022, from an earnings standpoint, actually didn't really budge. It was more of the derating that you saw, was the valuations that took the hit. But a lot of that was the ability to pass through those pricing pressures. Now, I think here there may be signs where there might be a little bit more challenge when you think about where the consumer is right now and the squeeze a consumer is likely to face from those higher energy costs. But I think at the same time, there will be sectors where we still think that pricing power, or that ability to absorb some of those inflationary impacts is still there.
What do we need to hear from US President Donald Trump to calm the equity market at this point? Genuinely, if he were to say, and we were discussing this earlier, if he were to say there will be a ground offensive, but it'll be limited and it'll be short, would that support the equity market? Look,
I think a ground offensive, I think in my mind, wouldn't be taken particularly well by the market so far. I mean, I think, look, the reality is we've heard lots of, obviously, noises coming out of the US administration. We've heard, obviously, kind of, noises on the other side from Iran. I think really what the market needs to see, other than obviously the signs that there are talks taking place right now, it's really going to come down to when is that Strait of Hormuz going to reopen again? Because again, that is really what is the choke point right now when you think about it from an energy price perspective, but also from a global economy perspective. So talks are well and good, noises are well and good, statements are great, but ultimately we want to see a sign of that strait reopening again. And I think ultimately that is what the equity market is going to need to see. And it's interesting, actually, we've seen, obviously, last week on Monday we had that statement. We saw, obviously, markets push significantly higher, oil prices came down. I think that reactionary function to that is somewhat diminishing, I would suggest, because really what markets want to see are those channels reopening again, allowing that flow of oil to come through, and that ultimately will ease those pressures that we're seeing right now.
In the meantime, Richard, if we're not seeing that just yet, what does it mean that the bond market story seems to be pivoting a little bit from focus on inflation and higher yields to a focus on growth? And, we don't want to draw too many conclusions about just one day, but today we are seeing slightly weaker yields as if markets are now focused a bit more on the growth impact of this. What will that mean for stocks?
Yeah, so look, I think you're absolutely right. Look, we've seen some significant moves in rates markets, right? We've gone from pricing, cuts here in Europe and particularly in the UK to pricing in hikes now as people go, central banks need to kind of fight this inflationary fire, as it were. Now, I think, as you said, we're shifting more from it being an inflationary shock to also people thinking about the growth dynamic. And I think ultimately for equity markets, we've seen that doesn't tend to be particularly constructive when we think about it, if people are starting to worry more about the growth aspect. As we've seen in prior periods, look, equities can absorb $100 oil if it's a short-term impact. But once you start getting into months-long impacts of $100 oil, we've seen equity markets do tend to struggle somewhat in that. So again, for central banks right now, all eyes are going to be, obviously, they're walking the tightrope somewhat and trying to manage what could be a transitory impact to what actually could end up being quite a shock to growth.
Richard, good to see you. Richard Saldana there, Global Equity Portfolio Manager at Aviva Investors. Thank you. Well, let's check in on the core six now, shall we? How are they faring this morning? Against this backdrop, we have LVMH and Nestle gaining, but the rest are in the red. Particular losses for Schneider Electric this morning. Many, Anna, had been saying that this could be a time to get into consumer staples at this point in the conflict, and Nestle indeed outperforming up 0.4%. Let's now check on some of the individual stocks on the move with Bloomberg's Abir Abir.
Good morning, Lizzie. We are turning towards oil majors. Like I mentioned in the previous segment, oil prices are now, or Brent prices are now close to $116 a barrel, gaining slightly over the past few minutes. And that has led to, and the weekend's events as well, have led to a surge and a gain in the oil majors here in Europe, as much as 2.2% in the case of Equinor. And this is on the back of the Houthis getting involved over the weekend directly for the first time since this conflict in the Middle Middle East has started, but also President Trump, or the Wall Street Journal, reporting that President Trump is considering troops on the ground in Iran or in the Middle East. This has led to a surge in Brent. We move on to aluminum, and aluminum prices surged as much as 6% this morning before pairing some gains, but that has led to a gain in the Asia aluminum session. But also we're seeing that reflected in Europe, with the likes of Norsk Hydro up over 6.4%, nearly 6.5% this morning, and this is after Iran attacked facilities both in Bahrain and the United Arab Emirates, with significant damage to those. We turn to a different story, and that is Boohoo, which is also doing quite well this morning, nearly gaining 7%, and this is on the back of some favorable results that were reported. Investors are looking favorably at that news, and this is doing well in the space of fashion. And then we turn to Inuit, which we spoke about earlier as well. Inuit and Telecom Italia are doing different things, diverging this morning, and this is after Telecom Italia said that it would terminate a deal with Inuit valued at over $2 billion this morning, cost-cutting, a process of cost-cutting for Telecom Italia. Inuit not doing well on that news. Telecom Italia gaining progressively as the session moves on. And then finally, the last stock we turn to, we go back to those Middle East stories, and that is Lufthansa, not doing very much now, actually pairing some of those gains as I speak. And this is on the back of some strikes by the company, which has a cabin crew has agreed by large in favor of strikes. But just when it comes to airlines, this is a sector that was not doing very well at the start of the war and going into the end of this month, as jet fuel prices, Lizzie, really gain on the back of the closure of the Strait of Hormuz, but also the wider tensions in the Middle East. But this is what we're looking at. Back to you.
Okay, Abir, thank you very much. That's Bloomberg's Abir Abu Omar.
Let's talk about some of the broader take on the markets, I suppose. Abir, going through some of the detail there, Lizzie. The Stock 600 actually just into positive territory, which marks quite a rapid turnaround from a few hours ago when we got into the office. The futures picture for Europe looked decidedly negative. No surprise, given Friday's session on Wall Street and all of the escalatory signs over the weekend and the higher oil price. But actually that higher oil price is acting as a bit of a support today, and higher aluminum prices also a support. Basic resources stocks, the highest or the best performing sector as a result.
And the FTSE 100 outperforming as well, carrying Europe really. We're just flat to the upside, but we are adding to gains for US futures as well. S&P E-minis up 0.3%, and same for Nasdaq futures as things stand. Well, coming up, oil prices gaining, as we say, as the Iran-backed Houthi militant group in Yemen enters the war in the Middle East. We'll get more on that next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Bringing you up to the minute global news whenever and wherever it happens. I'm Anne-Marie Hordern in Davos, Switzerland, and this is Bloomberg.
Welcome back to the opening trade. 18 minutes into today's session, and the Stoxx 600 is back in the red. Stock sliding for a third day here in Europe as we have higher oil prices. Brent now trading at $115 a barrel, up 2.8% off the back of the latest in the Middle East. We'll get to that in a moment, but because of the higher oil prices, you are seeing outperformance here in London for the FTSE 100, Anna, up 0.1%.
Yeah, absolutely. So that's the upside for stocks. Upside for oil evident this morning. 115.81 is where we trade. That's on Brent. Oil gaining today as the Iran-backed Houthi militant group in Yemen enters the war in the Middle East. The escalation comes as U.S. troops arrive in the region, with energy markets expecting further potential for chaos as the conflict continues to expand. For more, let's bring in Bloomberg's Middle East energy market reporter Anthony DePaola, who is with us from Dubai. And Anthony, over the weekend then, a lot of comment about the fact that the Houthis have joined the conflict, and this could have an outsized impact, I suppose, not necessarily because of their military capabilities, but just geographically where they are located and how this will continue to have an impact, or maybe a stepped up impact, on the flow of crude out of the region.
Good morning, Anna. Yeah, that's correct. The Houthis came in this weekend saying that they were entering the war, launching a missile at Israel. So there is a heightened risk there, but what we haven't seen yet is a real declaration from the Houthis that they are going to act in terms of trying to block or interdict shipping in the Red Sea. And as they've been doing up until the last few months, launching missiles, drones, even some small vessel attacks on ships going through the Bab el-Mandeb Strait that runs south from the Red Sea. And that is important because that would be the...
When do you usually do it?
Oh, we seem to lose our connection to Anthony. That's unfortunate. We were just in the context, we were just having a conversation there with Anthony about oil prices, about the involvement of the Houthis and what that will do. The East-West pipeline, of course, seen as a way, this is through Saudi Arabia, seen as a way of cushioning the blow for the global economy from what's been going on in the Persian Gulf. But with the Houthis entering the fray, maybe that is not the case. Let us pivot from that to a conversation about what's going on. In fact, it seems Anthony is back with us. Anthony, I hope you can hear us. Maybe we'll move the conversation on to what President Trump has been telling the FT, that he wants to take the oil in Iran, and commenting on Karg Island. What would we make of these latest comments?
Yeah. Hi again. Glad to be back. I was also going to say that I think that it's more the uncertainty around what's going to happen going forward that's moving oil prices today, rather than kind of those comments from the Houthis this weekend. Because as you mentioned, we hadn't seen that comment from the Houthis that they were going to really have an impact or start attacking the oil flows out of the Red Sea. But I think what traders are talking about this morning is what's going to happen going forward this week with the U.S. Will the U.S. forces try to take Karg Island? Will they do some action perhaps around Hormuz to try to open that? So traders are really watching the movements of U.S. troops, watching, of course, the comments of President Donald Trump, which seems to say both things and everything. So it's difficult really to gauge from his comments what he's going to do. But you're watching what's happening with more troops coming in and kind of where the strategic nodes are, being Karg for the Iranian exports as well as around Hormuz. So I think that's what traders are really kind of focusing on this week with added risk of additional intervention and that doubt as to how those peace talks are going on. So we've got those two tracks going on at the same time, and that's really what seems to be occupying the traders this morning, Anna.
Anthony, thank you for the context. That's Bloomberg's Anthony de Paula there out of Dubai. Well, as prices for oil skyrocket, worldwide growth forecasts are being slashed and critical fuel shortages are paralysing nations from Pakistan to Thailand. In South Korea, the government is now weighing drastic driving restrictions to insulate its energy reserves from that escalating conflict in Iran. For more, we're joined by Bloomberg Jill Desis out of Hong Kong. Jill, good morning. What's been the impact so far in Asia as the Gulf suppliers cut output?
Hey, good morning, Lizzie. Right, so, there's the South Korea measures that you just mentioned. So this is something that Seoul has already implemented for their public sector employees, basically scanning license plates to kind of prevent the number of times that you can access government buildings. They're actually considering expanding this to the private sector as well. That would be, Lizzie, the first time that such driving restrictions would be in place since the Gulf War, so more than 30 years ago. So that kind of gives you that idea of how drastic things have really kind of become. But it's really not just South Korea. You've also seen measures announced across the rest of Asia Pacific today. Australia, for example, the Prime Minister, Anthony Albanese, came out and talked about implementing a tax cut for fuel because they're trying to drive down petrol prices there. That's the first time we've seen something like that since 2022, when, of course, we saw Russia's invasion of Ukraine push up oil prices worldwide. So you do have some concerns there as well. In 2022, those types of measures lasted for 6 months. So far, we're looking at a 3-month tax cut here. And then, of course, you've also got, just the measures that have been in place across the region over the past several weeks. So in the Philippines, implementing some work from home restrictions for private sector or for public sector employees. So again, just that kind of measurement there. You've got some increases to various ferry fares and things like that in Thailand. So again, really, really hitting the region pretty hard.
Yeah, absolutely. And so you wonder how much Europe is going to have to pay attention to what is happening in Asia and think about at least the possibility of some of these measures. Meanwhile, then, Jill, what signs are we getting about Chinese cargoes going through the Strait of Hormuz? Because maybe that offers a little bit of relief.
Yeah, so this is interesting. We actually were just analyzing some vessel data, looking at a couple of Chinese tankers that appeared to have delivered more than 260,000 barrels of diesel to the Philippines. So as I mentioned, the Philippines being one of those nations where you are seeing some of those austerity measures. And in true, in fact, we haven't heard full disclosure exactly on these vessels or anything like that, but that does kind of track with this idea that China is, offering some diesel to some of its neighbors in kind of a bid to help ease some of the supply crunches, because as we know, China is one of the only nations that's really been able to get some vessels through the Strait of Hormuz at this time. But yeah, again, does indicate to you that when it comes to several places around Asia Pacific, they're dealing with these really big supply crunches, and it does seem like maybe there's at least some temporary relief there. But as we all know, I mean, the longer this goes on, the more difficult it is to really kind of envision what a lot of these supply crunches are going to look like long term.
Jill, thank you very much. Bloomberg's Jill Desis there with the latest on how Asia is responding to this current crisis. Meanwhile, the likes of SocGen talking about $125 oil and beyond. It seems that higher oil prices are something that the markets are starting to take really seriously.
Yeah, what I'd like to know is these thousands of US troops, how many of them would it take to take Karg Island? Just going back to what Anthony was saying, and how many would it take to try and reopen the Strait of Hormuz? These are two, is it an either or situation? escalation. Interesting to work out what those troops could be for. And we're going to talk about geopolitics next. No end in sight to the war as it enters its 5th week, with strikes continuing across the Middle East. Perhaps we can get the answer to that question with Lindsay Newman, visiting research fellow from King's College London. She's coming on next. This is Bloomberg.
Take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard,
Oh boy.
can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
When it matters, investors turn to Bloomberg Surveillance.
I said it maybe even on your show here.
I hear you guys talking about this a lot.
Our investors are really thoughtful. They're engaged. They listen to your show.
As a number of people you've had on your show have mentioned.
The three of us have talked about it on this show many times.
I think you find, and you've heard this on your show,
We've already talked this morning on your show. As you know, and you cover every day on Bloomberg.
You've heard a lot of guests talk about that.
I think your show is incredible.
Bloomberg Surveillance, we're talking about it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back. This is the opening trade, Monday morning, 30 minutes into our session here in Europe. And we had anticipated a negative session for European stocks. At the start of it, though, it looked a little more resilient. Today, we are still flatlining, essentially, across European stocks, but we're just dipping a little further into the red than we were just 15 minutes ago. The FTSE 100, yes, that's still in positive territory, up by 0.2%. Energy stocks, basic resource stocks. Lizzie, you'll talk about that in a moment, no doubt. But that is one area of cushion, but elsewhere, we do see some negativity, in particular around the DAX. That's down by 0.2%. In terms of the underlying dynamics then, Lizzie, what are you seeing?
Well, it's quite a reflection of the fact that it is Easter week, Anna, and it's Monday of Easter week. Volumes down 41% this morning, but a pretty fair balance between members higher and lower on the Stock 600. More to the downside, reflecting that slightly risk-off mood that you were seeing in the geographical breakdown. But let's take a look at some of the leaders and laggers this morning, shall we? Because if we come back to the latest on the ground in the Middle East war, we have seen strikes by Tehran on Middle Eastern plants for aluminium, and therefore you're seeing Norsk Hydro and Rio Tinto gaining as aluminium has surged as well. We're also seeing Ørsted higher more than 5% this morning, this after it was raised to buy at Bank of America. But flipping over to the laggards as well, an individual story for Delivery Hero down more than 6%. This after Prosus is said to be mulling selling its 10% stake in the delivery company. We also have TUI down 1.2%, EasyJet falling as well, as we have those higher oil prices weighing on the airlines this morning, Anna.
Let's get up to date with some of the other news flow we're covering this morning then, Lizzie. And the ECB Governing Council member, Francois Villeroy, says the central bank is prepared to act to rein in inflation expectations. The Bank of France governor told La Stampa the Iran war could inflict a negative supply shock, incurring slower economic growth and faster increases in consumer prices, though he added that betting on dates for potential interest rate hikes is premature. The UK Chancellor Rachel Reeves will urge G7 partners to boost domestic energy supplies and warn the recent surge in oil and gas prices is playing into Vladimir Putin's hands. Reeves will speak with finance and energy ministers and central bankers in an online call later today. We're told she'll ask for allies to ramp up investments in renewable energy and nuclear power to wean themselves off gas. And President Trump says Tehran has given in to most of his administration's demands. But the nature of any direct negotiations remains quite unclear beyond messages being exchanged via third parties. Iran has rejected a 15-point proposal and disputed the U.S. president's claims about negotiations. Earlier on Sunday, President Trump talked of seizing Iran's oil resources, a move that would mark a major escalation in the conflict. Lizzie.
Let's get some analysis now on the latest in geopolitics. We're joined by Lindsay Newman, visiting research fellow over at King's College London. Good morning to you, Lindsay. Thank you for making time for us this Monday morning. We were discussing how the US has sent thousands more troops to the Middle East over the weekend. Do you genuinely believe that the US is gearing up for a ground attack, or is it just that the US is keeping its options open?
Thanks, Lizzie, for having me. You know, I'm a big believer that when Trump moves personnel, when he produces an executive order, when he tells you what he's about to do, he's probably going to do it. The movement of thousands more Marine expeditionary units, we're now at 50,000 military forces in the region, which is about 10,000 more than generally are in the region for the U.S., suggests that something is coming. Now, what that is the big question. But here's what I want to tell you, Lizzie. The big risk is that the status quo as it currently stands is not sustainable. Despite Trump saying that Iran has given in to those 15 points in the plan, Iran is continuing to wreak havoc on the region. We saw this over the weekend with targeted strikes on Saudi Arabia and Kuwait. Iran has learned through this conflict that even though there's asymmetries in might and capability in military power, that it can export the conflict not just to the region, but with knock-on effects on the global economy. So leaving Iran as it currently stands means that Iran would potentially have learned a lot of lessons in this conflict, although quite degraded, and would be a more volatile, more potentially dangerous actor, at least for the region, if not the world. So there must be more coming in terms of how to reconcile this tension.
Okay, we could come back to the diplomatic efforts, what there are of them. But Lindsay, when we look at those troops heading there, already there in the region, I wonder what you think the most likely purpose for them will be. Will it be occupying Kharg Island, as Trump said to the FT yesterday he wants to do? He wants to take the oil in Iran, in his words. Or do you think that they're more likely to be used to reopen the Strait of Hormuz?
Well, we know that the administration is considering a range of options. There's always a spectrum of potential options that they are going to be considering, all the way from, as you said, restarting the diplomatic talks in earnest, to declaring victory and just going home, down the line to the most likely, most costly option would be for troops to go into Iran and look to actually seize that enriched uranium. There's thousands of pounds in enriched uranium. They're believed to be at multiple sites across Iran, from Natanz and Isfahan. This would not be a sort of simple, quick in and out operation like this type of military personnel have recently undertaken in Venezuela. This is not a 38-minute operation as we saw there. This is going to be a multi-day operation, so that would be incredibly costly, incredibly dangerous, and we know that Iran is very well aware that this is something that the U.S. administration is looking to potentially pursue. So the most likely scenario here has to be something along the lines from a blockade of Karg Island to potentially efforts to bomb and disrupt the resources there to prevent further exports, Iran control over the exports from Karg Island. But again, the U.S. has not ruled out going all the way down the line to seizing that enriched uranium, and Trump has said for himself that is what he wants to do, seizing that dust, he calls it.
Lindsay, what can you tell us about the status of any talks that are taking place? I mean, clearly messages are getting through from one side to the other, but we know mostly about that via intermediaries, the exchange of the 15-point plan from the US side, and then Iran pushing back with its own 5-point plan. And it doesn't seem from the outside that there is much meeting of minds on that front. I mean, Iran talking about wanting reparations, about wanting de facto ownership, control of the Strait of Hormuz, which do not seem likely to be things that the US would go along with. What do you make of the status of talks?
Yes, Anna. So we know over the weekend non-combatant participants held talks in Pakistan. So Saudi Arabia, Turkey, Egypt met in Pakistan with to have conversations about mediation efforts. But those are, of course, indirect. We know, as you have mentioned, that last week the U.S. has delivered this 15-point plan. Iran has said, we're not interested in that 15-point plan. Here's our counterpoints. This is a bit like Groundhog Day. If you remember back to just before the conflict started a month ago, the two sides were in these indirect conversations, and even then they could not even agree about what they were willing to talk about. Iran has consistently said that its missile program and its enrichment program is not on the table. Well, this is exactly what the U.S. has always said that it needs to have on the table. So the idea that these two sides are going to reach some sort of ceasefire or some sort of mediation without further pressure being applied on Iran, it seems very, very low likelihood. And this is why, we're thinking that there is going to have to be some sort of further force and force posturing deployed, as Lizzie and I were discussing, in order to sort of further extract pressure on Iran to drive it back to the negotiation table. Because for right now, Iran feels as though it's quite emboldened. It feels as though it can make these demands because of what we're seeing in the Strait of Hormuz and because of the threats and risks to the Red Sea, which people are incredibly worried about, and I think rightfully so. We see during this conflict that supply chains and energy markets can be a strategy, a target of war now.
Yes. So we're seeing Iran flex its muscles and use those levers of control that it has. Meanwhile, Lindsay, I wonder what you make of the extent to which we have seen regime change in Iran, or the extent to which we've not. I mean, we're just hearing from the Tasnim news agency in Iran this morning saying that the IRGC naval commander has been killed. That name then added to a list of Iranian leaders who have been killed as a result of the Israeli and US action here. To what extent have we seen regime change or not? Is that still pending?
Yeah, Anna, we know over this weekend that President Trump says that we've already seen regime change. Actually, we've seen several regime change, if you follow what Trump is saying. And what he's pointing to is a personnel point, but that is not a structural point. So absolutely, from the Ayatollah on down, we have seen personnel removals that the U.S. and Israel in particular have targeted the regime personnel. But the regime itself, for all intents and purposes, for all we know, remains in control of the country, is directing the conflict strategy. We know that the country itself is under an almost complete internet lockdown. So very little is coming from the country itself. But to suggest that we are already in a regime change scenario, I think is ambitious. I think it's not actually appropriate language. We have seen personnel shifts, but we have not yet seen the regime collapse or regime change. This is a regime that is very much continuing by all counts to execute a strategy that was set before the Ayatollah was killed, even as it has seen massive personnel degrading and those 11,000 attacks within the country, 11,000 strikes that the U.S. has imposed on the country itself. So we're not yet in a regime change scenario. Doesn't mean that we may not one day get there, but for now, I think that's inappropriate language to apply.
And Lindsay, Gulf allies are reportedly frustrated here, both at the apparent lack of strategy from President Trump, but also privately questioning American security guarantees. How significant is that for U.S. influence in the region? Could that frustration start to reshape alliances in the Middle East?
Lizzie, I think what we're seeing here from the U.S. administration is that the U.S. administration wanted to achieve certain objectives around the missile program, around the naval program, around the nuclear program, and then it has had, because of Iran's response, has had to make some adjustments. And now, so for example, the Strait of Hormuz and reestablishing deterrence over the Strait of Hormuz has now vaulted to the top of the list. And so the U.S. is now struggling with what cost it's willing to pay in order to achieve these objectives. And we know back at home in the U.S. that 3/4 of Americans are worried about the U.S. getting too involved there. So what that means is the signals coming out of the U.S. are quite difficult to read. And for its Gulf partners, that means they're left wondering, well, are we going to actually see the U.S. continue through this operation, or are they going to back away? That obviously leaves them feeling quite unsettled, quite nervous. But most of that is coming from actually Iran's strategy itself, the fact that Iran has decided to pursue horizontal escalation and make the conflict not just Iran's problem, but the region's problem. I think that these partnerships, these alliances are deeper than just this conflict. They're economic, they're in terms of supply chain. You know, the U.S. under President Trump has worked very hard over this administration and his first administration to deepen those relationships. So I wouldn't think that this operation itself is going to damage those relationships. And if anything, it's shown to regional partners that the U.S. remains the most sort of impactful security superpower in the world. That's what we're all seeing from this.
Lindsay, thanks for your analysis. Good to speak to you. Lindsay Newman, Visiting Research Fellow at King's College London. Coming up then, Iran-backed Houthi militants have entered the Middle East war, as we've just been discussing, raising concerns about the threat to shipping in the Red Sea. Of course, pre-existing concerns, reigniting concerns around the Red Sea. We will talk more about that next. This is Bloomberg.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, you know, maybe more traditional human generated. But what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content, and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be
using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
Right now, the headline, bad news, is bad news.
This is a stagflationary mix.
It's a double squeeze for the rest of the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The market is tightening financial conditions.
It's not just what's happening present day. It's 5, 6, 7 months out.
The longest first quarter ever continues.
The March Jobs Report, Friday on Bloomberg.
They've agreed to send 8 boats 2 days ago, and then they added another 2, so it was 10 boats. And now today they gave us as a tribute, I don't know, I can't define it exactly, but they gave us, I think out of a sign of respect, 20 boats of oil, big boats of oil.
President Trump speaking aboard Air Force One there. It does seem that volumes going through the Strait of Hormuz still firmly reduced compared to what they were previously. Some of the Chinese and Pakistani shipments, according to our reporting, managing to get through. But let's talk about disruption to global trade. The Houthis' entrance into the Iran war adds further complications to global shipping and supply chains, already dealing with the blockage of the Strait of Hormuz. With the Hormuz and Bab el-Mandab straits compromised, tankers are diverting around Africa, skyrocketing costs and transit times. Let's bring in our trade czar, Brendan Murray, who's been tracking the trade story for us and can talk us through some of the latest here. So, Brendan, how much does it complicate things that the Red Sea, now we could see tensions there, the Houthis entering the conflict, of course, and that brings in the Red Sea. But the Red Sea wasn't deemed to be fully passable even before this war started, was it? So what difference does it make to the global sort of shipping narrative?
Yeah, well, it just adds to the overall cloud of uncertainty surrounding the ability to ship goods through the Red Sea, the Suez Canal. The Houthis, have harassed shipping since late 2023. They had kind of gone quiet for a while, and some of the container shipping lines were even talking about coming back through the Red Sea a couple of months ago. But of course, since the war started on February 28th, they've started going back around. So the big question is, to what extent will the Houthis start to affect the shipping lanes? Again, in the energy sector, we've seen the Saudis come up with this workaround to pipe their oil across to the west coast, to Jeddah, and try to export it that way. So the question is, will the Houthis try to prevent that energy supply from reaching markets overseas?
And while you've got so much disruption a month into this war, how's the port ecosystem holding up? Yeah,
it's a really complicated one. Number one, because the air cargo, marine cargo, and road cargo are all sort of tied together, and you've got restrictions in air cargo capacity still. There's still some airspace that's closed, and the carriers aren't running at full schedule. You've got Jebel Ali, the biggest port outside of Asia, that is operational, but there's no volumes flowing in and out of there because ships can't come and go, and so that's creating the opportunity there for the port operators to try to work with other ports in the region to get containers flowing from these other ports. But we saw over the weekend that a port in Oman was hit by a projectile, and Maersk said that was going to be out of commission for a couple of days. So you've got this kind of whack-a-mole situation going on where the workarounds are starting to become the targets, and some of those targets are increasingly becoming industrial assets. We saw the aluminum smelter get hit over the weekend. So the war is widening not only geographically but in segments of the economy.
Yeah, Maersk saying that impact of the incident is going to be limited, and Maersk shares actually up 1.5% this morning.
Yeah, which sometimes trades off the pricing, doesn't it? That longer route around Africa, if that's more likely, they charge higher prices, and then they make more money that way. Let me ask you about how this is widening to other commodities as well. So you've talked about how this is widening in terms of targets. We've gone from just targeting military to now industrial, and questions over energy, of course, with the truce on that front from President Trump getting an extension. But in terms of widening the commodities being affected, aluminium then is now in focus. Fertilizers, a lot of talk over the weekend about what this does to global supply chains for food. What are we looking at there, Brendan?
Exactly. So the companies that operate in the region have a certain amount of inventory that they can absorb, some weeks of a shock. But once those start to run out, and their operations there, whether they're distribution hubs or some sort of assembly that they're doing there, and once they run out of the inventory to keep their production going, they're going to have real problems, and they're going to call on the government authorities for help, and the sort of band-aids that they've put up to try to bring in cargo on the road are going to become ineffective, and they're going to need a lot more help. So it basically the signal is that this is going to widen beyond the region, the economic impact, the price of things that we wouldn't normally think would be associated with an energy crisis in the Middle East will start to go up as well.
Yeah, if you have higher aluminium prices, you'll get that hit to manufacturing, and then less manufacturing goods to go through, right? A vicious cycle. But just focusing on oil, we've got a fantastic feature today talking about how the oil shortage impact is going to spread from Asia here to the West. What's the implication of that for broader trade?
Yeah, I mean, it's one of those things. Well, everything kind of runs on fossil fuels. Shipping, the ships that move oil run on bunker fuel, and so it's all kind of snowballing in a way that's really going to go beyond the energy question. I heard a story yesterday about a ship that needed to offload onions from abroad into the UAE. Now you can imagine, you think onions, how big of a deal is that? But you can imagine a shipload of onions that doesn't get to where it needs to go, with the impact that would have on the food service industry where those need to go. It's that kind of thing that we're going to hear more and more of.
Okay, Brendan, thank you for the colour. Brendan Murray, our trade czar there, for a look at the impact on trade and shipping. Let's just take a look at what else we're watching throughout the week. Today we've got German CPI and the UK Chancellor Rachel Reeves joining a meeting between G7 finance, energy and energy ministers and central bankers as well later on. Tomorrow we have Euro area and French CPI as the French President Emmanuel Macron visits Japan and South Korea on Wednesday. On Wednesday we have Artemis 2 launching, as well as US retail sales, and on Thursday it's US jobless claims, before on Friday we get US unemployment data. But it is, of course, Good Friday, so we'll have partial market closures here in Europe and stateside. But joining us for more on what to expect in markets this week is Bloomberg's Morwenna Coniam from the Markets Today team. And Morwenna, I mentioned some of that US data coming through, but given that you've got the market closures and given so many developments in the Middle East war, how relevant will it be to traders' expectations of the Fed path ahead?
I think that's really an important point. It will be difficult to take a clear read. Also, data tends to be backward-looking, and I think right now markets are really looking forward. And in some ways, for the first time during this conflict, are really starting to price in what's a protracted conflict, really focusing on the implications for growth rather than inflation. And that's something we're seeing in the bond market today, with sovereign debt actually rising across regions, whereas we have seen it really taking a hit from those rising inflation expectations. Now people are starting to say, actually these higher energy prices, which may be there for some time to come, are actually going to harm growth, and that actually means that central banks may take a more hawkish, have less inclination to take that really hawkish stance that had been feared, and actually, the focus could be on growth. So that data may feed into some of that, but I think actually something that's backward-looking, particularly on a market closure day, is going to be difficult to really read too much into.
Yeah, so that's the US employment side. We get, before that, midweek, we get the Eurozone inflation picture. I wonder if that actually threatens to have more of an impact. It is data for March, at least, and it does relate to that pivot that we've seen in bond markets. You know, bond markets going from thinking about inflation to thinking about growth. They could get a reminder come the middle of the week about the inflation risks, I suppose.
Absolutely. I mean, we saw that to an extent, even with last week's CPI for the UK, which was, February, and actually we saw it in Europe as well, where it's like, but even before March, things were actually not quite as good as policymakers would have hoped. I think certainly if it comes in hotter than expected, particularly given it is for March, it will be the first time we really do see some of the actual impact on inflation that the conflict is having, that the higher energy prices are having. Although, of course, we still haven't seen those higher energy prices properly filter through to households. Perhaps we have seen it at the fuel pumps, but we haven't seen it in terms of energy bills. That tends to be a bit more delayed, but we will start to soon, and that will be really watching.
Morena, thank you very much. That's Bloomberg's Morena Conium, and that does it for the opening trade. The Pulse with Anna is coming up next as we look at the Stock 600, now in the green, up 0.1%, and US futures getting increasingly positive, up 0.4% on S&P E-minis. That does it for the opening trade. This is Bloomberg.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, now for a full hour only on Bloomberg Television.
Up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Welcome to Bloomberg This Weekend.
Breaking news today from Wall Street to Washington.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Guys, buckle up. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
Brent crude on track for a record monthly increase as Iran-backed Houthis enter the war in the Middle East and the U.S. expands its military presence. President Trump claims Iran gave the U.S. most of its demands to end the war, even as it remains unclear whether either side is directly negotiating. And treasuries rise on concerns the war will trigger a sharp economic slowdown. Money markets also slashing the odds of a Fed rate hike this year. Let's check in on some assets for you, and we'll start with the energy prices. We see oil prices up by 3% this morning on Brent at $115 a barrel. That is the handle. The WTI price, incidentally, has gone over $101. The copper price is a little firmer this morning. We've got European stocks just pretty flat. U.S. futures moving higher, up by 0.3%. The U.S. 10-year yield at 4.39%. Quick check on what's going on the inflation picture out of Germany. We are gradually building up today a picture of the German inflation story, and it is coming in much higher than the prior period, as you may expect. The Bavarian March consumer prices rising by 1.2% month on month. That is a whole percentage point higher than the previous month, which is something of an Iran effect. Let's take a look at how European markets are responding right now. We've got European equity markets are flat to positive, up 0.1%. The FTSE 100 is up by 0.4% as energy and basic resource stocks are pretty resilient this morning. The CAC 40 pretty flat and the DAX under pressure. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacroix here in London. Now, President Trump says that Tehran has given in to most of the U.S.'s demands, even as it remains pretty unclear just how the two sides are negotiating or talking to each other via intermediaries. He told reporters on board Air Force One that he believes an agreement could come soon.
Sir, could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon.
They offered a 15-point plan to Iran. Did they ever come back?
Yeah, they came back on the 15-point plan. They gave us most of the points.
The U.S. president also told the Financial Times he wants to take Iran's oil. This as an additional 3,500 U.S. troops arrive in the Middle East. Joining us now, Bloomberg Horizons anchor Jumana Basechi. So, Jumana, bring us up to speed with the latest and what's been happening. Despite apparent talks or talk of talks to end the war, we are seeing plenty of further signs of escalation over the weekend.
Yeah, that's right. And President Trump there, in a few of his comments from the weekend, suggesting that Iran do want to make a deal still. But I've got to say, over the course of the weekend, there are no signs that there's been progress towards any diplomatic solution. So if anything, there's been more military escalation over the course of the weekend. Friday, we talked about the arrival of that MEU, the Marine Expeditionary Unit, to the region that comprises of around 3,500 troops, around 2,200 Marines. Questions really about where they're going to be deployed and whether President Trump is actually going to follow through on some of those suspected plans to take over Karg Island or even deploy them along the Iranian coastline. At this point, we don't know, but the fact that they are in the region signals that there is the potential for further escalation. At the same time, the joint Israeli-U.S. military operations in Iran continue. President Trump has said that they have struck 10,000 sites. There are another 3,000 sites that they're looking at targeting. On Friday, nuclear research facilities were targeted alongside 2 steel facilities. And in reaction to that, Iran once again lashed back at Gulf Arab states' infrastructure. We're talking about the targeting of 2 key aluminium smelters in the region. Over here in the United Arab Emirates, we're talking about Emirates Global Aluminium, some disruptions there in Bahrain, also Alba. The UAE sustaining their biggest night of projectiles in a couple of weeks over the course of the weekend. And ongoing attacks in Saudi Arabia as well, and a key one at the Prince Sultan Air Base, which resulted in casualties and 15 servicemen being wounded, alongside some heavy damages on U.S. aircraft as well. So really no signs of things de-escalating for the time being, Anna.
Yeah, no signs of de-escalation then, and oil advances today, continues to advance, up by 3% on Brent, just shy of $116. It's been over that mark, of course, in the last few hours. What impact could the involvement of the Houthis in this war have on the energy story and the ability to get energy out of the region?
Another very important development that you raised there. On Saturday morning, Houthis did enter into the war. They targeted their attacks at Israel, specifically a couple of attacks on Saturday, mostly intercepted by Israeli air defense systems. But it does mark a new entrant into this war. And perhaps some people were surprised that it took them so long, given Hezbollah had also got involved in the war in solidarity with Iran. For now, the language out of the Houthis seems to suggest that they're going to continue to target their strikes at Israel. Remember, they did counter a truce with the U.S. in May 2025, and since the October 2025 ceasefire, Israel-Gaza ceasefire I'm talking about, they have not attacked ships or disrupted shipping on the Red Sea. Now, of course, all of this may change, and it is a major risk looking ahead to markets, not least because Saudi Arabia have been so successful at rerouting a good chunk of their oil exports through that east to west pipeline. We reported over the weekend that they're now using it at full capacity, around 7 million barrels a day, 5 million of which is exported from the Red Sea. So, of course, does indeed pose a risk there, but no signs as of yet that the Houthis are willing to disrupt either the truce that they have with Saudi Arabia signed in 2022 or the one with the U.S. in 2025, but a risk for the market. I will just say that speaking to energy experts and reading the flood of research that's come through this morning, the consensus is that the longer the Strait of Hormuz remains effectively shut, the more you're going to start to see physical disruption in this market. And indeed, that is one of the reasons why you continue to see this uplift in prices. I'll just leave you with a statistic, Anna. It is estimated now that about 11 million barrels a day have been taken off the market because of the disruptions around Strait of Hormuz. Even before the war took place, IEA were estimating a surplus of around 2 million barrels a day. So net, you're still talking about daily 9 million barrels a day of oil that's being taken off the market. Cumulatively, it's having an impact. And what's happening now is the physical supply destruction is one that's really beginning to show up in these markets, and hence why you continue to see that upward pressure on oil, despite the several measures and policy announcements that the U.S. administration have made.
Yeah, upward pressure on prices for sure. Jumana, thank you very much. Bloomberg Horizons anchor Jumana Besetja. Our next guest is dialing down risk on the supply shock from the Middle East. Let's bring in Wei Li, Global Chief Investment Strategist at BlackRock. Wei Li, nice to have you with us on the program. So I want to get into some of the inflation dynamics, growth concerns in a moment, but just tell us how you're dialing back risk. What is the approach that you're taking?
Well, last week we noted that there is a disconnect between equity pricing and also the broader market and supply disruption. So when we were looking at U.S. equities, still just 4% lower from the beginning of the conflict, that's just not consistent with the oil market pricing in doable disruption. So this is why we dial down risk. But right now we're actually really thinking about thematic opportunities that will be accelerated by events in the Middle East, no matter what happens from here on. And energy security and energy independence is one such theme. So we're actually putting out the research paper this week, specifically talking about how we can play to this theme. If you think about of the 8 billion people living on Earth, 80% of them live in countries that are energy oil importers, and 60% of them live in countries that are natural gas importers. So we're talking about environment, really supply is disrupted, but perhaps also takes longer to recover from, because we're talking about energy infrastructures being impacted. And also it's possible to see that countries will focus on kind of building resilience and also stocking up inventory even after the war. So when you bring all of this together, we're in this environment for longer, supercharged environment of world shaped by supply. So we're talking about an environment where we look at energy independence, and it's all of the above when it comes to energy choices. That was already the case last year. We put out a research note talking about how in the context of AI data center build out, we need to tick all the energy boxes, but now even more the case, right? So you look at energy as a sector in U.S. equity market, S&P 500, it's just 4% of the index. It's foreseeable that could grow and that should grow, reflecting the greater significance. And you look at, like renewable, clean tech, electro-tech, these are the themes that we find it really interesting right now.
Okay, and we know that there's going to be a meeting of certain G7 leaders. I think it's finance ministers, central bankers, all going to be gathering today to talk about some of those things, energy independence and the importance of investing in it, Wei-Li. So if you're taking a sort of medium-term perspective here, does this mean further opportunities for renewable energy, nuclear projects of varying sizes? Are those the themes that you're still investing around?
I think so. Renewable and also kind of all of the above for all energy boxes, right? Because demand is increasing and the supply is disrupted for now and maybe for quite a bit longer. But in addition to energy, we're also looking at broader supply chain resilience as a key theme, and also infrastructure as a key theme, and also defense as a key theme. So if you think about all these events, developments, catapulting structural themes that were already in place, I think they're just getting accelerated even more. So whilst we dial down directional equity convictions, so we're neutral right now for U.S. equities and broader equities in general, we are leaning into these themes that are becoming more and more clear, even as we think about kind of the world after the war.
Yes, okay, so these are some of the themes. We'll return to those in just a moment, Wei-Li. I just want to get your thoughts on the near and present inflation risks and dangers. We've just had a host of data coming out of Germany, which shows, I mean, roughly a 1 percentage point step up in rates of inflation in the various regions. I'm looking at Bavaria, the month-on-month inflation there is 1.2%, Brandenburg 1.1%, Saxony 1.1%, North Rhine-Westphalia 1.2%. These are the month-on-month inflation upticks that we're seeing in these places. This tells us something about the very near-term impact. I guess if oil prices stay elevated for a longer period of time, or even go much higher, then there is still inflation risk to the upside, even after these numbers have come through for the month of March.
I think that's very fair. I think one thing that markets were complacent about, and we have been flagging coming into this year, is the disinflationary trend that people are feeling really comfortable with, and that is starting to look quite precarious, right? So I think what is happening right now, this broader supply shock against the backdrop of inflation already above target in most part of the world, is that actually central banks are going to find it increasingly hard to justify wanting to look through, especially because they lost control of inflation during the COVID times, right? So I think the question is going to increasingly shift from can central banks cut to can they hike fast enough to catch up with inflation? Because if they don't, the real rate that accounts for inflation may well be actually accommodative, not restrictive, even as they hike, right? So we're talking about an environment where the calculus facing central banks is really, really challenging. You talked about inflation, but then the read across to growth is capturing a lot of kind of investor focus. And you look at some of the front-end repricing since the second half of Friday, it starts to show that maybe they are worried about the growth dynamics as well. I think all of that is pointing to the trade-offs facing central banks is becoming quite impossible right now.
Yes, so are we going to see central banks increasingly having to hike, even though they know they're hiking into weakness?
I think the question will be, are they going to hike fast enough to actually offset inflation? Because it's the real rate that matters in terms of financial conditions. So it's possible. But one last consideration I want to throw into the mix, which is the very high debt levels facing DM economies, and the debt servicing considerations may well actually limit how far central banks can hide. And that, again, just makes makes the trade-offs facing central banks really, really tough.
So monetary policy actors very aware of the impact that they will be having on fiscal actors then there. I mean, in terms of the other themes that you mentioned around defence and infrastructure, so clearly a lot of themes to invest around. Is there further to go then on the defence narrative for Europe? Because you've seen, I mean, European defence stocks have really gained incredibly since, well, the full-scale invasion of Ukraine, and then this has just added to that sense of urgency around investing in defence.
I think that's fair. I think the decision to increase defence spending definitely catalyzed a re-rating in European defence names, but we are also looking globally for addressable market, right? Because the size of the market is only this much in Europe, so inevitably there could be spillover into the US market. So we're thinking about all of these themes from a global context. Equally for infrastructure, you know, like infrastructure could be disrupted. Where they will be rebuilt is important to consider. But some of these infrastructure companies, they're global, right? So again, they play to this theme almost regardless of where new infrastructures will be rebuilt. But I think it's safe to say because there will be greater focus on resiliency, so reshoring is a consideration, and I think that inevitably points to greater demand to build more and potentially duplication and excess, but that just kind of enforces the near-term and medium-term demand, and that enforces the investment theme.
We've seen emerging market assets under pressure during the month of March, that's for certain, but a number of people have pointed out that actually the state of emerging market debt, for example, had been improved in the run-up to this particular war. And so I wonder where that puts EM and DM assets when you think of those, Wei-Li, now, because you mentioned the debt levels that developed markets have to confront. Do emerging markets, how do they look to you? Yes, they've sold off. Do they look like there could be opportunities there now?
We like to play emerging market at this particular juncture through our modest overweight in dollar emerging market debt, also because of the index greater exposure to Latin America that is well positioned along the energy importer-exporter spectrum. But one broad observation I would make is that actually since the end of February, beginning of March, we have seen a bit of a reversal of the market performance in the beginning of the year. So if you think about dollar, it went from kind of weakening to strengthening. If you think about the relative performance of U.S. market versus international market, that reversed as well, and emerging market is part of that. And if you think about curve steepening and now flattening, so it's we have seen a bit of a reversal of the crowded positions early in the year, and I think emerging market has been caught up in that. But over the longer term, the structural improvement of the quality of EMD is also why we are modestly positive on dollar EMD at this juncture.
Yeah, another crowded trade in the run-up to the war was around AI and the physical products that were going to benefit from that in Asia. So we'd seen software selling off, and we saw hardware gaining in Asia. That was a January-February conversation. And now we've seen a reversal of that as well. I mean, are there opportunities within that space, really? Now we've seen that reversal, or do we continue to play that reversal of the things that gained in January, February?
I think in AI, we see even more pronounced pattern of narrative swing from one side of the boat to the other side of the boat and back, right? Just because there is a time lag between spending and revenue creation. So markets are anyway going to periodically question the huge spend, even without the geopolitical events kind of throwing additional volatility to market. But the bigger picture in AI is that we see conviction in AI transformation increasing, not decreasing, as evidenced in big companies' commitment to spending more capex. So we continue to think that the trend is in the right direction, but because it may take a while for winners to emerge beyond the build-out layer winner, which is the picks and shovels. If you think about adoption layer winners, it would take time for them to emerge while it actually is becoming clear the losers were those that don't have a moat, don't have a vertically integrated system and data to kind of incorporate into the ecosystem. Then they have been disrupted, like some of the retail software. So all of that just to say that is why we're seeing huge amount of volatility in AI, because the focus shifting from winners to losers, and then the adoption layer winners taking time to emerge. But the overall direction is positive. Conviction is increasing. We want to be actively invested in the AI transformation theme.
Whaley, thank you very much. Thank you for bringing us your thoughts this morning. Global Chief Investment Strategist at BlackRock, Whaley. Coming up on the program, how Pakistan is styling itself as a peace broker between the US and Iran. We'll discuss where the path to diplomacy goes from here. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Pakistan has offered to help facilitate peace talks between the US and Iran, despite the situation on the ground appearing to escalate. This comes after Pakistan's foreign minister met counterparts from Saudi Arabia, Turkey and Egypt. Joining us now with regional analysis is Sanam Vakil, Director of the Middle East and North Africa Program at Chatham House. Sanam, nice to speak to you. How would you rate the chances of any face-to-face talks taking place between any Iranians and Americans, and what should we expect on the talks agenda?
Good morning. It's nice to be with you. On rating the chances, I would say very slim that they meet face-to-face. But the fact that diplomacy is and on the table right now is very important. I think President Trump is assessing if an off-ramp to this war is possible. All the while, it's important to note that the U.S. is mobilizing troops to the region and is considering an operation to open the Strait of Hormuz and potentially also try to take Iran's highly enriched uranium that it buried last summer in the June 2025 war.
Right. I mean, we've got the US then flexing its military muscles, Sanam. We've also got the Iranians increasingly aware of the lever that they control, which seems to be the Strait of Hormuz. When you say that there is some expectation, or at least some talk of the Americans trying to take the Strait, what could that look like?
Honestly, it's a very dangerous operation. It's unclear exactly what it would look like, but the U.S. is bringing amphibious forces in. They have the 82nd Airborne coming in. It would be a combination of ground and air. And they ultimately also need to assess if the Strait of Hormuz has been mined as well. The expectation from military strategists and experts there is this is going to be a very dangerous operation that will certainly be deadly, and one that I expect the Iranians have been preparing for. So, you know, this is what in door number one, and door number two, of course, are the negotiations that you asked about as well, and that is continuing, but not through any sort of direct contact between Tehran and Washington, because you will remember that prior to this war, both sides were indeed speaking, and that didn't result in a deal.
Yeah, it did not. And I mean, what kind of extent of regime change do you think, Sanam, we have already seen? Is it just personnel change? Any sign that the regime is weakened?
The regime is certainly weakened because militarily the United States and Israel have been pummeling Iran and taking out its ballistic missile facilities, striking its nuclear facilities, striking Iran's infrastructure. So certainly this system is going to be weakened, and people, we haven't seen the humanitarian consequences either, and the elites have been decapitated. But this is not a personalized system, it's a bureaucratic system, and so they've been able to replenish their forces. I think the biggest challenge for Iran will be when this war stops. Right now they're able to fight on, and that says something about the regime's resilience. Donald Trump can walk away and say perhaps he's changed the nature of the regime, and certainly he has done that, but I don't think he's brought to the fore a better group of people. He's just created a hardened, militaristic version of the Islamic Republic.
So now, just very briefly, what do you think Saudi Arabia is pushing for here?
Well, yesterday we saw Saudi Arabia's foreign minister sit with Turkey, Pakistan, and Egypt's foreign minister, and I think together they see a deal or a negotiation as the only solution, because if the United States puts boots on the ground in Iran, that is going to be a very dangerous endeavor that will impact everyone.
Okay, thank you very much for your analysis. Sanam Vakil, Director of the Middle East and North Africa Programme over at Chatham House. 9:26 here in London. Coming up on the programme is one of the few European nations running a budget surplus. We will discuss the impact of the Iran war on the European growth story, and specifically the Portuguese growth story. Portugal's finance minister will be with us. There's been a lot of talk about surpluses over in Portugal. Does that leave them in good stead to fend off the crisis? We will talk about that next. This is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
When it matters, investors turn to Bloomberg Surveillance.
I said it maybe even on your show here.
I hear you guys talking about this a lot.
Our investors are really thoughtful. They're engaged. They listen to your show.
As a number of people you've had on your show have mentioned.
The three of us have talked about it on this show many times.
I think you find, and you've heard this on your show, you've already talked this morning on your show, as you know, and you cover every day on Bloomberg.
You've heard a lot of guests talk about that.
I think your show is incredible. Bloomberg Surveillance, we're talking about it. Good morning. This is Surveillance.
Welcome back to the open Asia trade.
This is Wall Street.
Watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up to the minute global news whenever, and wherever it happens. I'm Anne-Marie Hordern in Davos, Switzerland, and this is Bloomberg.
Good morning. Welcome to the Pulse. I'm Anna Edwards in London. And the US expands its military presence. President Trump claims Iran gave the US most of its demands to end the war, even as it remains unclear whether either side is directly negotiating. And treasuries rise on concerns the war will trigger a sharp economic slowdown. Money markets also slashing the odds of a Fed rate hike this year. Let's pivot from what's going on in the US and US monetary policy expectations to the European growth story. Now, Portugal, as an interesting case study, has posted a bigger than expected budget surplus for 2025. By severe flooding earlier this year, as well as the Iran war, which is weighing on growth across Europe. We're joined now by Portugal's finance minister. I'm pleased to say that Joaquim Miranda Sarmento, the Portuguese finance minister, joins us on the program. Minister, thank you very much for being with us. As I mentioned, you recently reported a higher than expected budget surplus for 2025, which no doubt is a good story, a positive. But how concerned are you that the war in Iran is going to damage the fiscal position of Portugal?
Well, good morning. Thank you for your kind invitation. Until this conflict in Iran, the prospects of growth in the Portuguese economy and in the European economy as a whole were quite positive. Obviously, in the case of Portugal, we had several storms and floods that affect part of our territory with significant economic and fiscal impacts. And now we have this situation in Iran. Obviously, will depend substantially on the duration, dimension, and impact of the conflict. If the conflict continues for a significant time and affects the supply of oil and gas, most likely will have a significant impact in the growth of the world economy and the European economy, and obviously the Portuguese economy will be affected by that. Nevertheless, we, just like you said, we had a fiscal surplus of 0.7% of GDP in 2025. Our fiscal forecasts are significantly positive for this year and next year. So we are our public debt is now below 90% of GDP. So we are in a very positive situation to accommodate and to respond to the impacts of these several crises.
Okay, Minister, what are you looking at, though, in terms of Portuguese reaction to this crisis? We've seen lots of Asian countries having to quite rapidly come to terms with the idea of rationing fuel consumption. Are you looking at any such measures for Portugal?
Now, I believe we were the first country in Europe to respond to this crisis in terms of fuel prices. We have already approved several significant discounts on tax fuel to accommodate part of the increase on diesel and gasoline. We're also supporting families with low incomes and also transport companies. We don't expect any rationalization of consumption, but I believe some companies are obviously increasing their distant working and avoiding some traveling. But for now, the problem is more on the increase of price of fuel, not electricity, because the Iberian market is relatively protected from gas price increases, but obviously on fuel, the impact is significant, especially on transport of goods and people.
Are you concerned, Minister, that it could be difficult to replicate the success with the budget surplus this year because of war in Iran?
Well, this year have several challenges. First, we have a significant impact of the EU Next Generation loans, which is the last year of the program, and we have 0.8% of GDP this year on loans for investment and projects. That by itself was already a significant challenge. Then we had the floods and the storms that will have an impact, a fiscal impact, at least 0.5% of GDP, and now this conflict that could obviously have a significant impact on GDP growth and the measures needed to compensate families and firms with a significant fiscal impact. Nevertheless, we are committed to keep our fiscal balance. Even if we have a small deficit, we will continue to reduce our public debt. And after this year, which is a very difficult year, we will continue to have fiscal surplus over the next years. So the fiscal position of Portugal in this moment and for the next years is quite positive and allow us to respond to these several crises with a very significant instruments.
Are you more concerned, Minister, about higher inflation or weaker growth, or a combination of the two?
Well, I think we are in a very different situation from 2022. In 2022, we had two shocks almost at the same time. We had the shock on supply with the war on Ukraine, increasing prices on energy and food. But before we had a shock on demand, when the pandemics start ending, people start consuming substantially, what was called at the time the revenge spending, and production was still below the pre-pandemic level. So were those two shocks after a decade of a very expansionist monetary policy that created inflation in 2022 and that inflation was fought with a strong increase on interest rates from central banks. We're now in a very different situation. We have a shock on the energy prices. Let's see about food prices, what the impact will be. But we don't have a shock on demand. On the opposite, if this situation continues, most likely consumers will slow down their consumption pattern, and production is very high. So I think we'll have a little bit more inflation, but far from what we had in 2022.
Okay, and looking at the economy more broadly, you've signalled your desire to bring in some tax cuts. Portugal still has relatively high tax burden compared to other parts of Europe. How do you manage to or plan to stay competitive?
Well, we have in this last 2 years, 2024 and 2025, strongly reduced the income tax. We also create a special income tax for people under 35, so we can attract and retain young talents. And we have also approved a strong reduction on corporate tax. We will continue, as we'll have some fiscal margin for that, we will continue to reduce the income tax for the next years, because you're right, when we compare Portugal with some of our competitors, we still have marginal effective tax rates higher than some of our competitors. So that effort will continue over the next years, especially on the income tax.
Yeah, can I ask you about consolidation within the aviation sector, Minister? Because, of course, TAP is the subject of that. You're expecting this week, I think, non-binding bids. This is, of course, a sector that has been really affected by higher oil prices already. So how confident are you that you're going to see strong interest for TAP?
Well, I would separate what is a short-term crisis that obviously, if continued for a long period, could lead to a recession. But nevertheless, I would separate that from medium and long-term perspectives. TAP is a very well performing, consolidated company. It's probably the last company, at least on the mid-sized company in Europe, available for the three large aviation groups to continue to grow. It has a huge market in South America, especially in Brazil, but in South America as a general, also a good position in US and Canada markets, and also Africa. So I don't think that those groups, but let's see on the 2nd of April, which is the deadline for a non-binding offer. But I think those three groups continue to look at TAP in a medium and long-term perspective of growth, and with the fundamentals of the company relatively good. And I don't think it will have this crisis will have a strong impact on the interest and the conditions for the privatization.
Okay, we'll continue to watch that then. And consolidation in another sector in focus in Europe, Minister, and that is in the banking sector. I wonder if you expect further consolidation across the European banking landscape, and whether you would be comfortable with more foreign ownership of Portuguese banks.
Well, I can give you an example. Last year, there was selling of Novo Banco, which was a bank owned 75% by Lone Star and 25% by the Portuguese government. And that bank was bought by BPCE, which is the second largest bank in France and one of the largest banks in Europe. And we welcome that offer from BPCE. We have no problem with foreign banks buying Portuguese banks, as long as there is no excessive regional concentration. And at the time I said, well, Spanish banks already had 1/3 of the market. We should stop by there. But again, we welcome any other banks from Europe to invest in Portugal, both on the banking or insurance sector or in share services, like some large banks already operating large operations in Portugal in terms of their back service. So I think there is a need in Europe for stronger consolidation of banks. We need to create banks across several countries, and Portugal welcomes the investment of banks from other EU countries.
Minister, thank you very much. Thanks for joining us. The Portuguese Finance Minister, Joaquim Miranda Sarmento, we thank you very much for your time. Sticking with the banking sector, the chief executive of HSBC says he needed to make changes from the top down when he began his radical restructuring of the bank. Georges El-Hederi says not enough executives were fully accountable for the performance of their businesses. He's been speaking on the latest episode of the podcast series Leaders with Francine Lacroix.
I was definitely ruthless about killing the complexity and the drag in the back. The most difficult part is when you have to separate with some of your colleagues. I think we've been very thoughtful, we've been very considerate, we've done it hopefully the right way and the most respectful way for the benefit ultimately of the firm and its customers. We needed to be agile. We needed to be, to be ready for a modern world. And to be that, we needed to be simple. And therefore, kind of everything then drives what decisions you take from that mission statement.
How did the bank become so complex? And again, this is something that actually most organizations have to face as they grow. I guess there's, various factions, or a lot of companies actually could just become much more simple and simplified. What did you see?
Entropy is a feature. Entropy tends to increase, which means complexity, if you do nothing about it, tends to increase rather than decrease. So things don't become complex by design. They end up becoming complex by lack of focus. So bringing the focus at the simplification will allow you to start dealing with it. That's the first observation. Second observation is you have to be extremely methodical. What has created the complexity? How can it be addressed methodically? Try to identify ways to be simple. Some of the ways to be simple is to decide not to do certain things, and this is why we exited a number of activities. The third thing is When you're taking structured decisions, you have to start from the top down. You can't take structured decisions from the bottoms up. This is why the first decision structurally I've taken relates to simplifying the group operating committee. We moved from more than 20 people to about 12. More importantly, we moved from 0% single accountability. Everything had dual or multiple accountability to now about 60% of our revenue is generated under single accountability. So that's important. And then the last thing, Francine, is to be patient, because we're not solving simplification overnight. It's going to be a journey, and we have to be relentless at that journey, quarter after quarter, month after month, until we get the desired outcomes. And that journey is still on, like we're not there yet.
But as a big chief executive of a big bank, you basically have, the shareholders that you need to please. So simplification maybe helps with them understanding what the bank wants to become. You have your clients, and then you also have the employees. So how difficult is it to juggle these, the three masters?
So there is one consideration which, fortunately, the three masters align on, is being best at what you do. Your customers want you to be the best at what you serve them with. Customers tick. Your shareholders will pay you for what you're best at doing. They won't give you valuation for something that you're average. They will give you valuation for where you really command, where you're an authority in being able to provide that service or that product in that market. So the shareholders align to be the best. And then our colleagues want to be the best. Our colleagues want to win. Our colleagues are in a competitive landscape, and they want to win. And they basically thrive when we're delivering the best we can, and when we're delivering best outcomes. And we're basically the best at what we do. So, you take this as a guiding thread and you say, let's focus on that. Focus where we can grow in areas where we're the most competitively advantaged. And then everybody aligns, colleagues, clients, and shareholders.
Is that why you learned Mandarin? You wanted to be the best for HSBC?
Yeah, I don't think I'm the best at HSBC speaking Mandarin. That's far from it.
But you're the first CEO to speak Mandarin.
Possibly, yes. I think what is important is to gain access to understanding, the culture in which HSBC operates. And obviously, one of the very important cultures within HSBC as a whole, but that is probably one of the least understood for, say, people living in London, like I'm living now, is understanding the Chinese culture. And if you really want to understand the Chinese way of thinking, the way of reasoning, the way of negotiating or engaging or presenting simply, then there is no better way than kind of put the pain in trying to learn the language and see how it's done in the language.
It was quite bold because you took a sabbatical for it. Was it a difficult decision, or did you automatically know this was the right way to also service your clients?
First, I knew if I really wanted to make a leapfrog in my early starts in Mandarin, it needed much more time than I could give it. Now I'm proud to say I still take lessons. Whether I'm progressing or not, I don't know, but I'm still taking lessons. I'm maintaining that journey. But there needed to be a leapfrog at the start, which a sabbatical has helped.
Was it for yourself, or was it for the bank? Because it's interesting. It was Mandarin and nothing, and not something else.
No, well, look, I mean, I've taken 6 months out, and there are a number of things I achieved during those 6 months. Some of them personal, some of them professional. But yes, it was full on.
You can catch more of that exclusive conversation with the Chief Executive of HSBC in the new Leaders with Francine Lacroix podcast. It launches later today. Coming up on this programme, then, the latest CPI figures out of Germany, wrecking the image of inflation being well contained in the country, perhaps. We will discuss that ahead of the wider euro area release tomorrow. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, now for a full hour, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
Right now, the headline, bad news, is bad news.
This is a stagflationary mix.
It's a double squeeze for the rest of the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The market is tightening financial conditions.
It's not just what's happening present day. It's 5, 6, 7 months out.
The longest first quarter ever continues.
The March Jobs Report, Friday on Bloomberg.
This is the Pulse. I'm Anna Edwards in London. Let's talk about commodity markets. Oil is rising. Oil prices are rising today as the Iran-backed Houthi militant group in Yemen enters the war in the Middle East. Elsewhere within the region, strikes on aluminium plants are threatening to send a fragile market into crisis. Let's take stock of where we are then on the commodities story. Bloomberg Energy and Commodities reporter James Heron is with us on set this morning. James, good morning. So what impact could we see then from the Houthis entering the conflict? Not necessarily because of any superiority and firepower, but just because of where they are geographically positioned, what they're able to hit.
Yeah, well, the Houthis for a long time have been threatening Red Sea shipping, and that's been there was an irritant for the global economy way before this war started. Now the Red Sea is vital because the Saudis have redirected 7 million barrels a day of crude from the Gulf to the Red Sea. These ships are sailing. It's a vital lifeline for the market, and now with the Houthis entering the war, it really puts a threat to some of this shipping at least.
Even though some of the shipping had not gone back, we've seen it disrupted, haven't we, over recent years, and it seemed to be almost closed, and then we saw talk of some of the shippers going back in. Did they ever go back in through the Red Sea, through Suez?
Only in a very limited way, but the risk-reward ratio has really never worked out. Now, obviously, the reward is much greater because there's all this oil that has no other way. The Saudi oil has no other way out than through the Red Sea. So, yeah, it depends where the ships go, because the Houthis mainly threaten the southern area, which is quite far from where the Saudis are loading the crude. But, these ships have got to sail out of the Red Sea as well to get to market. So a lot depends on, how aggressive they are in targeting shipping.
And there'd been a lot of talk about how there'd been a truce between the two as well recently. So we'll see how that plays out. Briefly on aluminium then, we've seen facilities hit. And actually, I think 9% of the world's aluminium comes from this region, comes from the Middle East. So this could have an impact more widely.
Yeah, obviously this aluminium was already shut in because it has to get out through Hormuz too. But like with energy, when we saw the gas facilities attacked, the risk that there's going to be long-term damage. So even when the war is over, we're going to see a long-term impact from facilities that could take months or maybe years to repair. The market's reacting to that. We're seeing that in aluminium prices this morning. So it just represents another long-term risk from the conflict.
Okay, yeah, so it's not just the shut-in, it's the fact it takes such a long time to fix things and get things back up and running. James, thank you very much. Thanks for coming to talk to us. Bloomberg's James Heron. Let's pivot to the macro story. The German economy has shown signs of recovery following a period of stagflation and dwindling performance, though the reversal may be short-lived as the global shock of the war in Iran spreads across the nation and the rest of Europe with risks of rising inflation. We're joined now by Bloomberg Europe economy reporter Mark Schroers. Mark, good morning to you. So what does Germany's latest regional CPI data tell us? There's been quite a step up in the inflation figures that I've seen this morning across the Bloomberg terminal.
Yeah, yes, Anna, you're absolutely right. We were all eager to see the data as they offer an early read of the impact of the Middle East conflict on the euro area and on the German economy. What the data tell us so far is that we will see a big jump in German inflation in March. How big the jump will be, that will definitely seen by 2 o'clock when the Status will publish the nationwide numbers. Economists expect indeed a big jump towards 3%, roughly 3%. That shouldn't come as a big surprise, as we all know that Brent prices usually pass through quite quickly to consumer prices, and it shouldn't also come as a surprise if that trend continues for quite some time now, for the next couple of months. The big question now is to what extent this accelerates, or if it even how long it lasts, and if it spill over into the broader inflation picture. And that's what economists and also policymakers will focus on very much at the moment. So what happens to inflation expectations, what happens to second round effects on wages and price setting behaviors of companies, and that very much depends on the length and on the intensity of the war.
Yes, is there a risk in the German context, Mark, that because of the fiscal push into defence and infrastructure that we're seeing in Germany, that any uptick in inflation does spread then more widely into the underlying economy?
That's definitely a risk. Why one must say that the situation is quite different from 2022, when we saw the last quite significant inflation shock. There's less demand in the economy. The labor market is not as hot as it was back then. There's definitely a risk, but policymakers are keen on that, and they will, for example, the ECB has made crystal clear that they won't allow a repeat of the 2020 shock. So far, they say they remain agile, they remain vigilant to whatever happens. And for now, they don't want to rush actions. To that extent, we saw a very interesting speech by Executive Board member Isabel Schnabel on Friday. She very much made the case for not rushing action and also for not overreacting. So while the ECB is keen to avoid a repeat of what was seen by most observers as a mistake, they are also keen to assess the situation in all details, and that will very much depend on, as I said, on how long the war will end.
Mark, thank you very much. Thanks for the update. Bloomberg's Mark Schroers with the latest on the German economy. Let's have a quick look at some of the assets and where they're trading as we bring this hour on Bloomberg TV to a close. This is the picture for energy markets, up by 2%. $115 a barrel is where we're trading. The aluminium story, we've talked a little about that. S&P futures are pointing higher, substantially so, up by 0.5%. We are getting a lift, perhaps, from the lower bond yields here in Europe. So utility stocks doing pretty well. I wonder if that translates into the US session ahead. We will leave you with the brief. That's coming up next. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The Iran war escalating, missile attacks sweeping across the Middle East. President Trump says a deal with Tehran could come soon. Deepening fuel crisis. Brent crude on track for record monthly gains as the Iran war enters its 5th week. And global bonds rally as uncertainties over economic growth rise around the world. Let's take a look at these markets then as we enter the 5th market week of the war. We are seeing Brent crude trade above $116 a barrel. No let up in sight. We're a little below that now, but earlier on we were well above that. WTI was above 102 earlier. Now we're just below 101. Nevertheless, higher in this 5th week of the war. And that, of course, will have a knock-on effect on equities. If you look at the 10-year yield, we are down 4 basis points now. That's coming off the boil just a little bit as money goes into sovereign bonds around the world. That trend reversing just a little bit as investors start to price out economic growth around the world on this war. Now, NASDAQ 100 futures are positive, but we did dip into correction territory on Friday. The NASDAQ down more than 11% now from its peak. That said, it's been a very down day across Asia and looks like it'll be a down day in Europe as well. So we'll see how the NASDAQ actually trades when we get as far as the US Open. Aluminum up another 4.3%. A little crisis brewing there after 2 Gulf refineries were hit. And gold is trading back above $4,500 an ounce. Let's get to some individual movers now in this early going. Here's Abir Abu Omar.
Good morning, Vonnie. Good to be back with you. Let's start with the story for the day. It's Brent is up and it's impacting oil companies across the board. Now, we've seen this move mirrored in Europe as well, but big oil in the U.S. pre-market is doing quite well this morning on the back of this surge in Brent off the back of the weekend's events where the Houthis in the Middle East got directly involved for the first time since this conflict in the region started. So you're seeing the likes of Exxon, Chevron, and Occidental gaining, and all big oil companies in the U.S. gaining as much as 1.6%. Now, if we flip the board a little bit, we turn into a different story, and that's artificial intelligence, the disruption in AI that we've spoken about multiple times since the start of the year. Resolve is this AI solutions company. It is surging this morning, nearly 14% gain in the pre-market, and this is on the back of investors looking forward to these earnings that it will provide later today. And then finally, we turn to this part of the world. We flip the board and we look at aluminum, which you mentioned earlier. Now, aluminum prices have surged on the back of the attacks in Bahrain and the United Arab Emirates across aluminum plants. So we're seeing the likes of Rio Tinto and Norsk Hydro gaining significantly this morning, as much as 8%, both producers and miners of aluminum on the back of these surging prices, Vonnie. This is what we're looking at. Back to you.
All right, Abir, thank you so much. We'll be back to you a little bit later on. And coming up this hour as well, Cole Smead of Smead Capital joins as futures bounce back after the NASDAQ dipped into correction territory. We'll also discuss dollar strength with Rabobank's Jane Foley later this hour. But first, the war with Iran entering its 5th week.
Sir, could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon.
You had offered a 15-point plan to Iran. Did they ever come back?
Yeah, they came back on the 15-point plan. They gave us most of the points.
Iran disputing the president's claims. Joining us now is Bloomberg's Jumana Bersachi. Jumana, bring us up to date. We've heard so many things from the president. Depending on the outlet, he's either going in to take Kharg Island, he's going to take the uranium. The Iranians are in negotiations. It's just very difficult to know where we stand.
Yeah, exactly that. And we just played a little bit of his sound speaking to some reporters on Air Force One, and he indicated that there could be a deal as soon as a couple of days' time. But again, no indication coming through from the Iranian side that these negotiations are actually taking place. So there has been a push for diplomacy led by Pakistan, which is emerging as a key mediator, but no real signs as of yet that Iran are coming to the table. And if anything, what we are seeing is further military escalation over the course of this weekend. On Friday, CENTCOM announced that Marine Expeditionary Unit comprised of 3,500 troops, about 2,200 Marines had arrived to the region. Some questions about where exactly they're going to be deployed. President Trump, in an interview with the FT over the weekend, suggesting that they could be used to take over Kharg Island or not. He said all options are open. Wall Street Journal also reporting that they could be used for a limited raid to go into Iran and extract that enriched uranium stockpile. Again, a very risky operation if indeed that does go ahead. And at the same time, strikes and counterstrikes continue. So on Friday evening, 2 steel facilities in Iran alongside a nuclear research facility was targeted. In retaliation to that, Iran fired back at Gulf states. And you were just talking about aluminium there. They hit one of the major aluminium smelters in the region over here in the UAE. The Emirates Global Aluminium Facility sustained a lot of damage there. Alba in Bahrain as well. They've also hit the Prince Sultan base in Saudi Arabia and also a desalination plant in Kuwait. So the strikes on infrastructure, at least coming from Iran, are not leveling off. And we are heading into a crucial period. Trump has signaled that this could perhaps be a window for diplomacy, but it could equally be a window for them to ramp up military pressure.
I mean, April 6th was the new deadline, right? That's a week from today. At that point, Iran is supposed to have allowed the Strait of Hormuz to open and operate freely, or the president had threatened that he would actually, not hold back on targeting even energy infrastructure. Is that date still valid? Jumana, are we still, operating with that date in the back of our heads?
Well, these deadlines tend to be moving deadlines, so we'll see what happens over the course of the week. There certainly is the impression from Gulf Arab states right now that things are leaning towards more of an escalation as opposed to a de-escalation. And the fact that Pakistan held these talks over the weekend with foreign ministers from some of the regional powers, including the likes of Saudi Arabia, Turkey, Egypt, but no one there from Iran or U.S. suggests that the diplomatic channels for the time being are not really progressing. At the same time, as I say, ongoing strikes on infrastructure, and then you have a new front as well to the war. On Saturday, Houthis entered into the conflict. They struck at Israel a couple of times, missiles intercepted, but what they have said is they're acting in solidarity with Iran. It took them a couple of weeks to get involved. And one of the big concerns is not only that, of course, Iran maintaining their control of the Strait of Hormuz, but on the other side, on the Red Sea, that Houthis could once again look to disrupt shipping there, given the significant amount of oil that is being routed away from the Arabian Gulf to the Red Sea by Saudi Arabia. So that's also a risk in this war as we enter into day 31 and the 5th week of conflict. Vani.
All right, Jumana, thank you so much. Jumana Bersachi there in Dubai. Well, oil continuing to rise along with the fear that the widening conflict will cause further chaos in energy markets. Concerns spreading also in the aluminum markets as Iran's attacks on plants threaten supply. Let's get more with Bloomberg's Alex Longley. SocGen, the latest to talk about the $150 per barrel oil paradigm. Alex, is the market very out of sync with the physical market? I mean, we're still looking at $116 per barrel of Brent. It doesn't seem that much given what we're being threatened with.
Yeah, and I think this probably depends on your worldview. If you were a perma bear, you'd probably argue that $116 is a very high oil price. In reality, compared to what could come here, things can clearly go a lot higher, and that's why why you're starting to hear the banks talk about $150. We had Macquarie talking about $200 on Friday. And I think what the issue we're facing now in the market is really one of time. So we've had this disruption. We're waiting for it to filter through the system. And as that happens week after week, you're going to see crude prices move higher. And all of this is happening as well against a backdrop of a kind of battle on social media between the US and Iran over oil prices, right? We had President Trump tweeting last week and moving the price down by $17 in seconds. By the end of that week, we're back to where it was before he posted.
Do we have any clarity on how many ships are actually getting through the Strait? So we get these numbers, right? President Trump said Iran had gifted some, and then that Iran had allowed 20 through, but was that 20 plus the already gifted ships? And what about the ships from other countries that have gotten through?
I think it's extremely unclear at the moment. One thing that is for certain, a lot of Iranian oil is still getting through. That's one of the flows that is least inhibited by this conflict. You're seeing a trickle of ships each day, and the numbers are hugely volatile. So some days we're talking low single digits. Some days, for example, over the weekend, we saw slightly higher numbers, closer to 10 or 11. Either way, that is far lower than we would see in normal times when you'd be talking sort of 40, 50, 60 oil tankers going through, or ships, going through in a day. Most of the rerouting that we've seen going to Yanbu, as Jumana was talking about before, is enough to kind of allow a significant volume of Saudi oil to get to market, but it doesn't fully replace the volumes that we've lost, and there are other countries like Iraq that don't even have anything like the replacement mechanism Saudi Arabia does.
That spread has been pretty stable, right, between WTI and Brent, given that, the US has plenty of its own oil. Is WTI reflecting reality, trading at $101 a barrel?
Well, I think the next thing to watch here is probably a big surge in US exports. We've sort of heard from the market last week that that's something that's coming, as we've seen that kind of WTI level hold a bit lower. And also we're seeing it in the oil tanker market at the moment as well. The smaller ships that tend to load from the US Gulf and the larger ones that take oil from the US to Asia, they're all in huge demand at the moment and rates are surging. So I think the next knock-on you see there is as this kind of crisis flows across the globe. It's started in Asia. It's rippling to sort of parts of Latin America, Europe, Africa now. And then the last place it will hit will be the US, and that will happen when you see the US exporting large volumes of oil and having to price to keep more at home. So we're not quite there yet, but the next phase in that story is likely to play out over the next few weeks if the Strait of Hormuz remains closed.
Fascinating watching it all in real time, and everything could change still. Alex, thank you so much. That is Bloomberg's Alex Longley. Global bonds also on the rise as demand returns now amid concerns that the Iran war may derail economic growth. Bloomberg's Ben Ram joins us now for more. So Ben, it's hard to say that this is a directional move that has suddenly flipped, right? That we're going to go in this new direction now for a while. But what was the impetus for sovereign bond buyers to change their mind, and will they, return in force?
Morning, Moni. I think we could go one of two ways in terms of global rates. If the idea is that the war is going to end imminently, of which we have no indication whatsoever, as you've been mentioning in the program, is that then the front-end bonds could get some kind of a respite. We could see yields retrace back to somewhat from here. But if the other scenario plays out, which is one of a protracted war that keeps the oil prices even higher, mind you, Brent crude is trading at $115 a barrel today. That's materially higher from the March 1st to last Friday's average of $98 a barrel, meaning this is a considerable second leg higher in crude prices. And if that sustains itself, then I don't see how the rally in front-end bonds that we are seeing this morning is going to get any traction in the coming days. It's a one-day blip, and that's how it'll remain. As far as the markets are concerned, this is first an inflation shock and then a growth shock. It is not a growth shock that is oblivious of the inflation shock. And that is a mistake that the markets are making today.
If that's the case, then should we expect gold to start going from strength to strength again? I mean, we're at 4,500 an ounce now.
Well, in normal course of facts, you would assume that gold probably has got a leg higher, but we need to conflate it with what it is in terms of its fair value. Gold's fair value, when passed as a metal that holds its store of value against inflation, against US dollar valuations, and central bank purchases, is about $2,900 an ounce. Now we are at 4,500 despite the correction. So there's still plenty of froth left in gold, and I think that's got to correct lower. And what we have seen throughout this episode of distress in the markets after the war started is that you cut short your winners, and that syntax is still applicable, which means that gold is unlikely to find the momentum to gallop any higher from here.
Then, should we be concerned about tech stocks? I mean, the Nasdaq has entered a correction on Friday, down 11%, but that's from like a massive peak.
Exactly. I think that, if you look at the Nasdaq's forward earnings, Bonnie, I think we are doing about 20, 21 times, and which is, again, not in line with its long-term average. The long-term average is something like 17 times. So even despite the correction, I think there's still plenty of froth in AI stocks. I think we have seen NVIDIA correct and give back some of its gains, but I think that even at current levels, the price earnings ratios are prohibitively expensive with some of the AI names, and that correction has got a lot further to go. The longer this war goes, the longer that energy prices stay higher, as markets just simply do not have a place to hide. And I think that that correction has got further to go.
Then, what's the risk outlook from here? So what's the next catalyst that could make markets reprice in a severe way?
I think that I think we need to think of what happens if crude gets to 125 from here. As a participant earlier was mentioning, there are people who are talking about $150 a barrel. Macquarie has put out an estimate for $200 a barrel. If we see anything of those moves, and you can't rule those moves out because the Houthis have joined the confrontation now, and there is reports that the US is preparing for a land invasion, that means that Iran is going to dig its feet in, and we are likely to see a protracted war, even more disruptions to supplies, and that will mean oil surging past $125, $130 a barrel, and that is not something that is going to that the global economy is going to be able to withstand very easily. We are going to see the inflation shock that I mentioned earlier. I think that is already reverberating. If you look at the first inflation prints that we have got after the war out of German regional economies today, that is showing an inflation overshoot already. So I think that, I think that as the inflation narrative turns sour, I think that bonds have got lots to, bond losses will pile up from here. And it's a pretty ugly picture for the global economy.
Yeah, and we've seen lots of central bank intervention around the world. We're also seeing warnings that some Southeast Asian nations only have 20 to 50 days supply of oil on hand. Ven, thank you so much. That is Bloomberg's Ven Ram. Now to other top stories trending on the terminal this morning. Investors are said to be pushing back on terms in JP Morgan's $7.2 billion debt deal to fund PE firm Clayton, Dubilier and Rice's takeover of bubble wrap maker Sealed Air. Bloomberg sources say concerns center on some provisions, including a clause that gives the option of spinning off some of Sealed Air's units. Representatives for JP Morgan and CD&R declined to comment. Japan's top currency official warns of possible intervention. Vice Finance Minister Atsushi Mimura says authorities may take decisive action as speculative activity rises in foreign exchange and in oil markets. Mimura spoke to reporters after the currency slid past 160 yen per dollar. China's Xi Jinping has invited Taiwan's main opposition leader to visit, setting up a high-stakes meeting weeks before a planned summit with President Trump in Beijing. Kuomintang Chairman Chung Li-won will travel to China from April 7th to 12th, making the first such visit in nearly a decade. Chung has advocated for closer ties to China. This is Bloomberg.
got the idea for Play-Doh.
My one son was playing with a mound of Play-Doh, and he said, "Dad, voila." And I thought, this is what I'm trying to do every day, to make something that you can't make a judgment about.
Welcome to Bloomberg This Weekend.
Breaking news today from Wall Street to Washington.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Next week on Leaders with me, Francine Lacroix.
I speak to George Alhedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
It's Jobs Day, and Bloomberg has the report under surveillance.
Right now, the headline, bad news, is bad news.
This is a stagflationary mix.
It's a double squeeze for the rest of the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The market is tightening financial conditions.
It's not just what's happening present day. It's 5, 6, 7 months out.
The longest first quarter ever continues.
The March Jobs Report, Friday on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in London. Time now for your front page news. First up, the Financial Times is reporting Donald Trump has said he wants to, quote, take the oil in Iran and could seize the export hub of Card Island. This as the U.S. sends thousands of troops to the Middle East. The president told the FT his preference would be to take the oil, comparing the potential move to Venezuela. Next up, the Wall Street Journal is leading with President Trump weighing a military operation to extract nearly 1,000 pounds of uranium from Iran. The Journal reports it would be a complex and risky mission that would likely put American forces inside the country for days or longer. The Journal says the U.S. has previously removed enriched uranium from a foreign country in a peaceful transfer. And the Washington Post says President Trump said he would not enforce his effective blockade against fuel supplies to Cuba, allowing a Russian tanker to deliver crude oil to the island. The Post says the Russian tanker is carrying oil that, once refined, could power Cuba's aging energy grid for a few weeks. This is Bloomberg.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
When it matters, investors turn to Bloomberg Surveillance.
I said it maybe even on your show here.
I hear you guys talking about this a lot.
Our investors are really thoughtful. They're engaged. They listen to your show.
As a number of people you've had on your show have mentioned.
The three of us have talked about it on this show many times.
I think you find, and you've heard this on your show, we've already talked this morning on your show, as you know, and you cover every day on Bloomberg.
You've heard a lot of guests talk about that.
I think your show is incredible.
Bloomberg Surveillance, we're talking about it.
This is Bloomberg Brief. Some breaking news now. Tasneem says Iran says U.S. demands have been excessive and illogical. Tasneem is crediting the Foreign Ministry spokesperson for these lines, saying Iran didn't participate in Pakistan meetings. These are the meetings that Pakistan is trying to broker as a mediator, in fact, between the different parties. But once again, Tasneem is citing Iran's Foreign Ministry, saying that the U.S. demands that President Trump said Iran had acceded to most of were illogical and overdone. So perhaps that's one of the reasons why oil is trading above $115 a barrel this morning on Brent, above 101 on WTI. We're also seeing gold priced above $4,500 an ounce. A little bit of tension in this market. We're fully into week 5 now. The VIX was trading above 30 on Friday. We also had the NASDAQ 100 into correction territory. Coming up, we're going to talk the dollar and emerging market currencies with Rabobank's Jane Foley. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because The one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The Iran war escalating, missile attacks sweeping across the Middle East. President Trump says a deal with Tehran could come soon. Deepening fuel crisis. Brent crude on track for record monthly gains as the Iran war enters its 5th week. And global bonds rally as uncertainties over economic growth rise around the world. So let's take a look at crude then. We're still seeing that spread between Brent crude and WTI, but as we can see, Brent crude just wants to go ever higher. It was about $1 higher a little bit earlier in the session. New York crude very close to $102 a barrel. Halima Croft of RBC saying, you know, executives are indicating that the delta between the physical and the paper market is just unsustainable, and that we haven't even seen really the beginning of the end of this disruption, which could in fact be calamitous. All sorts of refined products are also soaring in trading. The 10-year yield is back down about 2.5 basis points at 440. A little bit of bond buying today. Don't want to generalize. There might be some economic growth concerns out there, but inflation concerns will no doubt come roaring back in the next few sessions. Aluminum also is rising. A couple of plants were hit in the Gulf region, and that's sending aluminum skyrocketing, really, and we're up another 4.5% today. The NASDAQ 100 looks like it might bounce back a little bit, but that's from correction territory. The NASDAQ was down more than 11% from its peak after Friday's nearly 2% drop, and we're seeing some dollars go back into gold. All right, let's get to some individual movers now. We're back with Abir Abu Omar. Abir.
Good morning, Vonnie. Starting with the story of the day, really, which is oil. Brent, as you just mentioned, is now close to $116 a barrel, with crude across the board accelerating in price. Now, this has inevitably affected big oil companies in the United States. In the pre-market, we're seeing the likes of Exxon, Chevron gaining this morning as much as 1.4%, pairing some of earlier gains in the session, but still up a lot compared to other sectors and mimicking the move that we're seeing across big oil companies in Europe that opened earlier today as well. This is on the back of the escalation, obviously, in the Middle East over the weekend, but also some of these conflicting statements that we have been seeing out of the U.S. Now, we flip the board and we flip industries and we move on to artificial intelligence with Resolve AI surging this morning, gaining about 14% in the pre-trade session. This is as investors await those earnings that are set to come later today. It's a company that has done relatively okay this year, down around 7% year to date, but gaining nicely this morning. And then we flip the page and we return to the Middle East story, albeit a slightly different industry. And this is also on the back of those aluminum prices that you mentioned, Vonnie, gaining as much as 6%, pairing some gains, but getting very close to $3,500 a ton this morning before pairing some of those gains. That has affected miners and producers of aluminum in Europe, already trading. Rio Tinto gaining 3.5% and Norsk Hydro up around 8% on the back of this price premium from aluminum. Vonnie, back to you.
Just another repricing. Abir, thank you so much. That's Abir Abu Omar. The US dollar gaining as it heads for its best daily run since early January. Joining us now is Jane Foley, head of FX strategy at Rabobank. Jane, are things still orderly out there in the FX markets, or are we beginning to see a little bit of disorder?
I think it depends which currency that you're looking at, but certainly things are very anxious, and I think we all know that. But with respect to the dollar, I think we can look at this and perhaps the medium term, which I think is very complex. Is this going to be the next chapter of de-dollarization, for instance, as countries such as China press to have their oil delivered in more one? But in the short term, I think it's really quite simple. The dollar has been used as a safe haven. It is liquid. That is what people want. They obviously value liquidity over returns when things get this uncertain. So you're looking at a move into US dollars because of the words escalation, of course, have been used a lot over the weekend. And that, of course, leaves the high-yielding currencies, those of the emerging market space particularly, very vulnerable.
It's essentially the only safe haven out there right now, is it? And why?
Well, again, there's a multi-factor answers to that because, traditionally we would be looking at the Japanese yen, we might be looking at the Swiss franc for those, and neither of those have been performing particularly well since the war began. And Switzerland, there is some fears of intervention. Certainly the central bank has talked about that over the last month or so. And with Japan, of course, that's been on the back foot since October, particularly since we had the new prime minister, and the market very anxious about the yen. So the dollar right now is playing that game. And we've got to remember that the market went into this crisis short of the dollar. The market had been very reluctant to really go long with the dollar since last April, since the dollar fell out of bed last April on the back of those tariff addresses from Trump last April.
So you mentioned the Japan Ministry of Finance, a verbal intervention, basically, but we also had the RBI really, enacting measures to curb speculators, but already the Indian rupee has raced the gains that it saw after those measures were enacted. I have to ask you about all of these emerging market currencies and whether it's worth it for them to draw down their reserves to defend their currencies. So, for example, our host Linda Amin spoke with Philippines President recently, Ferdinand Marcos Jr., and he said it's going to be futile. Why would we spend all our foreign reserves defending the peso when it won't help anyway? Do you feel the same way?
Well, I think that is a justifiable risk. And of course, I think everybody knows, whether or not you're talking about foreign exchange or oil prices, etc., this is all about the duration of the conflict. And we all know, because of the market is now fearing escalation, that the dollar could go stronger. So why, throw themselves under the bus and waste a lot of money providing better levels for speculators? I think for all of the intervention that we've ever had over the last 30 or so years, I think we can step away from that in hindsight and say, oh, that intervention worked, but only because the fundamentals were on the turn already. And right now, we can't say that, because if this war carries on, it is going to be further moves into the US dollar.
But aren't they then between a rock and a hard place? Because if they don't defend their currencies, and I'm not talking of all of them as one sort of a monolith, right? They're all individual countries, individual central banks, but their populations could suffer dramatically. Are there some that should defend and some that shouldn't?
Well, clearly, the downside is even more inflation, because obviously oil prices in these local currencies are surging quite sharply as these currencies weaken. And if they don't intervene, then there is more intervention. Now, whether or not it's worth playing the game against speculators will depend. And one of those factors is how much reserves do they have? Will speculators think that this is a justifiable threat, or do speculators think they're going to walk away anyway? And so this is why generally, if you look at the Ministry of Finance, for instance, they play their cards very close to their chest. What they would rather do, and what they've been doing over the last couple of weeks, is verbally intervening, because obviously that doesn't cost them. But at some point, they do generally have to put their money where their mouth is, because otherwise that loses credibility as well.
Jane, do you have an opinion on which currencies should be defended by their ministries of finance or central banks?
That's very difficult to say. And like you've just used the example of India, that's really, really tough. I mean, my focus is, G10, and obviously the Bank of Japan do have a lot more reserves. But again, they're in a similar position because they don't want to show their hands too much. I think they probably will have to intervene at some point in order just to back up the verbal intervention that they've had. Similarly, with the Swiss, I think possibility of intervention there is certainly likely, I think, over the next 3 months, if there is pressure on inflation.
Would an end to the war or some kind of a coming to the table, let's say, of all parties and a ceasefire or some such thing, would that return sentiment around not just EM but the dollar to sort of pre-war levels, or are we looking at a very different environment now for a long time?
I think we are looking at a different environment. I think most energy strategists are saying that, especially with respect to gas. There can be no quick return to gas. Oil prices, well, maybe we'll have 80% of those ships going through by the summer. Even that now is looking optimistic. So we are looking at a different environment in terms of inflation, and clearly in terms of these currencies being weaker, that will just exacerbate that. So there is obviously a hit to world growth already being absorbed. So from that point of view, there is difficulties, particularly for emerging markets, particularly for those most vulnerable oil importing nations, given where we are.
Jane, thank you so much. Looking forward to checking in with you again very, very soon. That is Jane Foley of Rabobank. President Trump downplayed that steep sell-off in U.S. equity markets when he spoke late last week. Bloomberg's Natalia Knichevich was there at a summit organized by the FII Institute, a nonprofit run by Saudi Arabia's Public Investment Fund. So, Natalia, what stood out to you during the president's speech at the FII Forum in Miami? How were investors reacting to his comments?
Hi, Bonnie. Yeah, so President did talk about the stock market a little bit. He said actually that he expected stock prices would go lower versus levels that we are seeing today, and oil prices would be higher. Of course, he talked a lot about record highs that the stock market did last year. As for this sell-off, he did not say anything specific, and of course, it came on Friday after the market closed when the Nasdaq 100 fell into a correction territory. He said that the stock market would be, quote, a rocket ship once the war in Iran ends. I should say that investors during panel sessions, they were pretty bullish because people were talking mostly about like long-term trends, AI, infrastructure, etc. But during my private conversations or interviews, people were much more cautious. So, for example, Guggenheim CIO Ann Walsh told me that she models a stress case scenario in which if we see oil prices staying at these levels for about 3 months, she expects a 10% decline in U.S. stocks on top of all losses that we have already seen. And the key metrics or the key pillar of this forecast is that if consumers are paying more for gasoline, they will start making choices. As a result, it's going to derail consumer sentiment and market sentiment across retail buyers, because she expects that in that case, they will stop buying the dip. And of course, we know that retail traders have been so important for the U.S. stock market as they account for about 20 to 30% of all trading volume. So that is a pretty pessimistic outlook.
Yeah, and I mean, when you think about it, the Nasdaq being in correction territory, it's only, quote unquote, down 11% from its peak. So, it had run up a long way to get to that peak. Natalia, what about things like private markets and concerns that had been there before the war started? On your panels and, in private conversations, are investors still very much concerned about private markets, or are they excited about the IPO pipeline, SpaceX coming to market and so on?
Yeah, so I did see a lot of panels on private markets. Again, I should say that mostly panelists were optimistic because longer term they do see this healthy pipeline of companies that are expected to go public. But of course, for this year, one of the key events to watch would be SpaceX IPO, and this is one of the key liquidity events for the stock market. So, for example, one panelist, Jack Selby, he's a managing partner at Copper Sky. He said, if the SpaceX IPO gets delayed or doesn't happen, he said, I can't give you a more negative impact on venture capital. He called SpaceX IPO a mother of all IPO liquidity events, and he said if it gets delayed, it would be a pretty big disaster. So again, we are watching the SpaceX IPO, which is supposed to come at a really crucial moment for the U.S. stock market, and that will determine potentially how the IPO pipeline will look later this year.
What were were the other conversations that were being had, sort of, hush-hush, if you like, Natalia? I mean, obviously, Anne Walsh of Guggenheim is modelling in much higher oil, but what about much higher aluminum, much higher fertilizer prices? A lack of a healthy supply chain for automakers and so on. Are people thinking through the consequences down the line of this war?
Exactly. People are really concerned about supply chains. I should say that the consensus could be that people, speakers, investors are pretty bullish on everything that is related to commodities and energy. And globally, I think this is also one of the most important conversations that people are having right now. People are getting more bearish on Europe, of course, first of all, because of its dependence on energy prices, but also capacity that central banks in Europe have or don't have when it comes to managing this potential crisis. And also investors still like the U.S., so we do see that this U.S. exceptionalism is coming back. Investors really like the AI trade, AI infrastructure trade. So this is one of the also key takeaways. And investors are also pretty bullish on Asia, I should say. So that are the key takeaways. Commodities, energy, and U.S. stocks are one of the most favorable right now.
All right, Natalia, thank you so much for that update from real investors, as it were. Bloomberg's Natalia Knichevich. Coming up, the war with Iran rages on, despite President Trump saying he sees a deal in the near future. This is Bloomberg.
Next week on Leaders with me, Francine Lacroix. I speak to George Al-Hedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
In case you missed it, on Bloomberg Crypto.
Crypto has had this terrible, horrible, no good, very bad 2026 ever since the events of October 10th. What do you chalk up this weakness to, this volatility to?
Well, I think there's a lot of structural pressure on Bitcoin that's been happening after 1010. It's just a change of who's holding Bitcoin, and you're moving from people who had long-term belief and were holding Bitcoin directly to just access to Bitcoin being wired up to our financial system and markets in ways that didn't happen before. So the combination of what happened on 1010 plus the mix shift change of who's holding changes the dynamic of price action. This is not a short-term market play. You have to have long-term belief and vision, and I think that for those people who have that long-term belief, they'll be fine.
Don't miss the next Bloomberg Crypto.
In case you missed it on the opening trade.
This time last year was too optimistic on all counts. So I think, yes, the market's asking for the hyperscalers to show a little bit more proof in the pudding. Last year it was, oh wow, you've raised your capex numbers, you're convinced, I must be convinced. Now investors are saying, I need to see the ROI on this capex before I want you to do more.
Don't miss the opening trade, live every weekday.
See a deal in Iran, yeah?
Mr. President.
Could be soon.
It offered a 15-point plan for Iran. Did they ever come back to the...
Yeah, they came back on the 15-point plan. They gave us most of the points.
President Trump there signaling a potential agreement in the works. Iran, though, disputing his claims just a few moments ago, saying the demands from the U.S. have been excessive and illogical, according to the Tasnim news agency. Joining us now from Washington is Mika Solner of Bloomberg Government. Mika, it's very difficult to know who to believe or what exactly is taking place. Do you have any insight on, if we can say for sure there is any kind of a dialogue happening either in front of the scenes or behind the scenes?
Yeah, absolutely. I mean, the White House has kept details pretty vague when it comes to the timeline of this military operation in Iran, but I know that people inside the White House are getting very antsy in terms of when is this going to end? What are the next steps? There's a lot of preparation happening, and I know that the administration is also cognizant that they need to do something while these oil prices increase, and it's leading to anxiety at the gas pump too in a critical midterm year.
Yeah, we're literally today at $3.99. We're about to hit $4 a gallon at the pump. The president isn't going to like that. What does he do about it, Mika?
Yeah, I think that a lot of that is still being figured out, but even some of Trump's closest allies are saying that the administration really needs to do more here when it comes to either, being very aggressive on those actions. I mean, Trump has hinted that he's wanting to take the oil in Iran, but it's also sending markets just spiraling all across the world. And I know that this is a huge issue. I was on the ground in Texas this weekend at CPAC talking to the president's biggest supporters who have said that gas prices are a problem and affordability is an issue, despite agreeing with him on not only this operation, but pretty much everything that the president has been doing so far in the administration.
Mika, what's on the agenda for the president today? Where might we hear remarks?
Yeah, the president has a policy meeting today. We may be able to hear from him. I know that he's going to have a little bit of a lighter schedule today, but we'll no doubt be hearing about him either, via the press this week, likely tomorrow, or online.
Yeah. Mika, thank you so much. Bloomberg Government's Mika Solner there. Let's get more now on those oil prices with Bloomberg's Emma Ross Thomas. So, Emma, every Friday, there's a little bit of a sell-off. It looks like people are sort of taking risk off the table. And then we come back in Monday and oil prices are higher again. And I guess it's no wonder, but where does this end?
Yeah, I mean, I guess the main development since the weekend, we woke up on Saturday morning to find that the Houthis had entered the war. Now, to what extent they've entered the war, I think there's still a bit of a question mark over that. So far, as far as I know, the strikes have mainly been directed at Israel. For the oil market, the real focus is the Red Sea. As you know, Saudi Arabia did this pretty impressive rerouting of oil exports from to avoid the Strait of Hormuz, going west so they could go out the Red Sea. But the worry for the oil market is that those exports could be targeted by the Houthis. And the reason for that is because, as you know, before the Houthis did target, we were talking about the Red Sea, weren't we? As a real hotspot. And suddenly the Red Sea is this kind of peaceful alternative to the Strait of Hormuz. So that is the oil market's absolute focus, because we've been getting 5 million barrels a day out of that west coast from Saudi Arabia. Now, so far, as I say, the attacks have only been on Israel. There has been some reporting that perhaps there was some kind of the deal between the Saudis and Houthis remained in place, and I think that will be really crucial.
Yeah, and I mean, I did think the original statement from the Houthis was a little bit reticent, so it did seem like they were only going to get involved if things escalated or Iran and its proxies were really directly targeted. Can they reach, the Bab el-Mandeb, where the Saudi platform is getting out, as you say, at least 5 million barrels a day? They were definitely able to reach sort of less far into the Red Sea, but can they reach that far?
Yeah, I think there's one for a military analyst. I think the sort of received wisdom is that they could, but let's not get too much into speculation there,
yeah,
right?
Exactly.
And as I say, so far we haven't seen that.
Now, the spread between WTI and Brent, is that also likely to stay as wide as it is, or at some point do we see U.S. prices creep even higher?
Yeah, it's an interesting one, isn't it? I think that the U.S. to a certain extent has been sort of insulated from the worst of this crisis. I mean, the crisis sort of started we've seen the real crunch in Asia, haven't we? And if you look at the benchmark prices in the Middle East, they are broken, some people would say. The next sort of phase of the crisis probably is that it's going to be the focus on Europe, and I think probably the US, both for oil and gas, because of its situation as sort of self-sufficiency. I think you will continue to have that insulation. That said, as you were just talking about gasoline prices, and while the crisis will bite more in Asia and Europe, the US will see that effect in gasoline prices.
Real quick one on aluminum. We've seen a massive run up, but we've been running up basically since Liberation Day. I mean, where do prices go from here?
Yeah, it's important, isn't it? That's the big difference between aluminium and the oil market. We went into this crisis with a glut. Same for gas. With aluminium, we did not. We already went in pretty bullish. The Middle East, I think, accounts for about 9% of production. 2 strikes over the weekend. I mean, that is massive. And aluminium, of course, is a super important input for inflation prices.
Yeah, for everything, it seems like. Yeah. Emma, thank you so much. That is Emma Ross-Thomas here with us in London. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, now for a full hour, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in London. Now a look at what's ahead this week. Well, Fed Chair Powell starts it all off. He's set to speak to a Harvard economics class at 10:30 a.m. Eastern Time. We understand he is taking questions, though. Then we get the U.S. PMI and retail sales data on Wednesday. But wrapping up the week, Friday, we have the March payrolls report, as if the Fed didn't have enough to think about it already. This is your macro picture as it relates to oil and aluminum, which will set the tone today. Oil was trading, in terms of Brent, above 116 earlier. It is a little below that now, but New York crude WTI just under $102 a barrel. And aluminum has been increasing after those 2 smelting plants were hit, up another 4.5% in London today. That's it for Bloomberg Brief. Surveillance is right ahead. Do stay with us. This is Bloomberg.
tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The level of uncertainty is extremely high.
Things seem to be in a free fall. You don't want to catch a falling knife. Equity markets and the markets generally are resilient.
We still see a compelling stock or equity story ahead.
It's just so difficult to determine what's going to happen next in this market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, the war enters week 5. Brent crude adding to the biggest monthly gain on record as Iran-backed Houthi militants are beginning to enter the conflict. And the Post indicating the Pentagon is preparing for a ground operation. Escalation risk is rising.
And we're seeing oil poised for the biggest 1-month gain on record as people start to reckon with this sort of escalation risk. You're starting to see real fear bake into markets. Not only are you starting to see the concern about some sort of slowdown being expressed in bond markets, but you're seeing 5 consecutive weeks of losses in the S&P 500 for the first time going back to 2022, and a feeling this isn't going to be a short conflict.
And attempting to work out, to process what the president's talking about in a conversation with the Financial Times. To be honest with you, my favorite thing is to take the oil.
Right. I think what he's talking about there may be Karg Island, where 90% of Iran's oil has to go through that island as it goes through the Strait of Hormuz. Potentially, that is one option that is on the table. There's a lot of reporting, though, Jonathan, not just from the Washington Post about the ground invasion, potentially, with thousands of troops already in the region, but also the Wall Street Journal had this out overnight, that the president is weighing a military operation to extract nearly 1,000 pounds of uranium from Iran. So at this moment, it does feel like the president is keeping all options on the table, because he told reporters last night on Air Force One that maybe this week there'll be a deal via the Pakistanis.
Lisa mentioned the bond market move. Let's talk about it. 2s, 10s and 30s. Yields lower across the curve so far this morning. 10s down by 3 to about 440. You will have noticed going into the weekend, the stocks closed at the lows, and so did the 2-year yield. Are things getting so bad it's good? Fixed income.
Yeah, and I keep thinking about what we were talking about with Bob Michael of JP Morgan Asset Management last week when he said, you've seen a technical move, a washout of positioning, and we now can have a healthier kind of trade in the bond market. Suddenly, people are worried about second-order effects, the disinflationary ramifications, and frankly, the suppression to growth as a result of high oil prices. You're starting to see that baked into multiples. You're starting to see that baked into the bond market. How far can that go?
Crude. Check out the new forecast. These from SocGen. I'm Michael Haig. We expect Brent to average 125 through the month of April and credible spikes towards 150. That's the latest from SocGen. They lift their 26 year-end Brent forecast from $65 to $80 a barrel.
This is because right now, what you have in the paper market, it is nowhere near the higher elevated prices you see in the physical market, especially out of the Middle East. And guess what? Things over the weekend got even more complicated when the Houthis decided they were going to enter the war. At the moment, the Red Sea, Bab el-Mandeb Strait, there are flows when it comes to cargoes and vessels. But the Houthis have shown that they have the capability to go after those ships. And then at that point, you'd be looking at Strait of Hormuz closed as well as Bab el-Mandeb Strait. You have two choke points in the Middle East.
Futures this morning doing a little bit better. It's a bounce following 5 weeks of losses on the S&P 500, up by just 1/3%. Coming up this hour, we'll catch up with Laurie Calvasina of RBC, with stocks on a 5-week losing streak. General Mastin Robertson of Academy Securities as the U.S. forces build up near Iran. And Bob McNally of Rapid and Energy Group with crude back near multi-year highs. We begin this hour with that top story. Fresh strikes ripping across the Middle East as President Trump threatens to take Iranian crude. Bloomberg's Jemana Bisechi leading our coverage out of the region and gives us some time this morning. Jemana, welcome to the program. I read that quote from the president to the FT. To be honest with you, my favorite thing is to take the oil. What's the reaction across the region this morning?
Well, the reaction is that there has been no progress on the diplomatic front. And, a little earlier on in the day, when President Trump was speaking to reporters, he seemed to suggest that maybe Iran would come to the negotiation table and that perhaps there is a possibility of signing a deal in the next few days. And you saw futures and stock markets turn on that. But the reality on the ground paints a very different picture. And to your point, President Trump seems to be implying that more military action is forthcoming. We were talking about the arrival of that first unit, the Marine Expeditionary Unit. It came to the region on Friday, 3,500 troops, about 2,200 Marines. Questions really about where they're going to be deployed. Remember, this isn't a huge number of troops, and they would be capable of perhaps going into these targeted raids. There's been some discussion about a potential takeover of Karg Island, obviously very risky. Wall Street Journal also reporting that they could be deployed into inland territory and perhaps look to conduct an operation to take out that enriched uranium stockpile, but again, a very risky operation as well. Or they could be just sent there as a means of deterrence. The reality is we just don't know. But in terms of the military operations over the weekend, I will tell you once again, we have seen a massive uptick in intensity. On Friday evening, Israeli operations conducted some strikes against 2 steel facilities in Iran, some nuclear research sites, and in retaliation to that, Iran once again lashed back at Gulf states infrastructure, hitting 2 key aluminium smelters in the region. That's having an impact on aluminium prices this morning. A key airbase in Saudi Arabia, the Prince Sultan Air Base. The U.S. sustained some critical damage there on some of their own jets. Also a desalination plant in Kuwait. And then add to the mix, as you were just talking about, a new front has opened up, which is the very fact that the Houthis have decided to enter into the conflict. They launched some attacks on Israel on Saturday morning. And the big question from here is whether they are going to start disrupting shipping again in the Red Sea. And just a bit of a history reminder here for viewers. The Houthis did sign a truce with Saudi Arabia back in 2022. They also signed a truce with the U.S. in May 2025. Since the Israel-Gaza ceasefire of October 2025, they have not done anything on the Red Sea, but they reserve the right to do so. And I think this is the big risk as we head into the next couple of days, and whether really another front in this conflict opens up, not just on the Persian Gulf, but also now on the Red Sea. And given how much oil Saudi Arabia has managed to divert from the Persian Gulf to the Yanbu ports, clearly a risk for oil markets as well.
Let's see if that truce holds. Jemana, thank you. Appreciate the coverage as always. Jemana Bisechi there, leading our coverage out of Dubai. Policymakers are scrambling. You're seeing it around the world. Qatar cutting rates. Australia halving its fuel tax for several months. South Korea considering expanding driving curbs. The latest from the Bloomberg team earlier on this morning.
It's a physical problem, particularly in Asia, particularly in South Korea, even throughout the region, with a question of physical goods not getting delivered. And that's the sort of difference a lot of commodity strategists keep pointing out.
Let's get to the view on Wall Street this morning. This from Laurie Calvasina of RBC, writing, stock pickers can be reluctant to bake in macro concerns until they're companies start to openly worry about them. It may simply take more time for the equity community to fully understand the impacts from an extended conflict. Laurie joins us now for more. Laurie, good morning.
Good morning.
We've had a correction of almost 9% on the S&P 500 from the highs. There's some multiple compression in there, which begs the question, is this an opportunity? At the same time, we haven't cut earnings expectations. So what's your advice this morning?
So look, I think we kind of have to take it one day at a time, and I know that's not a satisfactory answer. But the reality is that, at 8.7% from the January peak, we are still within what we would call a tier 1 drawdown. Now, if you go back to the financial crisis, we've actually seen that and you kind of use that as your starting point, we haven't had any drawdowns if you take the post-GFC high that have ended up between 10 and 14%. If you go past 10, you're going to the teens, right? And there's a little bit of an air pocket between the two. And I think what we're confronting right now is if this is going to stay relatively contained, right? If this is going to be relatively short duration. You've seen things like AAII net bulls are between -1 and -2 standard deviations. That's enough. But if we are going to have a more extended conflict and we're going to start sort of saying, okay, this isn't just an inflation shock, it's a growth shock, the U.S. is not as immune as we thought, that is something that could take you into tier 2 drawdown territory. Growth scares tend to involve periods in which something new happens, we don't understand it, it feels like things are out of control, and people genuinely start to fear a recession. We are not there yet, but we have to keep a very close eye on the narrative to see if that's where it's headed.
I'm sure clients are all asking you the same question. Is it an inflation shock, a growth scare, either or just a sequencing question?
I would say that most clients, so I was on the road for 4 days last week, and what we essentially saw was that most clients are more in the, this is going to create some inflationary pressures camp. We are seeing a lot of people sort of defend the resilience of the economy, the strong point coming in. And to be fair to those clients, you are seeing this in all of the C-suite survey data that has come out, including ones that had a little bit of the post-war period in them. You're also seeing, I have read, I think, everything an S&P 1500 or Russell 3000 company has said at a conference or on an earnings call, and I've read all the SMIDs because they give you great information in this period, but they are generally, for the most part, still sort of talking about this resilience, their ability to work around things. We're seeing a few companies make adjustments in terms of things like fuel costs or guidance, but not a lot. And so this is all going into the ears of the U.S. equity investors. Now, I will tell you, John, as the week wore on last week, I started to get a couple questions about growth impacts towards the end of the week. I had one client sort of say, if we look at what's going on in Europe and Asia, can the U.S. really stay immune from that? This same client thought that this conflict would go on a few months. He was the only person last week who told me it would go on a few months. Everyone else was debating 1 week or a couple of weeks.
Based on the fact that you've seen profits reaccelerate, actually, earnings expectations continue to increase, do you think this market's being overly complacent, or do you think that we're close to a washout that seems like a buying opportunity?
I don't think that we are being complacent. Frankly, and I kind of knew this heading into last week as well, but we are seeing a lot of people not doing a lot. Like, they're fishing around for trades. They're trying to figure out what to do. We know a lot of hedging activity has been put on, and people don't feel great. That is not complacency to me. But at the same time, we have seen the bottom-up S&P 500 EPS forecast. It was like at 313 to start the year. Then it dipped down to 312, and now we're all the way up to 323, and we just added $3 over the last week. So, you're seeing this help out the multiples. And if you look at the S&P bottom-up market cap weighted PE, we were at 28 times last fall. We were up around 25 times earlier before the war started, and then we are now, sitting down around 21 times. Now, I don't think it's a washout yet because you are not at the average, which is 18.5, and in 2022, when the broader market bottomed on that 25% drawdown, you dipped a little bit below the average. So is it improvement? Yes. Is it helpful? Yes. Is it a hold your nose and buying opportunity? I don't think we're quite there yet.
The more that the bond market thinks that this is potentially a growth scare, does that add to the attractiveness of stocks, given the fact that we've done all of this with increasing rate expectations?
Yeah, so look, I think that when I talk to investors, nobody, at least in my meetings, is looking for rate hikes, right? I think what we're much more sensitive to are 10-year yields. We actually worsened one of our stress tests. We had been looking for 4.5, sort of in like the $100 extended oil scenario. We took our inflation numbers up in our stress test. We took 10-year yields up to 5. That tends to be the number that spooks equity investors, but I'll tell you, Lisa, I had like 5 flavors of earnings in this stress test, keeping like that 15% growth that's in the consensus now and then going all the way down to 10% contraction versus 2025. I'm coming up with a range of like 5,700 to 7,400. And if you look at kind of like the more benign earnings assumptions, you can get a flat market this year, even with some pretty onerous numbers. So we have to pay attention to what's going on with earnings. We have to pay attention to what's going on with the inflation rate. But the 10-year yield is also a key variable, and the lower it is, the better it's going to be for the multiple.
We've got some big names in a lot of pain as well. Just last week, Microsoft down by close to 7%, Meta down by double digits. I know you won't do single names, but let's talk about big tech.
Yeah.
A lot of these issues predate this war. Is this war becoming a convenient excuse for something that was already developing?
Well, look, I think that we benefit in the U.S., and it kind of leveled out mid-month, but, you know, we sort of saw initially in this conflict that the U.S. was benefiting as a safe haven trade, outperforming the rest of the world. And if you look at PEs for U.S. versus Europe versus Canada versus Australia, so just take like a landscape of global developed markets, we were seeing the S&P PE coming down heading into this crisis. And so we already had a lot of de-risking on private credit fears, on AI fears, which really, frankly, perked up last Labor Day. At the same time, these other markets, their PEs were moving up. So we got to this Iran conflict, and the U.S. had lost its valuation premium if you looked at a 5-year average. And if you even looked at a 20-year time frame, we had lost that valuation premium in the U.S. as well. So, you know, the earnings are still looking pretty strong in that mega cap growth cohort. We've seen the rate of upward revision skyrocket in the top 10 market cap names back to last fall's highs. And if you look at that 323 number I mentioned, and you just look at like a 26 growth rate versus 25, tech is the thing that's driving the way. So you also have to figure out a way, if you really want to push this market into really negative territory in a sustainable way, you've really got to attack those tech earnings.
Laurie, it's good to see you.
Good to see you.
Thanks for dropping by. Thank you. Laurie Cavacina there of RBC Capital Markets. Pretty phenomenal. Amazing. Just try and get your head around this. Crude has ripped. The biggest monthly move we've seen on record if we close at these levels, and yet here we are pricing in a better outlook for earnings on the S&P 500.
Jurriën Timmer put it really well over at Fidelity. He said the S&P 500 index is down 9.2%, but the PE ratio is down 18%. This is all being led by multiples going down, even though the earnings are actually increasing. And this speaks to a lot of the positivity that you're hearing under the hood.
Futures on the S&P positive by 1/3 of 1%. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Good morning, John. President Donald Trump says he's ready to make a deal with Iran. Speaking to reporters on Air Force One, the president saying Iran is giving the U.S. most of the demands from its 15-point peace plan. Iran still disputes their negotiations. A confirmation hearing for Kevin Warsh could be held the week of April 13th. Punchbowl reporting the Senate's Banking Committee is planning to hold a hearing for President Donald Trump's nominee for Federal Reserve Chair in 2 weeks' time. And President Xi Jinping inviting Taiwan's main opposition leader to visit mainland China, setting up a high-stakes meeting weeks before a planned summit with President Trump. Chang Li-wan will visit China from April 7th through 12th, marking the first such visit in nearly a decade. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, looking for a deal.
Could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon. But you never know with Iran because we negotiate with them and then we always have to blow them up.
Up next on the program, we'll catch up with General Mastin Robertson of Academy Securities, live from New York City this morning. Good morning.
decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The Vienna report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Here is your week ahead later on this morning. Check it out, 10:30 a.m. Eastern Time. You will hear from the Fed Chair. That is going to be must listen, must watch later on this morning, going into a big week full of economic data. How important is this data? How dated is the data, Bremo, coming this week?
I actually think we'd always be focused on the jobs report, but instead, on Wednesday, we get ISM manufacturing and prices paid, and that might be the most important data point of the week because everyone's looking for the real-time increase in costs to companies. That might be the fastest and most current look we can get on that.
Heading into that week full of data, equity markets look like this. Futures positive by 0.4% on the S&P, up a third on the Nasdaq. In the bond market, yields lower by 3-4 basis points on a 10-year, 4.39, and in crude. A record-breaking rally for the month so far. Brent, 115 and up another 2%. Under surveillance this morning, looking for a deal.
The one regime was decimated, destroyed. They're all dead. The next regime is mostly dead. And the third regime, we're dealing with different people than anybody's dealt with before. It's a whole different group of people. So I would consider that regime change.
Could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon. But you never know with Iran because we negotiate with them and then we always have to blow them up.
So here's the latest this morning. The Iran war showing no signs of letting up. The U.S. sending thousands of additional troops to the region as Anne-Marie, Iranian-backed Houthis join the conflict.
And I think this is really a massive escalation risk at the moment. We do know the Houthis have the capability. They did this in 2023 in terms of going after vessels in the Red Sea. And right now, the Red Sea has become critical for this crisis because over the weekend, we also got other news. Saudi Arabia's East-West pipeline is now at capacity of what it's able to move through that pipeline. It is now moving 7 million barrels a day. This is a huge feat for Saudi Arabia, but all of that oil is going to Yanbu, which is on the Red Sea. And if the Houthis decide to close the Bab el-Mandeb Strait, which is between Yemen and Djibouti, this will be the second choke point. And then you could see prices escalate very quickly.
That's the nightmare for the energy market. Brent crude this morning at 115. General Mastin Robertson of Academy Securities writing the following. Iran's actions, left unaddressed, potentially sets an illegal new normal. General Robertson joins us now for more. General, welcome to the program, sir. Can we pick up on Houthi militants entering this war, this conflict? What are the consequences of that?
I don't know this. It really changed anything. I believe the Houthis have been involved the whole time. I think what we're missing here is that the Houthis do not make their own decisions. They're a proxy. And they act when Iran says, okay, we want you to act. And when Iran wants them to stand down, they have them stand down. Nobody controls the Houthis except for Iran, and certainly Yemen doesn't control the Houthis or those frontier spaces that are within their border.
One individual, though, John Lieber of Eurasia Group, said to me that the Houthis would rather being basically paid off by the Saudis instead of getting involved. Do you think the calculus is changing for the proxy?
I don't think it changed for the proxy because but I think the Houthis are businessmen. Yes, they'll take money from the Saudis, and yes, they'll promise A, B, and C, but at the end of the day, the Houthis are owned by the Iranians. And the question is, do the Houthis really believe there's still sufficient supreme leadership authority in Iran for them to be able to trust that that's where their calculus, their money, their direction is going to come from, or has this second or third generation of supreme leadership authority dissipated sufficiently to where they start to doubt? I have confidence that given the decades-long relationship Iran has with its proxies, although not decades long necessarily with the Houthis, Iran still has a firm grip, in my opinion, on them, largely not because of the Supreme Leadership Authority, but because of the IRGC that is below that, but is intrinsically connected to the Supreme Leadership Authority.
We do, though, have a recent killing, according to the Israelis, of the IRGC Navy commander. Do you think this breaks down their maritime command for the Iranians?
No, I think you've got to get into the tens of thousands, if not 100,000s, of killings of the IRGC if you're really going to have an influence and effect. But I don't think we really know. We know that they're 250,000 in theory strong. We know that they are just etched in stone in relationship with the Supreme Leadership Authority and have been since the beginning. We don't know how deep that etched in stone authority and loyalty goes, but we surmise it goes pretty deep, which is why I don't think what the goal here is how do we destroy the IRGC. The goal is how do we get Iran to a point where they're willing to negotiate a plausible non-nuclear Iran in the future. And to me, that's where the entire buck stops, is how do we get Iran to where they are not pursuing a nuclear capability that would be catastrophic for the world?
Well, how do you think we get there? We're not there now today, are we?
We are not. But I think that's the reason you're seeing more forces sent there. Everything is about leverage. Everything is about how do you create negotiation space. How do you create enough, not pain, but how do you create enough capability, threat, and anxiety that is all of this calculus combined together of, the killing of the Supreme Leadership Authorities, the reduction of their capabilities, particularly the destruction of their Navy and a lot of their air, to say how much more are they willing to sustain and be able to say we're still an entity to be reckoned with in the Middle East.
General, when President Trump says that he wants to take the oil in Iran, how do you understand that?
I see all this as purely negotiation strategy. If he can see something that causes the Iranians to say, okay, I didn't expect that, that's a bridge further than I wanted, then I think that gives the upper hand to what the administration is seeking. What I don't see this being is a ground invasion like Iraq. I don't see that is where we're headed. I do see where we're headed is where the leverage points that the administration believes are plausible, and it's really the leverage points that CENTCOM believes are plausible, because there isn't any surprise that we're doing something against Iran at some point. It's just the timing of when. But every regional combatant commander has in-the-can campaign plans and plans against certain scenarios that they break out, dust off, update based on how the situation has changed. And then they expand it based on what the current administration will allow and authorize them to do it. Most regional combatant commanders are willing to be a little more aggressive than their electoral officials are telling them to be. So there's always that calculus of the military wanting to be a little more aggressive and confident, the administration and the elected officials saying, well, wait a minute, there's more at stake here than just winning a battle on the battlefield.
General, well framed, as always. It's good to see you. Thank you, sir. General Maston Robertson there of Academy Securities. Another Monday morning that started on Sunday evening.
Always. I was thinking to myself, it's going to be one of those days, and my goodness, the oil price tells you everything.
Up next on the programme, we'll catch up with Bob McNally of Rapidon Energy Group with Brent crude over 115.
case you missed it on Balance of Power.
Senators, when we consider what is going on in the Middle East, there's also the question as to whether or not Iranian retaliation might include threats directly to the United States homeland. Does this potentially amplify the need to not only reopen the Department of Homeland Security, but also to quickly confirm a new secretary in Markwayne Mullin?
I mean, look, Iran has been trying to hurt our homeland for many, many years. I am ready to reopen the Department of Homeland Security, just carve out ICE. We have genuine problems in this country with the use of ICE. We all saw it with our own eyes. But in terms of the rest of it, FEMA, the Coast Guard, I mean, there's plenty of missions that should go on, and I've been supporting us moving forward on those things. ICE we have a problem with, and legit. But the rest of it, we should open and reopen immediately. And the Republicans shouldn't hold the entire TSA budget and everything else hostage because they are supportive of ICE.
Don't miss Balance of Power live every weekday.
Where did you get the idea for Play-Doh?
My one son was playing with a mound of Play-Doh, and he said, "Dad, voila." And I thought, this is what I'm trying to do every day, to make something that you can't make a judgment about.
Coming off the back of the biggest two-day loss on the S&P 500 since April last year. Equity futures looking to bounce. We're higher across the board here on the S&P 500, up by 0.4% following a fifth consecutive week of losses on the S&P. That's the longest since 2022. That's the S&P 500. On the NASDAQ, no better. In fact, in some places, by some measure, worse. We're down by 10% in correction territory, down by more than that. Some of the big names last week got absolutely hammered. Not just Microsoft down by close to 7%, but Meta down by 11 percentage points. And much of the pain in some of those names predates this war.
And has something that is completely unrelated to the war, which is a court case for Meta that really undermines some of its potential safety controls in social media, and questions about AI advancements that are going to undercut some of Microsoft's software tools. So some of these issues have already been percolating. It's why it's the trifecta that people talk about. The software concerns and AI disruption, a concern about the oil shock, as well as the labor market, which still kind of sits out there as a potential risk factor.
More data on the labor market coming on Friday. Something happened in the past Friday. Something switched. Something clicked. And you would have noticed at the close, when we closed on the low in equities, we closed on the low on two-year yields. Check out yields this morning. The move continues. Yields down by 2 on 2s, down by 3 on 10s, 4.40 on a 10-year yield. Are we starting to price in the growth aspect of all of this into the bond market?
Over the weekend, note after note, Goldman Sachs, JP Morgan, TD Securities saying, look for that growth shock. That is a more significant counterbalance. Does this come when the market is more balanced? You've already seen something of a washout of the technical positioning, but right now people are starting to consider, wait a second, why are central banks going to hike rates into potentially what could be a growth slowdown?
A bit of pushback to that story. Yields getting pulled lower. Crude still pushing higher. The problems persist. 115 on Brent, close to 116. Squeezing out a sixth consecutive week of gains just last week. Brent up on the month by almost 60%. 60% for the month of March.
And this is because the fighting continues. We have seen even just overnight, Iran continues to get hit from Israeli and U.S. strikes, as well as Iranians going after still infrastructure and bases around the Middle East. And at the same time, although you've seen some reporting from Iranian news agencies that some vessels are able to go through, we're talking about a very low number compared to normal flows. Iran still controls the strait, and they're only letting certain ships pass through.
115.60 so far this morning. 3 hours away from the opening pound. The cash open just around the corner with your morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing the aluminum stocks gaining this morning with Alcoa up 8%. Century Aluminum also up 8% in the pre-market. Attacks on two major Middle Eastern producers are threatening one of the biggest disruptions this market has seen in years at a time when inventories are already tight. So we are seeing the price of aluminum on the LME surging surging. The industrial metal is used in everything from autos to airplanes to food packages. We are also seeing oil stocks moving higher this morning. Exxon up 1.6% as this supply shock, already one of the biggest in history, moves past the 1 month mark, with investors seeing no end in sight. So we continue to see crude surging. As you said, Brent crude on track for its biggest monthly gain on record. And we end on Peloton, those shares up 3% in the pre-market after being up nearly 9% on Friday, after investor Eric Jackson of EMJ Capital said he is long the stock, saying the market has not caught up to its fundamentals-driven turnaround. John?
Yahara, thank you. Thanks for the update. More from Yahara later on this morning. On our radar this morning, the war entering week 5, Iran-backed Houthi militants entering the conflict, launching ballistic missiles at Israel Saturday morning following US and Israeli strikes on Iranian nuclear facilities. Elsewhere, the president claiming Iran is agreeing with most of a 15-point plan to end the war. Iran saying it rejected the plan and disputing Trump's claims about negotiations. Tehran insisting on its own 5-point plan, including war reparations. And finally, the president saying he wants to, quote, take the oil in Iran. In an interview with the Financial Times, the president saying the US may take Kharg Island, the country's main fuel hub.
So a lot of questions around how serious this is. We were just talking to General Maston, who is saying that he thinks this is looking for leverage. I found this interview really interesting from the pushback that the president was given to all of the criticisms that he's been getting with respect to the war. It's going to cost too much, seize the oil. It's potentially, we're not getting anything. He said, well, actually, we got this big gift. You said it was BS, but actually it was a number of ships from Pakistan that were allowed to go through the strait. One after another, he's talking about how they've already had regime change. The people we're dealing with are a totally different group of people. They are very professional. All of these signal that he's paying attention to some of the criticisms out there that keep peppering his administration.
The individuals he's talking about saying they're very professional are like Mohammed Ghalibaf, which is out on Twitter constantly trolling this administration. He was out last night talking about what is going on in financial markets. When it comes to the oil comment, what struck me is that the president compared it to what happened in Venezuela. Preference would be to take the oil, comparing it to the potential move to Venezuela, where the U.S. intends to control the oil industry. The problem is, this is so much harder to do in a country like Iran. How are you going to control the oil in a country that is still run by this regime, even though there's changes within, because there's been targets? And the fact of the matter is, you can't unless you do take Kharg Island, because 9 out of 10 barrels pass through that island. And how long are you prepared to stay there and control that island? I don't see the U.S. wanting to go into a protracted war, which would mean troops on Kharg Island for months or years.
We had trade recommendations from the Iranian government going into the opening of market trading last week. What do you make of that, Bramo?
I mean, this is the key point, is that they want oil prices higher and the U.S. wants oil prices lower. And, you know, this is the job voting that you're going to get with a lot of potential AI videos that are really entertaining.
It's becoming somewhat farcical, isn't it, on social media at the moment?
Yes, actual physically, like literally it is farce.
Brent crude on track for a record monthly gain as the war with Iran continues to intensify. Bob McNally of Rapid Energy Group writing, fade speculation on a near-term US-Iran ceasefire. US force posture points to escalation. Bob joins us now for more. Bob, welcome. Let's start with that line. It's an important line. What is it about the force posture of the US that points to escalation?
Great to be with you, John. So, yeah, we're flowing. We have 1 Marine Expeditionary Unit's arrived, another one's on the way, 82nd Airborne, and other forces are moving in. We think we're likely to see some form of ground operation. I'll doubt we'll go into Kharg Island. Most of the military folks I talk with just don't understand the utility of that. However, there are smaller islands that are more defensible that are used by Iran to interdict shipping. Perhaps it's those, but I think some form of U.S. ground force insertion is coming.
But Bob, when we talk about the president saying things like, I want to take the oil in Iran, inevitably that would mean some sort of operation with Kharg Island, no?
You know, it doesn't have to. I don't understand. I mean, back in 2012, I wrote an FT op-ed and I said, just put a quarantine up. You just stop all the ships in the Gulf of Oman coming out of Kharg Island. Kharg Island's like 5 miles from the coast. We could take it, but then we'd be under constant bombardment from drones and artillery and missiles and things. So, again, I'm not a military guy, but the military guys and gals I know don't really see the need to occupy Kharg Island. We can still choke off Iran's exports. We can do that. but we can do
Bob,
it far away on the water.
Why would this administration want to choke off their exports when they literally took Iran off of their sanctions list, even including in that general license that Americans can now buy Iranian barrels?
Right. So right now, Anne-Marie, you're right. Right now, the strategy of the administration is put every barrel it can into the market to try and break crude's ascent. Okay, and so that, you're right, liberalizing access to Iranian barrels, to Russian barrels, allowing Iran to export at will while others are constrained. But if we go in and take Karg Island by force, that strategy will obviously change. I'm just saying you can do it in other ways.
Bob, there is a lot of uncertainty around how significantly oil production has already been disrupted in some sort of significant way that could lead to prolonged shortages. Do you have an assessment of that?
We're starting to work that up. The problem is this is still underway and the damages are TBD. But right now, I think it's 3 to 4 months before the major Saudi Arabia, Kuwait, probably maybe longer for Iraq, Rumelia, that field, that 1 million barrel a day outage there could be much longer term. So if you put a gun to my head right now, it's still underway. I'd say on the order of 2 million barrels a day of crude that could be lost for a long time here. Now that's before we get into any potential damage to above ground facilities. Again, the silver lining so far on this cloud is we haven't seen escalation to destroying the facilities we need to process and export that crude when those fields can be brought back up. That would be disastrous. Abqaiq, Ras Tanura Terminal, Karg Island itself haven't been physically damaged. So that's the other thing to watch for. If that happens, then all the damage estimates, get increased.
How much has the SPR release in the United States and in Europe, as well as the unsanctioned Iranian and Russian oil, potentially cushioned some of what we're seeing in terms of actual production absolutely destroyed?
Well, from a flow perspective, it's marginal, right? At the most, when all the SPR barrels are flowing from the IEA countries, you're looking at maybe a little more than 2 million barrels a day. The deficit, and there's a lot of math going around out there, but we estimate the deficit to be about crude and products 12 million barrels a day or so. So obviously, from a flow perspective, it's not that significant. It is, however, helping keep WTI down. It is cushioning the market a little bit, but it's a speed bump kind of on the way higher.
Bob, can you translate a headline for me? Just help me understand how important this is or not. This came from the president speaking to the Financial Times. He talked about this a few times now, about these Pakistan-flagged oil tankers that have been allowed through the Strait of Hormuz. Whether that number is 10 or whether it's 20, can you give us some context on that? How big is that number relative to the amount of traffic that would traditionally go through the Strait?
Yeah, John. So, you know what? We haven't even, it's these tankers, we're not even sure they were oil tankers. They have been dry cargo tankers. If each one at max would have been 2 million barrels, 10 million barrels, 2 million barrels. So it's just not that much. I think all of this really is verbal intervention. It's a term I learned in the 90s working at Tudor and watching the central banks. This is activating this reservoir of hope and confidence in the market that this nightmare is going to go away. And the president knows when he says things like this, we almost have a deal. 10 cargoes went out. It was a gift. We're escorting tankers out. All of this, I think, is mainly intended to try and keep oil prices down. And that doesn't reflect a real return of barrels. At most, on a given day, maybe a half million barrels a day is getting out, but it's quite marginal.
Bob, it's good to see you. Thanks for breaking it down. Bob McNally there of Rapidan Energy Group. It doesn't seem to be working. Crude right now, 115.
No, because we're not up to normal flows, and how many ships are actually getting through, no one really knows, but it is less than a dozen a day. It's about 2 a day, potentially, on average, according to tanker trackers. And to Bob's point there, we don't know what kind of vessel it was, we don't know what the cargo was, we don't know the destination it was, so it really does seem like this is why it's a muted response.
6 years ago, this was the conversation in financial markets. I'm not a doctor, but 6 years later, I'm not a military guy, but. And you've said this a few times on this show, Bramo. It's difficult to get an edge in this story right now. It's really, really hard.
It's fraught with misinformation. It's fraught with a lack of information about the actual production facilities that have been affected or potentially even destroyed. How exactly you're going to get a foothold ahead of someone else at a time of such quick-moving news and, frankly, so much disinformation out there.
Equity futures just about positive so far, up this Monday morning by 0.4%. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Iran-backed Houthi forces in Yemen have entered the war in the Middle East for the first time. Houthis firing missiles at Israel over the weekend and saying they would continue operations until attacks stop on Iran and its proxy militant groups. A Russian oil tanker has arrived in Cuba. Russia's Interfax news agency saying the ship is carrying around 100,000 tons of oil. President Trump had said he would allow the shipment for humanitarian reasons, saying, quote, they have to survive. And President Trump ordering emergency pay for TSA agents over the weekend, but major U.S. airports are still urging travelers to arrive hours earlier to get through security lines. White House border czar Tom Homan saying ICE agents deployed to airports may remain for a while. That's your Bloomberg Brief, John.
Yahara, thank you. Thanks for the update. Up next on the program, avoiding a falling knife.
Things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. In the meantime, just let the markets go to wherever they're going.
Up next, we'll catch up with Jordan Rochester of Mizuho, live from New York City. You're watching Bloomberg TV.
Projections for unemployment, I have projections for inflation, so do my colleagues, and thus far the evidence from events over the weekend haven't led me to change any of my forecasts.
With the geopolitical events that we talked about, it's just too soon to know what imprint this has on inflation and for how long.
We've seen the economy overall, it's been pretty healthy, it's been brightening, the outlook has been positive.
I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around, but of course no one knows whether this is going to be short-term or long-term, and so we'll just see where it goes.
Inflation's hot. It's going to look even worse now with the oil prices, at least on headline. And then if you get a solid job number, it does say you can sit there and wait.
It can lead you in a stagflationary direction. The inflation side of the mandate getting worse at the same time the employment side of the mandate is getting worse. And that's always the worst case scenario.
Nobody covers the Fed like Bloomberg. Context changes everything.
Next week on Leaders with me, Francine Lacqua. I speak to George Alhedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
The longest first quarter ever is almost over. Just 2 more sessions. Then we can wrap this thing up. On the month so far, Brent crude up by some 60%, the biggest monthly rally on record. On the stock side of things, energy stocks up by double digits. Refiners on the S&P rallying 24% through the month of March. Check out the equity market right now. Futures a bounce this morning on the S&P up by 0.4%, on the Nasdaq up by 0.3%, small caps up by 0.5%. Bramo, lots of people making up lots of stories about what's happening with multiples. This from Mike Wilson of Morgan Stanley. We think the equity market is less complacent on growth risk than consensus believes. The S&P's forward PE ratio is now compressed by 17%, which is in the range of prior growth scare outcomes in the absence of a recession or the Fed hiking.
Yeah, with Mike Wilson saying we're getting to the end of this washout period and it's really starting to look more attractive. It's the same point that Fidelity was making with the idea of multiples coming under much more pressure, even as earnings actually start to pick up. No one can game out how big of a downward draft this is going to be on a lot of companies, which is why we're watching the ISM Manufacturing Index, in particular prices paid on Wednesday. It might give you the most current, up-to-date view of how much some of the incoming costs are increasing.
Can you get excited about multiples before the earnings cuts have started? That's a question we'll ask throughout this morning. Under surveillance this morning, avoiding a falling knife.
Things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for a recession. So in the meantime, just let the markets go to wherever they're going.
So here's the latest this morning. Traders raising bets. Higher energy costs will lead to a slowdown in growth. Global bond yields falling with the US dollar headed for its biggest monthly gain since 2024. Jordan Rochester of Mizuho writing, when it comes to understanding where we will trade, think less about taco and more about nacho, not actually changing Hormuz opening. Jordan joins us now for more. Jordan, welcome to the program. With that in mind, inflation versus growth, do you put more weight on one versus the other?
John, good morning. I think inflation is the most important thing. It depends which central bank you're talking about, though. There is, of course, the dual mandate for the Fed, where economists can definitely debate about the growth impact in the US because the labor markets tend to be much more important than the inflation target. But that is just not the case in Europe, with the ECB's explicit mandate being the target for CPI, the Bank of England as well. So, John, it depends which central bank you're talking about. But in Europe, I think it's quite clear the trades will be that the central banks respond to this by demand destruction. The rate hikes that are being priced in by the market will need to be delivered, John, if we stay at these levels of oil, because you will see second round effects of inflation. Where in the US, you've got the energy independence. You've also got a smaller rise in energy prices. Natural gas prices have barely moved in the US. Therefore, electricity won't be responding in the same way that Europe will. And therefore, you have to really talk about the difference between the two.
Jordan, let's talk about the US side of things. I hear a similar story. We all do repeatedly on this program. Just a bit of pushback. The idea being the US economy is in a stronger place, that the labor market might be somewhat tighter than would otherwise be known by looking at the payrolls numbers every single month, and the fact that the fiscal story is front and center too. We're getting tax refunds just as these higher oil prices are hitting. Do you think we're underestimating the potential for second-order effects?
I think so, John. I think never underestimate the potential for the US to bounce back as well. It's a very resilient economy. You had my colleague, Stephen Rasciuto, on the program just last week, I believe, talking about how he doesn't expect any Fed cuts this year. And that was before the war even started. So I think, John, the sort of risk here is that we start to price in rate hikes more aggressively to the US than what's being given credit for. But just think about the second round effects of inflation here. So a lot of economists talk about this being an oil shock, and then they kind of forget that it's also about polyester. It's also about fertilizers. It's also about everything to do with helium. And this will feed through to many different parts. That's clothing going up. That's your sort of plastics, your consumer products also responding. And, of course, food. And the other point as well that economists are leaning on, because they don't really want to consider the other option, which is this is going to be a quick war. Well, what if it's not, John? What if we're here in June? What if we're in July talking about the same thing? I think what will have happened by that point is you'll have a new Fed chair, and he just won't be able to deliver the Fed cuts that the president hopes that he will. And the rest of the FOMC might be talking about the idea of maybe we have to raise rates.
Jordan, is 2022 a good point of reference when thinking about this moment?
I think it is for trading it. I think it's a playbook that investors can lean heavily on. In fact, if you look at how the currency market is moving, it's following, and the credit market as well in terms of credit spreads, it's following the 2022 movement in price action to the letter. It's quite spooky, really. Scooby-Doo needs to be given a Scooby snack for spotting it. But when it comes to economists, they will tell you it's very, very different. They will talk about how fiscal policy is not as loose as it was. They'll talk about how job vacancies are nowhere near as high as they were. All these factors, and the fact that inflation and supply chains in China are nowhere near as high as in terms of restrictions that we had at the time in 2022, nowhere near the same. That's absolutely right. But I think that if you just look at the experience of the sort of 1970s and 80s, we've had an inflation shock already. We've now got consumers whose inflation expectations are much more elevated and volatile than they used to be. And we've got employers and firms willing to raise wages and prices much more than we were used to in the period of the Great Moderation. So this is a very, very precarious time for central banks to lean on the idea of this being transitory, because if you have a few months of this where clothing prices, food prices, plastics, etc., not just energy, are all going up at the same time, that to me smells of second-round effects.
So, Jordan, how much upside do you see for the dollar versus the euro versus everything based on that kind of trading playbook?
Well, that playbook got euro-dollar down to parity back in 2022. It was extreme. It was a very euro-focused story, with the US benefiting from the LNG exports and oil exports and picking up the slack from Russia's supply being constrained to Europe. We're following the same path of euro-dollar's depreciation and the dollar's appreciation as 2022, but it's all about how long this war lasts. So if you make the assumption it's over by the end of this month, then sure, euro-dollar heads back higher. We're at 116 to 118, 120, who knows? But if you make the assumption that the strait remains closed and we get to July, we get to September, I really don't want to talk about it, but let's say December, then the below 110, 105 parity levels, each month this goes on, we're going to have to lower our forecast for it. So the way I see the dollar appreciating right now is I think we'll get euro-dollar down to 112. We talk about 110 if we get there July and onwards, but it's in terms of trade shock. The rate hikes that have been priced into the ECB and the Bank of England, it's helped buffer the sort of dollar strength that you would have usually seen, but we've now had so much priced in for both of those central banks. It's hard for the interest rate story to overwhelm the terms of trade shock that's feeding through.
Jordan Rochester, go away. It's good to see you. Thank you, sir. Jordan Rochester of Mizuho. December. Can you imagine if this went to December?
If it goes to December, I wonder if this idea of a petro-yuan actually comes and takes shape, meaning if you have to pay a toll in Iran, it's going to be in yuan, and China will be an ultimate beneficiary of that.
Well, right now, nobody is thinking that that's a possibility based on where the futures curve is, given the fact that right now we're looking at $76 a barrel in December. So this isn't exactly a priced-in scenario. A lot of things would have to get repriced, not just the euro.
If it started going on that long, to Anne-Marie's point, things start to change.
Structural shifts.
Yeah, and things start to become formalized, whether you like it or not. And that's Iran ultimately offering a toll. And if you've got a certain flag on a certain ship, you get through, and if you don't, you don't.
Well, over the weekend, we heard from one Iranian official saying we will never go back to normal. We are determined now to make sure that we get a fee for this strait. And I think for the United States, that's very unnerving, because this is an international waterway, not to mention Oman and UAE, which are part of that as well.
Futures right now positive by 0.4% on the S&P 500. Up next, a man who raised his price target on the S&P 500. We'll speak to Venu Krishna of Barclays in just a moment, plus Henry Trays of Veda Partners, Clayton Siegel of CSIS, and Ed Al-Husseini of Columbia Threadneedle. The second hour of Bloomberg Surveillance just around the corner. When it matters, investors turn to Bloomberg Surveillance.
I said it maybe even on your show here.
I hear you guys talking about this a lot.
Our investors are really thoughtful. They're engaged. They listen to your show.
As a number of people you've had on your show have mentioned.
The three of us have talked about it on this show many times.
I think you find, and you've heard this on your show, we've already talked this morning on your show, as you know, and you cover every day on Bloomberg.
You've heard a lot of guests talk about that.
I think your show is incredible.
Bloomberg Surveillance, we're talking about it.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay,
I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts. Next week on Leaders with me, Francine Lacroix. I speak to George Alhedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend.
Breaking news today from Wall Street to Washington.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
In case you missed it on the opening trade.
This time last year was too optimistic on all counts. So I think, yes, the market's asking for the hyperscalers to show a little bit more proof in the pudding. Last year it was, oh, wow, you've raised your CapEx numbers. You're convinced. I must be convinced. Now investors are saying, I need to see the ROI on this CapEx before I want you to do more.
Don't miss the opening trade. Live every weekday.
It's premature to talk about a Fed easing because the oil hit takes down growth.
The Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
I see no indications that this is going to go away anytime soon.
You still don't see the potential for rate hikes on the horizon.
The U.S. economy can take a few more punches than the rest of the world.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action, the scores look like this. Equity futures on the S&P bouncing by just a few tenths of 1%. We're up by 0.5 following the biggest two-day loss on the S&P since April of last year, down almost 9% from the highs earlier this year. In the bond market, are we beginning to price in lower growth, slower growth? Yields down by 4 basis points on 2s, down by 4 on 10s, 4.39. With this in mind, crude just holding on to these levels, triple digits on WTI, triple digits on Brent crude, 115 and up by more than 2% this morning.
Yeah, it is an incredibly difficult market to get your head around, given the fact that you potentially have an inflationary shock. You're seeing earnings hold in and actually increase. In other words, in the U.S., the consumer is still strong, and yet we don't know the second-order effects. You're starting to hear about them on the margins. Right now, at least if you listen to the likes of Goldman Sachs, J.P. Morgan, TD Securities, and many others, it is a time to buy bonds because ultimately we have overpriced the inflationary shock long term. Question is, what gives anyone certainty of exactly where we are at such quickly moving news as well as markets?
It's another Monday morning confronting escalation risks. Several stories over the weekend, just unnerving, rattling some investors. This from the Washington Post, the Pentagon preparing for weeks of ground operations in Iran. I believe the Journal discussing a special control, ground operation, maybe Cargill, and the president gave a nod to that over the weekend. This is where things get even harder.
It does get even harder because while there were discussions over the weekend in Islamabad with a number of countries that want to act as mediaries to try to bring this to a halt, and the president said maybe there'd be a deal, the Iranians saying no. And they were even saying they weren't really represented in these discussions. And then you have all of these reports, Wall Street Journal talking about potentially a special force to go in and seize the uranium, Washington Post talking about maybe more troops on the ground, and at the same time, the president to the Financial Times saying, I want to take the oil, which would maybe be going through Cargill Island, where 9 out of 10 every Iranian barrels goes through.
Multiples have compressed. We've had a decent correction on the NASDAQ 100. Other stocks, single names, some big moves on the likes of Microsoft and Meta. That's been building now for months. This from Stuart Kaiser. Do you want to buy the dip? We are not dip buyers yet. Negotiations show no visible progress, and next escalation steps are very worrying.
We have no idea of the downside risk. Potentially, the sky's the limit when it comes to some of these oil prices. We've heard $200 thrown around. We're hearing about physical shortages in Asia. You can come up with a really gloom and doom scenario. The knee-jerk reaction on Wall Street to look through geopolitical risk has not worked for the past 5 weeks. At what point do we have a sense that you can go back to that buy the dip moment, given the fact that we do not see a pathway out of this?
Brent crude at 115, higher this morning by a little more than 2%. Coming up this hour, we'll catch up with Vinu Krishna of Barclays as crude climbs higher, Clayton Siegel of CSIS as the Middle East war widens, and Ed Hosseini of Columbia Threadneedle as markets price in lower growth. We begin this out with stocks pairing losses as crude hovers near 115. Vinu Krishna of Barclays raising his 26 S&P target to 7650, writing, we are incrementally bullish on US equities. The macro regime has turned messier, but not hostile. Vinu joins us now for more. Vinu, good morning.
Good morning.
This is a really interesting note that you put out, and thanks for making some time for us this morning. What a moment to raise your price target on the S&P 500. Where's that confidence coming from?
You know, every year we assess our numbers after towards the end of the first quarter, when you have the full year, the previous year behind us, the fourth quarter earnings momentum, and that was a process. So while I fully recognize that the macro environment has become more fragile, but we are approaching it from a fundamental perspective. And the news over there is that earnings momentum has actually improved quite significantly. And we ended last year in a much better position than even what we thought. Earnings growth of over 14%. And this year, we're expecting that to accelerate 15-16%. Of course, the caveat is that the base case is that this war, which has come out of the blue, does get resolved in the next few months. If that goes out of the window, clearly we have a downside case where S&P we see going down to 5,900.
Messy and not hostile. A few months separates one versus the other. So if we're 2 months into this and these price moves continue, even then, you'd be bullish on this market. That's curious. I'm interested by that you wouldn't take down your earnings expectations even if we got another month, 6 weeks of this.
Not yet, right? At least we would wait for this quarter's guidance to come through. Let's see what companies are saying. Everything we're seeing on the ground is that the momentum is significantly to the right rather than the left. But I do recognize, like I said, that the left tail risk has become much fatter, mainly because of this one event risk. But while we can brush aside that, that the market is looking past geopolitical risk, and we have pointed that out, the reality is in the last decade, every geopolitical risk event has been resolved in a reasonably decent time frame, and it has been contained. Now, the risk right now is that it is not contained. In the Middle East, it's gone to Saudi Arabia, UAE, Kuwait, Bahrain, Oman. So I think that risk is real right now. But again, the core belief is that we're already in the early stages of negotiations, right? Obviously, the two sides are wide apart. And the single biggest threat to the global markets right now is the control of the Strait of Hormuz, right? And we have to figure out how that gets resolved. There has to be a give and take on both sides. One side is extremely weak, has its back against the wall, but they have a trump card in the Strait of Hormuz.
There are a lot of people who would agree with you, including Mike Wilson over at Morgan Stanley. There is, though, a shift in the dynamic when it comes to inflation and the rate backdrop when you talk about the oil price shock. If you do have companies that are continuing to raise their earnings expectations on the heels of a strong consumer, Don't multiples get compressed just by virtue of the fact that rates have to be a whole lot higher?
Multiples have already compressed quite significantly. I mean, I give you the example. S&P is trading below 20 right now, right? If you look at big tech, we were trading at 31 times last year, beginning of last year, ended last year at 28. Now we're at 23 and change. Same thing with the rest of technology sector. So multiples have already adjusted primarily to factor in what you're saying about the uncertainty about how this plays out. It's the earnings which have not, and they will react, in all fairness, if things go really bad. But we're not there yet. We're not seeing that yet.
I guess another way to ask the same thing is, are we underpricing the risk of true inflation that has a prolonged presence in the system if the economy is that much more resilient than people currently are expecting?
You know, inflation risk is already being priced by the rates market. That's why you're seeing the yield curve flatten quite significantly. The front end is up. You know, so I think we take a step back and say, what if, to your point, if oil stays, let's say, 100 or above for an extended period of time? And then it's a mixed bag in the sense that there are certain sectors that actually benefit. Clearly, energy, materials, partly industrials are able to pass on price. But the single biggest negatively impacted area is the consumer-facing segments, staples and discretionary. So I think it all boils down to how bad the situation gets, how long it persists, and that will tell you what the implication on inflation is. It's not just inflation. We are not factoring in the impact of growth as yet. So in the worst case, it's not just inflation, it's growth. It means your curve can actually get inverted. And we are looking at the 5,900 situation. So what I would say, the tail has become fatter, the probability has increased, but still, if you look at our base and upside case, that is still our dominant view that this will get resolved.
Your bear case, what would oil have to be to get there?
We are factoring in roughly $100 of oil, and that
Why do you think it's not going to be $100 in the next few months? There's a lot of
it's already
changes.
there. It's already there.
Yeah.
Our view is that this is not going to be sustained. If you look at the forward oil curve, that's telling you that this is not sustained. If I look at our own oil analysts, they also expect things to be lower down the line, right? We're talking about 6 to 9 months. So I think therein lies a risk in the sense that the market and the analysts, experts in the area, are factoring in some sort of a resolution. But listen, all bets are off if you're talking about 150 or higher oil price for a sustained period of time. That is the single biggest unknown. And unfortunately, I would say nobody, absolutely nobody has a clue as how this plays out.
This is the Middle East. That's that story down with. Let's look through that. You're looking through that. There's more to this market than just the Middle East right now. And a lot of the problems in this market predate the start of this war, particularly in tech. Microsoft has lost 30% of its value since the highs of late last year. The Nasdaq's down by 10%. Meta last week got hammered, down 11%. That had absolutely nothing to do with what's happening in the Middle East. Can I get your reflections on that? What's the driving force behind big tech, and where does the leadership come from?
Sure. So I think big tech is one of the most interesting conundrums right now, in the sense that on their earnings front, it's extremely robust. Even in fourth quarter, by the way, over 28%. So, and the rest of tech, outside that, over 22%. So that is tremendous number. What's happening is the market is clearly focusing on the scale of capital spending. If I looked at our own numbers on what we thought the hyperscalers are going to spend, in December we expected them to spend $550 billion in 26. Now we're saying about $715 billion, right? So we're talking about 30-40% increase in capital spending. The biggest uncertainty now is how long are they going to keep spending? Our internet analysts believe that the peak is going to be in 28 and significantly higher than where the market is, right? And I think that is where the problem is. The free cash flow yield has come down. The tech companies are insisting it's an investment in a transformative technology which is going to change the world. The market is a little wary as to how long this is going to happen, and is it going to be a permanently capital-intensive business? And that's why, as the free cash flow yield has come down, the multiples are adjusting from 31 to 28 to 23 right now. And that's the reason why we actually like that area, to the extent that the rate of earnings growth is significantly faster than the rate at which the multiple is compressing. You will have solid returns. You saw that last year. They, as a group, big tech, returned 23%. S&P returned 18%.
Does it make sense to you that you potentially have a sell-off in these names for investing too much, and a sell-off in names that are all going to get disrupted by all the cool things that they create with all of this money?
That is inconsistency, right? How can you have both at the same time? On one hand, you're saying this is the biggest technology and this is most transformative and the whole world is going to benefit, but they've been penalizing them. I think it's the disruption risk. Nobody knows who within software is going to survive, whether it's SaaS, whether it's security, which models in AI are going to happen. You can certainly expect some massive capital misallocation as well, but they're going to be huge winners and losers. I think it's not clear right now who they are. And we will stay in this limbo. But I like the setup where if your core earnings are still strong and your multiple is coming down, you're effectively now at a PEG ratio, which is less than 1. I love it.
The key call here, though, is do you think the CapEx ramp-up continues, even as the market pushes back?
Yes.
That's quite a big call.
The CapEx will continue because, one, we are still in the sort of early to mid stages of this technology's development. Two, these companies have very robust profitability. By the way, in fourth quarter, their overall profitability increased by 150 basis points on 28% plus growth. They're borrowing money from the credit markets. It's minuscule compared to the overall capital structure. It is multiple times oversubscribed and trading significantly tighter than where the IG index is even now. So I think the capital is there. They'll continue to spend because they're scared to be left behind. And therein lies some of the risk of capital misallocation between them. But we have no doubt that this is the future. And you'll see some big IPOs also this year. And we'll see where the dust settles. We like the setup.
The chip makers hope you're right. Let's put it that way. Vinay, it's good to see you. Thank you, sir. Vinay Krishna there of Barclays with a new call on this equity market, getting more bullish as the weeks go by.
I feel like we should have a new slogan for 2026. Nobody knows nothing, because ultimately we don't understand the parameters, and so everyone's trying to figure out what puzzle they can solve and then say, well, all bets are off if we're wrong on the parameters.
I said last week when the note came out, by the way, I appreciate the boldness.
I love it.
I really do. When people are just sat there paralyzed and don't know what to say, I appreciate the conviction.
It's good scenario analysis, fat tails, sure, but scenario analysis nonetheless that shows the strong position of a lot of companies.
76.50, almost consensus just several months ago, and now very, very bullish.
Yeah, earlier we were considered to be on the low end, right? And all we did was, by the way, this was in the works. I didn't raise it that particular day.
Yeah.
We had the numbers a week before. When we went to 321, we were $4 or $5 ahead of consensus. The first time in 5 years I was ever ahead of consensus. Now consensus is ahead of me. It's 323 from 307. So that trajectory is crazy. And by the way, I think the interesting thing to note, I forgot to mention, is that for the first time in a long, long time, by this time typically consensus goes down 150 basis points. Now we're up 400 basis points. That's the 550 basis point delta, right? How do you explain that?
Vinay, it's good to see you. Thanks for being here. Appreciate it, buddy. Stocks up by 0.5% on the S&P with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump says he's ready to make a deal with Iran. Speaking to reporters on Air Force One, the president saying Iran is giving the U.S. most of the demands from its 15-point peace plan. Iran still disputing Trump's claims about negotiations. An Iranian missile strike on a base in Saudi Arabia, damaging several military jets and destroyed a valuable E-3 jet. Sources telling us here at Bloomberg the $300 million plane was hit in an attack on Prince Sultan Air Base in recent days. And the Spanish government announcing it's closing the country's airspace and bases to U.S. planes carrying out missions in Iran. Spanish newspaper El País reporting that the country is only allowing the transit or landing of planes in cases of emergency. That's your Bloomberg brief. John?
Yahira, thank you. Thank you for the update. Up next on the program, navigating negotiations.
They're being hit so hard, anybody would be negotiating. They are negotiating. They're begging to make a deal. They have to open it up. They have to open up the Strait of Hormuz.
Up next, we'll catch up with Henrietta Trays of Veda Partners, live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, now for a full hour, only on Bloomberg Television.
At the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. The worst week on the S&P 500 since October. On the Nasdaq 100, the worst week since April of last year. That's just last week. This is the bounce this morning, up by 0.5% on the S&P. On the Nasdaq, up by 0.5% also. In the bond market, yields down across the curve. We're down by about 5 basis points on the 10-year this morning, 4.38, with crude still higher, just short of 115 right now on Brent crude.
Yeah, people looking at this as potentially a growth shock if it goes on for a long period of time. We've heard from a number of different executives, including the airlines, that should this continue, they're going to increase prices and they're expecting some kind of consumer demand pushback. That said, we don't have a sense of that. So it's basically people throwing darts at a dartboard to understand what the parameters of this conflict are.
Another Monday morning of doing just that with Brent crude at 114.60. Under surveillance this morning, navigating negotiations.
They're being hit so hard, anybody would be negotiating. They are negotiating. They're begging to make a deal. They have to open it up. They have to open up the Strait of Hormuz. When this war ends, it's going to be like a rocket ship. I thought oil prices were going to go up higher than they are now. I thought that we would see a bigger drop in stock. Hasn't been that bad.
So here's the latest this morning. The war in the Middle East at its 5th week with no end in sight. Anne-Marie, this is the escalation over the weekend. Iran-backed Houthi militants entering the conflict. At the same time, more U.S. troops arrive in the region.
A lot of individuals in the energy world, they were saying that this would be a serious escalation and a serious risk for oil prices. How much higher could they go if you then introduce another choke point that basically gets cut off? And that's the Red Sea, that's the Bab el-Mandeb Strait. We saw that in 2023. Do you remember all those ships started to avoid the Red Sea because of the Houthis? We could be in a place like that once again. And we should remind everyone, even though U.S. Maritime and you had the UK Navy was there, the British Navy was there as well, it took minimum 6 months for a lot of these ships to agree to even touch the Red Sea once again and go back through there. So this potentially could be a massive risk, not just when it comes to maritime safety, but also energy prices.
In some ways, it's surprising that crude's not higher than it is this morning. The paper market, once again, speaking to the disconnect that so many people are talking about between physical and what's happening in financial markets.
We don't really have a sense of exactly how much physical damage has been done and how long it's going to take to restart some of the production facilities. Also unclear exactly how much of a Band-Aid some of the SPR releases, as well as the Iranian and Russian crude that's been unsanctioned, has really been to cap some of those prices.
This is the take from Henrietta Trays of Vader Partners. She writes the following: there remains no end in sight to the war, and ceasefire negotiations are leagues away from reaching an agreement. Henrietta joins us now for more. Henrietta, welcome to the program. How much support is there for this operation on Capitol Hill?
I think that's the perfect question when you're trying to put parameters around the realm of the possible here. Lawmakers are gone. They went on recess. They'll be gone until mid-April, and at that point, they still have to deal with a whole host of other issues, from the Warsh nomination to reopening DHS, which is on day 45 or whatever of a government shutdown. The disconnect that I see most prominently is that the market is focused on the war so intently, on oil and gas prices, on the impact to inflation, and lawmakers are gone. So when you talk to members, it's plain that the president has absolutely no pushback politically from his conference or no meaningful pushback that's organized from the Democratic conference to force a political end. And I'm just trying to suss out from staff and members where their pain points are. And it's really $5 gasoline. It's not $4 anymore. So we're at $3.99, I think, right now.
Yep.
It's not the $4 point that's the inflection metric. It's $5 post the Arab Spring and post pandemic. And really, they have the latitude that they need to perpetuate this war into June, based on my conversations.
Henrietta, it is shocking but not surprising that lawmakers decided to go on their break. Meanwhile, they've caused havoc in terms of TSA agents not getting paid. And on top of that, we are in the middle of a war. And there's a $200 billion request from the administration for Congress to take up. Where does that stand?
I think those are really strong indicators that we are going to perpetuate this war first and foremost. You know, never mind the fact that thousands of Marines have now landed and are in the region ready to be deployed at the president's direction. But the president and Secretary of Defense Hegseth have requested $200 billion. Over the last maybe 5 or 6 days, you've seen the Budget Committee chairman spring into action. Lindsey Graham on the Senate side and Jody Arrington on the House side saying, we're going to get you reconciliation. On April 3rd, the White House will lay out its budget request. That will kickstart the process, and then Republicans will be off to the races to give the president whatever he needs on both the military side, but also on domestic discretionary spending, consumer fiscal spend, stimulus to get the American public through the war for as long as it will take. So in my experience, we don't pass reconciliation bills that are less than $700 billion.
Well, what kind of fiscal stimulus could they do? Again? What kind of fiscal stimulus is Congress able to do?
There's a couple different things that they could do. The first would be suspend the federal gas tax. That's going to be an 18.4% reduction or cent reduction in the gasoline price, 24.4 on the diesel side. Those are immediate term actions that Congress could do via the tax code that would work under reconciliation. And the rest is going to be on the spend side, from $200 billion to defense, money for Venezuela, money for Pell Grants for farmers. There's going to need to be another $15 billion bailout. And then they could see if they want to extend or expand any of the One Big Beautiful Bill tax cuts. Those benefits that they passed in July of last year have been wiped out per the Bloomberg analysis. After $83 a barrel, you've wiped out the whole stimulus from the One Big Beautiful Bill. So we're well past that.
Henrietta, always good to catch up and great to hear from you. Henrietta Trace there of Vader Partners. There is a dangerous military conflict undergoing in the Middle East right now. The president at the moment is conducting a lot of this. The support, though, has come from a senator in South Carolina. The airports are a mess in this country, and the senator from South Carolina has been seen at Disney World.
Yes, that's what TMZ, and they have photos of him saying basically had a great convo with Mickey Mouse, and he was at one of these character breakfasts. I guess he's on vacation in Disney World, and there is going to be a tremendous amount of pushback on all of them for leaving town at this time right now. Again, it is shocking, but it's not surprising.
The optics of that are just absolutely horrendous, aren't they?
The optics of people leaving Washington, D.C. to go on vacation while TSA agents are not being paid and people are waiting on 3-4 hour lines to go on their vacations doesn't scream of competency on any level. What we were just hearing from Henrietta Trace there, the only thing that they can pass is a reconciliation bill with more money to be spent to try to pay off people to make them feel a little bit better for some of the circumstances that have transpired. It is incredibly difficult to see how popularity of this Congress could get any worse.
I know, we talked about this just last week. I wish they'd stop seeing this as Democrats versus Republicans. This is not about Democrats versus Republicans. This is about Congress doing their job to help this country function.
And to build on that, how much does this hurt both parties significantly and make both parties more radical, frankly? Because everyone on either side is going to say, I want someone to go in there and rip the Band-Aid off and make a change. And usually that comes with more radical policies, which is pressuring both sides to the polls.
Sometimes it's nice just to talk about markets, isn't it?
I completely agree.
Equity futures positive by 0.6%. Up next on the program, we'll catch up with Clayton Siegel of CSIS as Brent crude heads for a record month of gains. From New York City, you're watching Bloomberg TV.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The Jan report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
A statement from the president just a moment ago. Allow me to read through it. It dropped just minutes ago. The United States of America is in serious discussions with a new and more reasonable regime to end our military operations in Iran. The president going on to say great progress has been made, but if for any reason a deal is not shortly reached, which it probably will be, and for any reason it won't be, if the Hormuz Strait is not immediately open for business, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island, and in brackets, possibly all desalination plants, which we have purposely not yet touched. This will be in the retribution for our many soldiers and others that Iran has butchered and killed over the old regime's 40-year reign of terror. That from the president just moments ago.
He's clearly negotiating at the moment, negotiating out loud. He's talking about maybe, like he said yesterday to reporters on Air Force One, maybe there is going to be a potential deal. He also was talking about the fact that he is dealing with a, quote, more reasonable regime. I think it's important to remember the regime hasn't changed. It is still intact. It was just new individuals that are now rising to the top. Does the president think he can really deal with the foreign minister, who his team dealt with on the last go-around, and the Speaker of the Parliament, Mohammed Ghalibaf, who he mentioned as well in the Financial Times? I think that remains to be seen, because right now Iran says they are not open to this negotiation.
If you're in this market, what do you do with that statement? Equity futures briefly at a new session highs up by 0.7% on the S&P. Does that move this story forward at all?
If you believe that there truly are negotiations and a deal will probably be reached, maybe you could see this as bullish. If you feel like this is potentially leverage increasing at a time where it's unclear exactly what the nodes of leverage actually are, it leads to even greater escalation risk if you start attacking some of the key infrastructure for civilians. So you could take it either way. Question that I have is, why is this market really trading on the idea that the deal will probably be reached, according to the latest post from President Trump?
So let's roll through the boards. Let's start with equities. We'll start with equity futures. We'll turn to bonds and finish on crude. Equity futures near session highs up by 0.6% off the back of this. On the Russell up by 0.7. Yields near session lows down by about 6 basis points on a 10-year, 4.37. And in the commodity market, crude higher by a little more than 2%, holding on to those levels at 115. So crude has barely moved off the back of this statement from the president just moments ago.
Crude is looking at the physical market, they're looking at the actual destruction, and they're looking at a very different calculus than some of the other markets. It seems like the taco trade is still what everybody wants to lean on. People want to essentially go back and buy the dip. Just really, I'm not sure where this leaves us, given the fact that this does also, if you take him at its word, increase the risk of escalation.
At the same time, to this point, the oil market potentially is, this is the boy that cried wolf. How many times have we heard this president say, if you don't open up the Strait of Hormuz, I will do this, and then he kicks the can down the road, and we have a new deadline and new threats. Earlier this morning, before the president's Truth Social, Iran's foreign ministry had this to say. They said the U.S. demands for the end of the war are, quote, excessive and illogical. They also went on to say we had never had any direct negotiation with the United States, which has been raised, our messages received through intermediaries, indicating the U.S.'s desire to negotiate. It does not sound like the Iranians want to participate at this moment with having that engagement with the United States to potentially have an off-ramp from this war.
Equities up by 0.6%. Let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. Starting with the aluminum companies this morning after seeing some attacks on aluminum production facilities in the Middle East by Iran. Both Alcoa and Century Aluminum have actually been down since the start of the war, but with new threats of supply constraints as the price of aluminum itself moves higher, these stocks are up by more than 9% this morning. Elsewhere, a little bit of sell-side action. Jefferies upgrading both Expedia and Instacart, saying that the internet names that have sold off with the AI fears have been overdone, specifically pointing out companies like Expedia saying they're going to benefit from AI. They're adopting more tools. It's a buy at this moment, considering how much it sold off. Those shares up 2.3%. Finally, a little bit of deal news. Cisco, one of the largest distributors of food goods to restaurants, hospitals, various businesses, is buying in a $29 billion deal. Restaurant Depot, they're a cash and carry business for distributing foods and supplies to restaurants. Cisco, it's the acquirer. You tend to see them fall because of digestion of such a big deal. Those shares off 4.7% in the pre-market, John.
Hey, Danny, thanks for the update. More from Danny in the next hour. On our radar this morning, President Donald Trump considering a high-stakes military operation to seize nearly 1,000 pounds of uranium from Iran. The Wall Street Journal reporting the plan would involve putting U.S. troops inside the country. Elsewhere, the Senate Banking Committee is planning to hold a confirmation hearing for Federal Reserve Chair nominee Kevin Warsh. Punchbowl reporting it could take place the week of April 13th. And finally, TSA agents set to receive paychecks today following President Trump's emergency order. Agents working without pay since DHS funding lapsed in February. Airports still urging travelers to arrive hours early to get through security lines. And that is your radar this morning. This is our top story from the president just moments ago. The US of A is in serious discussions with a new and more reasonable regime to end our military operations in Iran. The president saying we're making so-called great progress. But if we don't make progress, if we can't make a deal to open the Strait of Hormuz, in this statement from the president this morning is a long list of threats.
Yep, a long list of threats of what they plan to potentially go after. Desalination plants, some energy facilities across the country. Another threat for the president to want Iranians to open up the Strait of Hormuz. Even if the Iranians were willing to open up the Strait of Hormuz today, and remember, it technically is open, it is just controlled, a new precedent has been set. The Iranians have basically said it is never going back to normal, and we will continue now to collect fees. There is now a Tehran toll. In order to pass go, in order to get your cargo through, you are going to have to pay this regime a lot of money, and that seems to be the direction of travel when it comes to what is going on in what is an international body of water.
This is the escalation threat that's lingered over this market now for more than a week. This is the threat that they will go even further, obliterate their electric generating plants, oil wells in Karg Island, and possibly desalination plants. Now, that would be hugely controversial because that would hit civilians, and you'd have to worry about retaliation across the region as well, which I imagine makes Gulf partners very nervous at the same time.
We could already feel that, and they've already communicated that. Desalination plants, this could turn into a war over water, which is more severe than a war over oil, and that is clearly what a lot of people are concerned about. When you take a step back, you look at whether President Trump can solve this quickly, right? I mean, I'm just going back to the way that the market is sort of breathing a sigh of relief on this, given the fact that maybe this brings some sort of finish to this. It's hard for the physical market to see that sort of progress, given the fact that this is a very different set of circumstances. And it's hard to know who you're dealing with. I mean, can you de-escalate by escalating, given some of the parties involved?
Joining us now to discuss is Clayton Siegel of CSIS. Clayton, welcome to the program. I'm sure you've heard the statement from the president out just moments ago. What's your reaction to it? How are we meant to read into that particular statement from the president?
Hey, good morning, Jonathan. I would say today's messaging is rather escalatory. And I think, as you pointed out, there's really two big concerns here. Number one, we're supposed to be coming ostensibly to the rescue of the Iranian people and trying to loosen the shackles of this oppressive regime. So by destroying Harg Island, by destroying desalination facilities and other critical infrastructure, this would really be doing the people of Iran a terrible disservice once this regime is gone and out of the way. And the second thing, as you pointed out, is the risk of much more severe retaliation than we've seen so far against the Gulf countries that neighbor Iran and even against other critical infrastructure and supplies. I guess I'm not surprised to see the president looking for ways to lever up against Iran, because this new control over the Strait of Hormuz and the Mideast Gulf generally is, as you guys have said this morning, kind of the new normal. And it doesn't look like Iran is liable to cede that new leverage anytime soon. It's going to stick with it. It's going to leverage it in negotiations with all kinds of counterparties. And so no surprise that in Washington they're looking for ways to maybe level the playing field and get an edge if there are going to be meaningful negotiations.
Clayton, to that point, this is a signal that a lot of people are taking, that Washington is looking for a way into a true negotiation that can bring a sooner end to this. Do you see any way for the United States to get an angle to expedite some of those negotiations?
I think that the path to negotiations is open. It's either they're already taking place, as the president has asserted several times recently, or I think that door probably is open, even with the people that are running the regime in Iran, who are, by all indications, more hardline than the previous group that was in control before the wave of assassinations. With that said, yeah, the door is always open to some kind of negotiations, but the question in any market is whether the two sides can come together. You know, what's really the gap between the two. It looks kind of unbridgeable right now, but you never know until the sides get to real talking. So I think that the diplomatic process is where this is eventually going to go, and what markets are trying to price is how much carnage to supply chains and how much of a cascading effect through the macroeconomy is likely before we get there.
Do you think that the market is still underpricing just how high oil prices are going to remain, not necessarily now, but in 6 months, 9 months, and 12 months' time?
I do. I believe that the paper markets, futures, et cetera, are a little bit sanguine, I would say, to use the fancy terms. It looks like they are still expecting a relatively soon resolution, early resolution to the crisis that would resolve this big supply disruption. But we're going to be contending with the supply disruption even if everything ends today. And so depending on the math you use for how much Saudi Arabia and United Arab Emirates have been able to bypass the strait and get some oil out through the Gulf area, and maybe how much is coming just in a trickle from Iran, you're still looking at a disruption that's been somewhere around, on the low end, 10 million barrels per day for the past month, 3 or 4 weeks. So 200, 300 million barrels is going to be missing from global supply-demand balances going forward. It's going to hit, first of all, in those markets in Asia, and then it's likely to proliferate throughout buying regions in the world. That's got to eventually be reflected in higher prices, which, as y'all have pointed out this morning, have already been manifest in the physical market, what people are really paying for and selling for wet barrels of oil. It just hasn't translated into the futures market because a lot of traders, maybe non-commercials, are expecting an early resolution.
Clayton, how much of a direct threat are Saudi Arabian barrels in the Red Sea right now?
Well, they're under greater threat this morning than they were this time last week because the Houthi militia in Yemen has joined the war. It started in a relatively modest way by firing, I think, a couple, 3 missiles in the direction of Israel, which were intercepted. But the big threat here to oil markets and to the macroeconomy generally is that the west coast of Saudi Arabia, along the Red Sea, where some oil exports have been able to be diverted and still get to market, that could even be in jeopardy if the Houthis get back to their old tricks, which was disrupting commercial shipping in a big way in the Red Sea after November of 2023. So that's the big risk there, is that last kind of escape hatch for at least a limited amount of oil going to world markets could be in jeopardy.
What kind of impact on prices would that mean if we have both these two choke points basically closed?
Well, you would lose another, let's say, 4-ish million barrels per day that's been able to make it to market up until now, and then you'd get the Gulf exports really back to almost the full disruption. Let's say 15 million barrels a day of crude, another 5-ish of refined products. Prices have to move higher in that case, and I feel like a lot of folks are maybe downplaying the extent to which prices would have to increase in order to balance the market. If you just had to take like 8 million barrels a day of demand off, then you're looking at basically like COVID era 2020 type reductions in use of fuel and other oil derivatives, and so you're really looking at kind of a massive slowdown in economic output.
That is
so
massive
that's
demand
the
destruction.
market's last mechanism to balance when you get to those high prices.
Hey, Clayton, it's good to hear from you. Thanks for making time for us. Clayton Siegel there of CSIS. We've said it repeatedly over the last week. Two-way risk. This can go one way or the other, and they are in very different directions if we go in either. The United States of America is in serious discussions with a new and more reasonable regime. Great progress has been made. Then there's a major but. If for any reason a deal is not shortly reached, we will obliterate all of their electric generating plants, oil wells, and Carg Island, and possibly desalination plants.
The reason why this is concerning to the likes of Clayton is that in the past, Iran's response to this is, you strike us, we strike other regional countries that much harder, and we will attack their civilian infrastructure. That is the red line for Saudi Arabia and UAE, and the reason why this could escalate into something much larger.
And those countries have already seen this when it comes to energy facilities, when it comes to civilian infrastructure. Look at what's going on in some of these aluminum smelters, which immediately moved the market prices. But the president this morning is at least verbally escalating in attempt to de-escalate. Come to the table or this will happen. I think the market is just trying to really digest how serious he is in this moment, or potentially would he give the Iranians a little bit more time down the road.
Brent crude 115, WTI 101. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. As you all were discussing, President Trump with a new statement on the status of talks with Iran, writing that the U.S. has seen great progress in discussions with a new, more reasonable regime, but threatening to destroy Iran's key energy sites if a deal is not shortly reached to reopen the Strait of Hormuz. China's Xiaomi delivering more than 4,000 of its new SU7 electric sedans in its first week of sales. The company's CEO setting a goal of delivering 550,000 cars this year, a 34% increase from last year. And Apollo is looking south for a possible second U.S. headquarters. According to the Financial Times, the asset manager is considering a new location in several cities, including Austin, Nashville, or in South Florida. That's your Bloomberg Brief, John.
Yahira, thank you. Appreciate the update. Up next on the program, Fed policy on pause.
Everyone realizes that a policy response doesn't help get ships faster through the strait. A policy response doesn't help really offset demand destruction. The Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
Up next on the show, Ed Al-Husseini of Columbia Threadneedle from New York City this morning. Good morning. You're watching Bloomberg Surveillance.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Where did you get the idea for Play-Doh?
My one son was playing with a mound of Play-Doh, and he said, "Dad, voila." And I thought, this is what I'm trying to do every day, to make something that you can't make a judgment about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
A new statement from the president out a little bit earlier on this morning. It reads as follows: the United States of America in serious discussions with a new, more reasonable regime. He calls it great progress in the talks so far, but if we don't reach a deal, this is the threat: to obliterate all of their electric generating plants, oil wells and Carg Island, and possibly also desalination plants.
That would be a real escalation that would lead to retaliation from Iran, attacks on other civilian infrastructure. There is a real question here. Does this indicate that they are closer to talks, or does this indicate there is another deadline coming up that we need to pay attention to?
It's a new era for financial markets. These statements just don't move the dial at all. You had an initial spike in equities, and since then we're where we were, up by about 0.6% on the S&P. Similar story in the bond market, yields still lower by 5 basis points on 10s, and in the commodity market still around 115. There was a time, maybe a week ago, when that kind of statement made a big difference, at least for a few hours, not even a few minutes anymore.
It initially was treated as signal, now it's treated as noise, because ultimately you've got both sides trying to jawbone the market into moving in a certain direction, and people are watching other things right now, like the physical market, like other potential nodes of progress.
So where does it leave the Federal Reserve? Under surveillance this morning, Fed policy on pause.
Everyone realizes that a policy response doesn't help get ships faster through the strait. A policy response doesn't help really offset demand destruction. If oil goes to $150 a barrel, right, there is an element of demand destruction, and a policy response doesn't help with that. So I don't think the market is counting on that. The Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
So here's the latest this morning. Fed Chair Jay Powell speaking at 10:30 Eastern Time. Traders looking for insight as higher crude prices increase the odds of an economic slowdown. Ed Al-Husseini of Columbia Threadneedle writing, it's in the Fed's interest to keep markets on edge. Doubt is their most powerful tool to keep inflation in check. Ed joins us now for more. Ed, good morning.
Good morning.
Is that how you describe this then? The first phase is a big communication push.
I think that's right. You want to create the permission structure for markets to price tight monetary policy up front. Then as we see inflation, as we see growth develop later this year, I think it opens up room for cuts. But the initial stage, you want to make sure that markets feel that the Fed's responding with sort of a whatever it takes posture.
How do you price that sequencing through this yield curve?
I think we've done a good amount of work. We've taken out about 2.5 cuts. We've taken that pricing to roughly neutral, maybe half a hike in the price. We've flattened the curve, right? If anything, in the extreme, if this conflict continues, we could invert the curve. And that would be very consistent with the Fed tightening policy in the background to make sure there are no second round effects from this.
So then how do you understand the back end of the yield curve, the 10-year, the 30-year, and the fact that yields have moved higher? Is this a lack of credibility that the market has that they truly can contain inflation?
I think the answer is twofold. One, not yet. Most of the repricing has been real rates. So it's been a tightening of policy. It's been a tightening of posture. The initial reaction to me is a couple of things. One, there's some technicals behind this. The market was positioned for cuts. It was positioned for a steeper curve at the end of February. We've unwound all of that. We haven't had time to price in the hit to growth in the labor market yet. I think it's starting to get a look now as we get, 30-year yields to 5%, 10-year yields to 4.5%. Those things start to become more durable ceilings. But I think the key question for an investor today is, which part of the curve is overshot? Is it the longer end of the curve or the front end? And I think I put a lot more chips on that longer end of the curve.
So you believe it's going to be a greater growth shock than people previously expected. I'm just wondering how the fiscal lever plays into this, given the fact that the previous declines in growth have been met with huge fiscal responses. And we see a similar type of impulse coming right now, at least in the rhetoric from Congress.
Absolutely. So that's a little bit of a wild card right now. The fiscal posture right now in the background is roughly neutral. Not a lot going on. It's a little bit more accommodative in China, in Japan, in Germany. To the extent that there is room to really ramp up fiscal stimulus the way we did after COVID, I think that room is a lot tighter. I think Congress has learned the fact that, look, you really need a different rate environment. You really need a different growth environment to drop stimulus into the economy without facing significant consequences. So I'm seeing a little bit of adjustment on the margin, gasoline taxes and the like. But large fiscal stimulus so far is not part of the picture. But that's a massive risk for bond investors.
Is there a bond market you're worried about? I looked at Japan, highest yields across some tenors since the late 1990s, the UK since 2008, Germany since 2011. Is there a market you're more concerned about versus others?
I think some of the volatility you see in UK rates, for sure, is symptomatic of the fact that, look, there's very little capacity for that market to absorb additional supply. That's one. Two, a lot of the participants of that market are leveraged hedge funds. They move their positions around very quickly. You see that in the rate volatility. But if I zoom out, I would be most worried about emerging markets, particularly local currency emerging markets. This has put significant pressure on them, both directly through the inflation oil shock and indirectly through a stronger dollar. So to the extent that emerging markets were a real sweet spot last year, a really nice runway for cuts, that's gone, and a lot of them will have to tighten policy pretty significantly. So from a growth perspective, that feeds back in a nasty way.
That is just brutal. They don't get just hit once, they get hit twice, maybe 3 times.
And how many people were positioned for emerging markets to outperform heading into this year? They thought that they would benefit from the tailwind of global growth continuing to expand and potentially at a faster pace, the rest of the world outperforming the U.S. How much things have been completely turned on their heads in just 1 month?
Forgive me for shorting this down to about 30 seconds. That's all I've got. Do you think there's an underappreciation still this morning about energy rationing in EM and the hit to growth we're about to see?
Yeah, absolutely. Absolutely. We're starting to see that in Asia, particularly in East and South Asia. That's starting to play through in the physical markets. It's the place where manufacturing is concentrated and so most sensitive to the inflation and the energy shock story.
Ed, thanks for making time for us. Appreciate it. Lots to think about. Ed Al-Husseini there of Columbia Threadneedle on emerging markets and the pain that they're in right now, the hit through energy, the hit through foreign exchange, and the hit through rates.
Yeah, and the hit through having to wait online to get oil because you are seeing a physical shortage in a lot of these countries.
Up next on the program, we'll catch up with Judy Bill of Kane Anderson Rudnick, Neil Mehta of Goldman Sachs, Nancy Lazare of Piper Sandler, Ed Yardeni of Yardeni Research. The third hour of Bloomberg Surveillance up next.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
You know, investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every Wednesday at noon Eastern, only on Bloomberg Television.
Next week on Leaders with me, Francine Lacqua. I speak to George Alhedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
In case you missed it, on Bloomberg Crypto.
Crypto has had this terrible, horrible, no good, very bad 2026 ever since the events of October 10th. What do you chalk up this weakness to, this volatility to?
Well, I think there's a lot of structural pressure on Bitcoin that's been happening after 1010. It's just a change of who's holding Bitcoin, and you're moving from people who had long-term belief and were holding Bitcoin directly to just access to Bitcoin being wired up to our financial system and markets in ways that didn't happen before. So the combination of what happened on 1010 plus the mix shift change of who's holding changes the dynamic of price action. This is not a short-term market play. You have to have long-term belief and vision, and I think that for those people who have that long-term belief, they'll be fine.
Don't miss the next Bloomberg Crypto.
When it matters, investors turn to Bloomberg Surveillance.
I said it maybe even on your show here.
I hear you guys talking about this a lot.
Our investors are really thoughtful. They're engaged. They listen to your show.
As a number of people you've had on your show have mentioned.
The three of us have talked about it on this show many times.
I think you find, and you've heard this on your show.
We've already talked this morning on your show, as you know, and you cover every day on Bloomberg.
You've heard a lot of guests talk about that.
I think your show is incredible.
Bloomberg Surveillance, we're talking about it.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
The level of uncertainty is extremely high.
Things seem to be in a free fall. You don't want to catch a falling knife. Equity markets and markets generally are resilient.
We still see a compelling stock or equity story ahead.
It's just so difficult to determine what's going to happen next in this market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action, your scores look like this. Holding on to gains, up by 0.6% on the S&P 500, up by 0.5% on the Nasdaq, following the biggest weekly decline of the year so far. In the bond market, yields starting to run here, bonds starting to rally. We're down by 4 basis points on twos. We saw this in Friday's session. At the back end of the session into the weekend, this is the follow-through. We're down 5 basis points on 10s to 437, and crude holding on to gains also. WTI and Brent crude. Brent at around 115, up by 2%, with some encouragement from the president and also a rather large threat. The president saying talks are going well. Progress is being made, but if we don't make a deal, there's a big stick at the other end.
So how do people trade this? And ultimately they don't. Initially there was a pop in equities, no real move in oil. Right now, people looking at what are the off-ramps, right? How do you have a taco-type trade? Trump always checks out, which is not the right way to phrase this at all. But how do you have an off-ramp at a time where it seems to be only escalations that could potentially get you to that de-escalating point?
What's changed in the last week for the better? The answer to that is not a lot. in the last week or so, two-way risk has persisted. This can go one way or the other, conclude, or it escalates. But in the meantime, as it persists, the problems just accumulate. And this was the story on Friday for so many people. The longer this goes on, the problems persist, things start to accumulate, it gets harder and harder to rebound from. And that's what I wonder is starting to click into the bond market. Yields down on Friday, down again this morning, the focus shifting from inflation to growth. We'll see if this holds. It's only a few days, but it feels like the story is starting to adapt, change into a new phase.
Yeah, there is the sort of belief that the longer this goes on, as you say, the worse it's going to get. I find it interesting that initially we were talking about if it goes on for more than a month, it could be a problem. Now, if it goes on for a couple months, it could be tolerable. But if it goes on through December, well, God help us all. And there's this question of at what point do you get that trigger of full capitulation? Or have we already seen it? And you now have some analysts coming out and saying, you have already seen capitulation in certain pockets, and now people are going back in. Ultimately, I don't know how you get a handle on this market.
What has changed is if you ignore what Trump says, what he does has changed. And that's the sense that there already is a Marine Expeditionary Unit in the region. There's another amphibious assault ship heading to the region, and the 82nd Airborne was already deployed. So things on the ground have actually changed, which show that this administration is serious when it comes to escalating to de-escalating. The president in this truth is just giving the Iranians potentially one last chance for an off-ramp.
Here's another thing that's changed, and it's the data. It's an early read on how inflation's going to look, how things will change through the month of March and into April. This from Germany. CPI, year over year, it was 2%, it's now 2.8%. Get used to seeing more of those kind of numbers over the next few weeks.
Yeah, and actually, I would say that these are the data points that actually are going to be much more interesting than even the key jobs figure that comes out on Friday. Not only the CPI that's going to be released in Europe throughout the day, but also the ISM manufacturing numbers and prices paid that we get on Wednesday. That's the real-time information that a lot of people are looking for to understand exactly what companies are having to fork over and what kind of potential hit there could be to growth.
Big hour coming up. Coming up on the program, we'll catch up with Judy Beale of Kane Anderson Rudnick as President Trump renews threats against Iran if a deal isn't made soon. Neil Mehta of Goldman Sachs with crude prices heading for a record monthly rise. And Ed Yardeni of Yardeni Research saying the bond vigilantes are making a comeback. We begin this hour with our top story. President Donald Trump pushing Iran to make a deal, renewing threats to strike energy infrastructure and more. Bloomberg's Jemana Basechi joins us now from Dubai. So, Jemana, on the one hand, we're making progress. On the other, those threats still linger.
Well, I'm going to take you back 8 hours. When I was doing my show, U.S. futures were down 0.5%. And then President Trump gave some comments to reporters on Air Force One. He indicated that they could be making a deal with Iran in the next few days. Futures went positive. And then obviously now he's come out with this post suggesting that they could be probably making a deal with a more reasonable Iranian regime. If not, then, of course, he has threatened once again to strike some of those power plants and key energy infrastructure units in Iran. Now, the point here is who exactly are they talking to? And this is the question that we raised last week. There was an opportunity for the two sides to meet in Islamabad over the course of the weekend. We know that a meeting took place mediated by Pakistan, but with foreign ministers of other regional powers there. We had Egypt, we had Turkey, we had Saudi Arabia. We did not have Iran representation, and we did not have U.S. representation. So most definitely there's an attempt from the region, at least some of the mediators from the region, to push through the diplomatic channels. But then the question is, who is going to be the person on the Iranian side? President Trump himself has said essentially that the Ayatollah is non-present, the new Ayatollah. Nobody's really seen him since he was appointed a couple of weeks ago. You have the Speaker of the Parliament who continues to taunt President Trump on social media and in fact has mentioned his jawboning of the market. And then you have the Foreign Minister, Abbas Araghchi, who just a couple of days ago has mentioned the lack of trust between the two sides. And he specifically referenced the fact that on the day that President Trump pushed back that deadline to April the 6th, Israeli strikes, then the Israeli forces conducted some strikes against steel facilities and those nuclear research facilities in Iran. And on the back of that, they had to retaliate against some of these Gulf Arab states. So there's a question of trust here, but then also who exactly is going to be representing the Iranians on the other side, and whether that person actually has the clout to convince
the clerics, and also the hardliner Revolutionary Guard. So, you know, as ever, I think you have to read this with a grain of salt, but there is an attempt from the region to de-escalate. At the same time, let's be mindful of all of the troops and the military assets that are being deployed to the region.
Jemana, just one line in the president's statement at 7:30 jumped off the page to me, and it was in brackets, desalination plants. Jemana, you're in Dubai. How concerned do you think Gulf partners would be about the prospect of them striking desalination plants?
John, Iran actually hit a desalination plant in Kuwait over the last 24 hours. And it hasn't been, it's sort of gone a little bit under the radar, but actually many Gulf Arab states are very quick to condemn that attack. It didn't actually cause any disruption to water supplies in Kuwait, but it does tell you that this is a key and would be a key game changer for the region, not least because around 90% of the water that we consume over here in the GCC region comes from desalinated water. It would be deemed an extreme escalation and an outcome that everyone over here wants to avoid. So initially, when he postponed that deadline to April the 5th, it was met with a bit of relief. But from Iran's perspective, and at least the fact that they went after this Kuwaiti desalination plant over the weekend suggests that from their perspective, anything is on the table still.
Jemana, I appreciate the update. Thanks for making time for us. Jemana Basechi there of Bloomberg, leading our coverage of this war out of the region. To state the obvious, that would be a major, major escalation.
That is the bulk of the water, as she said, 90%. When you look at some of the regions, it's actually 99% of the water for Qatar, right? So you're talking about some of the attacks here. What you end up with is a crisis that is humanitarian in nature very quickly, and that's what everyone in the region and beyond wants to avoid.
Already we're seeing humanitarian crisis in the sense that there have been civilian infrastructure that's been hit, and also humanitarian crisis on serious levels in Asia when it comes to the energy shock. But if desalination plants were hit, that is going to be massive across the region. And you'd probably see mass migration, individuals just trying to catch any flight out anywhere for safety.
Let's get to the markets. Difficult to make that transition, but we've got to. Let's talk to Judy Beale of Kane Anderson Rudnick. Judy, welcome to the program. Stocks are higher, bond yields are lower. Can we sit on the bond piece of things first? It felt like things switched on Friday in the back half of the session where investors began to price in lower growth and lower yields. What do you think is behind the move?
Well, I think people are starting to really recognize that, you know what, I think these oil prices are probably here to stay because there's so much damage to the infrastructure. And if that's the case, we know that there can be real meaningful demand destruction. And a lot of what led inflation, right, in the last period of the 2021-2022 period was just too much demand for too few goods. And so if we have real demand destruction for the worst reasons, right, just the paycheck is eaten so much by oil prices, it is a negative thing, but it does mean that there are limits to how inflationary this time period can be, and I think what it can mean for the overall growth of the economy.
What does it mean for how long the Fed will sit this out before they step in and do something about the hit to growth?
I do think that until we have more clear data, it doesn't make sense for them to make a lot of movements one way or the other. Their biggest problem is just that the data itself is so noisy, right? We've had so many adjustments in terms of jobs. We had all of the problems in terms of the government shutdown. That makes it really difficult for them, and I think that their upside and downside scenarios of whether they make a move, whether it's to cut or to raise, it's high. So for them, I think that there's just more benefit in being able to stand pat before really making a decision.
Julie, there's been a discussion around complacency in markets, a sense that in risk assets in the U.S. in particular, there really hasn't been recognition of some of the carnage that we're seeing expressed in oil markets, particularly physical oil markets. What's your sense of just where sentiment is right now in risk assets?
I think that most people have a lot of anxiety, and there's good reason for there to be anxiety, right? It's not just this. It's, is AI going to continue the way that we're hoping it is? Are we going to see a meltdown in private credit? Most people that I talk to, they're not having a great time at the office these days. But I think that there's a force that's more powerful than that. Let's set aside FOMO. FOMO is something that happens in college. It's POMO, the pain of missing out on a day like last year when we had post-Liberation Liberation Day and Trump said, never mind, and the markets rallied 9%, if you were not on risk assets at that time, you had a very hard time making it up for the rest of the year. There's real pain in not being in the market when things revert really quickly just on the blink of an eye. Now, it's interesting, right? Because based off of Trump's comments, people are starting to realize there's a little bit of a boy who cried wolf element to that. But I think that that really limits how much people really get risk off. They can be realistic, they can have a little bit of a cash position, but they recognize that things can change very quickly. And if they miss out, it really hurts the rest of the year.
How long can this go on, Julie, before people realize that there's not going to be a quick snapback like what we saw after Liberation Day?
I think that there really has to be a recognition of not just prices at the pump, but prices through the rest of the supply chain, I think is the moment that people recognize that this takes more time than expected. And I think what's very difficult is this war feels very, very opaque to a lot of people. If you remember just the Iraq war, right? Every day on the news, you had images of what was going on there. And now we have an administration that prefers to use memes and cartoons and, movie clips to describe this war. So I don't think people have any real indication of what the damage looks like and how long lasting it really is. It's very easy to kind of blow up infrastructure. To rebuild it is very, very painful. And I think it's unclear how companies can really shift their supply chains around when an input as basic as oil, as fertilizer, as natural gas ripples through the rest of the pricing.
Judy, it's always good to catch up. Thanks for jumping on for us. Judy Bill there of Kaynas and Rudnick, her reaction to that statement from the president just moments ago and her thoughts on where we are in this market. Plenty of debate on Wall Street about how well priced we are for a hit to growth. Morgan Stanley's Mike Wilson really pushing back this morning for his note to start the week. We think the equity market is less complacent on growth risk than consensus believes. The S&P's forward PE ratio has now compressed by 17%.
At the same time that you're seeing earnings expectations increase from a lot of companies, and a number of different strategists have pointed to this, adding that the United States is in a better position strategically than the rest of the world based on its oil and natural gas supplies. That said, at a certain point, you're going to start to see consumer demand, and you're not seeing it to the extent that some people would expect in consumer discretionaries.
Just about holding on to gains this morning on the S&P 500, following an almost 9% decline off the highs earlier this year on the S&P. We're positive by 0.6%. Let's give you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. President Trump posting new threats to Iran. Trump saying that the U.S. will destroy Iran's electric plants, oil wells, desalination plants, and the key sites of Karg Island if a deal is not shortly reached to reopen the Strait of Hormuz. The president saying a deal will still, quote, probably be reached. Banks led by J.P. Morgan are facing pushback on the terms of a $7 billion debt deal to fund a takeover of Sealed Air. Sources telling us here at Bloomberg that the deal is sparking concerns. It could give private equity firm CD&R the option to spin off either Sealed Air's food or protective reporting units. And Air Canada's CEO is stepping down following the deadly runway crash at LaGuardia Airport. Canadian Prime Minister Mark Carney reprimanded the CEO for releasing a statement in English with only 2 French words. The airline is headquartered in Montreal, Quebec, where French is the primary language. That's your Bloomberg Brief. John.
Hey, you too.
Yahara, thank you. Appreciate it. I'm next on a program, The Morning Calls Plus. Neil Mehta of Goldman Sachs with President Donald Trump renewing his threats to destroy Iranian energy infrastructure. Live from New York City this morning. Good morning.
decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg.
Next week on Leaders with me, Francine Lacqua. I speak to George Alhedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Stocks holding on to gains up by 0.6% on the S&P 500 following a fifth consecutive week of losses on the S&P, the longest losing streak going back to 2022 on the S&P 500, down from the highs by almost 9%. This morning, a bounce of 0.6% following the biggest two-day decline going back to April. It's been painful in this equity market. It's not just been about the Middle East. Big tech in focus too, and those problems predate this war.
It's a question about how much they're spending. It's a question about AI disruption. It's a question about regulatory pushback given the lawsuit that Meta lost over social media and the influence there. That said, you do have a growing number of contrarian investors saying maybe this is a time to buy given the fact that the earnings picture looks pretty good. Question is, how much are those earnings upgrades factoring in the higher hit from prices that we're going to see from oil, that we're going to see from gas for a long period of time?
We're starting to price in slower growth. Check out the bond market, 2s10s30. Something happened at the back half of the session on Friday. This equity market closed at the lows. The two-year yield did as well, and we're down another 5 basis points this morning, 3.86. Starting to push out that rate hike stuff and starting to price in a much bigger hit to economic growth.
Yeah, people had gotten carried away, according to some strategists, with how many rate hikes they've been pricing in, particularly in Europe. Now the question is, how much can they really hike rates into a growth shock, as has been every single previous oil spike that we've seen to date?
Brent crude right now, 115, WTI triple digits, 101. That's the price action. Let's get you some morning calls. First up, Jefferies upgrading Expedia to a buy, saying it's less exposed to geopolitical risk. That stock is up by 2.5%. Your second call from Morgan Stanley, cutting its price target on Meta to $7.75, noting fears around Gen AI is weighing on sentiment. Meta up this morning, but down hard last week, negative 11% just last week. And your third and final call from RBC, raising its price target on Kinder Morgan to 35, highlighting commodity prices as a benefit to its estimates. That stock is up by a little more than 1% this morning. Let's down our top story. The president renewing his threats to destroy Iran's energy infrastructure, including Karg Island, if no deal is reached to end this war. Neil Mehta of Goldman Sachs writing the following: if commodity prices surprise to the upside in 27, as our analysts now forecast, it would provide support to our base case valuations, which use a view of $75 a barrel on Brent. Neil joins us now for more. Neil, good morning.
Thank you for the opportunity.
Hey, it's good to see you. Let's break it up. Upstream, downstream, but let's start midstream.
Yep.
How squeezed are all services right now?
Yeah, so I'd say oil services companies, there are a number of them that we do have a constructive view on still, Halliburton and Schlumberger as well, SLB. I would say activity in the Middle East is definitely going to be down. You will see a pickup on some activity here in the U.S. I would say, but as we look at the outlook on a multi-year basis, there are still some opportunities here in the services complex, particularly Halliburton, which is a good blend of the U.S. side and the international side.
Before we turn to the Middle East and the damage done, just on the U.S. side, how tight is the relationship between activity and price?
Very tight. I would say as we look today, EBITDA per fleet is around $18 million. At peak, we were in the 30s. I do think there's an opportunity for some pricing for U.S. land to move back into the mid-20s here.
Before we get to that destruction, how much are you seeing any oil companies considering in the U.S. increasing production in response to the increase in pricing?
Yeah, we spent a lot of time over the last couple of weeks spending time with our management teams trying to evaluate whether there will be a change in activity. And so far the answer has been it's quite muted. I think when our companies make decisions about taking up activity, they're not looking at the front of the oil curve, which, as he's noted, is $115 a barrel. They're looking at the backs. They're looking at 27. They're looking at 28. The deferred oil price is still in the low 70s Brent, and so it's not giving a signal to the market to meaningfully increase activity. And I think the big picture is that the U.S. has gone from 5 million barrels a day to 13 to 14 million barrels a day. So shale is already at a point of relative maturity. Inventory is starting to get dwindled down a little bit. And so the companies have less inventory to aggressively grow into, which is part of the reason we're long-term constructive on the price of oil, because as shale matures, demand still grows, and there are fewer projects internationally. It does set up for a more constructive long-term price environment, notwithstanding the front of the curve, which I think is fairly impossible to predict right now.
Well, the back end of the curve, let's get into that, given the fact that you're pretty constructive on that going higher. In other words, oil prices going higher than they currently are 6, 12, and even 24 months out. Part of that is the destruction to facilities in the Middle East. Yeah. How much do you see actual real destruction to both natural gas and oil facilities that could potentially take years to come back online?
I think that in our coverage, the one asset that has been impacted is Qatar. The Qatar LNG facility, which is in the process of growing and will continue to grow over the next couple of years. ExxonMobil has two trains that were impacted significantly. It's difficult to know the magnitude of the damage. The operator is saying it could extend 3 to 5 years to get that fully repaired. Some of those expansions, Northfield South expansion and then the Northfield expansion itself, are likely going to be delayed. For our modeling purposes, we push it back about 6 months. And so this global gas glut, which looked very apparent for 2027, does look like it's been pushed out to the right. As far as oil, I think it's too early to make that call. Whether there's been meaningful infrastructure impacts, we'll continue to watch it. At a minimum, we need to start talking about putting geopolitical risk premium back into the long end of the oil curve, which in the low 70s doesn't reflect the increased risk, especially with dwindled OPEC spare capacity in the
Let's stay on that. This is an important topic because some comfort in the equity market is coming from the backwardation in the curve. Yep. Just the idea, if you don't follow crude closely, that crude prices further out, looking further out, are lower than where they are right now. How far up do you think they need to come? From the 70s to what?
Yeah, our base case modeling, as we said, was $75 Brent. The bias on the long term would be higher for 3 reasons. 1, shale is maturing. 2, you have demand that's going to grow on our modeling till at least 2035 with the bias that it's actually longer. And 3, when we model the large projects, we call them the top projects that are coming in, there are a ton of projects that came in 25. There are a ton of projects that came in 26. There are very few projects, big projects, that come in 27. And at the end of the day, the backs are also going to be correlated with the extent of OPEC spare capacity. Saudi is producing in the low 10s right now. I think they will struggle to produce well above 10.5 to 11 on a sustained basis. So when you have OPEC spare capacity that has now been dwindled down, along with the maturity of the U.S. and the growth, I do think you need to move higher. We use 75 for modeling. It is not crazy to think of scenarios where the back end needs to move into the 8 handle.
Let's say we get to the 80s. Who's best positioned to take advantage of that curve?
You want to own the companies that have long depth of inventory. And so I think that the stock that we have on our conviction list right now is ConocoPhillips. I think if you have an asset in the United States, meaning lower 48, like the Permian, or Alaska, or Canada, it is inherently more valuable today than it was on January 1st. But you need to have depth of inventory, which there are fewer companies that have it. ConocoPhillips is that stock for us.
That stock right now is up in a pre-market by 1%. Neil, it's good to see you. Thank you, sir.
Great to see you.
Neil Mehta there of Goldman Sachs on this energy market and adjusting the long end of the curve.
Yeah, given the fact that there is some destruction to these plants, but really more importantly, and it's the point that Jeff Curry was talking about, that risk premium that needs to go on pricing based on the geopolitical backdrop, something that a lot of people are talking about, doesn't seem to be priced in at this point.
Up next on the program, we'll catch up with Nancy Lazar of Piper Sandler, looking ahead to a busy week of economic data. Danny has your morning movers, energy stocks jumping on renewed infrastructure threats, plus this. Don't miss this. In a few minutes' time, Anne-Marie back in the studio right now, just getting off the phone from a conversation with the President of the United States. The headlines from that conversation on the other side, that's about 3 minutes away.
in case you missed it on the opening trade.
This time last year was too optimistic on all counts. So I think, yes, the market's asking for the hyperscalers to show a little bit more proof in the pudding. Last year it was, oh wow, you've raised your capex numbers, you're convinced, I must be convinced. Now investors are saying, I need to see the ROI on this capex before I want you to do more.
Don't miss the opening trade, live every weekday.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, now for a full hour only on Bloomberg Television.
A lot of damage was done in this equity market last week. On the S&P 500, the worst week, the biggest weekly decline we've seen so far this year, going back to October. On the Nasdaq, the worst week since April of last year. On the Nasdaq this morning, higher by 0.75%. On the S&P 500, likewise. In the bond market, yields down across the curve. 2s out to 30s, 10s down by 5, call it 6 basis points lower at 437. As these moves hold, Brent and WTI. Brent crude at around 115 all morning, 114.70 right now, and WTI back in triple digits, 101. Moments ago, Anne-Marie on the phone with the President of the United States, speaking to him about where we are in this war.
Very briefly, he said he's very busy this morning, but he wanted to reiterate that he thinks the United States is doing very well. The war, he says, is going, quote, unbelievably well. And then this is what he left me with that stuck with me. They want to settle. He said, that's all I can say. They want to settle. So right now, the President of the United States is projecting and socializing to me and the world that the Iranians want to settle, as this comes off the heels of his long Truth Social post where he's saying almost, this is their last opportunity to go to the table, or there's going to be massive reckoning when it comes to what he is calling things that he wants to, quote, obliterate. Electric generating plants, oil wells, Karg Island, and maybe even desalination plants.
At the same time, the Iranians are denying they're engaging in a diplomatic effort. Through the Iranian state media again this morning, they say they didn't participate in the meetings in Pakistan. They say the U.S. demands are excessive. The president says we're making progress. I think we're all trying to figure out where precisely we're making progress.
Where is the progress made? Also, when his Truth Social post came out, when he talks about if a deal is not shortly reached, what does shortly mean? Are we talking about days? Are we talking about weeks? Or are we talking about months? So I think it's important to remember not so much what the president says, but what he does. And what has changed over the course of the last week is now we have Marines in the region. We also have soldiers in the region right now. And potentially, given the reporting over the weekend, the President of the United States is weighing sending even more.
There is a self-imposed deadline. That self-imposed deadline currently is April 6th. And now we know the additional threats read as follows from the president: obliterating all of their electric generating plants, oil wells, Karg Island. And in this statement from the president earlier on this morning, the threat of possibly all desalination plants. And I keep going back to that because I imagine that's going to make partners in the region very nervous.
That's the bulk of their drinking water for civilians. There was a desalination plant that was hit in Kuwait, as we were hearing from Jumana. A question about how much this would escalate. Also a question of how there is some sort of agreement that could potentially come to the fore. It is the fog of war on steroids. There is a sense that nobody can really get a handle of what's going on the ground, what's going on around the ground. And that's part of the reason why there is a huge range of outcomes that are potentially at play here.
And the president, in his truth, and he talks about this a few times, he does feel like the regime has changed, even though it's not what he says regime change. It's changed within, meaning top brass has been taken out. But a lot of analysts you talk to will say that the individuals he's still dealing with, maybe some of of the lower level that are now rising the ranks because the others have been eliminated, they are hardened by what has happened. These are people who are still trying to avenge for Qasem Soleimani, and now they have to avenge for the Ayatollah and others who were taken out by these Israeli strikes.
That's the setup this morning. Stocks are positive by 0.8%. Let's get you some morning movers. Danny's standing by with more. Hey, Danny.
Hey, John. I want to look through some of the industries that have been affected from the war in Iran. First, starting out with the best performing sector month to date. It is no surprise. It is the oil majors, Exxon, Chevron, Occidental Petroleum. They're all up this morning off the highs of this morning. They did seem to reach there after the president's Truth Social post talking about, as you've been saying, negotiations, but the threat of escalation. All of these companies up in the low teens so far this month. Then there are the fertilizer companies. This is interesting because they've had a little bit of a varying fortune. CF Industries, for example, is up 13% month to date, but Mosaic is actually down. The Strait of Hormuz, also an important waterway for getting various components that go into fertilizer, something we've been tracking. These are also holding on to their gains, up around 1.5% for all these fertilizer companies. Finally, the new grouping of companies that have joined in on the rally over fear of what's happening in Iran is aluminum companies. They had been falling month to date because there was a fear of slower growth because of what's happening in the Middle East and that's effect on inflation. But now we learned over the weekend that aluminum producing plants were hit from Iranian forces and strikes. So Alcoa, Century Aluminum, they are up double digits this morning, John, 10.7% and 12.6% for Century Aluminum.
Danny Berger, thank you. Danny, appreciate it. Look out for Danny Berger at the top of the hour, about 25 minutes from now, to guide you towards the opening bell at 9:30 Eastern Time. Looking ahead, a busy week of economic data on deck, wrapping up with the payrolls report this coming Friday. Also later on this morning, the chairman of the Federal Reserve speaking at 10:30 Eastern Time for a preview. Bloomberg's Enda Curran joins us now for more. And how useful, how instructive is this data this week?
Well, look, payrolls is going to be the highlight, John. There's no doubt about it. Expected increase there of 60,000 jobs added, reversing that big 90-odd thousand decline in February. Unemployment expected to stay around 4.4%. There's some idiosyncratic factors there around weather and a health strike behind that rebound. But nonetheless, if those jobs numbers come in on Friday around those numbers, that indicates that the labour market is as you were. It's not necessarily very strong, but neither are we in the mass layoff territory just yet. That, of course, feeds into the whole broader Fed story about, their scope to cut. Are they going to stay on hold? It would surely suggest they have room to stay on hold, perhaps for a little while longer. We also get retail sales this week. That will be important to keep an eye on. Expecting some firm numbers there in the back of car sales. And then, John, as you mentioned at the beginning, we do, of course, have Fed Chair Powell coming out later today. He may or may not give some new signals on what he's thinking about the impact on energy prices and inflation from the Iran war, but probably not expected to move the needle too much, I think, given he just spoke only recently after their policy decision.
And what is the current posture of the Federal Reserve? What do they seem to be getting behind at the moment?
I think it's, look, very much a wait and see, John. We had that a few weeks ago with Chair Powell after the Fed press conference. They don't yet know. It's probably an open mind in terms of how the energy shock will ultimately impact core inflation. We all know that, yes, prices will go, inflation goes up near term, but do they look through that and wait to see what the second round effects are on in terms of people's spending, in terms of the impact on businesses and households? As I say, we get the retail sales data this week. They're expected to hold up, but eventually that shoe will start to drop. We're in the worst energy shock in decades. It is expected that will start to hit business people, small businesses, large businesses, and households. And when that impacts confidence and spending, then you will start to see, I think, some movement in the Fed debate. But right here, right now, I think it still remains very much, they don't yet know, too much uncertainty, and they kind of want to see how this plays out in the weeks ahead.
They're looking to sit this one out, at least so far. And a thank you. Enda Curran down in Washington, D.C. Nancy Lazar of Piper Sandler writes the following: ignore the unreliable and often revised payroll data, which are currently weak. Nancy joins us now for more. Nancy, good morning.
Good morning.
Is this war another reason to ignore?
For sure. Payroll employment is just a lousy data set. If you were the company that produced payroll, would you as an investor buy that company? Their data are constantly being revised down. Since 2022, 80% of the time payrolls were revised down, and then at the end of the day, we got the QCEW data, and it was revised down another almost 900,000. So to be sure, the war could clip employment growth, but payrolls are not the data to look at. Unemployment claims are a much better measure of actually what's going on from the labor market perspective.
Well, looking at claims, it screams things are absolutely fantastic right now, around 200K.
Yeah, I did some work over the weekend, and unemployment claims have high correlation with swings in employment. I tend to use the household employment data, and they're suggesting, if anything, we should be seeing a reacceleration in employment growth. We saw the regional Fed manufacturing indices last week, and their current and future employment indices were all up. And so claims aren't the only measure out there suggesting the labor market is healing.
It seems like the labor market right now is taking a backseat just because it's a slower moving train than some of the other indicators that could be coming out. We got earlier, as John was mentioning, Germany's preliminary harmonized CPI, which came in at the fastest pace in about a year. You have the ISM manufacturing data coming out from the United States. How much more important are these data points, given the fact that we're looking for real-time influence?
So higher oil prices impact CPI data very quickly, if not immediately. And so we would, it's not surprising you saw the German data. We're going to get our data later in the month. They're going to show a pretty big increase of 0.6%. But historically, it does take time for changes in oil prices to work their way into the economy. It can't just be a one-time blip. It needs to be a sustained shift up. And so I would argue that looking at the employment data that we do have, that's reliable, the fact that it's healthy is a sign that we have a pretty strong backbone. I overuse that word, pretty strong backbone in the U.S. economy. Business confidence is solid. Earnings are improving, not just large companies, but smaller businesses. And so, to be sure, this oil could derail things, but at the end of the day, going into it, unlike 1990, unlike 2008, the backbone of the U.S. economy is pretty healthy.
There are two potential scenarios. On one hand, this would be a real hit to growth and potentially would pressure the Fed from having to or being able to raise rates in response to some sort of shock. On the other hand, if you do think that the economy is that strong, why isn't this even more of an inflationary shock that would prompt some sort of response from the Fed?
Well, the economy is solid. I don't want to say it's strong and at risk of overheating. There's a difference. We are in the early stages. Our view was of a reacceleration in the economy where you don't yet have a labor market strains, where you don't have a labor market, to say the least, that's too strong. So we're early stages in this improvement in the labor market. So our argument would be energy is a tax on the U.S. economy, similar to what we saw in the world economy, similar to what we saw with the tariffs a year ago. And actually the Fed in the back half of 2025 cut rates because it was a headwind. We're not looking for any change in Fed policy. That's not what I do. But given economic conditions, we would argue that the Fed doesn't need to cut rates. And this health in the labor market and business confidence and manufacturing surveys would all point in that direction.
Nancy, it sounds like you think what the Fed does is what they did with tariffs. Look through it. It could potentially be a hit, but it's only once. Yes. Price adjustment.
Yeah, exactly. It was a one-time hit. They understood that. This is very different than the 1970s. This is not stagflation a la the 1970s, when you had double-digit increases in both money supply and government spending. The Fed way behind the curve, shoving rates down too low. Nixon put in place wage price controls, 71, 73, which totally distorted the inflationary backdrop. And so this is not a stagflationary environment. We think this is an obvious temporary risk to the economy associated with a one-time hit to higher oil prices.
How do you define temporary? We're already a month in.
Good point. The duration does matter here. And our view has been that it takes time for higher oil prices. We saw that back in 2021. Oil rose sharply in 2021. And it wasn't until early 22 that you started to see the effects of that. So if this were to last for 6 to 12 months, then I would worry. We have 3% kind of as our base case for growth in the United States. 3% this year, 3% maybe even in 27. Given monetary fiscal policy and productivity. But at the end of the day, if you do move up toward 100, 120 and stay there, that 3 is at risk of shifting down something closer to 2%.
Nancy, good to see you. Thanks for the update. Thank you. Nancy Lazare of Piper Sandler. I don't even want to begin to think about what it would look like if the Strait of Hormuz was still closed 6 to 12 months out.
This is all people care about. And as we were talking about why the labor market report isn't going to matter, Andrew Hollenhorst puts out a note saying the labor market report isn't going to matter. Even if the jobs report is more surprising, energy prices may continue to dominate fundamental economic data in the U.S. In other words, we can't game them out, but those concerns are what hover over every single projection out there on Wall Street.
And the Strait of Hormuz at this moment is just one risk, now added with the Houthis entering into the conflict this weekend. Potentially, if you start to see any sort of conflict or the Houthis firing off missiles or drones in the Red Sea, that is also going to impede the flow of traffic in the Red Sea and the Bab el-Mandeb Strait, and then you have 2 choke points. I don't see how Brent stays at this level. I don't see how it doesn't go closer to $150 a barrel.
Brent right now around 115, 114.50. Let's give you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. President Trump posting new threats to Iran on Truth Social. Trump saying that the U.S. will destroy Iran's electric plants, oil wells, desalination plants, and the key sites of Karg Island if a deal is not reached soon to reopen the Strait of Hormuz. Anne-Marie spoke to the president a few minutes ago, and he told her Iran wants to settle. The Spanish government announcing it's closing the country's airspace and bases to U.S. planes carrying out missions in Iran. Spanish newspaper El País reporting that the country is only allowing the transit or landing of planes in cases of emergency. And for the first time in more than 50 years, NASA is sending astronauts back to the moon. The Artemis 2 mission is set to launch on Wednesday. It will take the astronauts on a 10-day journey that will go to the moon without landing and then return to Earth. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update and thanks for this morning. Up next on the program, we'll set you up for the day ahead. Plus, Ed Yardeni of Yardeni Research saying the bot vigilantes are making a comeback. That conversation up next.
In case you missed it on Balance of Power.
Senators, when we consider what is going on in the Middle East, there's also the question as to whether or not Iranian retaliation might include threats directly to the United States homeland. Does this potentially amplify the need to not only reopen the Department of Homeland Security, but also to quickly confirm a new secretary in Mark Wayne Mullen?
I mean, look, Iran has been trying to hurt our homeland for many, many years. I am ready to reopen the Department of Homeland Security, just carve out ICE. We have genuine problems in this country with the use of ICE. We all saw it with our own eyes. But in terms of the rest of it, FEMA, the Coast Guard, I mean, there's plenty of missions that should go on, and I've been supporting us moving forward on those things. ICE we have a problem with, and legit. But the rest of it, we should open and reopen immediately. And the Republicans shouldn't hold the entire TSA budget and everything else hostage because they are supportive of ICE.
Don't miss Balance of Power live every weekday.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Welcome to Bloomberg This Weekend.
Breaking news today from Wall Street to Washington.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
inflation risk is already being priced by the rates market. That's why you're seeing the yield curve flatten quite significantly. The front end is up. So I think we take a step back and say, what if oil stays, let's say, 100 or above for an extended period of time? In the worst case, it's not just inflation, it's growth. It means your curve can actually get inverted.
That's the worst case. It's not their base case. That was Venu Krishna of Barclays. The base case is earnings are going to be fine. And this S&P 500 could climb to 7650 by year end. They actually increased their target on the S&P 500 in the last week against the backdrop of a war that continues. Equity futures near session highs, up by 0.8% on the S&P. On the NASDAQ, up by 0.75%. Yields are down across the curve, 2s, 10s and 30s. 10-year bond yields declining by 6 basis points this morning, 436.61. And crude elevated, holding on to gains. Brent crude around 115 all morning. WTI around 100. Anne-Marie, about 30 minutes ago, on the phone with the President of the United States. The President saying we're making progress and they're desperate for a deal.
Yeah, he says the Iranians want to settle. He said, that's all I can say. They want to settle. It's very different than what we're hearing in terms of what the regime is saying. They're saying that they're not really engaging right now when it comes to the diplomatic talks, which we saw take place over the weekend when it comes to Pakistan. I think the President's Truth Social today basically giving the Iranians one last-ditch effort, because you have to remember, it's not just what the President says, it's what he does. And now there's a mass amount of troops right now that are trained for things like taking over an island. So potentially when the President tells the FT as well, we want all the oil, that means Karg Island.
For market participants, this is a complex moment. Lisa's talked about this a million times. How do you get an edge in a moment like this? What is your anchor looking at 6, 12 months, maybe beyond? How reliable is the economic data? We've got a week full of it. You'll get payrolls on Friday. The Fed chair speaks later on this morning, 10:30 Eastern time. A lot of people think he's just going to sit this out. Can't really get guidance from the Federal Reserve. They're not going to provide an anchor for you. The data on Friday is not going to provide an anchor for you, because a lot of this is subject to change in the next several weeks.
Which is why things have been swinging around such significant degree. One thing that people are doing is analyzing what they know, which is the earnings expectations that have been going up, which is the reason why Vina Krishnu, as well as Mike Wilson over at Morgan Stanley, have been upgrading their expectations for equities. That said, we don't understand the monetary policy response and we don't understand the fiscal policy response, and those are two key components to this entire situation.
Let's turn to the bond market. Think about where we closed on Friday going into the weekend. These kind of levels. A 10-year bond yield at the highest level we've seen since last summer. In the UK, the highest level since 2008. In Germany, the highest level since 2011. In Japan, the highest levels we've seen since the 1990s. Are the vigilantes back? This is what Ed Yardeni, if Yardeni Research, has got to say. The bond vigilantes are back, taking matters into their own hands and tightening credit conditions. Ed joins us now for more. Ed, welcome back to the program, buddy. Let's just sit on that, because some people believe that maybe the buying has started on Friday and continued into this morning. Where are you on that?
Well, I think we're going to continue to see bond yields fluctuate at these levels, which are relatively high and relatively tight in terms of their impact on the credit markets. Clearly, we've got a bullish and bearish tug of war going on here. This morning, you folks, Bloomberg has you've posted an article on how bond yields have come down a bit, and suddenly the market focusing on the fact that this oil shock could slow global economic activity. On the other hand, we got to these high levels over the past few weeks on worries about higher inflation, and I think it's pretty clear that inflation is going higher. It's not clear that the global economy is going to be as weak as the bond market would like to see, but we'll have to look. As you said, a lot of known unknowns and unknown unknowns.
For sure. Do you think the fiscal offset that some countries might provide to cushion the energy shock might contribute to higher bond yields from here?
Well, I think good point, and I think the bond market clearly has the attention of politicians. We saw that just last year with Liberation Day on April 2nd when Trump imposed his reciprocal tariffs. And by April 9th, he postponed Liberation Day because of the backup in bond yields. So the bond vigilantes do get the attention of the folks in the White House. And by the way, I think that's one of the reasons they might have postponed their 2-day ultimatum into a 5-day ultimatum and then a 10-day ultimatum, as they were concerned by the backup in bond yields and by the weakness in the stock market. So the financial markets are having a vigilante impact on policymaking.
Perhaps they are, although there is talk right now in Washington, D.C. of Congress coming together with another stimulus package as part of the reconciliation of the current dispute going on. What do you think the market's response would be to that? I'm talking about 10-year yields in particular.
Well, I think it's any continued widening of the deficit I think is fundamentally a bearish development. And so stimulus, before the war, we all thought there was plenty of stimulus coming from last year's tax bills, with the refunds likely to be as much as $1,000 extra for a lot of people. And that's still in the pipeline here. So we already have fiscal stimulus. Arguably, we also still have monetary stimulus from the easing that started a year and a half ago, and to provide more fiscal stimulus. And then the president's asked for $200 billion in additional defense spending. Well, that's a billion here, a billion there, becomes $1 trillion pretty quickly. And we all thought the bond market that kind of learned to live with $1.5 trillion in deficits. Now let's see if we may be stress testing the bond market to see if it can live with $2 trillion deficits at an annual rate.
Ed, always good to catch up. Thank you, sir. Ed Giardini there of Giardini Research. It's an interesting situation how consensus has shifted. Coming into this year, consensus view was cyclical bounce. And now consensus view is you won't get second-round effects from the inflation spike because the economy's not as strong. I find it difficult to reconcile those two views.
Either you believe that the earnings expectations are going up at companies because the economy is strong and then you've got a pass-through of inflation, or you believe that demand destruction is going to come into play and then some of those earnings expectations have to be overly optimistic. You are absolutely correct. Which is it? And ultimately, this market is not choosing. This market is confused, and rightly so.
Confused, rattled by a war in the Middle East. The president speaking to Anne-Marie a little bit earlier on this hour, saying that this is going to wrap up pretty quickly based on the conversation you've had and the progress they're making in talks so far.
He says the progress of the war is unbelievable, but then he said they want to settle, which if you're a market participant and the president is saying they want to settle, you would think potentially they do want to settle, but the Iranians say they're not, and you have to remember there's a lot of troops right now, and that buildup has happened over the course of the past week.
I should say indicating things could wrap up pretty quickly, but they've been indicating that for quite a while.
They have, and maybe we're just at another moment where you kick the can down the road for a little bit longer.
The president telling Anne-Marie Iran wants to settle. Coming up tomorrow, Sebastian Page, T. Rowe Price, and a whole lot more from New York City. Have a wonderful week.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The German report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
at the Fed are on Bloomberg.
I have projections for unemployment. I have projections for inflation. So do my colleagues. And thus far, the evidence from events over the weekend haven't led me to change any of my forecasts.
With the geopolitical events that we talked about, it's just too soon to know what imprint this has on inflation and for how long.
We've seen the economy overall. It's been pretty healthy. It's been brightening. The outlook has been positive.
I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around. But of course, no one knows whether this is going to be short-term or long-term, and so we'll just see where it goes.
Inflation's hot. It's going to look even worse now with the oil prices, at least on headline. And then if you get a solid job number, it does say you can sit there and wait.
It can lead you in a stagflationary direction. The inflation side of the mandate getting worse at the same time the employment side of the mandate is getting worse. And that's always the worst case scenario.
Nobody covers the Fed like Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Starting the week with a rally 30 minutes ago until the start of your cash equity trade. I'm Danny Berger. Matt Miller is off today. Bloomberg Open Interest starts right now. Coming up, Brent heads for a record monthly gain as a buildup of U.S. troops and renewed threats from President Trump stokes concerns. Aluminum also rising as Iran's weekend strikes on Gulf smelters threaten to send a fragile market into crisis. And Wall Street games out the fallout, with Goldman seeing signs that hedge funds are now capitulating on stocks. Let's get a check of where things stand after 5 consecutive weekly losses, the longest losing streak since 2022. We are higher this morning. The reason for that, for risk assets, appears not to be happening with Brent crude, but what's happening with U.S. 10-year yields. They are down 6.5 basis points after steadily climbing to near 4.5%. We're at 4.36. But can S&P futures, can stocks continue the gains if yields are falling for the wrong reason? Brent crude is still higher this morning, up 1% at 113. That's despite on Truth Social this morning, President Trump making a post. He renewed threats on Iranian energy assets if the Strait of Hormuz remains closed, even as he pointed to great progress in talks. That mixed message underscoring the volatility in the region after this weekend's escalation.
Could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon. I would only say that we're doing extremely well in that negotiation, but you never know with Iran because we negotiate with them and then we always have to blow them up.
Joining us now is Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Surveillance, who spoke with Trump just this morning. Anne-Marie, what was the message you heard from the president?
Yeah, about an hour ago, super brief, but he reiterated that he thinks the United States is doing unbelievably well when it comes to this war. We've heard that from the president a lot, as well as from Truth Social. And then he also said Iran wants to settle. It's like, that's all I can say, they want to settle. Obviously, that is not the message we are getting out of Tehran when it comes to their semi-official news agencies or some of the leadership that is now taking a more robust tone, individuals that are now probably working within the regime and maybe the individuals that are on the outreach on the other end of the United States, they're not saying that they are negotiating. But clearly something is happening in terms of intermediaries that are trying to de-escalate. We saw that happen over the weekend with these talks from other parties, not the Iranians or the Americans, but when it comes to individuals from Turkey, the foreign minister of Egypt, Saudi Arabia, and of course the Pakistani foreign minister, having this potential diplomatic talk to try to open up that sort of gateway. The other fact of the matter is, though, the president basically put out a huge threat this morning on Truth Social. He said, open the Strait of Hormuz, let's get a negotiation, and listed potentially what the United States can go after when it comes to more energy facilities like electricity, desalination plants, which is critical for all of these countries in the region. And then also another mention towards Karg Island, which he spoke to the Financial Times about last night.
What did you make of that Financial Times interview when he said that our preference would be to take the oil in Iran?
I think the president there was insinuating that there could be this option on the table for these Marines who are literally trained. These expeditionary Marines are trained to take islands like this. Potentially they could try to blockade this island. 9 out of every 10 Iranian barrel of oil has to go through that island when it comes to their sort of exports into the Strait of Hormuz. So I think the president was clear that at some point he is going to do something, whether the Iranians open it up. They're controlling it right now, whether they open it up to everyone or not, the United States would get involved. I also think it was interesting because the Financial Times was talking about how the president really was making what was going on right now, or potentially would go on with Carg Island, sort of parallel to what happened in Venezuela. This was the same rhetoric he used when he talked about, of course, the capturing of Nicolas Maduro earlier this year.
Anne-Marie, thank you so much, and thank you for bringing us that conversation you had with the president as well just an hour ago. That's Bloomberg's Anne-Marie Hordern. Elsewhere, aluminum prices are surging this morning, along with aluminum-producing companies. Their stocks, Iran hit key Middle East smelters, raising the risk of a global supply shock. Joining us now is Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. Mike, we've been concentrating a lot on oil and fertilizers, but the impact to different commodity markets seems to just be expanding in this conflict.
Well, Danny, that's a good example. Aluminum. We've all become oil traders now. But the key thing to remember about aluminum, it's bucking the trend in metals to go down since the war started. And most notably, industrial metals. Copper's dropped from a pretty significant rally, around 15% to down almost 5%. Aluminum, obviously, specific reasons, but it's an industrial commodity. It's basically electrified metal. The key theme about aluminum is the cost of electricity keeps it expensive. But let's remember, less than 10% of the world's supply of aluminum comes from the Middle East. 60% from China. So to me, you mentioned supply shock. Before this event happened, my BI colleagues said aluminum was probably more likely to head towards 2,500. Right now it's around 3,500. Because the supply was increasing, the demand wasn't picking up. We have to ask ourselves, with the price spike, what's that going to do? It's going to bring on that supply, reduce demand, rinse and repeat, probably make it lower. But most industrial metals are suffering now because of that risk of recession from spiking crude oil.
Mike, I would also love to get your thoughts on just the price movement of oil. It continues its gains this morning, despite the president putting on Truth Social that it's a much more reasonable Iranian regime in place that will have talks, but then goes on to issue all of these threats if the Strait of Hormuz is not opened. Is this just a market trading on that likelihood, or is it a market that is less susceptible to the president's jawboning?
I think it's all the above. You just look forward. Let's go to where the puck's going. By the time we get to November's, that December WTI crude oil contract will be front month, and right now it's $77 a barrel. It's actually ticking down because the market sees what's happening. It sees what happened before. It saw that natural gas front contract be up 100% in the beginning of the year. Now it's down 20%. That's the same thing it did in 2022. Went up to 10, and by the time it got to 2023, it was 2. That's what the market's looking forward to. What does Mr. Trump want and need by the time he gets to midterms? I think that crude oil contract, it's at 77 in December, is going to more likely be 50 than 100. 100's a recession, 50's normal. But what's also happening in all commodities, most notably grains and energy in the U.S., is producers are selling forward saying, thank you. We finally can bring on some profits, bring on some supply, and add to our profits, actually add to that cycle before we get to that low price cure. So overall, this looks to me like it's going to be post-inflation, deflation, heading towards, and the futures curve is sniffing it out.
And add this to the situation, Mike, Scott Bessent giving an interview to Fox News this morning, saying over time the U.S. is going to retake control of the straits and there will be a freedom of navigation, whether through U.S. escorts or multinational escort. Oil is still up 1.7% for Brent crude. Mike, thank you so much. Mike McGlone of Bloomberg Intelligence. And then there is the reaction in stocks. They're up today, but the S&P is down 7% this year. That's the worst quarter since the rate hike sell-off in 2022, which, by the way, some big stagflation concerns then also. Goldman Sachs says that heavy short sales by hedge funds have increased the potential for a sharp swing higher for stocks in the event of a de-escalation. Bloomberg's JP Barnett wrote today's Before the Bell column and joins us now. JP, there had been this idea that coming into the conflict, originally what we saw was just a big momentum meltdown, a shift and a change in position, maybe less of a reaction to the day-to-day of the war. How does that look for the technicals and positioning in U.S. stocks now?
Well, exactly as you described it, we have seen that a lot of the momentum positioning has come off, and a lot of the fast money has positioned accordingly in the conflict. I mean, there was this argument that stocks were very slow to react in the initial days of the strikes. That has now completely changed. Is this the floor or the bottom of it? I'm not so sure, but it adds to the sentiment that we have seen a certain positioning shift now, and that makes it easier for the market to recover. That said, of course, the market stays in a very headline-driven environment as we have just seen today, and I guess without an all clear or at least some very strong signal that we are on the right path to end this conflict, stocks will struggle to move higher. But if that comes, then it's certainly clear that some of those short positions that are now in the market will be removed rather fast.
Does that also mean, again, going back to the Goldman Sachs research, which you've been looking at this morning, JP, that if hedge funds have capitulated, that is a signal we're somewhere near a bottom, or did they say they have more room to go?
Well, I mean, you can take it as a signal that a bottom is at least possible. I wouldn't take it as one where we say, okay, it's really in. And one of the Goldman personnel also said, it's very hard to predict the bottom. And a couple of people have already tried and failed. So that person wasn't really sure if we are at the point yet. And I would argue, if you take this as a signal for a bottom or not, doesn't really matter. What it tells you is how the market has shifted. And whatever your signal for the bottom is it a headline? Is it the next macro print, whatever it is, you can use that data and that positioning intel to then make your mind up how fast and how quickly the market will rise.
Of course, the next big macro data point is going to be jobs on Friday when markets are closed conveniently, but Bloomberg Surveillance will be on air, so everyone should still tune in from that, hopefully from the comfort of their homes. JP, thank you so much for joining. That's Bloomberg's JP Barnett. Let's get a check on your markets this morning. 20 minutes to go onto the start of cash equity trading. We are gaining this morning thanks to what yields are doing. Yields are lower by 6 basis points. We heard from PIMCO, JP Morgan, Columbia Threadneedle saying that this market wasn't enough pricing in growth concerns. You're starting to see that this morning, but should stocks really be moving higher if that's the case? Regardless, to say they're down 7%, as we were saying, to start the year, a tough start. As Brent crude, that's up 2.2%. The president writing on Truth Social this morning that it's a more easy regime to negotiate. However, issuing threats, including bombing of different sites if they don't reopen the Strait of Hormuz. That more moving the price of oil this morning, trading at $115. By the way, the 3-month oil forward curve is above $100 too. So we're pricing in longer-term elevated oil prices. Let's look at some individual movers this morning. Cisco, they're buying Jetro Restaurant Depot. It's a $29 billion deal. It will expand Cisco's reach to small business and restaurant owners. Shares are down 6.5%. You often see that with the acquirer of a company. Fannie Mae, Freddie Mac, they are apparently stupidly cheap. That's according to Bill Ackman, who also put on X that he could see them rise tenfold. Shares up as much as 10.3% for Fannie Mae. Elsewhere, Expedia, that gets an upgrade from Jefferies. They say that concerns about artificial intelligence and disruptions from it have created a buying opportunity. Shares up 2.75%. Coming up, President Trump warns Iran of escalation as American troops arrive in the region. We're going to discuss with Democratic strategist Adam Hodge. That's next, right here on Bloomberg Open Interest.
Next week on Leaders with me, Francine Lacroix. I speak to George Alhedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
In case you missed it, on Bloomberg Crypto.
Crypto has had this terrible, horrible, no good, very bad 2026 ever since the events of October 10th. What do you chalk up this weakness to, this volatility to?
Well, I think there's a lot of structural pressure on Bitcoin that's been happening after 1010. It's just a change of who's holding Bitcoin, and you're moving from people who had long-term belief and were holding Bitcoin directly to just access to Bitcoin being wired up to our financial system and markets in ways that didn't happen before. So the combination of what happened on 10/10 plus the mix shift change of who's holding changes the dynamic of price action. This is not a short-term market play. You have to have long-term belief and vision, and I think that for those people who have that long-term belief, they'll be fine.
Don't miss the next Bloomberg Crypto.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Let's get you some high-interest stories, a look at what's making headlines around the world. First up, Air Canada, or Canada Air CEO, rather, Michael Rousseau is leaving the company after backlash, after a video following that deadly LaGuardia crash. In the video, he spoke mostly in English, sparking outrage in Quebec. Canadian Prime Minister Mark Carney criticized Rousseau, saying the video showed a lack of judgment and a lack of compassion. The airline says that French fluency will be key in choosing its next leader. Wall Street's biggest bond managers are warning that markets are underestimating the risk that the war in Iran could trigger a sharp economic slowdown. Money managers at PIMCO, JP Morgan, Columbia Threadneedle say that they are positioning for a hit to growth that could spark a rebound in bonds and push yields lower. Elsewhere, Apollo considering opening up a second U.S. headquarters either in Florida or Texas. The move would place the firm among a growing number of financial companies expanding in the South and Sun Belt, following a post-pandemic shift away from higher-cost areas in the Northeast. Now, the biggest question hanging over Washington and the world this morning is whether President Trump is preparing to send U.S. ground troops into Iran as thousands of American forces move into the region. Joining us now is Adam Hodge, Managing Director at Bully Pulpit International. He's also a Democratic strategist who advised senior government officials and political leaders through high-stakes global challenges. Adam, thanks for joining us this morning. And I just wonder what you make of this. The message from the president this morning saying that there are more reasonable people in Iran, the regime, to negotiate, but then issues this big threat. If the Strait of Hormuz is not immediately open for business, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island. What do you do with that, Adam?
I mean, Danny, it's really hard to tell. It's a bit of a mixed bag, to say the least. Look, what you've seen from the beginning of this conflict is a bit of mixed messaging out of the White House, from the president himself on down. And I think what I keep coming back to is that just overall, there seems to be this hope that there's some grand plan that's going to come together. But hope is not a strategy. Hope is not a strategy to alleviate stress in, the private credit markets. It's not a strategy to getting out of this conflict in the Middle East. And so what I think the president needs to do over the next couple of weeks is just lay out clearly to the American people what he hopes to get out of this conflict. Is it regime change? Is it some sort of lack of stress in the Strait of Hormuz? Or is there some other broader regional pact that you can come together that brings some stability? That, I think, is what is needed most and foremost. And that's clearly what the market is hoping that they can get out of the White House.
Adam, where are lawmakers in all of this? Congress decided to go on their break. Is there support or pushback or anything coming from the Hill?
It's a pretty embarrassing act, to be honest. I mean, to go on a 2-week recess when there's a war in the Middle East, when there's a shutdown with DHS and ICE, I can't fathom in all my years working on Capitol Hill that a Speaker of the House and the Senate would go on recess when you're in the middle of a war and you've got part of the government shut down. And so I think Congress should come back and try to help address this issue. Look, the president has asked for $200 billion. There should be an honest, an open debate about how soon that money gets flowed or whether it should in the first place. Now, Democrats have been pretty clear that that's a non-starter, that they don't think that the president both needs the more money, but also that you shouldn't be funding this war that they deem as illegal. Obviously, the Republicans, on the other hand, want to give the president all the tools that he has to wage the war. And that's, I think, a debate that the American people deserve to see from the lawmakers in Washington.
What is your advice to Democrats in this moment in their ability to push back not just the funding of the war, but perhaps the war itself?
I think they need to press the administration about what its objectives are. That fundamentally is what they owe the American people, and I think they're on the higher ground if they put that pressure on the White House, while also making clear that none of this does anything to reduce costs for the American people. And that what we've seen is the #1 political issue that is driving races across the country. Democrats, since President Trump took office, have won about 30 special election races. And in all of those wins, they focused on affordability. And a war in the Middle East does not do anything, certainly with crude at 115, with aluminum spiking, with all the other downstream effects on key metals and inputs into the economy. It's hard to see prices going down anytime soon, and that also puts more pressure on the Fed, right? I mean, we know that they are watching what's going on, and we're going to get CPI and PPI in about 2 weeks now. There'll be 2 weeks for the Fed to digest that information. And the White House and Congress is going to have to try to figure out a solution here, hopefully, by the time that. Otherwise, I think it makes the outlook for a cut in rates even more cloudy.
On the point of affordability, Adam, we are still looking at gasoline prices that are under $4, and I mean literally just under $4. $3.99 is where the national average gasoline price stands at this moment. Is there a pain point? Is there a threshold that we cross, that you get some real pushback? Not even just for Congress, maybe the president himself, the taco trade comes in. Is there a level which would really concern consumers and therefore concern Washington, D.C.?
I think you've seen a little bit of the taco over the president kind of bounces back and forth there. I think, oil, gas at $4.50, $4.75 a gallon certainly is something to watch out for. But let's not forget, diesel prices have also spiked tremendously over the last couple of weeks, and that hits people, farmers, that hurts producers around the country. And so this focus on just the average consumer driving, getting to work, while important, is only a small part of the picture. And I think what Democrats, what Republicans, what they should try to do is how do we force the president's hand to negotiate an end to this conflict that helps relieve some of that pressure. Otherwise, I think you're looking at increased Democratic enthusiasm. I think you're looking at more likelihood that Democrats win the House and maybe the Senate in the future. And then that adds to more pressure on the president politically. But again, hope is not a strategy, right? The president has to find a way to put out clear objectives for the administration, how this conflict comes to an end. If you can do that, maybe you'll see a little bit of a break in this dam.
Well, even if there is that push, Adam, to end this conflict, what could that possibly even look like? And would it put the Middle East on even more fragile footing? Because you have an Iranian regime that says we control the flows through the Strait of Hormuz, and they've demonstrated their ability to do so. They have a huge negotiating hand at this moment. Even if the president were to turn around tomorrow and say, I want to end this thing, what could that even look like? Is there an outcome that doesn't include caving into Iranian demands at this point?
I think what we have learned over the course of the last month is that the fundamental dynamics in the Strait of Hormuz and in the Gulf have changed. And I don't think there's any going back anytime soon. Iran has learned, no matter who is leading the country, that they can essentially shut off the large share of global oil flow, and that has a downstream effect for countries around the world, not just here in the U.S., but look at Southeast Asia, right, and the splits of unrest you're starting to see over there. So I think the Iran regime has learned that they can hold the global economy hostage. And our partners in the Gulf have seen the impact, and that's why they're pushing the administration in some ways to go even further to try to help and create some regime change. The key question I have is, regime change to what? There's no other force in Iran. There's no sort of uprising that it seems to be on the horizon that will lead to a different fundamental setup in Iran. The IRGC is even more empowered. The new Ayatollah is even closer to the IRGC. And there seems to be even more extremism from those leaders than were in place before. So I think that, again, gets to this fundamental change that we've seen in the region. It's hard to see us going back to times before. And I think that means higher commodity prices, higher overall prices for the foreseeable future.
Adam, we appreciate your time this morning. Adam Hodge, a Bully Pulpit International. Coming up, Chris Farone from Strategas says it's easy for investors to lose the plot in this Iranian war. He's going to join us after the opening bell, which comes in about 7 minutes' time. This is Bloomberg Open Interest.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Thousands of American Marines are heading to the Middle East.
Greece will not participate.
There's a very good chance we're going to end up in a deal.
He's looking at putting boots on the ground.
This is going to be a short-term excursion.
Trust Bloomberg for on-the-ground coverage.
Things are not de-intensifying.
A lot of fear here in Europe. Ukraine is being left out in the cold.
Up-to-the-minute reporting.
The Jan report has been hit.
Missiles have struck the U.S. Embassy.
And the analysis you need.
The United States military has shown its might. Now it's time to please calm down.
Nobody covers geopolitics like Bloomberg. Welcome to the world of decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg.
Check on your markets ahead of the opening bell, less than 5 minutes away, and we are rallying after 5 consecutive weeks of losses, the longest losing streak since 2022. We're up just about just almost 0.9%. Nasdaq up 0.8%. Remember, it was tech that largely let us lower last week. 10-year yields, those go down by 7.7 basis points, which is maybe why we are seeing a rally in risk assets. 10-year yields at 4.35, and Brent crude up 2% at 114.84. Just on the other side of this break, your opening bell alongside Chris Farone.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazla Amin in Davos, Switzerland, and this is Bloomberg.
Just seconds until your trading day starts. You're watching Bloomberg Open Interest. I'm Danny Berger. Matt Miller is off. He is back tomorrow. We're starting with gains this week as yields move lower. S&P up 0.8%, as is the NASDAQ. Russell 2000 even better, again, off the back of lower yields. Maybe we're starting to price in growth concerns for this market and not just inflation. Maybe we need to dust off the stagflationary playbook. I don't know, but either way, kind of a cool day down at both the NASDAQ and the New York Stock Exchange. Very philanthropic. At the New York Stock Exchange, we have Women in Financial Markets. It's a nonprofit that promotes, you guessed it, women in financial markets. Always a valiant cause, I do say so myself. And then another organization that is just wonderful down at the NASDAQ, it is Make-A-Wish, celebrating all of their Make-A-Wishers. So great news there. All right, back to these markets. Let's take a look at one of the biggest gaining sectors so far today, and that is the aluminum producers. Aluminum stocks like Alcoa, they are rising following Iran's attack on Middle Eastern aluminum facilities. They had actually been losing year to date because of growth concerns, but now it's supply concerns that lifts up prices. Occidental Petroleum, that's up 1%, moving with the rise in oil prices after the president puts on Truth Social that unless the Strait of Hormuz is reopened, he will escalate his attacks. And then there's FedEx, higher right now, 1.1%. It was falling, though, earlier as major U.S. industrial and transportation stocks fall into a correction. Again, growth concerns, logistics, higher fuel costs, all of those weighing on companies like FedEx. Now, elsewhere, Morgan Stanley and Goldman Sachs see potential for stocks rebounding soon. Morgan Stanley's Mike Wilson says the S&P 500 correction is nearing its final stage. Are we really in a correction? Anyway, and we have priced in higher energy costs. Wilson believes that positive earnings growth will help protect against a U.S. recession. And Goldman Sachs strategists say some signs of capitulation are starting to emerge when it comes to hedge fund exposure to U.S. stocks, and that suggests funds are close to their maximum levels of pessimism around the market. Let's head on back over to the desk this morning because I want to add another excellent voice into this conversation. It is Chris Ferrone, Chief Market Strategist and Partner at Strategas. Chris, thanks so much for joining.
Great to be here, Danny.
Great to see you.
Yeah.
I mean, is that all there was? A correction down 7% for the S&P? Is everything priced in now?
You know, our general thinking here is that we have what I would describe as a marginally oversold market here. We've been using 6,200 as kind of our line in the sand where I think good support steps in. Whether or not we trade down there or not, I don't know. When I look at some of the internals. What we probably still haven't seen at this point is really that deep internal flush. I think 20-day lows on Friday were something like 30%. We generally want to see that north of 50, 55. You're down to about 20% of the S&P above its 50-day moving average. So you're kind of in the zip code or in the general ballpark of an oversold condition. But again, that can be early. So our gut is here, watch this bounce that's developing here. Let's see if it kind of has the internal characteristics that we want to see. Does the leadership kind of reassume a more pro-cyclical bias, or is this just a bounce in a developing downtrend?
There did have a real big momentum sell-off feel to the start of this. Where do we stand now on that? Was that a lot of hedge fund deleveraging? Is that mostly over?
I think actually one of the constructive things about late last week is finally they started to hit a lot of the big Mo stocks. So think about like Micron or SanDisk or Western Digital or Hynix or Samsung. These memory names, which have really been the epitome of the momentum story really over the last 6 months, finally have started to succumb to the selling. I actually think that's a good thing. It's a message that you're moving to the later phases of the weakness. I think gold getting hit last week was reflective of that as well. When you sell really not what you want, but what you have to, generally a message you're near the later phase of a drawdown.
Even so a day like today, we're moving much more on yields than we are oil. It had been oil. We've all become oil traders, looking at what it's doing every day. Have we reached kind of the maximum of this? Are we shifting now into maybe growth concerns? Maybe Fed can cut again, and that's good for stocks?
We were traveling all last week, and one of the big points in all of our client meetings was this idea that there's asymmetry in the Fed funds future curve here, where you can't have it both ways. You can't think the oil shock's going to last forever and be pricing in hikes. That just doesn't make sense. At some point, you would want to start to reprice cuts, and that's where I think we are. If you look at like June 27 SOFR, pretty big reversal last week, kind of in the direction of more cuts, not less. So I think we're kind of at that tipping point where you'd actually want to, not lose the plot. Don't forget what you thought. I still think ultimately we're moving more towards cuts as we look out to, back half 26 and into 27 here.
That's been a really big point of yours, that we're in a fog of war, a lot of volatility, but don't lose the plot. Where does this economy stand? Where are we heading? What is the fundamentals that you need to grasp onto?
What's interesting is when you're in these moments that are very headline driven, you almost forget what you thought before it started. And you think about how investors entered the year. They were very bullish value over growth. They were very bullish equal weight over cap weight. What I have found remarkable over the last 4, 5, 6 weeks is you're at new highs in value versus growth. You're at new highs in equal weight versus cap weight or equal weight versus Mag 7. So kind of in this fog of war, focus on what hasn't changed. This is still a market that I think craves value over the top of the market. It craves the average stock over Mag 7. That has not changed here in the slightest bit.
What about U.S. versus international? Because that's gotten a rethink. That at first last year, it was a year of outperformance, but this year maybe the oil crisis, energy costs, it's more costly to Asia and Europe.
I think it's very geographically specific here. Europe trades poorly. I think the bond market there, markets have a very brutal way of reminding us, what the weakest links are. And I think the way that German yields and French yields have responded the last 4 or 5 weeks is a stark reminder that the European sovereigns are much more vulnerable than U.S. Juxtaposing that, I've been impressed with how Japan has acted. I know the equity market's down, but you're still very much in a bull market there. You're just back to where you really broke out from late last year. I think the leadership in Japan is still pretty good. It's mainly industrial. So it's become, I think, more specific geographically. Europe certainly on the weaker side. I don't like euro currency here either. I think that goes lower. But Nikkei has actually held up pretty well throughout all of this.
And I know as part of your travels, you were in Asia a lot. What was the sense there? What were you getting from clients?
It's funny. I think the two big questions last week in our travels all throughout Asia was, number one, do we think the low in stocks is in yet? I actually think that's the wrong framing. I think the more important question is the high in stocks in? And that's a very different question. I mean, is the low in? I don't know. 6,200, I think, is probably a better level than where we are here, but we'll see whether or not we have to go down there. I think the harder question is, what we saw in January and February, did that have the makings of what a bull market top looks like? And our contention would be probably not. We'll see what any rally develop looks like over the next 4, 5, 6 weeks into the spring, but we actually have some pretty good seasonality the next 6, 8 weeks. April tends to be a very good month for markets, so let's see if we can live up to that. The other big question I thought on the road last week was simply with gold, right? If it's not a safe haven, what is it? And kind of our contention is January and February looked like a blow-off in gold and silver. I think we learned that at $5,500, gold is not a safe haven. Maybe it is at $3,500, but it certainly wasn't at $5,500. It acted more like a risk asset or a momentum asset than it did some geopolitical safe haven.
Often the adjacent question to that also is, if gold isn't the safe haven, then what is it?
Yeah, you know, it's interesting. Bonds, I think, are interesting here. We're back in that 440, 450 zone where historically the last just couple of years you've wanted to be a buyer, not a seller of bonds. The weakness in equities has generally been on the path to 450, not from 450. So you're in that zone where if the playbook from the last several years holds, this is actually where you might be thinking about long bonds.
Yeah, and again, we heard that from PIMCO, JP Morgan's, a few others. So joining that, Chris, wonderful to see you.
Great to be here, Danny.
Thank you for stopping by after your long travels. Great to have you back in the U.S. strategist partner and chief market strategist, Chris Verone, a Baird company. Let's get a check on your equity market right now because we are gaining. We're up more than 0.5%. Breath is pretty good. 424 stocks are up this morning, only 77 down. And it's the Mag 7, along with some oil companies, that's trading higher. Microsoft, Amazon, Meta, JP Morgan. Recall on Friday, it was those big tech companies having a really tough go of it. Yields come in. That allows them to rally. Energy companies also rallying. Eli Lilly rallying this morning, too. On the downside, Apple having less of a good day. Cisco, we're going to talk with Liana Baker of our deals team about this in just a moment, but a big deal from them buying another restaurant provider that caters more to small and medium-sized businesses. NVIDIA is down this morning about 0.7%, but I believe, if my memory serves me correctly, all sectors are up this morning, and there you go. They all are. When's the last time you've seen this? I actually don't know if we've seen this since the start of the war. I'm sure we have, but memory isn't working for me on this Monday morning. We did have 5 consecutive weeks of declines for the S&P 500, so this is a turnaround. Will it hold? We have at the top of the pile, energy doing well, materials, utilities, financials. At the bottom of the pile, it's staples and information technology. Again, we are up 0.6%. Coming up, the European Union's antitrust chief, Teresa Ribera, joins to talk about AI priorities after her visits in San Francisco. This is Bloomberg Open Interest.
In case you missed it on the opening trade.
Software's going to survive and software's going to do quite well overall, but the multiples that they trade at have contracted, and they'll probably stay contracted for a while until we can sort out the winners from the losers. The markets have woken up, and so no, I'm not surprised at all. I tried to warn people 2 years ago, a year ago, I wrote about it, I spoke openly to our investors here on Bloomberg
Television. So why did it take so long?
And so, you know, that's a question for, you know, the markets, and so the markets take some time to adjust sometimes, but to me it was a train coming down the tracks that you could see from some distance, because we first started learning about this with the first drop of OpenAI 3 years ago, and so I started thinking about this 3 years ago. I started openly speaking about this 2 years ago, and so that's why Marathon only has 1% exposure to software.
Don't miss the opening trade, live every weekday.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
Key
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Where did you get the idea for Play-Doh?
My one son was playing with a mound of Play-Doh, and he said, "Dad, voila." And I thought, this is what I'm trying to do every day, to make something that you can't make a judgment about.
Minutes into your trading day, here's where we stand. A rally on our hands. Will it last after 5 consecutive days of declines? We're up 0.4% for the S&P, off of the initial highs as Brent crude still moving up by more than 2.5%. Let's get some top calls from the analyst action that we're focusing in on this morning. First up, BNP Paribas initiating Starbucks with an underperform rating, saying the stock's premium assumes near perfect execution while the company's risks remain high and its earnings visibility is limited. Next up, Deutsche Bank is upgrading Colgate palm oil to a buy, saying the company is making the right long-term investments and it also has the flexibility to weather the current volatility. And finally, Jefferies upgrades Expedia, saying the stock looks cheap after a broad sell-off tied to AI fears. The firm also says that Expedia faces less geopolitical risk than its peers. Europe's top antitrust chief says that tech trends of snapping up startup talent and technology without embarking on a formal takeover warrants further scrutiny. European Commission Executive Vice President Teresa Ribera has been meeting with tech executives and regulators in the U.S., and I'm so pleased to say joins us now. Thank you so much for joining us, Commissioner. We appreciate your time this morning.
Thank you. Thank you so much. It is my great pleasure to be with you today.
So you've had meetings with the who's who of different tech executives, Sundar Pichai, Mark Zuckerberg, Sam Altman. What was your takeaway from those conversations?
I think that it was a good way to open conversation with them, so to clarify why it is important to keep an open, competitive market also in the digital sector, because we need new entrants in commerce that have good ideas to have a chance to compete with the big guys, and for that interoperability, access to data is so key. So I think that it is great to understand where their concerns may be, but also to state clearly that our competition rule to ensure that the market stays open and thriving is key.
Obviously, this has been an issue which you've been focused on for some time when it comes to big tech, but the new wrinkle in it is AI. And you have these behemoths and open interest and Anthropic that have really come in and started to hoover up a lot of the market share. Are regulators already behind in this very fast advancing technology?
This is quite an important question, the one that you are raising. In fact, things happen so fast that we are wondering to what extent they need to think also in ethical terms, how we can ensure that the data being used to develop these services is sound and we do not make mistakes, that there may be new challenges ahead of us that could impact on how we create things and remunerate this creativity, how we can provide sound information, not to give us room for biased information, how it could impact in the way we work and we take news and we make up our minds is so important. So again, for these questions, ethics is important, understanding how it may impact in an anticipated manner is important, and having this conversation with the main stakeholders to ensure that things go reasonably smooth, even if quick, is absolutely key.
Do you think your U.S. counterparts are also as keyed in to this as you as well? How have those conversations looked?
I had nice conversations with the people in charge of the antitrust capacities in the DOJ, in the Department of Justice. I have the sense that an average American citizen may share the same type of concerns than an average European citizen. Think of what it has happened last week in Los Angeles and New Mexico with the grand jury stating that we need to pay attention to how this may impact in the education of our children, the type of information that they may get, and how it can ensure or facilitate a great impact in terms of how they feel and how they engage towards behaviors that no parent would like to see in their children.
Right. Well, I mean, so historically, I guess the question is, how do you deal with this? And historically, the Commission has sought after behavioral orders, sometimes fines. Is that the path to continue going down, or is it time for some of these big tech companies and these big emergent AI companies to start to look at things like breakups?
There are things that can bring inspiration from the past. For instance, I have just been having a very nice conversation on how the traditional media were responsible for the type of information and the credibility of the information that was reflected in their pages, in their TVs. This is what we try to reflect in what we call gatekeepers. So those relevant players in the digital field should also have some responsibilities on what they are providing to the final users to ensure that there is a minimum threshold to be respected. Then there are new questions that we may identify as relevant questions, and this is where I think that we need to engage together in a very candid manner, but firm manner. And yes, regulators need to identify the best things to do that. What we try to do, we try to come up in a learning process with a specification. So saying, in order to ensure that these obligations that you may have as a gatekeeper, we identify that there are things that do not match very well. We would like to have some clarifications. Can we engage in an early conversation to ensure that you comply? Not because we are going to end with a fine. That may be the case if it is necessary. But the thing is how we can learn to ensure this compliance with these minimum rules in order to ensure that things do happen, how to say,
How concerned
nicely.
are you that any of that pushing, that attempt to get these tech companies to engage with that, and then the threat of fines at the end, might also result in retaliation from this American administration if it is around U.S. tech companies?
That is quite a weird comment that comes with some frequency from our U.S. counterparts at the federal government. These regulations started to be crafted during Trump 1 administration. Trump himself is an owner of a very small digital service company. So he could also think that this small digital service company would like to grow up in a context where the big ones should not be ensure this concentration of power in the market. So I think that to a certain extent there may be misunderstandings. This is not related at all in terms of trade behaviors. It is not related at all in terms of trying to attack any American company. On the contrary, these American companies have succeeded, but they are the main players in digital markets, as it may happen in other sectors that players come from other countries in the world. That doesn't mean going against American companies, but taking care of a market that is mainly crowded with American companies, big and small. By the way, there are lots of small American companies knocking on the doors of the European Union to say, hey, we may trust you because your regulation goes quicker and is much more effective in terms of ensuring that we can accede to this market. So I don't think that this is a fair claim. And on the contrary, we are more than happy to come up, to explain, to identify how we can improve, but of course, with full respect of our own capacity to decide on a democratic basis how we can take care of our own citizens.
Commissioner, really appreciate you stopping by here as well on your tour for the U.S. For you to explain to us what you're looking at, that is the European Commission Executive Vice President Teresa Ribera. Thank you so much. Coming up, Cisco is buying Jetro Restaurant Depot. $29 billion is the price tag on that as shares fall 12.5%. We'll have the deal details for you up next. You're watching Bloomberg Open Interest.
bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Next week on Leaders with me, Francine Lacroix. I speak to George Alhedri, the CEO of HSBC, about his massive restructure.
Things don't become complex by design. They end up becoming complex by lack of focus.
Integrating AI into the bank.
If we don't know how to embrace it, we will become obsolete.
And how to run a meeting.
Make decisions.
So tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Cisco is buying Jetro Restaurant Depot in a $29 billion deal that will create one of the largest food service groups in the United States. Joining us now is Liana Baker, Bloomberg's U.S. Deals Managing Editor. Liana, what is the thinking behind the joining of these two very large restaurant servicing companies?
For Cisco, the key is going to be cash and carry. That's Jetro Restaurant Depot's big business. As a mom and pop owner or any restaurant owner, you show up with your credit card, you take what you need, whether it's meats or fish or fruit, it's heavily discounted, and then you leave that day. This is a new business for Cisco. Cisco has more consulting type relationships with their big customers, whether it's hospitals or stadiums or massive restaurant chains where you have huge orders. These are smaller orders, and Cisco believes this is going to be more resilient to what happens in the economy. Apparently, in a downturn, smaller restaurants want to save money, and these businesses, cash and carry, do pretty well.
The stock, though, getting hammered. I mean, down 12.5% thereabouts. There's something here, not even just, the fact that they're the acquirer, so they might fall, but there's something here that clearly shareholders aren't really liking.
So I would say that even though these companies knew each other for 50 years, which is what Cisco said on the conference call, it was a bit of a surprise to see this deal this morning. $22 billion in debt Cisco is going to have to raise for it. And there's also a stock component, and that means it's going to be dilutive to shareholders. So all of that came as a surprise, and why you might see a bit of an overhang on the stock.
And I know Fitch and Moody's also said that they were looking for a possible downgrade. I mean, we've seen in financing from some of the biggest banks about terms being disputed. There was that JP Morgan CD&R. How difficult would it be for a company like this to get this deal done, to raise $21 billion of debt, and to have a market digest it, and to not have themselves downgraded off the back of it?
Sure. Well, Cisco Foods is a really big company. You might see their trucks everywhere. So it's sort of a blue chip name, even through a downgrade. This is a company people know. You could see their balance sheet, their sales. And this deal will add 20%, revenue to the, balance sheet. So I think there's going to be a lot to like long term for Cisco if you buy into what they're saying. But certainly this Restaurant Depot is a great business. It started here in New York. It's actually controlled by a South African billionaire. And Leonard Green, a private equity firm, also had a stake in it.
Well, I definitely do see those trucks literally everywhere. So definitely familiar with it. Liana, thank you so much for joining us. Liana Baker from our Bloomberg Deals team. And catch Liana and her team alongside me every Wednesday on Bloomberg Deals at 12 p.m. New York time. Coming up in the next hour, Caterina Simonetti tells us if the correction is nearing an end. Ken Kinsella discusses anxiety around private credit funds and redemptions. And Gareth McCartney from UBS on the Iranian war's impact on M&A and IPOs. You're watching Bloomberg Open Interest.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies. You know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
CBS News on the Hour, your home for original reporting.
I'm Deborah Rodriguez. President Trump has issued new warnings this morning to obliterate Iran's Karg Island and target desalination plants if Tehran doesn't agree to a peace plan and open the Strait of Hormuz immediately. CBS News has learned hundreds of U.S. Special Forces, including Navy SEALs and Army Rangers, have arrived to help get the job done. Correspondent Elizabeth Palmer is at the foreign desk.
There's no question the country is being pummeled. There was very heavy bombing around the country last night, including in Tehran. And eventually the regime needs that to stop. For now, though, it has a powerful leverage in that it's able to choke the Straits of Hormuz and force the price of oil up.
Slight improvements reported at U.S. airports, with TSA workers set to receive back pay as soon as today, after President Trump issued an executive order. Roderick Pfeiffer passed through the airport in Philly. I think it's sad that they had to wait this long, but I mean, kudos to the people who stuck around because they made it easier for people like me who still had to travel. TSA officers have been working or calling out sick for over a month during the partial government shutdown. The Artemis II moon rocket is on the launch pad in Florida, set for blast-off Wednesday for the first human flight to the moon in more than 50 years. Lori Glaze heads the NASA program.
Our flight systems are ready. The ground systems are ready. Our launch and operations teams are ready. And our flight operations team in Houston are also ready.
The launch pad is the same one that was used in the historic Apollo missions in the 60s and 70s. We're learning more about a deadly mid-air collision near Washington last year.
Documents show 2 close calls at Reagan National Airport in Washington, D.C., shortly before the deadly mid-air collision between an Army helicopter and an American Airlines jet January 29th of last year. Emily Hanoka was working in the control tower at the time. She told CBS's 60 Minutes controllers long worried about safety issues.
You had frontline controllers ringing that bell for years and years saying, this is not safe.
this cannot continue. Please change this. And that didn't happen.
67 people were killed in the collision over the Potomac River. Jim Crisula, CBS News.
Some top international beauty brands are being accused of shady marketing practices targeting kids. CBS's Vicki Barker.
At Sephora,
Italian regulators are investigating beauty brands Benefit and Sephora for covertly marketing anti-aging treatments and other beauty products to children. They suspect parent company LVMH of recruiting young influencers to market skincare to children.
Dow up 129. This is CBS News. Former Trump official has issues with a current nominee.
President Trump's former Surgeon General slams the current choice for the post. Jerome Adams was on Face the Nation.
70% of Americans say they support childhood vaccines and school mandates, yet a similar majority say they do not trust health information from Robert Kennedy and say they would not trust Surgeon General nominee Casey Means.
On Air Force One last night, President Trump was asked if he's considering pulling her nomination.
We're looking at a lot of different things.
Means, a physician who is a wellness influencer, has seen her nomination stall on Capitol Hill. Steve Kathan, CBS News.
The flap over an English-only condolence message has ended with retirement. Air Canada says its CEO, Michael Rousseau, is calling it a career later this year after he failed to issue condolences in both English and French after two Canadian pilots, one from French-speaking Quebec, were killed in a collision with a fire truck at New York's LaGuardia Airport. Deborah Rodriguez, CBS News.
Staples presents.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube. We're streaming live on Bloomberg.com as well. Scarlett Fu and Paul Sweeney along with you here, the Bloomberg Intelligence Radio program. Coming up, we're going to check in with Matthew Dion, Bloomberg Montreal Bureau Chief. Air Canada CEO to quit over furor about crash condolence video. I didn't know. It just, once again, it just highlights the sensitivity of language in Canada.
He actually has gotten into some hot water over this a while ago, too, so it's not the first time.
And apparently he's been trying to learn French, just not happening for him. So Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes, is going to join us here. And then at the bottom of the hour, Fed Chair Jerome Powell participates in a moderated discussion at Harvard University's Principle of Economics class. We're going to bring that discussion to you. That'll be at the bottom of the hour. Ed Price, Senior Non-Resident Fellow at NYU. He'll join us here to get the latest on what's happening in Iran. Does not seem to be like anyone is standing down at this point. But right now, let's kick this whole thing off with Alexis Christophers and a business flash. Alexis.
All right, thanks very much, Paul. So stocks have turned mixed here in recent trading. Oil is higher, though, as investors try to assess what the ongoing war with Iran will mean for global economic growth. Let's begin with equities, where the S&P 500 is now up just 9 points. The Dow Jones Industrial Average up about 173. That's after rallying about 400 points earlier this morning. The NASDAQ Composite reversing an early rally and now down about 15 points. The Russell 2000 down about 10 points. As for oil, we've got Brent crude up 1.5% at 114.36 the barrel. WTI crude at 102.47 the barrel. The Bloomberg Dollar Spot Index stronger at 1222.53, and yields are lower. 2-year yield 3.83%, 10-year 4.35%. Taking a look at some stocks, Cisco down 11%. This is the food distributor Cisco. That is the most in nearly 6 years. It is also the worst performer in the S&P 500 after the company said it plans to raise about $21 billion of debt to help fund its $29 billion buyout of the wholesale food supplier Jetro Restaurant Depot. And watching shares of Alcoa here, they're up 11% in the early going as as aluminum, the metal aluminum, rises about 3% today after Iran struck 2 aluminum facilities in the Middle East over the weekend. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, Alexis, thank you so much. We appreciate that. Scarlett, Phil, and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube, and we're streaming live on Bloomberg.com as well. As Alexis was just reporting, we got red and green on the screen here today. Let's take a look at some of the stock movers on the day here. We're joined by Bloomberg's Isabel Lee. Isabel, what are you looking at today?
We're looking at Expedia, ticker EXPE, but I want to throw in Instacart there, ticker CART, because both shares are in the green with Expedia up by more than 1%. Instacart up by more than 4%. That's after Jefferies upgraded both to buy. The firm said a pullback on concerns of AI would mean that there's a good buying opportunity for both shares. So the two stocks are poised for upgrades to consensus estimates, trade at notable valuation discounts when adjusted for growth, and are less exposed to geopolitical risks. So Expedia can continue to grow EPS by 20% per annum in the next 3 years. And Instacart should see at least mid-teens EPS growth going forward. So both those stocks are seeing a huge jump today, and they're green.
And they're green. All right, let's talk about some M&A because it is Monday.
M&A. So this is Cisco, ticker SYY. It's not the Cisco CISCO. It's
food company.
SYCSO, yes. Yep. It's a food company. They supply food to restaurants, hospitals, and schools and have a market value of at least $40 billion, which is interesting because I don't think I've heard of this Cisco, but I guess it's one of those companies that are very valuable on the back end.
You see the trucks all around.
Oh, okay.
And they just park, and then they walk, and they deliver all the stuff to the restaurants within like a 2-block radius. I haven't heard the company they're buying, though.
Yes, I'm in the Grammy subway, so maybe that's why I don't see trucks. But yes, they're buying. So they agreed to buy a privately held Jetro restaurant for $29.1 billion. So this is a cash and carry wholesaler, and they serve around 700,000 smaller restaurant owners and food service operators. So I guess it makes sense. It's kind of the same.
Yeah, I feel like I've gone past the Restaurant Depot before in the past.
I
think it's in Brooklyn, if I'm remembering correctly.
Well, what's interesting is this seller, this company that's being acquired, privately held.
Yeah.
So here's a privately held company. He's going to get a, $30 billion payday?
Yeah, $39 billion. And the financing would help them, their credit ratings, for one. Cisco said it's pausing its share repurchase program to prioritize reducing leverage following the acquisition. It's the largest cash and carry wholesaler in the U.S. That's Jetro. So again,
and investment bankers, we got J.P. Morgan doing some financing. We got the acquirer advised by Goldman Sachs and TD Securities. Yes. And the sellers being advised by Evercore. Again, another boutique investment bank getting paid big time on a big deal.
And Jetro was founded in 1976 by Nathan Kirsch. He's a South African billionaire.
Yep. Awesome. Good for them.
566 Hamilton Avenue in Brooklyn. There's also one in Jersey City, Paul.
Okay.
On Amity Road. In the industrial parts of town, essentially.
Got it. One more. What do you got for us?
Viridian Therapeutics, ticker VRDN. Stock is down more than 30%. It pared back some of those losses, but still it's down 34%. This is again after a clinical trial in active thyroid eye diseases. They announced those results, but it fell because the drug developer gave efficacy data from a late-stage trial of its experimental therapy that fell short of expectations. Again, we talk about all these biotech companies, and they swing big gains and big losses depending on the outcome. But for now, it's not looking so great for them. We have Jefferies, though, still maintaining a buy rating.
Okay.
So there's that.
All right, very good, Isabel Lee. Thank you so much. We appreciate that. Isabel Lee giving us the latest there on what's moving in the stock market. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else you listen. I don't really fully appreciate the sensitivity to language in Canada. And once again, it came again today, and I don't think the CEO of Air Canada does as well.
Then that might be the problem.
Yes, exactly right. So the Air Canada CEO is going to stepping down after a furor over the crash condolence video that it was only really in English, not in French. And of course, for the 21% of the people in Canada that have French as their primary language, that's a problem.
And one of the two pilots who was killed in the crash was from Quebec, and this flight was actually headquartered in the Montreal region. I believe it came from Montreal as well. He did say bonjour and merci.
I can do that.
But that's it.
Yeah. Matthew Dion joins us here, Bloomberg Montreal Bureau Chief. Matthew, thanks so much for joining us. What's happening at Air Canada?
I think we have to go back a few years ago to understand what's going on. So in 2021, Michael Rousseau was CFO and then became in 2021 the CEO of Air Canada. He made a speech in front of business leaders in Montreal. Montreal is a bilingual city, right? But within French-speaking Quebec. It's the only territory essentially in North America where people still talk French, and Quebecers want to preserve that. And there are some laws in place to preserve it because there's a lot of pressure from English coming in and a lot of influence, right? So after his speech, Michael Rousseau talks to reporters, and some reporters are asking him, why did you deliver your speech only in English? Why not even a few words in French? And he essentially said that he's been able to live in Montreal for more than a decade without speaking French. He was proud of that. That sparked outrage. And over the years, it was a constant criticism about him from French Canadians, French-speaking Quebecers. Then, last Monday, he makes this video statement entirely in English. Like you said, he said, bonjour and merci. That's hi and thank you, right? There was some captions in French at the bottom, but considering that one of the boat pilots killed was a French speaker, Antoine Forêt, and you have a lot of employees working at Air Canada who are from Quebec. So it sparked outrage in the province because it was the last straw, essentially. Then you have Prime Minister Mark Carney coming in, saying that Air Canada has a responsibility to always communicate in both languages, regardless of the situation. Air Canada is subject to the Official Languages Act in Canada. There's a law in place. The two languages in Canada are French and English. So that's essentially what happened there. And you even had the National Assembly of Quebec passing a motion last week asking for Michael Rousseau to resign. So that brought us essentially to today.
Matthew, I'm looking at the Air Canada ticker on the Bloomberg terminal. If you go to the DES page, it gives you all the basic information. And what you see there is that Air Canada is based in Quebec City, St. Laurent, which I'm probably mispronouncing. So this is a company that's probably based in Quebec itself. Why was this not an issue from the get-go? Why did he become CEO even with this language deficiency?
That's a real good question. A lot of CEOs are appointed in Montreal, and with the promise to learn a little bit of French. Michael Rousseau said that he took more than 300 hours of classes in French, and today all he's able to say is bonjour and merci. So a lot of Quebecers are just seeing that as a lack of consideration, or even something like that's very condescending on his part regarding the French language. So, I mean, he was appointed with the promise probably that he would learn French. I mean, as a CEO, he did deliver at the beginning with Air Canada, deleveraging the company from the COVID pandemic. Over the past few months, year or so, the company has underperformed global peers, but it delivered from a CEO point of view, if you want. But on the French language side, like, it really failed here. And he failed especially last week. And today, the company had to issue its notice to shareholders for the annual meeting on May 1st. In the documents and the filings, you have the compensation of the CEO in 2025. So Michael Rousseau earned a compensation of $13.1 million Canadian dollars in 2025, up 6% from a year ago. So that would have added another layer into this debate. And it's our understanding that Air Canada wanted to end this. And there was especially a global search for a new CEO anyway, because he was planning to retire.
Okay.
That search started in January. So probably that they just announced this sooner than expected. And now he's expected to retire at the end of the third quarter of this year, which is on September 30th.
All right, Matthew, thank you so much. We really appreciate your reporting. Matthew Dion, Montreal Bureau Chief for Bloomberg News, joining us from Montreal. Again, the Air Canada CEO leaving a little bit earlier than anticipated. Again, that condolence video in English only, no French, and that is obviously
There were some captions. They did have some subtitles, but that's not what people were looking for.
So I'm guessing the new CEO will at least be bilingual.
Yeah,
at the least
I think it's safe to say.
Got a little bit of green on the screen. We're giving up some of the gains from earlier. The S&P up 15 points here. The VIX sitting right at 30.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash is brought to you by EisnerAmper. Most advisors tell you what happened. EisnerAmper tells you what to do about it. Assurance, tax, outsourcing, and advisory services built for businesses that can't afford to guess. EisnerAmper.com. Taking a look at the action on Wall Street, stocks are mostly higher as investors go bargain hunting following a deep sell-off last week that pushed the Dow and NASDAQ 10% below their recent highs. We've got the S&P 500 now up 14 points at 63.82. Dow Jones Industrial average up 185 points, or about 0.5%. NASDAQ up just about 15 points right now. Oil is pulling back a little bit from the morning highs. We've got Brent crude up about 1% at $113.68 the barrel after being up more than $115. WTI crude now at $102.10 the barrel. We've got shares of the food distributor Sysco, the worst performer in the S&P 500 today. It's down more than 12%. Moody's says Sysco's debt is now on review for a downgrade after the company said it plans to raise about $21 billion of debt to help fund its $29 billion buyout of the wholesale food supplier Jetro Restaurant Depot. And shares of CVS Health are on the move, up about 1%. It plans to open more pharmacies than it closes this year, marking the end of a 4-year contraction for the largest American retail pharmacy chain. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous, and that's a Bloomberg Business Flash. Paul and Scarlett.
All right, good stuff. Thank you so much, Alexis Christoforous. As Alexis was telling us, we are seeing a recovery in U.S. equity markets today, with stocks higher after the S&P and the NASDAQ entered a correction last week. That is down 10% from their recent highs. So where do we go from here? Let's bring in Phil Orlando. Phil is Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes. And Phil, I feel like when it comes to any risky asset, it really depends on where oil goes. Yet today you have a day in which oil prices are rising and show no signs of really slowing down, given the vitriol right now, the rhetoric between Iran and the U.S., and the fact that there is no resolution anytime soon, and yet investors are willing to go bargain hunting. How are you thinking through all of this?
Good morning, Scarlett. First of all, thank you very much for having me back on the program. I'd focus on the increase in the price of crude oil, and I would note that the rally, and I'm putting that in quotation marks, that we're seeing in the equity market is relatively de minimis, given the roughly 9% decline we've seen in the S&P 500 from the record high of 7,000 right towards the end of January. So you've got some structural issues this week that would suggest that the path of the stock market is probably still lower here in the immediate future. We've got this 15-point peace plan that the administration laid out that, you know, is unlikely to be accepted by the Iranians. The Iranian counter plan is unlikely to be accepted by Israel, the United States, and our Gulf allies. The president extended the deadline for the final blow by 10 days out to April 6th. That's next Monday. And then you look at where we are here with Easter week and the Passover holiday. The equity markets closed here in the United States on Friday. Equity markets are closed in Europe on Monday. I'm not sure that investors want to be long equities on Thursday going into potentially a 4-day weekend, depending upon where you're trading from, given the fact that there may be a military incursion that accelerates the beginning of next week. So for all those reasons, I think the path of least resistance here, it probably continues to be lower until we've got some more clarity on exactly what's going on.
Phil, is there a scenario where these equity markets can move higher with oil where it is? Is there a time when fundamentals such as earnings, such as interest rates, maybe can fight through the concern of higher energy, or do we need resolution in Iran before this market can start to move higher?
Well, certainly there are some aspects of the market, like the energy companies themselves, which are probably doing fine with $100 crude. But I think for the rest of the market and the impact on inflation and what might the Federal Reserve's monetary policy plans be in the second half of this year, we'd much prefer to see a resolution of this situation and the sort of Damocles hanging over the head of inflation based upon the impact that we may or may not see crude oil prices depending upon how long this whole thing lasts. So I think we want to see a positive resolution and getting energy prices back to a more normal fundamental supply-demand balance, as opposed to one that's elevated with the equity risk premium that we're dealing with right now.
There's also talk that from U.S. government officials, analysts, having to kind of consider all kinds of scenarios, including the prospect of $200 barrel oil. What would that mean for the U.S. market, for U.S. companies? I mean, we mentioned how energy companies in the U.S. might be okay with that, but what about consumer companies? What about manufacturing companies?
Well, Scarlett, this is the $64,000 question that the market's grappling with right now. The bear case is that this conflict is another forever war in the Middle East. Crude oil goes to $200 a barrel. Gasoline goes to $6 a gallon. We're looking at best, a stagflationary environment, probably a recessionary environment, and the Federal Reserve is forced to increase interest rates in order to deal with the inflation problem. That's not our view. Right? Our base case is that this situation is going to be resolved in relatively short order rather than a forever type war. We'd love to see energy prices moving back towards a more reasonable fundamental point of view. We were at $65 a barrel, a month or two ago, and whatever short-term spike there is in inflation, that calms down. We get a leadership transition at the Federal Reserve, and we begin to see lower interest rates, later this year and into the beginning of next. Those are two diametrically different views of how the world is going to play out from an economic standpoint, a military standpoint, and a financial market standpoint. I can't tell you with any confidence which scenario is going to happen given what we think we know right now. So that uncertainty is clearly filtering in to stock prices and bond prices for that matter. Ordinarily, you would expect to see Treasury yields plumbing below 4% as a flight to safety, yet we're up in that 440, 450 neighborhood, I guess because of the concern about inflation. So nothing's working right now.
Yeah.
There's no place to hide out in the bond market until we've got this thing figured out.
How do you think these markets will react? Let's assume we come to some resolution at some point in time. Is it a snapback? What does history teach us about how these markets recover?
I would expect that the snapback would be brisk, that the markets would rip on this.
Yep.
Because the longer term picture, if you've forced regime change in Iran and you've got the Strait of Hormuz as international waters, you've got a free flow of crude oil again. Crude oil moves back to $60 a barrel, and importantly, you've eradicated or eliminated the threat of an axis of evil regime with nuclear capability. So I think the market would respond very well to that. The question is, where's the bottom here? Is the bottom today? Is the bottom the long-term support line below 6,000? Depending upon how long this situation lasts, we've got complete uncertainty and visibility in terms of how long this thing is going to take place, and what's the collateral damage to energy infrastructure.
So, Phil, how are you recommending investors position themselves? You mentioned, at least in the short term, it'd be difficult to see how people might want to be long heading into this long weekend. But beyond that, 3 months out, 6 months out, 1 year out.
So because Paul made a great point that this market could very well rip if and when this thing is resolved. And that our base case is that this thing is going to get resolved. It's not going to last forever. It's not, crude's not going to $200 a barrel. So you don't want to be sitting in cash and potentially missing a huge move. But what you do want to do is have a defensive positioning that are anticipating to some degree the potential that this might happen. We felt that overweighting international stocks with an emerging markets focus, domestic large cap value stocks with a big dividend focus, and domestic small cap stocks, both growth and value, those sectors of the market much cheaper with higher dividend yield support than a lot of the pricey growth and technology names. So our feeling was that if the market was going to pull back by, let's call it 10%, just to keep the math easy, those growth and technology names might be down 20 or 30%. The other sectors that we like, might be down 5% with some of that loss offset by dividend yield support. And then once we get more certainty on how the environment plays out, then we've got the ability to move assets around and get more aggressive if it looks like the threat is behind us and we're going to begin to discount better times ahead.
Hey, Phil, before the Iran war, it was all AI all the time here, and there's been a lot of shifting views about how to play AI in the equity markets. Where were you guys, I guess, pre-Iran, or where are you, assuming this market does come back when we do get some settlements?
So I guess the transition we made was about 9 months ago, sort of mid last year. We thought the growth and technology names had probably gotten ahead of themselves, and companies, the big hyperscalers, had gone from investing excess cash flow into the building of these data centers and the expansion of AI. They were taking on debt at that point. And there was a question in our mind as to whether or not that incremental financing and the expense associated with that was going to reap dividends. So we sort of made a tactical decision at that point to sort of shift gears a little bit, if you will, moving into international and value and the smaller cap names. They were cheaper. They offered better yield support. Fundamentals looked pretty good to us. And then just from a market sentiment standpoint,
right.
Our sense was there was time to sort of, move to the other side of the boat.
All right, Phil, thank you so much for joining us. Phil Orlando on this Monday morning. He is Chief Equity Market Strategist and Head of Client Portfolio Management at Federated Hermes. Joining us, his base case is that oil will not go to $200 a barrel.
All right, so we'll keep an eye on that. But again, expecting a bounce back in markets when we do get some resolution here. In just moments, we're going to go to Harvard University Fed Chairman Jay Powell, participating in a moderated discussion at Harvard's Principles of Economics class. Before that, we want to just check in. Stuart Paul here, U.S. economist for Bloomberg Economics. What do you expect to hear from Mr. Powell today? I mean, boy, it seems like the war is driving the economic discussion, the financial market discussion.
Absolutely. And when you're in a university setting, you can be sure that he's going to be at least asked questions about how he's thinking about balancing inflation and downside growth risks, upside unemployment risks. In a monetary framework, it's obviously a tension that he has to deal with on that front. And I expect that students are going to be pressing him with exactly those questions. What's he putting more weight on? How is he judging inflation expectations? Does he still see inflation expectations as anchored? What does that mean for his inflation outlook? How much downside growth risk is he expecting? How much deterioration in real consumption is he expecting from the rise in gasoline prices? Those are all questions that are likely to be put to him, and what a time to be a student in the room. Together with the Fed chairman during, global conflict.
Right, there's going to be a Q&A as well, so we're going to take you through the entire conversation and the Q&A that follows as well. When it comes to the possibility of a rate hike, this is something that we've seen traders start to price in over the last 2 weeks. And, right now they're pricing in 50% odds of a rate hike sometime this year. Is that just a knee-jerk reaction to all the volatility in oil prices, or do you see reason, Stuart, from where you sit, for the Fed to need to raise interest rates?
I don't think that there's going to be a need for the Fed to raise interest rates, mostly because I think that if we see persistently elevated oil and gasoline prices, the deterioration in the real consumer landscape will start gutting any sort of demand pull inflation that the Fed would have to lean against by hiking rates. So by hiking rates, they're just adding to what's already going on fundamentally in the real economy.
All right, Stuart Paul, he is our Bloomberg U.S. economist with Bloomberg Economics. Let's go now to Harvard University, where Fed Chair Jay Powell is participating in a moderated discussion at the school's Principles of Economics class.
Were you thinking about public service and economic policy making at the start, or did all of that come as a surprise later? And how did you decide to make the pivot when you were in the middle of your career?
Let me start by saying, David, thank you so much for having me, and thanks to all of you for being here today. It's great to be here. I've been looking forward to this. Yeah, so I took macro and micro my freshman year, and it wasn't as interesting to me at that age than some other things, so I wound up majoring in politics, actually specializing in Africa. It's fair to say that my freshman major was acoustic guitar. My parents gave me a Martin D35 for high school graduation. They must have regretted that because that's what I was really working on mostly. But I did finally figure out what I wanted to do. And when I graduated from college, I really had no plan, but I did have one thought, and that is to have a career in the private sector, but also to do public service intermittently. And I was thinking about people like George Shultz, who was famous at many economic jobs, and others who had done those sorts of things. And I grew up in Washington, D.C. My parents were not, my dad had fought in World War II, and he had been a U.S. attorney, but they weren't people who were terribly plugged in politically. I was very interested, though, in those years in public policy and in trying to create a life that was partly private sector and partly public sector, and amazingly enough, that's kind of what happened.
Great. So now, jumping right to the present, we talk about the Fed as a unitary entity, but of course, the Fed is led by the Federal Open Market Committee. There are 12 voting members. You, despite being chair, only have one vote. And in normal times, there's a lot of consensus. Everyone's in agreement. Lately, there's been some disagreement. There's been votes to keep interest rates the same, but some members of the FOMC have decided instead to vote to decrease interest rates. How does the disagreement on the FOMC make your job harder as you describe the path of economic policy going forward?
You know, I don't think of it as making my job harder. I think it's, and I've found throughout my career that when you have a really difficult problem, it helps to hear from all sides. And in a way, for example, when I was a private equity investor and I was looking at supporting a transaction that I wanted to do, I really wanted to hear from the smartest people. Tell me why it's a bad deal. Tell me now before we do it. And I just think you don't really know how much you believe in something until you've had somebody literally try to take it apart. So I welcome that at the FOMC and at the Fed generally. And I think it helps us make better decisions. The Fed has had a tradition of governors not dissenting, but that's really not typical of other major central banks where there's more dissenting, or I mean, they're different, depends on the central bank. And to me, what matters is a dissent thoughtful? Is it helpful? Does it help? Does it express a point of view? Can you stand behind it and say, yeah, that's very thoughtful? And that kind of a thing is not bad. And it doesn't hurt with communications. You know, I think a situation like the present situation where, you know, there's sort of downside risk to the labor market, which suggests keep rates low, but there's upside risk to inflation, which suggests maybe don't keep rates low. You've got tension between the two objectives. And I think to try to expect unanimity at a time like that, where it's really quite historically challenging, it would almost be misleading to be really confident in which way that should go. In fact, it's been said that confidence is what you feel before you really understand the problem.
Okay. Let's turn to the Fed's balance sheet. In 2008, 2009, that great financial crisis, there was a massive expansion in the Fed's balance sheet. And then again in 2020, under your leadership, there was a second vast expansion in the Fed's balance sheet to address these two economic and financial crises. The balance sheet has since come down a bit, but it still sits at over $6 trillion. So I'd like to hear your views on how efficacious this vast bond buying program has been, both in the 2008 and then again in the 2020 episode, and also hear your reaction to the critics who say that the Fed has become too big a player in the bond market. The Fed has become too influential. There's been a muddying of, as according to the critics, of monetary policy and fiscal policy. Do they have a point, or are they wrong?
So I think the place to start with that is the problem that people were struggling with from about 2008 to 2022, let's say, in central banking everywhere in the world is once you've cut interest rates to zero, do you have anything else you can do? Let's say you cut interest rates to zero and the economy is still clearly not flourishing and it wants more support. So do you just say, well, we're done, we're out of ideas here? And there were two ideas that were followed in the global financial crisis, one of which was to buy assets, longer-term assets, and what you're doing there is you're buying longer-term government-guaranteed securities, which would hold down longer-term rates, and that should stimulate the economy. Or also forward guidance, which would tend to hold down forward rates as well, or just rates generally. So we did those two things rather than do nothing. And I think in the first instance, they were both efforts were successful at restoring market function and at restoring financial stability. At the beginning of the global financial crisis and the pandemic, we had massive problems of market function. They were solved. I think the question, getting to your question, David, of the macroeconomic effects is a much less certain question. I don't think there is an accepted answer, but I would just say there's an oceanic quantity of research on this, and overall it tends to find that buying long-term assets does lower interest rates and does provide some support for economic activity. And I guess I'd be in the camp of thinking that there's something in that, but it's hard to quantify it. And I think, different people have different views on how much those effects could be. The other side of it is, QE is thought by the critics to risk all kinds of other things. So, for example, you could buy too much of the Treasury market and it would stop functioning well. We have not seen that here. At the very beginning, there was the thought that it would be inflationary. We have not seen that, or that it would threaten financial stability or even create inequality. So we haven't really seen the downside risks. At the same time, the last thing I'll say is, I remember before I took over as chair thinking, I'll almost certainly never have to do quantitative easing. So what's that expression? Man plans and God laughs, something like that. So it just, the pandemic came around and we needed to do a lot of asset purchases in a big hurry, and we did. So far, no Treasury Department has ever said, stop doing that, you're supporting the economy too much. Maybe that'll happen someday, but it hasn't happened yet.
So let's talk about the dynamics of inflation since the spike in 2022. Inflation has been coming down since then, but it still hasn't reached its 2% target. Some have argued that that last mile is extremely difficult, and to obtain that, we will need a recession. Others have argued that you've gotten us very close and you'll get us the rest of the way. Are you concerned about the time duration of the path from the high inflation of 2022 back to target? It's taken time. We're not there yet. Is that a destination we'll reach, or are you concerned that the last mile will prove very difficult?
So we will reach, the FOMC is and will continue to be committed to getting inflation back to 2% on a sustained basis. That's the place to start. So I feel like we had pretty much gotten there at the end of 2024 against the predictions of almost the entire economics profession. When we raised rates a lot and very quickly in 2022, 100% essentially of economists were forecasting a recession. We didn't have one. Actually, we had 23 and 24 were both very strong years as the supply side healed and as our higher rates had some effect on inflation. So by 2024, you had the economy growing at 2.5%. You had inflation in the 2 plus a few tenths on a 12-month basis by the end of the year. And you had the employment market. You still had the labor market at essentially full employment. So I would call that a soft landing. We had it there. Then since then, we've had to face a much smaller source of inflation, which is the tariff inflation is visible, and we think it's really just a one-time price increase. That's been our thinking since the beginning. Right now, we think it's adding somewhere between 0.5 and a full percentage point to inflation, but that's a much smaller thing than we saw during the pandemic inflation. And and of course now we're facing events in the Middle East which will certainly affect gas prices, and we feel like our policy is in a good place for us to wait and see how that turns out.
Great. So let me turn to the current crisis in the Middle East and the effect on energy prices. Indeed, this classroom is familiar with that question from the last problem set, where we asked, how would you advise the Fed to respond to the rising price of oil? And we teach that when there's a demand shock, it's a pretty natural set of recommendations that emerge for the Fed. But when there's a supply shock, like this energy price shock, there's trade-offs that the Fed has to juggle. How do you make those trade-offs in general, and how do you make those trade-offs in this particular instance? And can you help everyone with their piece?
Well, maybe they should tell me. Sure. So you start with what you said. Our tools work on demand. Higher rates will tend to moderate demand. Lower rates will tend to stimulate demand. And when you have a supply shock, our tool doesn't have meaningful shorter-term effects on supply. So when you have a supply shock, the first question is, do you respond to it? And the classic question has been around energy, just in general, not really speaking about the current situation, although I'll get to that, I guess. But, energy shocks have tended to come and go pretty quickly. Monetary policy works with long and variable lags, famously. And so by the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone, and you're weighing on the economy at a time when it's not appropriate. So the tendency is to look through any kind of a supply shock. But a critical, essential aspect of that is you have to carefully monitor inflation expectations, because you can have a series of these supply shocks, and that can lead the public generally, businesses, price setters, households, lead them to start expecting higher inflation over time. Why wouldn't they? At the end of a certain number of years, the inflation is now just higher, and that can happen. So you monitor that very, very carefully. Also, in the current situation, you have to be mindful of the whole broader context. And the broader context is we're still, we've been coming down close to 2% post-pandemic, but we've never actually, gotten right and stayed at 2%. So it's been a while. And we're very mindful of that fact. Inflation expectations do appear to be well anchored beyond the short term, but nonetheless, it's something as we will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be, but we'll certainly be mindful of that broader context when we make that decision.
We're listening to Fed Chair Jay Powell speaking to Harvard University's Introductory Principles of Economics class. Let's listen in.
Monetary policy. You've also been collaborative with administrations with respect to financial regulation. So under President Biden, you collaborated in a program of increasing regulation. Under President Trump, you've worked together to reduce regulation. So on the one hand, we've got an independent Fed with respect to monetary policy, and on the other hand, we have a collaborative Fed with respect to financial regulation. I don't think there's a tension there, but can you explain to us the two different approaches and how you understand them?
Yes, so start with monetary policy. I think there's pretty broad consensus in both political parties on both sides of Capitol Hill, and our oversight, by the way, is Congress, not the administration. But pretty broad agreement that on monetary policy, the Fed needs to be fully politically independent, not reactive to political things at all. We just need to do our job and stick to our knitting. Regulation is a little bit different, especially since Dodd-Frank, where the Dodd-Frank Act created something called the Vice Chair for Supervision, who has a specific statutory assignment, which is to oversee all of supervision and also set the agenda for regulation. So the Vice Chair for Supervision, if she wants to propose a change in, for example, the Basel III Accords as implemented in the United States, she has to bring that to the Board of Governors, which is the 7 governors, and vote for it. But she has full control over supervision. So as chair, the whole idea is to be non-political and not, never working for or against any political party or individual, or never even considering things like that. So I think the way the law works is the chair should allow the vice chair for supervision to carry out the role that Congress has assigned to that person by statute. And that's what that is. So you'll see And, you know, the two parties really have a big difference on regulation now. So I like to think that the chair should always be someone who is working without regard to political, and should be therefore a person who can be reappointed by either side. That's always been the case. It's been, you know, Ben Bernanke was reappointed, I was reappointed. And I think it's a good test of the Fed's nonpartisanship that your appeal is really bipartisan. I think that's a critical thing. So if I were to try to impose my personal views on regulation, that really wouldn't work. So I think there's I don't want to say deference, but any chair needs to let the vice chair for supervision take the lead on those issues, and then I'm another voter, is what I am.
Great. So let's talk about Dodd-Frank and the reforms to the financial system. 2008 was a terrible crisis, and there were many efforts made in the years afterwards to tighten the bolts and create a safer financial system, less prone to these kinds of cataclysmic events. But today we look out at the world and we see lots of threats, both inside the formal banking system that you regulate and in the non-bank financial system, which is lightly or not at all regulated. So I wanted to have your thoughts on whether we're in a position of relative safety after all the Dodd-Frank and other reforms following the 2008 financial crisis, or whether the new threats actually have brought us to another period of concern. And just to illustrate with a couple examples, inside the banking system, there's commercial real estate that has fallen in value. That affects both the banking system and non-banking financial institutions. We have the private credit market and a very active debate about its health. We have concerns about cybersecurity in the age of AI. Do you worry that another financial crisis looms out there? Of course, there's always a possibility, but is it something that's an issue of high alert, or do you feel that we're putting all the pieces in the right places?
You know, after the global financial crisis, we actually started a new division called the Division of Financial Stability, and their job is to be, you know, sort of the watchers of all financial stability issues all the time. So the old system was a crisis arrives, we get the team together and we battle the crisis. This is much more of an ongoing monitoring thing with a framework that can be checked. So I would say after the global financial crisis, which happened when you all were extremely young, between Dodd-Frank and the Basel agreements, we pretty dramatically raised the amount of capital and liquidity that the largest firms and other banks have. And I think that's been a good thing. I think they're also much sort of more transparent and more aware of their risks and that kind of thing. So I think we've significantly hardened the system against the kinds of things that happened in the global financial crisis, where you had a lot of credit losses really around mortgages. And so that kind of a situation, we've got well-capitalized large banks. But that's just one part of the financial system. The capital markets, the U.S. has by far the largest capital markets sector relative to the banking sector. The other countries still have a much bigger banking sector relative to their capital markets. And, you know, that's going to be less well regulated, and that's a good thing. You want it to be the place where biotech companies can do IPOs, and they may or may not succeed, but they can get capital out of that market. And you know you're taking a lot of risk, but great things happen because people put money into biotech. So we've done some hardening of that, but we shouldn't be trying to regulate risk out of existence. So I think, and we did fix some of the things that broke in the global financial crisis and the pandemic, we did address. The real thing, though, is the financial sector is just always evolving rapidly. And I think the vigilance is what you need. You just need to always know that there's another thing coming. And I think in particular, we've had all kinds of financial crises, but we've never really had a successful cyber attack on a large financial utility, let's say, or financial institution. And that would be quite a different thing. You know, if people are going to lose money in a certain part of the economy, we have a hugely resilient financial system now. It's more, let me say this, it's more about resilience than it is about avoiding crises. One of our former people used to say that we're in the levee building business, not the hurricane prevention business, right? So they're going to be hurricanes, and they're going to come, and you just have to assume you won't know what direction or what the nature of it will be. So you want a highly resilient financial system, and we do have that. But again, nobody who's in that business will ever give you a green light. They'll always say, here, these are the risks, and we got to monitor. You mentioned private credit. So private credit is something as you guys are probably following. It's a relatively small part of a very large asset pool. We're watching it super carefully, as everyone is. We're talking to the people in the industry and investors and everything. I think we understand it. We're monitoring it for looking for things that might lead to greater contagion or greater losses or connections to the banking system. And, you know, we're going to do that. Again, you're not going to hear people say, oh, there's no problem here, because that's a jinx. But nonetheless, it's something that we're following very carefully.
What is one of your biggest regrets in your time as Fed chair? And on the other hand, what is something that you're very proud of?
You know, on regrets, I don't allow myself the luxury of that. I think it's really important that in my job, I'm focused on the windshield and not the rear view mirror. And so I don't. I'm tempted to say regrets, I've had a few, but then again, not so many, or whatever the line is from that Frank Sinatra song. So I just think I'll have plenty of time for that after I'm out of this role. But honestly, you just have to keep looking at the next thing. You can't be berating yourself for the mistakes that you've made. You're going to make mistakes, and you're going to learn from them. Take it from an expert. I've made plenty, but I don't focus on regrets and things like that. You know, overall, in terms of what I'm proud of, I'm more than happy to talk about that.
Let's go for it.
Yeah, let's go deep there. Basically, I'll just say it's an incredible honor to do public service, as many of you will find out at some point in your life. I always wanted to do some of it. I saw these people around Washington who were well-known public servants like George Shultz. I would think that looks like a really interesting thing to do. It's different, you know. In the private sector, I love my years in the private sector, but there really is a feeling of what you're doing is ideally helping all Americans and that kind of thing. It's a great honor to serve the public, and particularly in a job like this. So that is the main thing I'm proud of is, you know, 14 years at the Fed and 8.5 of them as chair. I'll always be proud of that.
And I'm very grateful to you for your service to our country.
Thank you.
So if you were willing to share publicly some advice that you would give to the next Fed chair, we'd love to hear it.
So one thing you will learn when your children are grown up and they have their own children is never volunteer advice. Only give advice when asked. So, and I would only give advice if asked, and I would do it privately. But I'll just say in general a couple things about the Fed. It is very, very important to stick to your knitting and to stick to the things that were actually assigned. And there's always a temptation to want to move into other areas. And I think we have very powerful tools. They're supposed to be for maximum employment and price stability and financial stability. There's always a time when an administration looks and says, it would be good to use that tool for something else. What if we were just to and call that that's part of the mandate? Happens all the time, and we just have to be in a situation where we're not trying to work against any politician or any administration, but we have to be careful to stick to what we're doing. The other thing is, I'll just note that, you know, the Fed's not a perfect institution. Don't look for perfection. What we do is very challenging and highly uncertain, but it's a great American institution, and I'm very proud to work with the people I work with. They're extraordinary right across the board, an incredible group of people, and I'll just close by saying it's very hard to build great democratic institutions and much easier to bring them down.
So, though you were uncomfortable giving unsolicited advice to your successor, I know that the students in this room would love to hear your advice. They've asked me for my advice and asked me what you would advise them. So they're entering into an uncertain time. an economy where new job formation is lower for many reasons. In particular, jobs that were plentiful a couple of years ago for students coming out of college are no longer so. And AI sits as this remarkable technological transformation that is both promising and existentially threatening. So if you're advising the 600 students that sit here today, what would you suggest they think about as they embark on both academic and then ultimately professional careers?
Let me start by saying that I'm well aware, and my colleagues too are well aware of the current situation for students coming out. It's a time of very low job creation. And also you have AI going on. You've got the effects on job creation of significant changes in immigration policy, which have brought down both demand and supply of workers. The unemployment rate is really low, but that doesn't help you if you're coming into that kind of market. So it's a time when the business, I mean, there's a business cycle, right? And you're coming out in the business cycle at a time when getting hired is a little bit challenging. There's also probably something more longer term, more secular that's happening and around technology and AI. So yes, it is a challenging time, but I'll say a couple things. One just is that the U.S. economy, compared to other major open economies and big market-based economies around the world, is just incredibly dynamic and productive. Since World War II, U.S., compared to other, again, large, mature economies, our productivity has grown at like twice the speed, for example, in Europe, and higher productivity is the way, compensation and earnings can grow over time. So it's an incredibly flexible and dynamic economy. It reinvents itself. Technology, it always comes from the United States. So just be optimistic about the medium and longer term. I'm very optimistic about the medium and longer term. The other thing is, my observation is that these large language models make people much more productive. I feel like it's making me more productive because I can learn things really quickly. And I talk to my son and others who are out there in the world, and I think if you use it well, it's making you more productive. So I think you're in a situation where you need to invest the time to really master the use of these new technologies, and that should stand you in good stead. But there's no denying it's a challenging time to enter the labor market, but it may take some patience and all that. But in the longer term, this economy is going to give you great opportunities, and just be a little optimistic about that.
When you're listening to Fed Chair Jay Powell, he's speaking in Harvard University economics class. Economics professor David Leibson is interviewing him.
They'll be wind at our back as we use these tools over the next decade, but at some horizon, let's say 40 years, there'll be substitution rather than complementarity?
It's so hard to say. I mean, a lot of people, you talk to business people, are talking about, the sort of the next few years being big years for AI to come in, but they're mostly talking about existing, middle management, back office jobs and things like that. I don't think it shouldn't have those kinds of effects on people who can use AI well and that kind of thing. I don't know, but so certainly the next few years look like whatever the effects are, we'll start to feel them, because major U.S. companies, and we talk to a lot of those people who run those companies, and they're all looking at what they can do, and the truth is they can take out a lot of jobs that can be automated by a very smart large language model. They just can, and they will, because their competitors are doing it, and they can't afford to have higher costs than their competitors. What's that going to mean for you? It may not mean that much. It depends on what you're going to wind up doing. You may stay in school a little bit, and you may do something that is, it's going to create new jobs too over time. And again, it makes people more productive. I did talk to a CEO in tech world who said the marginal benefit of a new employee in this world is actually very high. Now, that's not what you hear all the time. So I don't know. I mean, if you look back through history, to generalize, this has been going on for a couple hundred years. Since the loom was invented, right, and to put all the people who were doing weaving out of business. But so in all cases, it has wound up raising productivity and raising living standards as long as the society keeps producing people who have the skills and aptitudes to benefit from that technology. So that will be the case here, but you're right, there can be a period during which it's challenging, and this may be one of those, but nonetheless, I would just say it's out there, and it's out there to be done, and I would be medium and longer term very optimistic about this economy compared to any other economy.
Terrific. Thank you so much. We're now going to open it up to your questions. So I think I've got Jason and David in the well, and I've got 2 microphones in the balcony. Why don't we start with Jason? Do you have a question?
I think I have a question.
Okay,
if that's
great,
okay.
fantastic. We're going to let Jason ask the first question.
So, Chair Powell, when you're making decisions at the Fed, I'm curious, how much are you relying on very specific economic models? The Fed has its own big fancy model, FERBIS. How much are you relying on information you get from talking to people out in the real world, to businesses, your own intuition and experience? What do you bring together as a way of thinking about these decisions with a role of economics, but everything else that feeds into it?
So it's really all of the above. We have to start with the perimeter. You know, we have the reserve banks are in touch. They're in all 50 states, right? 12 reserve banks, and they bring summaries of these extensive conversations they have with the public sector, the private sector, universities, healthcare, everything in their district. And we see all of that in the beige book and in the meetings. We get all of that. We also look at several models. It's never just the FERBIS model. It's many, many different models, and we look at different alternative simulations. You look at all of that, and then we look at where our policy stance is, and we look out the window and we say, does it look like our policy stance is affecting the economy in a way that moves us closer to our goal variables or keeps us at our goal variables? You do all of that. We also talk to each other. You know, I talk to the other 18 participants on the FOMC a couple of times each cycle, and people have different thoughts and ways of thinking about things. Talk to the senior staff. You know, they've been doing this longer than any of us. So all of those things go into it. I wouldn't say, you know, I mean, so a good analogy is when I was in the private equity business, we had really good models of companies, and my big boss said, we want to have the best model in the industry, but if you think that model is going to make the decision for you, you're in the wrong business. So the models are just illustrative. We cannot model the U.S. economy with the kind of precision that we will never be able to. Probably it's like modeling the weather. You can't predict it 2 months away. So it's all of those things, Jason.
Thank you.
Okay, so David, why don't you pick the first hand, and then Jason, you'll get the second hand. And then we'll go to the balcony, so looking for someone upstairs.
Hi, my name is Fabio. I'm a first year studying economics and government. I'm really interested in kind of decision-making in the Fed. How do you work with situations where like the decision might be very tight, and like sometimes there's like expectations of like the interest rates increasing, or it might be very tight, and those very tight decisions, like how do you end up making the decision?
So remember, I'm one of 12 voters. So an FOMC cycle is about 7 weeks between meetings. We have 8 of them a year. So, and I would say sort of 3 weeks before the meeting, by then, I have to have a pretty good sense of what I think we need to do. And staff will already have been working on, if we're doing anything in particular, we always have like a special topic. So a lot of work is going on. So I almost need to make a decision about the probable thing we're going to do. And then I have to talk to everybody a couple of times because I got to get people to vote for this. And a lot of it is finding out where the sentiment of the committee is. I've been working with these people for many years, so most of the time I kind of know how they'll approach a problem. That's how it works. So it's a lot of talking and listening and understanding. I think an underrated skill is in listening to people. Listening is, you know, if you listen to people and you hear them and you can make their argument and they understand that you're actually listening to them and not just, you know, communicating at them, for most of the people, most of the time, that's going to be enough. And by the way, that's true on Capitol Hill. That's true. It was true when I was a governor. If I felt, I mean, I always felt like Ben Bernanke or Janet were listening to me, and if they could engage with the points I was making, then I felt like I could support what they wanted me to support. So it's a lot of that, though. I mean, it's a lot of committee management. That's the big part of it is to have active dialogues going with all of the FOMC participants, and by the way, also with all the senior staff who've been doing this a very long time, and they bring. In many cases, they bring, history going back many years. For example, in the public communications that we make, somebody who's been doing that for 30 years will tell you don't use that word, even though that word might make sense in another context.
Okay. Over here.
Good morning, Mr. Powell. I wanted to ask you a bit more about private credit markets and particularly rising defaults among non-bank lenders like Blue Owl Capital. So I wanted to ask, to what extent could stress in these private credit markets spill over into the traditional banking system?
So that's the question we ask ourselves quite a bit. And, as I mentioned, we're watching very carefully. Of course, what you can read in public, we're also getting the backstory from the people who run these organizations and from all the banks. The supervisors are well aware of what the bank's exposure is and what is not. And, I'm reluctant to say anything that suggests that we're dismissive of the risk, but we're looking for connections to the banking system and things that might, result in contagion. We don't see those right now. What we see is, a correction going on, and certainly there'll be people losing money and things like that, but it doesn't seem to have the makings of a broader systemic event. But again, we never give a clean bill of health. We just keep watching for that. We don't see those characteristics though right now.
Okay. Let's go to the balcony, and remember to share your name when you begin your question. Great. What's over here?
Hi, my name is Cody. Thank you so much for being here, Mr. Powell. My question is about whether international relations has impact on your decision making. I know you mentioned that the Fed's job is to do exactly what's best objectively for the American economy, but I'm wondering, if you're competing with, let's say China or other powerful countries, whether or not you would kind of, cut interest rates or do something like that to stimulate the economy to kind of get ahead of other countries.
No, it doesn't. We're always asking the question, as you suggest, what we serve the American public always in all of our decisions, and what is best for them. How do we achieve maximum employment and price stability on a sustainable basis? That's what we're always asking. We do, meet with, in Basel, the central banks all meet without the finance ministries, and we can talk privately about what's going on in global financial markets. It is a global economy. We all know each other, and frankly, many of us have regular communications going on just privately, or by telephone, or email, and text, and things like that. But we're never looking to get on the turf of the national security people or the State Department or things like that. We're not looking at things that way. We're looking at our goals. That would be, I think, a classic case of mission creep if we were to say, hey, let's deviate from just chasing these two goals and let's do something for a third purpose. That would almost by definition make us less effective at the things we're supposed to be doing, so we try to stick to that.
Okay, great. David, you're next.
Good morning. My name is Jenny, and thank you so much for coming. We're all very honored that you took the time to come. So last lecture, we learned about soft landings and about how it's definitely much more ideal than hard landings, but in the US history, we've had far more hard landings than soft landings. And we were just talking about how it's really important that you are monitoring expected inflation. And I think a lot of that just comes down to the trust between the public and the central bank. And the central bank is known to be much more technocratic, but I think especially with the rise of populism and previous events, there seems to be a lot of impact of political tensions between, or cooperation between the Fed chair position and the administration. And I wanted to ask you, how do you still keep the public's trust this way?
By sticking to our jobs and doing them well, ultimately. If we deliver maximum employment and price stability, or at least are seen to be doing everything we possibly can as we meet various shocks and multiple supply shocks in recent years, the public keeps its faith in us. And if you look, we look at things like longer-term inflation expectations, and you'll see that they've remained pretty well anchored right through all of this. So if you really think inflation is going to be higher, you can make some money betting against that. But people don't do that. The people who are putting their money to work in the financial markets, not to give too much credit to that, but that's it. If we stick to our knitting and we do our jobs, we stay out of politics, stay out of the hot political issues of the day, and just do your job and keep your head down. I think I see this through my dealings with elected people. If they get the sense that you're not there to deliver talking points, you're there to listen to them, and you're really somebody who's committed to doing your job and sticking just to that job, and that's all you want, and you're not going to get into politics, that's what we need to do. And I think generally, I think we are accepted in that spirit in Washington, and I think generally around the country as well.
Jason. Remember to tell us your name.
Thank you, Chair Powell, for being here. My name is Jake. As you know, your term ends in May, and a potential successor, Kevin Warsh, has indicated a desire to cut rates if he fills the role of chair. What is your take on the effect that a cut would have on the flexibility of the Fed to remain well positioned to maintain both sides of its dual mandate, particularly given the fact that inflation has remained elevated above the Fed's 2% target for several years now, and progress is further halted by the oil shock and tariffs especially?
Jake, that's not something I'm gonna swing at, that pitch. Is that a Red Sox jersey, by the way?
I called on him.
Yeah, okay. I know this must be Red Sox country.
So we're going to go to the balcony next.
Hi, my name is Eamon Candido. So earlier you said that you don't know how much you believe in something until someone tries to take it apart. So my question was, what's the thing you currently believe about the economy that you're least confident in?
Interesting question. I'm not going to give you a particular individual thing at the moment, but I will say that I would say this, and of course this is self-serving to an extent, but having worked in the private economy for most of my career, I don't have any predisposition to believe that models can really capture it, because so much of it is animal spirits, as Keynes called it, and also it's again, I go back to the weather. Will we ever be able to predict the weather with any precision three months ahead, other than the seasons? So the economy, no one has been able to really successfully predict the economy. So I think the temptation is always to place too much sort of stock in in models or in one particular outlook. The other thing is, another thing which is a big takeaway is, about fat tails, right? So famously there's a normal distribution and the tails are what they are. It's not a normal distribution. The tails are fat, and however fat you think they are, they're fatter than that. The possibility for the economies at any given time is so much broader. For example, the pandemic inflation. We'd spent 15 years with the inflation below target, and that was at a time of QE and lots of fiscal stimulus and that kind of thing. We had inflation below target, and people, pretty much the profession had, the big problem the whole profession was trying to solve was, how do we get inflation up to 2%? That was really the problem. And then along comes the pandemic inflation, and bang, suddenly you have a 40-year high inflation. So it's hard to keep your mind open to just how broad the possibilities are.
Take down here, yes.
Hi, my name is Robert. Thank you so much for being here. I'm a first year studying econ, math, and philosophy. So many economists that I've listened to, at least retroactively, say that what we really needed during the COVID pandemic was around $3 trillion, and the government printed something along $6 trillion more than that. And so inflation rose, but that money is still out there. So if rates come down, obviously you took initiative and you raised them very significantly. If rates get lowered again to, let's say, 2% or so, do you think that the price spikes have already played out, or do you think that all that extra money being out there will, on top of, instability geopolitically, do you think that's going to push us back into an inflationary spiral? And then also I was wondering, for your next press conference, are you going to start it with good afternoon or hello, everyone?
Let's talk about that later. Sorry, the first question was
the expansion of the money supply.
Yeah, no, so I think monetary quantities are a very challenging way to try to think about inflation and the economy. There was a time when the profession thought that, monetary quantities and inflation were tightly linked. And of course, in an abstract way or in a simple model, it makes sense. If you don't increase the amount of goods and you double the amount of money, then the price has to go up. But there has been relatively little correlation. And, my story of the pandemic inflation would not be about monetary quantities mainly. I'm not saying it might not have played a role. It was more, you did have a lot of stimulus, particularly in the United States. At the same time, we were looking at the possibility of another Great Depression. We didn't know whether there would ever be a vaccine. We didn't know what this was going to be. How many millions of people was the disease going to kill? So literally, for the first time, probably ever, we're looking at little alternative simulations that are a Great Depression lasting many years. So we did a lot of stimulus. And then when the global economy reopened after shutting down, you had this burst of demand, red hot demand, and constrained supply still. So automobiles is a great example. Everybody wanted a car because they didn't want to take public transportation, and they'd all moved to the suburbs and out of the city. So I need a car, and yet you couldn't make cars because you couldn't get the semiconductors. So you're looking at a vertical supply curve. So a little bit of demand drove prices up a lot. Then, of course, we took the view, my colleagues and I did, that a vertical supply curve works both ways. If a little bit of demand could bring that price right down, and also it won't be vertical forever. It'll start. You'll get supply side healing. You got those two things. It was always both supply and demand for me, and you got inflation coming down very sharply in 23 and 24. We got close to the end of your question. We got pretty close to 2% by the end of 24. Now we were just dealing with the effect of tariffs, which have largely fallen here in the U.S. and not abroad. They've been less than expected because the other side, others didn't retaliate, and also because what was implemented was less than what had been announced. Nonetheless, that was the piece. We were at about 3% inflation, and somewhere between 0.5 and 0.8 of that is from tariffs. So we've been pretty close to 2% all this time. Now we have another supply shock coming. It's one of those times where you get a series of supply shocks. First the pandemic, then the much smaller one from tariffs, and then we're getting now an energy shock. No one knows how big it will be. It's way too early to know. As I mentioned, we do think our policy's in a good place for us to wait and see.
We're listening to Fed Chair Jerome Powell, participating in a moderated discussion at Harvard University's Principles of Economics class. Let's listen.
Hi, Mr. Powell. I'm Lola, and I was wondering at what point does the size of the U.S.'s debt break the point of natural systems repayment, and if that's something you're worried about now or something you think our generation should look out for?
I don't think we know what that number is, a sort of ratio of debt to GDP, where it'll be a problem. There are, of course, Japan being a great example, there are countries that have much higher levels of sovereign debt to their GDP than we do. What's clear is that our debt is growing much faster. The federal government debt is growing substantially faster than our economy, and that ratio is going up. And, in the long run, that's kind of the definition of unsustainable. The level of the debt is not unsustainable, but the path is not sustainable. And so it's really important that we get back to, we don't have to pay the debt down. We just need to have, primary balance and and begin to have the economy actually growing better, growing more quickly than the economy. It will not end well if we don't do something fairly soon. This is not the Fed's job, of course, and I pretty much limit myself to those high-level points which essentially everyone ignores.
So we're going to thank Chair Powell, but let me just describe the sequence of events that now follows. So first, we'll thank Chair Powell. Then anyone who wants to is welcome to join us on the stage, and we'll take a group photo with Chair Powell. Because of a tight schedule, there can't be any selfies, because if there's one selfie, there's 600 selfies. Right. So you'll need to make do with one photograph of the entire class with our esteemed guest. But before we do that, please join me in warmly thanking Chair Powell.
There you go. Fed Chairman Jerome Powell, participating in a moderated discussion at Harvard University. The Principles of Economics class. The moderator was Harvard University economics professor David Laibson. So I think the Fed chair is saying, you know, there's a lot of uncertainties out there, a lot of crosswinds out there. Most recently, the war, and that suggests that perhaps this Fed can just wait and see a little.
Right. And in fact, I think the takeaway here is policy is in a good place for us to wait and see. Yep. They're not going to get ahead of themselves. They're going to wait to see how this all shakes out. Things are changing constantly.
Yep. A couple other headlines coming out regarding this speech. Per Mr. Powell, no sign past Fed bond buying was inflationary. He also says that there are risks to both sides of the mandate, and he remains confident that the FOMC will reach its 2% inflation goal. We got the S&P up 24 points and Dow up 350 points.
There are also some questions asked about private credit. And of course, cracks in that industry have started to appear. Jay Powell, the Fed chair, says that he is watching private credit super carefully, and they're looking for what could lead to contagion. But for now, they're seeing a correction going on in that part of the world, but they don't see connections from private credit to banks, and private credit is not having a broader systemic impact. So it's kind of confined to its corner.
Okay, that's what we have been hearing from market participants, so it's good to hear the Fed chair confirm that as well. All right, let's step back and get a little bit of a reset here. We'll go to Charlie Pellet with the Bloomberg Business.
Hi, thank you very much, Paul. We've got stocks higher with the price of crude oil. And this Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. goldencrestmetals.com/guide. Bond yields fell as Fed Chair Jay Powell said longer-term inflation expectations do appear to be in check. Right now, we've got the 10-year 4.33% with the 2-year 3.81%. I mentioned stocks advancing. S&P today, after several weeks of losses, up 20 now to 63.88, a gain there of 0.3%. Dow Industrials up 337, up 0.7%, while Nasdaq higher by 10, little changed, up under 0.1%. The VIX holding just above 30. Again, we've got the 10-year 4.33%. Gold at 45.31 the ounce, up 0.8%. Crude, the big story. West Texas Intermediate trading at $102, $102.30 right now. That is a gain of 2.6%. And Brent, the global benchmark, 112.50 now, trading a little changed, up by about 0.2%. So bottom line here, stocks higher, along with the price of crude, the Dow, the S&P, Nasdaq, all gaining. S&P up 0.3%, your 10-year 4.33%, and West Texas Intermediate crude 102.48 the barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We appreciate that. Charlie Pellet with the Bloomberg Business Flash. Looking at the markets, as Charlie was just saying, in the bond space, we've got yields coming in. The 10-year's in almost 10 basis points at 4.33% here. Let's check in with Ira Jersey, Chief U.S. Interest Rate Strategist. Ira, anything? Did you hear anything from Fed Chairman Powell up at Harvard that maybe caught your attention?
Not really. I mean, a lot of it was a history lesson, right? What went on during 2022, what went on in other periods during his tenure as the Fed chair. I think one of the things that stood out maybe a little bit is some of the discussion about how to deal with oil-based supply shocks and the fact that the Fed tries to look through them a little bit, which we knew and he just reiterated. And I think that's one of the reasons why you have the market, even though it looks like the market might be pricing for
some small chance of an interest rate hike, that's not really the way to read that. I think the market generally believes that the Fed's going to be on hold for a while because that's their path of least resistance, effectively, until they have a better idea about what the real economy is going to do. And you just mentioned, 10-year yields being so low today. Look at 5-year tips today. They're down 12 basis points in terms of yield, and that's a signal that the market's starting to really worry about the real economy and economic growth being affected by these higher oil prices. So you have inflation break-evens going up, and while views of what the real economy is going to do going forward going down. So I think that dynamic is just starting here, and I think it might even get more acute.
So demand destruction as opposed to inflation shock. One thing Jay Powell said, Ira, is that when it comes to the impact from the war, we don't know what the economic effects will be. The tendency is to look through any kind of supply shock, but a critical, essential aspect of that is you have to carefully monitor inflation expectations. You just mentioned the break-even rates, but there are several ways that you can look at and measure inflation expectations. You've got the break-even rates, you've got inflation swaps, you've got inflation forwards, then you've got the University of Michigan survey-based measures of, asking consumers where they think inflation will be. Then there's professional economist forecasts. Which one is the Fed paying attention to most? Is there like a rule of thumb here?
Yeah, there's not. I mean, at the end of the day, they look at the whole mosaic and what are the different measures saying, and what will ultimately will that lead to different shifts in either business or household appetite for the economy and what they're going to spend. So when you think about things like the Michigan Inflation Survey, that matters to them, because if the household sector really thinks that you're going to have high inflation for a long period of time, they might pull forward some purchases to now. So it might be good good economic growth now, bad economic growth later. Whereas when you look at it in inflation expectations based on the market actually has been a pretty poor indicator of where inflation is going to be on a forward basis. It's actually been quite bad. So the market tends to move with what inflation is today versus what inflation is going to be, say, a year or two from now. And you see that all the time when you just graph break evens against realized headline inflation. But nonetheless, the market is certainly thinking that, look, inflation is going to be high now and going to come down a little bit later. Some investors were talking with me this morning about why is 5-year break even. So the idea of where is inflation going to be 5 years from now, that has actually gone down quite a bit, now at 2.1% from about 2.3% in the not too distant past. And that is another signal that, hey, high inflation now, but maybe much lower inflation later.
All right, Ira, thank you so much. Appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us here today. Again, a little bit of green on the screen for the equity indexes today. The VIX down 1 full point. We're now below 30, but still well above the 20 level. That kind of suggests there is angst in this market. As Ira was just mentioning, 10-year Treasury yields in almost 10 basis points, 4.33%. We were just at 4.5% a few days ago. So we'll go back here in the rates. We'll have more coming up. This is Bloomberg Good Morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pella. We've got the Dow, the S&P, NASDAQ all advancing. Stocks higher after that rout fueled by concerns over the fallout of the war with Iran. The S&P right now at 63.98. It is higher by 29 points, up now by about 0.5%. Dow Industrials up almost 400 points now, up 0.9%. The Dow up 393. That is a gain again of 0.9%. NASDAQ Composite Index up 0.2%, up 47 points. All of this with the VIX just below 30. The 10-year 4.32%, with the 2-year 3.81%. Fed Chair Jay Powell saying longer-term inflation expectations do appear to be in check. Spot gold up 55 now to 45.50. That is a gain of just about 1.3%. Crude continues to be the big story. 101.93 right now for a barrel of West Texas Intermediate crude, up 2.3%. Interestingly, though, a retreat for Brent, the global benchmark, 112.28 right now. Barrel of Brent down by about 0.3%. Bottom line here, stocks are higher. Phil Orlando is chief equity market strategist at Federated Hermes, and this morning right here on Bloomberg Intelligence, he told us he gets why stocks may move lower this week.
I'm not sure that investors want to be long equities on Thursday going into potentially a 4-day weekend, depending upon where you're trading from, given the fact that there may be, a military incursion that accelerates the beginning of next week.
Phil Orlando of Federated Hermes, and of course, keep it locked into Bloomberg for any and all developments coming out of the Middle East. CVS Health plans to open more pharmacies than it closes this year, marking the end of a 4-year contraction for the largest American retail pharmacy chain. CVS shares up now by 0.7%. Recapping, we do have West Texas Intermediate crude 101.80 a barrel, the 10-year 4.32%, S&P up 32, gain there of 0.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We are streaming live on YouTube and on Bloomberg.com. Let's get right to it. Ed Price joins us here in studio. He's a non-resident senior fellow at NYU. Ed, we're day 31 into this war in Iran. I think if you ask 10 different people out there, they might give you 10 different reasons what are our objectives for being there. Not sure they were clearly articulated, so that makes it maybe even more difficult to articulate how we get out of there. What's your view of how the war in Iran has developed over the past 4 weeks?
Thanks, Paul. Well, let me first of all start by saying that I hope and pray our service personnel are safe, so I don't revel in this at all. I think that the initial strikes that we carried out on Iran were successful in the sense, like I said last time, they are our enemies and we killed them, and we can't forget that as a bottom line. I think you're right now to say what is the second phase of this war, and it does look like there's a growing consensus that it's not being handled very well, and possibly also a mistake, and you have people, august people like Larry Fink pointing to the price of oil, which does seem to be the coalition point, the muster point for those who are concerned. Let me just paint a quick counterfactual. In February 2022, Russia attacked Ukraine. Imagine if China had gone after Taiwan and Iran had gone after Israel on the same day. So I know that this war looks messy right now, but there is a counterfactual in which our enemies overwhelm us and we lose that war. I think that Russia and Iran are losing theirs.
But that didn't happen. And right now the U.S. is in a bit of a mess, some would say. And Americans are rightly questioning what the objective is at this point. To Paul's point, how does the U.S. resolve this in the end? What does victory look like?
So the obvious answer to that is the one that Americans don't want to hear, which is that there'll be an escalatory ladder in which the United States has to pour more and more resource, more and more blood and treasure, and that means boots on the ground, and that means regime change. That is the way that the regime would fall, right? And that's the way the region would be reconfigured. I'm slightly stumbling over my words because it's a terrifying prospect, even to think about that. But that is the way that this war ends very successfully. I would say, however, that it's not a binary between win and loss. If the United States and Israel have degraded the power of the Iranian regime, they're not as powerful a player in a future confrontation that is a general war scenario.
So could, some people are suggesting that at some point, President Trump will look at everything that's been accomplished militarily, which is substantial, claim victory and leave that part of the world. Is that a scenario you think is possible, and if so, under what time frame?
Well, President Trump, I mean, we've spent years discussing his mind together, and it is another terrifying prospect. I'm not sure what he's thinking. I think that he could very well act like a wounded tiger at this point. He's an elderly gentleman. He's going to be out of power, if not office, in November. And so I think he's thinking, this is my last chance to make a splash. And he may very well move up that escalatory ladder simply through vanity. It's an ugly thing to say, but I think he might do that. That would be my bet. But again, he might get distracted by something else. I mean, Rubio was talking about Cuba, and Trump is always thinking about things like ballrooms. So there's another sort of ADHD scenario here where he just loses interest.
Yep.
What about oil prices? We see oil prices surge, and they're up, I think, 90% so far since the start of the war. How does this go? I mean, even if the U.S. decides to come up with a definition for victory and retreat in any way or wind things down, and Trump says we got what we wanted, if oil prices stay elevated because Iran controls the Strait of Hormuz, how does that shake out for not just the global economy, but for geopolitics, for who's got leverage, who doesn't?
Bad for the economy. JP Morgan just released an excellent report, which is kind of like a doomsday scenario if oil goes anywhere near 150, 180. But it's also bad for China. So we talk a lot about how this is good for Russia because their oil revenue is funding their war in Ukraine. I imagine that's true, at least in the short term. But China gets a lot of its oil, a lot of its energy out of that area. And so one scenario is that China decides, look, enough is enough, and communicates with the Americans to try and wind this thing up. It's also not in European interests. So I'm always cautious of what I think about as the financialization of geopolitics and strategy. Yes, the economists are right to warn us about the price of oil, but I think that's an independent variable. I think the most important thing is Western security, and at the end of the day, like I say, the Iranians have been at war with us for effectively 50 years, and now we're fighting back.
So if the U.S., if President Trump were to claim victory and cease operation, is it a fair assumption that Israel will follow our lead?
I have absolutely no idea.
Yeah.
I don't think Israel follows anybody's marching orders. If anything, we've followed theirs to some extent in the timing and nature of this operation. I don't think that's necessarily a bad thing, because Israel is a foundational ally of the United States and of the West, and is effectively fighting people in that region that would otherwise be in Europe or in the United States. It's that simple. But I am not an analyst of Israel, and I would defy anyone who claims they are to guess at the next move. I mean, look at the pager thing. Nobody saw that kind of behavior coming, so no idea.
What are you thinking? How are you preparing yourself, bracing yourself for what could come? What's on your mind as we enter into the second month of this war?
We are struggling to describe World War III. Gary Kasparov calls it World War IV because the Russians think of World War III as being the Cold War. I've called it the Central War, Ukraine and Iran as one war. But this is a global conflict. It only gets worse, it only gets bigger. And that's why, with that very zoomed out lens, I look at what's going on in Iran and think, on balance, this is the thing to do. Again, I repeat myself, if we had waited, if we had just sat in that boiling water like a frog and waited for a much more coordinated attack through these three powers, we could have been overwhelmed, our morale could have been broken. All credit to the president. I'm a massive critic of his, but he is crazy enough to see a bad guy and do something about it.
So, again, what are our erstwhile allies around the world, what are they saying? Do you have any sense that they're saying, okay, we're really getting hurt by this energy situation more than you, United States, because you're a net exporter of oil. Do you think that pressure has any bearing at all?
I don't think that the president is subject to any pressure of any kind, but the Germans are seriously rearming, and they're talking about a war with Russia in the near future.
Right. Ed, thanks so much for joining us. Always appreciate it. Ed Price, non-resident senior fellow at NYU, joining us live here in our Bloomberg Interactive Broker Studio, and we appreciate that. I'm just looking at oil here higher, just from that peak first day up, almost 60% is just an extraordinary move for a commodity that traded on a global scale. We got green on the screen here today. I'm not sure why, but we'll take it. But we got kind of a mix. We got Brent oil kind of down maybe 60 cents, WTI up 2.25, and that is enough to push this S&P 500 up 33 points. This is Bloomberg. Good morning.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney. We are live here in our Bloomberg Interactive Corporate Studio in New York City. We're streaming live on YouTube, and now we're streaming live at Bloomberg.com/video. So the content is everywhere, folks, the video and the audio content. Meta Platforms, down about 18% this month, putting them on pace for the worst performance since October 22. I think there's some legal risks in there, maybe some spending on artificial intelligence. I don't know. Mandeep Singh joins us here. He's Global Tech Research Head for Bloomberg Intelligence. What's going on with Meta these days? Because it was a story that was working on cost cutting, number one, and number two, AI seemed to be a really viable work case to augment their advertising platforms. What's going on with the stock?
Yeah, I mean, look, they have underperformed relative to the Mag 7 peers, and on top of that, they had that addiction lawsuit that they lost along with Google. So from that perspective, it could create that negative sentiment that I don't think is going away anytime soon, simply because when you look at their free cash flow expectations for this year, I mean, they're spending almost $135 billion in CapEx. Wow. That'll take them to almost, negative free cash flow territory. And last year, they had almost $45 billion in free cash flow. So, look, when you have, this much investment and people aren't even clear what the focus is on, yes, they are building data centers. That's a real asset, but we know it's a depreciating asset. And when I look at their model relative to OpenAI, Google, and Anthropic, they don't even have a model. So
they don't have a large language model of their own.
They have a large language model, but in the leaderboards, it's nowhere.
Okay.
So from that perspective, look at how well Claude has done, in terms of coding agents, and Anthropic Claude is almost adding $1 billion in revenue every week.
How do we know that?
Well, there are some leaked sources, and when you look at, the token usage, that's the one metric that everyone is tracking right now for these LLMs, is how much is that token usage growing? And some of that can be, reflected in the revenue run rates. Others is tied to training these LLMs, but at the end of the day, that's a real metric in terms of how your model is getting used. Meta doesn't even have a model that is being utilized externally. So the promise was Meta will use the LLMs within their own ecosystem, and that will drive revenue. And so what saved Meta, otherwise the stock would have been down even more, is their top line is still quite healthy. They've guided to mid 20% top line growth.
Right.
But that will reduce in the back half because of tougher comps. So I think that's the challenge, and that lawsuit, I mean, this has never happened in terms of Meta losing a lawsuit around their product being addictive and dangerous, harmful. And so we already know they are banned in Australia. And so in the EU, there is a proposal to ban the app for under 16. So from that perspective, if you are losing that demographic that is one of the highest using demographics for your platform, that becomes a challenge. And now there could be more lawsuits, along the similar lines to the ones where they had, a verdict go against them. So
this is the first time, really one of the first times, I'm not going to say the first time, one of the first times where some of the legal issues for a technology company are really material, potentially.
They are.
Because, I mean, you ask, myself included, you ask everybody on the street, I spend too much time on my phone. If they have children, they will cite that, I'm thinking, is one of their top worries.
Yeah.
And I think that's a global situation. Any parent anywhere in the world would probably say that.
Yeah, and now the judge said it actually harmed in this case. So it's proven. I mean, the $1 million fines are not that big, but suddenly if you have got 2,000 more lawsuits like that, then it all adds up.
Now, is this a similar risk for a Google, for... I don't know. I mean, you could argue YouTube. You spend too much time on YouTube.
But in YouTube's case, the harm was more in terms of autoplay than the content or the filters.
Okay.
So in terms of the type of content, I think the verdict said that it was more harmful from the Meta side compared to YouTube, where it was more like, yes, it shouldn't be auto-playing content or things along those lines, not about the type of content. But there's a very fine line, and I do agree, you know, YouTube and Instagram are similar in that regard, but we'll see if there are more lawsuits.
All right, just real quick, are we going to get an AI IPO this year? Like, give me, like, is it Anthropic or is it? I mean,
most likely it's going to be Anthropic 4Q IPO, and they really, at the run rate that they are in, I mean, everyone in the private market right now is queuing to get, you know, a small slice of that a transaction, which we're expecting.
So Anthropic would be one. What else? Does ChatGPT go?
Yeah, I mean, if Anthropic is going public, I think right now OpenAI feels they're losing share to Anthropic, given they had a head start. So from that perspective, I do think OpenAI will likely go public if Anthropic announces they're going public.
Wow, what kind of multiple would that get? I mean, if you take a multiple premium to Google, right? Like a multiple revenue or something like that.
And then there are smaller ones like Cursor. That would be huge, you know.
All right, this is going to be fun when these IPOs happen. Mandeep Singh, a global tech research head for Bloomberg Intelligence. Appreciate that. As always, start your big walk back to the 10th floor there. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and a global business headlines are coming up in just a moment, with the S&P holding on to a 28-point gain, 0.4%. This is Bloomberg. Good morning.
This is CBS News on the Hour, your home for original reporting.
I'm Steve Kathan. With a new batch of U.S. troops in the Middle East, President Trump ratchets up the pressure on Iran. CBS's Natalie Brand at the White House.
He does insist that discussions are continuing, but he did issue this new warning saying that if a deal is not reached, if the Strait of Hormuz is not reopened for business, he will move forward with blowing up and, quote, obliterating all electric generating plants, oil wells, and Iran's Karg Island. We know that's the main terminal for Iran's oil exports, potentially other infrastructure. And this threat comes as CBS News has confirmed that U.S. Special Forces, including Navy SEALs and Army Rangers, are now in the Middle East to serve as potential options for the president.
And President Trump says he has no problem with a Russian oil tanker off the coast of Cuba delivering relief to the island, which has been hit with a U.S. oil blockade. CBS's Mugo Odigwe.
Russia says the tanker, loaded with more than 700,000 barrels of oil, arrived today. Cuba has suffered weeks of fuel shortages and island-wide blackouts since the blockade started.
The U.S. has reopened its embassy in Venezuela for the first time in 7 years, months after seizing President Maduro. CBS's Camilo Montoya Galvez has learned the Trump administration is easing back on its crackdown on asylum seekers.
The Trump administration policy that is now being partially lifted really amounted to an unprecedented and indefinite pause on all asylum applications overseen by U.S. Citizenship and Immigration Services. That pause on asylum case is now being lifted by USCIS, except, importantly, in cases filed by people from 39 countries in President Trump's so-called travel ban.
Now to Florida, CBS's Mark Strassman is covering the Artemis II mission to reach the moon, with blastoff of the 4-member crew planned for Wednesday.
The astronauts are ready to go, and NASA will begin its official countdown clock later this afternoon, and before you know it, it'll be all systems go.
When it comes to streaming, there are more services than ever, and prices keep going up. CBS's Matt Wolf.
A new report from Amper Analysis shows streaming subscriptions globally hit $157 billion in revenue last year. That figure is triple from 2020 with $60 billion. Amper says it's the result of price increases and ad-supported tiers, not just subscriber growth. They're also predicting this will explode to $202 billion by 2030.
And checking Wall Street, right now the Dow is up 361 points. The S&P is up 26. This is CBS News. Paul McCartney drew some huge crowds in Los Angeles.
Taylor Swift, Elton John, Harrison Ford, even fellow Beatle Ringo Starr. Everyone who's anyone seemed to show up. The hype began when fans entered a ticket lottery for $1,600 seats. Cell phones were banned, but fans say the 83-year-old remembered the Beatles' early days, playing gigs in Liverpool. He told them it wasn't so different from the Fonda Theater, before it was named for Jane's dad and went by the Hollywood Music Box. The concerts were timed to promote McCartney's 19th solo studio album, The Boys of Dungeon Lane. Deborah Rodriguez, CBS News.
At the movies, Project Hail Mary won the weekend box office with more than $54 million in ticket sales. It's taken in more than $300 million globally over 2 weeks. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
President Trump doubles down on threats to Iran's power grid as the war enters its 5th week. Welcome to the Monday edition, with questions about the status of negotiations now with what President Trump is calling a new regime and the arrival of ground troops in the region. We're going to get the very latest and talk about the significance of these developments when we get some time with Bloomberg National Security Editor Michelle Jamrisco. It's now the longest shutdown of any government agency ever. We'll talk to Nathan Dean at Bloomberg Intelligence about what, if anything, will help to reopen the Department of Homeland Security. We'll keep our eyes on the airports as well, with analysis from our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. And it's all after a look at Wall Street. Let's get to the markets here. Charlie Pellet has the latest for us live from New York. Hey, Charlie.
Hi, thank you very much, Joe Matthew. And here's what you need to know. The VIX holding above 30. Oil is continuing to advance. Both West Texas Intermediate crude and Brent both gaining right now. We begin with crude. West Texas Intermediate 103.34 a barrel. It is surging 3.7%. Brent crude was trading lower. Last update right now, it is at 112.77. Barrel of Brent up by about 0.2% now. But again, WTI 103.30 up by 3.6%. The Dow, the S&P, NASDAQ solidly in the green, with the S&P up 20 now to 63.88. That is a gain of 0.3%. The Dow up 327, up 0.7. NASDAQ up by 0.1%. The 10-year 4.33%. Fed Chair Jay Powell says longer-term inflation expectations appear to be in check. We've got the 2-year 3.81%. Gold up 1.1%, 45.43 the ounce, and West Texas Intermediate crude again up 3.7%, 103.36 on WTI. As for the market backdrop, Julie Beal is portfolio manager at Kane Anderson Rudnick Invest, and on surveillance this morning, she told us the real worry is what she's calling FOMO.
The pain of missing out on a day like last year when we had post-Liberation Day and Trump said, never mind, and the markets rallied 9%. If you were not on risk assets at that time, you had a very hard time making it up for the rest of the year.
Julie Beal of Kane Anderson. Again, recapping, S&P 500 index up 20 now, up 0.3%. Crude oil is surging. We've got ExxonMobil up 2.1%, Chevron up 1.2%, ConocoPhillips up now by 0.4%. Your 10-year 4.33%. That WTI quote bears repeating, up now by 4.1%. WTI 103.80 a barrel. We're watching crude. We're watching developments out of the Middle East, and that, Joe Matthew, is a Bloomberg Business Flash.
Charlie puts it together, as he always does, in perfect form. And, of course, that is not a perfect market, Charlie. Thank you. With a VIX at 30, we'll get back to Charlie Pellet in about 15 minutes here for more on the Monday trade. Welcome to the Monday edition of Balance of Power. I'm Joe Matthew on Bloomberg Radio. We're live from Washington, streaming live on YouTube as well. Search Bloomberg Business News Live if you want to find us. Of course, always available on Bloomberg Originals. And then there's the podcast. Everyone said the same thing in the newsroom this morning. It's like we're in a holding pattern. Essentially, the same stories at the same state we left them on Friday, save for a lot of talk over the weekend. Homeland Security, still closed. The war in Iran, still underway. Day 31. And the president is continuing this sort of parallel track, intimating that it might be done soon, even as he prepares potentially for a much longer conflict that could involve ground troops. They have begun arriving, and the president talked to reporters in the back of Air Force One on his way home last night. Listen.
With Iran, we're weeks ahead of schedule. If you would have said that in 3 days we were going to knock out 158 ships, their entire Navy, which we did, we knocked out their entire Air Force. We knocked out most of their missiles. That's why you see missile attacks, but they're sputtering.
Interesting. On Truth Social this morning, with a very not good feeling in the marketplace, it's right around, 7:26 a.m., almost identical to the time he truthed a week ago, Monday morning, before the bell, to try to soothe the markets. The United States of America, he writes, is in serious discussions with a new and more reasonable regime to end our military operations in Iran. Great progress has been made, he says, but, and here comes the threat, if for any reason a deal is not shortly reached, which it probably will be, and if the Hormuz Strait is not immediately open for business, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island. And he says possibly all desalinization plants, which we have purposefully not yet touched. Is this getting better or worse? It depends who you ask. And the market right now is accentuating the positive, maybe not because of the news out of Iran, but because of the hope for some sort of snapback when this is over. Goldman Sachs writing about capitulation. Hedge funds cutting global equity holdings for a 6th straight week, driven by short sales. According to Goldman's trading desk, the latest selling widespread net disposals across all major regions. Check this out. In Europe, short exposure in macro products that trade on broader economic themes has reached 11%. That is a 10-year high. Imagine a morning in which all these shorts are being covered. A 2,000-point rally. This is what some people are hoping for. And realizing that interest rates are driving a lot of this. The fact that we're higher with crude oil, with WTI up 4%, as Charlie said, $103 a barrel says a lot. But let's talk about what we actually know and maybe parse some of the president's words with someone who does. Michelle Jamrisco is back with us today, Bloomberg's White House and National Security Editor on day 31. Michelle, it's great to see you.
Good to be here.
We're writing about a new regime in all caps. These are not new names, though, correct?
Well, we just don't know the names, Joe. I mean, I think that's the point of this. It's been a moving target, and I think for the U.S. administration as well, to know exactly who is feeling like they're in charge, who is legitimately in charge in Iran. And I think that's partly by Iran's own design. I mean, this is a regime that for a long time has been set up to be able to fracture in a way that allows them to decentralize power, that allows them to just survive and kind of bob and weave in moments like this, where the U.S. is trying to talk to someone that will agree with them to come to some points of agreement, but it's not clear that we have successfully identified people that are talking back.
Yeah.
So we just don't know the exact status of the negotiations. There are certain members of the regime, so to speak, that that the U.S. has identified, including the foreign minister and the head of parliament in Iran,
yes,
that they've identified as people to work with. And those people so far have denied that such talks are taking place. Now, that doesn't rule out the possibility that Pakistan, which has acted as a mediator and is said to be passing messages, that maybe Pakistan officials have reached those people. But again, we just don't know for sure, and it's very hard to pinpoint exactly how talks can move forward if you don't know who's being involved and how they're talking, if directly or indirectly.
You see Anne-Marie got him on the phone this morning?
Yeah.
Anne-Marie Horduran got the cell phone number, apparently. I love this. She got him on the phone, and this is how a lot of reporting takes place now. It's a couple of minutes on the cell phone. And today he said, they're dying to settle. They just want to settle. Is there any evidence that that's true?
Well, I mean, it goes back to the previous question. So no, there's not hard evidence that we know that position. Of course, publicly through their own state news agencies, Iranian officials keep saying no. There's no deal on the table.
Right.
We've replied. They have said that they've replied to the 15-point plan. Trump has since said, over the past couple of days that U.S. did receive that reply, and Iran, roughly is in agreement on half of it. I don't know if that's how Iran would characterize it. It seemed like what they have put forth as counter conditions seem very far apart from what we know to be true of the general direction of the 15 points that were presented to them. So it's, we have to kind of get underneath the surface of all of these comments coming out from both sides, and there's still a lot more questions than answers.
Jim Himes, of course, a Democrat and consistent critic of the president, but an important voice in national security, says the president's lying about the negotiations. There aren't any. At some point, I guess this will become clear, but the threats are stark. He's talking about blowing up, as he says, completely obliterating all of their electric generating plants, oil wells, and Karg Island, and possibly all desalinization plants. Those are war crimes, right?
This it would be, targeting the energy infrastructure as such would be war crimes under the Geneva Convention. And I think this gets at, that post this morning gets at a contradiction that has, embattled the White House since this began, which is how do you argue, well, two things. How do you argue that Iran's programs were obliterated last June, but then still presented a threat to start this war? Right. And at the same time, to close this conflict, how do you argue that they have obliterated all these capabilities? And we hear from Secretary of War Pete Hegseth all the time that they're so far diminished. How do you argue that at the same time as we need this big operation to close the deal? So it's very hard to pinpoint exactly what the thought process is on the timeline that the president is going for. Most importantly, but posts like that this morning, seem to make investors, for one, think that things are going to get worse before they get better. Right. There's going to be more escalation before we find some sort of deal, if we do. And the president himself has hedged on that as well. Well, that's right. Probably a deal, but if not, then, on our way out, we're going to take all this action.
You see, FT got him on the phone as well. This guy's numbers, I need to start paying more attention to the phone number here. Take the oil is the quote there. And remember, he used to say that about Iraq. Say, how come, God, that the dumbest people, we went in there and we didn't take the oil. We should have taken the oil to pay for the war. I'm not sure what he means if that's, he says, my preference would be to take the oil with the U.S. intending to control the oil industry indefinitely. Is he talking about Karg Island? How do you take the oil?
Well, I mean, if you look at a lot of that language and think about the context of Venezuela, it makes a lot of sense. Because in terms of the strategy, it doesn't make a lot of sense in terms of applying the same thing as apples to apples. But I'm saying in terms of the strategy and President Trump's thinking on this, they look at Venezuela as a success story, quick operation, bloodless, largely on the U.S. side. And we're now in charge of their oil industry. We're taking back what the U.S. says was stolen from them over decades. Now, if you look at Iran, it's a very different story in terms of what they have and how we might get it. But the same logic seems to be applied. We're coming in by force to remove a threat. And by the way, the oil is ours. This is in some way, maybe the U.S. demands for war reparations from this side, while at the same time Iran is saying, obviously not okay with that plan, and they're demanding war reparations from their side as one of their conditions for talks.
The quote, to be honest with you, my favorite thing is to take the oil in Iran, but some stupid people back in the U.S. say, why are you doing that? But they're stupid people. I guess Karg Island might be in our sights here, Michelle. We're going to find out together here in what could be an interesting week. That Marine Corps Expeditionary Unit is arriving, and there are several thousand Marines and soldiers behind them. Michelle Jamrisco is Bloomberg's White House and National Security Editor, and we thank you, as always, for the great coverage and analysis, Michelle. We're going to spend some time with Nathan Dean next as we turn to the other big bucket, and that's the Department of Homeland Security. Still closed. Despite all the hand-wringing and the voting last week, Republicans cannot agree. We'll have more on that straight ahead on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got NASDAQ just turning lower right now, along with the NASDAQ 100 index. The S&P 500 index holding on to a gain of 0.2%. The Dow does remain higher. All of this as the price of West Texas Intermediate crude is right around 103 a barrel. WTI right now up by 3.3%. We are seeing a divergence with Brent crude. Barrel of Brent down 33 cents now, down at 112.20 on Brent. But again, WTI right around 103 a barrel, up by 3.3%. So bargain hunters back in the market, lured by attractive valuations and prospects for resilient earnings. The S&P is up 18 at 63.87. That is a gain of 0.3%. The Dow up 354, now up 0.8%. NASDAQ down 8, little change, down under 0.1%. The VIX just above 30. 10-year at 4.33%, the 2-year 3.81%. Gold up $51 the ounce, higher now by 1.1%, 45.45 the ounce. And again, that WTI quote bears repeating, just about 103 a barrel now, up by about 3.3%. Shares of mortgage finance giants Fannie Mae and Freddie Mac both up more than 30% as they claw back part of a months-long decline. All of this after investor Bill Ackman called the mortgage finance giants, quote, stupidly cheap. Shares of Fannie Mae and Freddie Mac, again, they are both trading higher. Fannie Mae right now up 37.6%. Freddie Mac up by 33.3%. Recapping, S&P holding on to a gain of 0.2%. NASDAQ does remain lower. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We'll pull Charlie back into the program in about 20 minutes for another read on the markets here. The Monday trade on Balance of Power. Thanks for joining us. Back to reality here in Washington, where, boy, it feels a lot like last week. The Department of Homeland Security still closed, the war in Iran still raging, and a lot of people asking questions about how either might come to an end. We don't have a lot of answers this morning, although we'll try our best with Nathan Dean. Everybody's sharing pictures of members of Congress having a good time. It is the 2-week recess. They weren't late. Friday saw everyone leave town. Of course, a lot of folks left town on Thursday night, too. We got, Robert Garcia. TMZ is really leading the charge on this coverage, appealing to its fans to send pictures of members of Congress having a good time. Here we are, Congressman Robert Garcia. It's a good bet I'm in Vegas. Hanging at, what casino was he at here? This is interesting. Following, of course, in the footsteps of Lindsey Graham, who was at Disney over the weekend, with all the tip sheets asking, you failed to reopen the government. Now what are you going to do? Going to Disney. Okay, let's bring in Nathan Dean. America's Dad knows a lot about Disney and the Contemporary. And is it Chef Mickey's?
Chef Mickey's.
That's where, so we can't show you this because it's TMZ. It's got the photograph, but he's in there eating. He had the buffet at Chef Mickey's. Now this is at the Contemporary, right? Why would Lindsey Graham find himself? This is the one where the characters walk around, isn't it?
Yeah. So I mean, like when I took my kids there, I mean, there's chicken nuggets flying everywhere. I mean, it's not like it's not.
It's a food fight. You're saying.
It's definitely not Michelin star dining at it. But look, this is one of those things where even the Senate did their job, at least in their eyes. They did their job. They passed a bill, and they all left town even before the House got to this thing. Yeah. And Speaker Johnson came back and said, well, look, we're going to pass a 60-day stopgap, and we'll try and jam the Senate. And it doesn't really work like that. I mean, as much as the House members hate this, the Senate jams the House. Right. Now, there's talk about, are they going to come back next week? They're not coming back this week. I don't think they're coming back next week for 2 reasons. One, there's a lot of trips, a lot of codels out there that people are flying abroad. And secondly, I'm not exactly sure what they would do if they came back. They would essentially just be giving speeches and saying, look, the other side needs to fix this here. But ultimately, with the DHS shutdown, what I think happened is they reset the clock for pressure points. Because if President Trump's executive order to fund TSA begins to alleviate some of the pressure. I mean, BWI had a 7-hour line yesterday. If it begins to alleviate... Are you kidding me? No, 7 hours at BWI yesterday. Wow. I mean, so DCA and Dulles are doing a little bit better.
Yeah,
but
I keep hearing DCA people are flying through. I guess BWI is a different matter.
But BWI was really bad. So if that begins to alleviate in terms of pressure, I think it just resets the clock in terms of the next pressure point, and I'm not exactly sure what that is.
If TSA is getting paid, though, on this executive order, does that relieve some of the issue at the airport? Because that's the concern some have, is that you're taking the pressure point away. DHS is closed the rest of the year.
Yeah, that's exactly it. I mean, you take away the TSA pressure point, what else do you have there? FEMA.
Yeah.
Obviously, we have hurricane season coming up, June, July-ish. You know, we have Coast Guard, we have the other members of the Department of Homeland Security, about 270,000 individuals that aren't getting paid at the moment. But I think this is sort of indicative of where Washington is going after the midterms, especially if the Democrats take the House. Because President Trump just said, look, Congress is not doing its job. I'm going to unilaterally fund individuals using funds, we think, from the One Big Beautiful Bill. And essentially, if you don't like me doing that, sue me. And the Democrats in this perspective have just said, look, there's no political advantage here to sue you. We've done our job. We've worked with the Republicans on this. And so we're just going to not really negotiate. And so I think you're going to see a little bit more of this as we get into the second half of President Trump's presidency here, because it's a situation where both sides look at the same issue and says, no, we don't need to negotiate.
Wait, you do wonder, but I know that FEMA's controversial for some in the MAGA movement, and it's been an issue in this administration. The Coast Guard?
Yeah.
How come the Coast Guard doesn't know? Everyone talks about the TSA, I guess, because we're waiting in line.
Yeah.
Coast Guard's not been paid yet.
No.
What do these guys have to do?
Well, and calling in sick for a Coast Guard is much different than calling in for sick for a TSA. I mean, a lot of these TSA workers, according to reporting by Bloomberg and other outlets, are going and doing Uber jobs and driving for Lyft and so forth. So they're trying to replicate their income. It's a little bit different story when you have Coast Guard or FEMA. But, you know, we do think, look, let's just say that both sides come back in 2 weeks. They do want to get the DHS shutdown resolved for one simple reason. There's a lot left on their calendar in the Senate that they want to do. Crypto, housing, reconciliation bill. And for, you know, Kevin Warsh's nomination hearings, April 13th, that week, you know, as long as they're talking about, when reporters are coming up to him and saying, look, what are you doing on the DHS shutdown? The Republicans want to come back and say, this is what we're doing on affordability. And so there is this little pressure point to get things done, because ultimately they want to see that they can govern ahead of the U.S. midterms in November.
Really interesting. So it's Robert Garcia went to Fontainebleau. That's where he was in Las Vegas. The pictures, is he playing blackjack, James, or was he doing something else? Blackjack guy. Amateur photog walked up to him, asked if he was enjoying himself, knowing federal employees were not getting paid, TMZ reports. Garcia did not answer, but 2 security guards shoot him away. Garcia told the guard he didn't mind the guy took photos, and here they are. Interesting. So it costs $44 to get a kid in the buffet at Chef Mickey's. And you're saying it's not that good. $69 for an adult. Do we think that, like, does Mickey come over to everyone there? Did Lindsay spend time with Mickey and Minnie?
He did. If it's the best of my recollection, it's Mickey, Minnie, Goofy, and Donald.
Yeah.
And look, you're paying that price so that you don't have to go meet those characters in the park. I mean, from a parent perspective.
Right, a controlled environment here.
But there was probably a moment where Mickey came over and said, you know,
wow,
and maybe there's a picture involved.
I think we're going to see all of this. Producer James done a lot of reporting on this in the last little bit here. He tells us that they usually have Mickey Mouse-shaped waffles. That's the picture.
That's one of the best
that I think we're going to need. He's pouring coffee there in the photograph. He was spending time in the Tangled section of the theme park. So everybody comes back after 2 weeks. Let's say TSA's all back on the job because they're getting paid. And DHS remains closed for the rest of the year. Could they, in fact... You mentioned reconciliation, take care of all of this in a reconciliation 2.0. We were talking about putting ICE funding in there. Why not all the rest?
Well, you're not supposed to do appropriations as part of reconciliation. I mean, that's one of the you're not supposed to. Right. And this is where the Senate parliamentarian gets involved. And, you know, but look, you know, ICE is funded through the One Big Beautiful Bill through fiscal year of 2029. They got the $75 billion. So it's not out of the realm of possibilities. But the thing with the reconciliation, and this is what we just told our clients this morning, if you get something that's small, 200, 300 billion, that's dedicated solely to defense funding, I think you have an easy time. You could probably get the votes. You could even probably pick up someone like Senator Fetterman for that.
Yeah.
But if you begin to balloon it up, as you're beginning to hear in terms of Obamacare cuts or, you know, farmer aid, or if next thing you know, this turns into a $1.2 trillion mega bill. And look, everybody in the town is going to say, please attach something to this.
Absolutely.
And if you have President Trump saying, pass the Save America Act this way, when Senator Mike Lee even said you can't do it, you know, that's when things begin to break down. So small targeted, possible, and I wouldn't be surprised if the Republicans said, let's try and get it to the president's desk for the 4th of July for that celebration.
Wow. I've got to ask you about rescheduling because it just is a story that doesn't seem to ever resolve. It's been weeks since we've talked about cannabis rescheduling. With a Democratic member of Congress, a Democrat from Tennessee, Steve Cohen. He's out with a letter to Attorney General Pam Bondi and to the DEA Administrator Terry Cole to find out what is going on since the president ordered the quick completion of rescheduling. He's asking the officials to account for why DOJ missed a deadline to issue guidelines easing research barriers into Schedule I drugs. Marijuana Moment has been on this. Every time I bring it up, it's usually their column. Yep. Is this over? What are we doing here?
So the marijuana investors we talked to are essentially asking the same question, and they're saying, look, are there individuals that are trying to circumvent President Trump's executive order?
So it's getting personal?
You have to do that. Oh, they're because look, these marijuana stocks, like we say, they have hot sauce. These things jump.
Yes, sir.
The volatility is pretty significant, but right now they are really low. I mean, a lot of them are under $5. Yeah. And so there's a lot of confusion here about the process. And I've always gone back to the point where, look, nothing in Washington happens quickly. Even if the president were to say, I want you to reschedule it right now, somebody's got to write a rule. Somebody's got to be able to get this past the Administrative Procedures Act, and that takes time. So ultimately, I'm banking on the idea that usually the DOJ and the DEA is not in the business of telling the president they don't want him to do something, or at least we're not going to do what your order tells us to do. Yeah. So I do think that you'll see some type of movement ahead of the midterms, but it may not be full reschedulization. It may just be we're getting the process back on track.
Does that move the stocks on it if there's any evidence of this thing moving?
Any evidence whatsoever, you'll see a jump up, and then you'll see a subsequent decline once you see the reality.
Oh,
just
all right.
It's
the
pure,
reality.
It's a pure event contract.
I see.
Compared to policy headlines.
And it sounds like you sell news in that world. Or once it appears to be something different.
I mean, the tax relief for these companies is somewhat significant, but it's such a difficult business to begin with that it's going to be a challenge.
A lot of folks have said that the false promise was the TAM. The total addressable market was not as large as a lot of investors during COVID thought when we were bidding these things up to double and triple digits. Is that going to be the end story here for this sector?
There's a lot of it. I mean, look, the big tobacco companies aren't buying. They're not involved here because the profit is. And look, it comes down to regulations, risk, all this type of overhead costs to these businesses. Because when you're comparing to something that's really cheap, also you can buy it, just grow it on your own.
Sure, right.
When you tack on all these overhead costs, you need to have a significant margin to be profitable. And we've seen a lot of consolidation in this industry over the last couple of years as farms begin to realize that they can't reach that profitability.
Wow, amazing. I heard you were a referee last weekend. You put the whole uniform on?
No, I was
just the stripes or no?
I did give a kid an unsportsmanlike conduct.
You did? I did? Wow, is that true?
10-year-old boy.
Yeah.
He was mouthing off.
What? See?
Unsportsmanlike
America's dad will teach you a lesson very quickly. Parents are okay and everyone's good?
They were fine so far.
Life on the sidelines with Nathan Dean. This is the whole side of Nathan we don't ever get to see. He is the best in the business, senior U.S. policy analyst at Bloomberg Intelligence and a close friend of the program. If you subscribe to the Balance of Power podcast, you'll get Nathan's as well. I encourage you to do that by going to Apple, Spotify, or wherever you get your podcasts. We'll assemble the panel next. Rick and Jeannie are on the way on Bloomberg.
It's 1240 on Wall Street. We do check markets all day long here at Bloomberg. We've got NASDAQ and the NASDAQ 100 index both declining. The Dow, the S&P, they're higher right now. Oil is surging. Do want to begin with West Texas Intermediate Crude. 102.85 a barrel. WTI up now by 3.2%. Barrel of Brent, though, lower, down 0.6%. Brent crude 111.92 for a barrel of Brent. S&P up 12, 63.81 where we stand now, up by about 0.2%. The Dow up 285 points, up 0.6%. NASDAQ down under 0.1%. All of this with the VIX holding above 30. That's Wall Street's so-called fear gauge. The 10-year, 4.32%. The 2-year, 3.80%. Spot gold at $45.43 the ounce. Gold up 1.1% right now. And again, West Texas Intermediate Crude up 3.1%, 102.73 a barrel. Bob McNally is the president and founder of Rapidan Energy Advisors, and on surveillance this morning, he told us it will be a while before full oil production resumes from the Gulf.
I think it's 3 to 4 months before the major Saudi Arabia, Kuwait, probably maybe longer for Iraq, Rumelia, that field, that 1 million barrel a day outage there could be much longer term. So if you put a gun to my head right now, it's still underway. I'd say on the order of 2 million barrels a day of crude that could be lost for a long time here.
Rapidan's Bob McNally. ExxonMobil shares, they're up by 1.4%. Chevron shares gaining now 0.7%. ConocoPhillips turning lower, down now by 0.2%. CVS Health plans to open more pharmacies and it closes this year, marking the end of a 4-year contraction for the largest American retail pharmacy chain. CVS shares, they're up today by 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
All right, Charlie, we appreciate it, sir. He'll be back about 1 o'clock, top of the hour, 20 minutes away with another reading on the markets as we welcome our global television audience to Balance of Power. Thanks for being here on the Monday edition. I'm Joe Matthew in Washington, where it's a rainy day, but the blossoms are peaking, and boy, we've got spring in the air here. You can just imagine what that ballroom is going to look like this time of year when it's finished. The president, of course, is managing a war right now, and as he said last evening in the back of Air Force One, I'm fighting wars and other things, but this is very important because it's going to be with us for a long time. He's answering questions about the war in Iran while also showing renderings of the ballroom in the back of the jet. You know, you're hanging onto the doorway, getting jostled around. He's got these big pictures of the ballroom up, and we learned a little bit about it. He says this, what is this, $400 million, right? He calls it a shed. This would be the most expensive shed ever built. It becomes a shed, he says, for what's being built underneath by the military. You know, they got a big bunker down there. This has been the case for a long time. That's not new, but maybe there's something bigger going in. Drone-proof roofs, extremely thick bulletproof windows, he says, ahead of schedule and under budget. And that last line I mentioned, because the president's drawing parallels now between the ballroom and the war in Iran. Maybe they're not competing with each other. Maybe they're the same thing. Just like we're ahead of schedule on the ballroom, he says, in a much bigger way, we're ahead of schedule with Iran. I have no idea what that means. But he did spend some time for a while in the back of Air Force One, as I mentioned, taking questions and painting a very positive picture of the progress he says made in Iran. Listen to what he said.
They've agreed to send 8 boats 2 days ago, and then they added another 2, so it was 10 boats. And now today they gave us as a tribute, I don't know, I can't define it exactly, but they gave us, I think out of a sign of respect, 20 boats of oil, big boats of oil, going through the Hormuz Strait. We're doing extremely well in that negotiation. But you never know with Iran because we negotiate with them and then we always have to blow them up.
Well, we'll see if that's the case. Bill Pulte's standing behind him there. Depending on who he's talking to, he said, let's go back. Let's go to the back of the jet, talk to reporters. Despite 10 boats getting through, oil prices are higher. Brent is kind of flat right now, but WTI, West Texas in New York, up 3% to 102.62, and we are knocking on the door here of $4 gas, $3.99. We're just sitting right there, $3.99. Once that actually happens, it's only a penny away, but you just wait. The psychological impact of that headline hitting will be significant as we assemble our political panel for their take on all of this. Rick Davis is with us, Bloomberg Politics contributor, Republican strategist and partner at Stone Court Capital, and Jeannie Shanzano, Bloomberg Politics contributor, Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, let's start with you. How are you reading the threats and the sort of parallel narratives that the president is bringing forth here? It's confusing a lot of people as he suggests that this is about to end soon. We're ahead of schedule. We're under budget. But now he's threatening once again, if no deal, he says, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island. It sounds like he's got some big decisions still to make, Rick. What do you think?
Well, you know, we've been talking, Joe, a long time, for over a year, about escalate to de-escalate, right? And how the president has a tendency to raise the temperature as high as he can get it before he cuts a deal. I think we've now entered passive aggressive, where in the same sentence, you can escalate and de-escalate all at the same time. There's no more sort of one leads to another. It's all in the same package. And certainly that press briefing on the plane Sunday was exactly that. It was passive aggressive. You know, we're going to get a deal done. These guys desperately want a deal. I'm going to get a deal done. They agree with almost all of our 15 points, but I'm going to blow them to kingdom come. I mean, I'm not sure how all that really fits. And I'm not sure how productive that is in dealing with whoever in Tehran that the administration is dealing with. And it could be multiple factions within the same government through multiple intermediaries in different governments. So I think we've got a lot to unravel, but in the meantime, the stepped-up presence of more ground troops is costing almost twice on a daily basis what it used to cost before they arrived. And so this is getting more expensive and more dangerous every day, and we know less and less about what an outcome would look like.
Jeannie, you might have heard Anne-Marie got him on the phone today. She called Donald Trump on his cell phone. They did not talk for long. He said he's very busy, but he said, I'll tell you this, we're doing very well. The war is going unbelievably well. They want to settle. That's all I can say. At what point will he need to say more than that, Jeannie?
Everybody picks up the phone when Anne-Marie calls, so I'm not surprised.
Damn
Even
right.
the president, as busy as he is. That's right. You know, it's interesting because today what he posted on Truth Social, and you just read a little bit of it, Joe, that is the president of the United States threatening a war crime. I mean, can we underscore that? He is threatening to blow up civilian targets. That is a violation of international law and a war crime. That is what Russia has done in Ukraine. And we spoke out against it then, rightly so, and we should. And that is what the president is talking about. For all of his bluster, and certainly if you listen to him, you would think, wow, we are really winning this thing. The United States is in profound trouble as it pertains to this war, and nobody knows that better than Donald Trump. You know the old Jean-Paul Sartre play, No Exit? There is no exit here, at least not a good one for Donald Trump. Iran holds all the cards strategically. They have threatened and will continue to threaten an international economic disaster, and they have the power to inflict that on us. And Donald Trump's chances or choices at this point are to find an exit strategy. There's no good one because you can't force them to accept the 15-point plan, or to escalate. And they will benefit if he tries to escalate. So that's where we are. For all of his bluster and blunder, this is where we are in a very precarious situation. And you just look at the U.S. 10-year Treasury bonds, and you can see how bad this thing can get. And it's bad. And I'll leave you with one last thing, Joe. What about if they close the Red Sea? What about if the Houthis in Iran do that? That's another 12% of the world's oil, not to mention fertilizer.
Houthis getting involved here is significant. Jeannie, the president said more about that 15-point plan. When he went to the back of the jet, he said Iran has responded and, quote, they gave us most of the points. Rick, I'm not sure what he's referring to there when we're questioning whether negotiations are actually underway. But an enormous amount of ink today spilled on ground troops. The New York Times says several hundred U.S. Special Ops forces, including Army Rangers and Navy SEALs, have joined thousands of Marines and Army paratroopers in a deployment designed to give Trump additional options. They, of course, are talking about these same ideas, reopening the Strait, seizing Kharg Island. Washington Post, in the Sunday front page, Pentagon preparing for weeks of ground operations in Iran as thousands of American soldiers and Marines arrive in the Middle East for what could become a dangerous new phase of the war. When you see stories like these start popping up in different news organizations, Rick, and you start thinking maybe the sourcing is the same, whoever's talking to the Washington Post might be talking to the New York Times and so forth, does it imply confusion within the administration when the president, now on week 5 here, is still openly deliberating ideas like these?
Yeah, there's a split in the administration. Many believe that this is his way of dealing with the media, and putting out potentially false information to confuse the enemy. Mm-hmm. We saw that happen in the heels right before the Venezuela operation. And so I wouldn't be surprised that some of it is his misdirection strategy. Maybe that's giving him more than he deserves, but I think it has to be contemplated. That being said, the enormous cost and the enormous risk of having all these troops in one theater consolidated around one target is enormous. And at some point in time, you risk, one, depleting supplies because these ships and these men on the ground all live off of a supply chain that has to be constantly refreshed for weapons and fuel and food and shelter. And that is no small task when you're talking over 50,000 people in one location. And so, yeah, I mean, it's not without its cost. And at some point in time, people will start talking about how much financially this is costing us. Mm-hmm. That being said, there's nothing like the cost of blood. And if the focus is a ground invasion, whether that's on Kharg Island or anywhere else, to open up the Strait of Hormuz, that is going to put this in a completely different category of discussion. And I'd say at that point, the economic system of the United States and the rest of the world are really going to get stressed out if they aren't already.
Yeah. This is the kind of stuff that the market's thinking about and worried about, Jeannie, as the president talks about the ballroom. I'll get back to where I started here and whether this new talk of a massive military complex being built under the ballroom will be justification for this finally getting all the green lights. If you're with us on YouTube, there's the president showing off some of the renderings here as he's talking about war. He said that the military is, quote, building a massive complex under the ballroom. The ballroom actually becomes a shed for what is being built. And we've heard the White House invoke national security issues in the court cases that have challenged the construction of the ballroom. Is this how it gets done, Jeannie? This is just basically a big shed for a military compound underground.
It may be how it gets done. It's all so nonsensical. The economy is in dire straits. We have DHS, which is not even open at this point. We are in a war, and the president is spending his time talking about a ballroom, which is going to serve as a shed over a military installation. The president would be far better off to focus on trying to handle the mess that he has gotten us into in the Middle East, as well as the economy back home. I mean, just think about it. The president is posting and talking about how we are in the driver's seat with this war. And where is Iran? Their economy is right now far better off, given that he lifted the sanctions, than they were before. They are holding the entire economy of the world hostage at the Strait and potentially in the Red Sea. They have a more hardline leader there, and they have absolutely no incentive to go to the negotiating table. Why? Because Israel and the U.S. are threatening to destroy them. I mean, if we want to talk to somebody and bargain, this is a heck of a way to do this. So yes, the president's ballroom may or may not get done, but it is once again the president trying to divert attention from where it needs to be. And the American public deserve better, and Congress should be there to hold his feet to the fire, but they're not.
Jeannie Shanzano and Rick Davis, Bloomberg Politics contributors. Our great panel will be back in our second hour. The president says Corinthian. The columns will be Corinthian. Reminding us of history of the world. Mel Brooks, get your columns here. Doric, Ionic, Corinthian. This is Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
The war with Iran enters its fifth week with new threats from the president. Welcome to the Monday edition as President Trump issues a new warning that he will bomb Iran's energy assets if no deal is reached. I'm Joe Matthew alongside Kaylee Lines here in Washington. Kaylee, the market's trying to figure all of this out and having trouble finding a direction.
Yeah, the market may be trying to figure out if they should listen to good cop or bad cop here when they're being played by the same person. In the very same Truth Social post, President Trump saying that good progress is being made in negotiations with Iran. He refers to the regime as more reasonable, and yet also is threatening not just oil wells in Kharg Island, potentially even desalination plants, talking about water infrastructure here.
Right. potential war crimes if those were to be prosecuted by the president here. But of course, there are great questions about his motivations. We are seeing Brent pulled roughly steady today. WTI West Texas Intermediate crude popped a little bit earlier, Kaylee, as we try to figure out what this all means with now $3.99 gasoline on average facing Americans. And I'll throw another log on the fire. A Department of Homeland Security now closed to set a record. Longest any agency has been shut down before. So Washington, for many, is seeming dysfunctional.
Yeah, especially considering Congress, those that would potentially bring more function to at least funding the Department of Homeland Security is out of town for 2 weeks. So the lights are going to remain off theoretically for at least that long, as it's really Republican infighting that we're noting, the Senate and the House on very different pages in terms of the Republican leadership. So we'll, of course, keep track of that this hour. We also have to note when it comes to Iran as well, thinking about gasoline and oil prices, a lot of Gulf producers have been looking, like Saudi Arabia, for example, to other avenues like the Red Sea to get their exports out. Enter the Houthis, which were attacking Israel over the weekend.
I haven't had that conversation in a while. So you could frame this as a widening war, unless, of course, you go with the good cop and it's one that's about to end, Kaylee. What do you do if you're an investor?
That's a good question. So let's see what investors are doing today and check in on these markets now with Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee. You guys set me up perfectly because I'm looking at a mixed market right now. I'm looking at the Dow, the S&P. They are both higher. S&P very close, though, to session lows. NASDAQ and the NASDAQ 100 index, they are both trading lower. Right to the numbers here. S&P up 11, 63.80 where we stand, up by about 0.2%. Dow Industrials up 265, gain there of 0.6%, but NASDAQ down 0.1%. The NASDAQ 100 index also down 0.1%. With the VIX, Wall Street's fear gauge right around 30. 10-year at 4.32%. The 2-year 3.81%. Gold is now up 1%, 45.38 the ounce. West Texas Intermediate crude just below $103 a barrel, now up 3.3%. Brent, though, trading lower. Barrel of Brent 112.14, down by 0.4%. And Bitcoin lower now by just about, actually higher by 1.2%. Bitcoin 67,341 on Bitcoin. Oil stocks trading mixed as well. ExxonMobil up 1.2%. Chevron up 0.6%. ConocoPhillips down 0.3%. Air Canada CEO Michael Rousseau has announced he is leaving the airline after creating a public relations fiasco with an English language video about the deadly runway collision at LaGuardia last week. Air Canada says Rousseau will retire by the end of the third quarter. He faced criticism for not speaking more French in his video statement about the crash. Air Canada shares down now in Canada by 1.8%. Recapping, West Texas Intermediate crude above 103 a barrel, up 3.5%. The 10-year 4.32%. The VIX just above 30, and the S&P little changed, up by 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet trying to make sense of these markets for us. Thank you so much. As markets, of course, try to make sense of conflicting narratives when it comes to the war in Iran, which, as Joe mentioned, is now in its 5th week, knowing that President Trump initially suggested this could be a 4 to 6 week operation. And yet, as of right now, there is no clear end in sight. A headline just crossing the terminal that Israel says it has struck 170 Iranian targets in just the past 24 hours. And of course, we saw over the weekend more U.S. service members, including an amphibious assault ship with sailors and Marines, thousands of them on board, arriving in the theater with more on the way. All of that's to say, though, that there is still potentially a diplomatic off-ramp being pursued by President Trump as he gave a status update to reporters aboard Air Force One last night.
They've agreed to send 8 boats 2 days ago, and then they added another 2, so it was 10 boats. And now today they gave us as a tribute, I don't know, I can't define it exactly, but they gave us, I think out of a sign of respect, 20 boats of oil, big boats of oil, going through the Hormuz Strait. We're doing extremely well in that negotiation, but you never know with Iran because we negotiate with them and then we always have to blow them up.
We always have to blow them up, the president says. Stark rhetoric that would match the tone of his Truth Social post this morning. Following his post last week on a Monday in the 7 a.m. hour, he did the same thing today with, of course, eyes on the markets. This didn't really make a lot of people feel good, though, as he did talk about serious discussions with a new and more reasonable regime. Unclear exactly what he's referring to. But without a deal, he says, and if the strait is not immediately open, we will conclude our lovely stay in Iran, the president writes, by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island. And he says, and possibly all desalinization plants, which we have purposely not yet touched. Jeff Mason is Bloomberg's White House correspondent and joins us live here in our Washington bureau. Jeff, it's great to see you. I can't imagine another president issuing rhetoric like this, but it's difficult to tell. As Kaylee framed this perfectly at the top of the hour, we've got a good cop, bad cop, and it's the same guy.
It's the same guy.
So who are you listening to?
Well, indeed. I mean, I think that's the question. It's you guys also mentioned the fact that there have been mixed messages on the war, and there have been mixed messages on the war from the very beginning when the president first announced it. And I think there are different motivations behind that. One of them is clearly his sensitivity to the markets and the way the market is responding. You've heard him come out and say, the war is not going to last very long, or it's going to end quickly, when he is upset about the oil prices going up. But then in the same breath, or the next day, in this case the next day, he issues another threat. And if you're in the market, it's hard to interpret that other than to say it's a little bit of Jekyll and Hyde.
Well, you should point out we are expecting this hour a briefing from the White House Press Secretary Caroline Leavitt. We'll see if we can get any more clarity from her either way. But when we consider that the president himself, it's not just what he's saying in media gaggles like what we saw aboard Air Force One or on social media. He's also doing some singular interviews. He spoke with our colleague Anne-Marie Hordern briefly on the phone today. He also spoke with the Financial Times, talking about how he wants to take Iran's oil. What do you understand that to mean, Jeff?
The president is someone who obviously has a real estate background. He speaks in the language, and I think he has a paradigm of gifts. This is something good for me. He talked about Iran was making a tribute perhaps to the United States.
With the boats?
I don't cover Iran as a full-time job, but I'm pretty sure that wasn't a tribute. But that, I guess I say all of that in terms of, like, this is just the psychology of the president. And when he uses language like that, that's the paradigm that he sees it, or the framework through which he sees these things.
Out of a sign of respect, he said, I can't define it exactly, but they let 10 boats through. He says, big boats of oil. Those are not American interests, to be clear.
And it's interesting that, too, because the president has liked to emphasize that the United States does not rely on oil coming through the Strait of Hormuz as much as other countries do, which has been a sticking point for him in terms of feeling that NATO allies should be stepping up more, should be helping the United States more. That said, I think it's also really important to notice or to point out that even if that is true, that the U.S. has so many other oil sources, the U.S. is connected to the rest of the world via the global economy. So if our allies, if U.S. allies are suffering because of a war that the United States and Israel started with Iran, and that is leading to oil prices or this strait being closed or mostly closed, even if the U.S. doesn't rely on as much oil or natural gas coming through there, others do, and that has an impact as well.
Yeah, even our energy that we produce here at home hasn't been able to prevent $4 gallon of gas.
That's right.
In much of the country. Jeff Mason covering the White House for us here at Bloomberg. Thank you so much. And of course, as we consider what is driving those oil prices up, largely it is because the Strait of Hormuz remains ineffective, closed, if not just controlled by Iran, which is why President Trump is issuing this ultimatum: open the strait or else get your energy infrastructure and potentially water infrastructure as well attacked, in addition to the many attacks and strikes that have been carried out on military targets already in Iran, a military operation which the president does maintain is still ahead of schedule. Here's something else he told reporters aboard Air Force One last night.
With Iran, we're weeks ahead of schedule. If you would have said that in 3 days we were going to knock out 158 ships, their entire Navy, which we did, we knocked out their entire Air Force. We knocked out most of their missiles. That's why you see missile attacks, but they're sputtering.
So let's get more on this now as we turn, Joe, to Michael Allen, Managing Director of Beacon Global Strategies, also former Special Assistant to President George W. Bush in the national security sector. He's here with us in our Washington, D.C. studio. Michael, welcome back to Bloomberg TV and Radio.
Thanks so much for having me.
Always good to see you. The president, of course, says we're still ahead of schedule, though by my calculation, we don't have that much more time to be ahead of schedule if this was only supposed to be a max 6-week operation in the first place, and we're in week 5. Do you expect that it is going to end at 6 weeks with the signals we are seeing, both from the troop presence that is getting even larger in the Middle East and the rhetoric from the president?
I don't think so. I think that we still have work to do to sort of set the conditions around the Strait of Hormuz for us to even begin to move to an escort mission. We're, of course, have been in an attack mission. We've been in a missile defense mission. But to shift, they have to finish degrading the coastal defenses of Iran. They probably need to degrade their drones more, and of course fast boats. So we're bringing the equipment over. It's going to take time, but I think it's going to be a little bit longer than forecast.
That's the narrative in the major papers this morning. The New York Times talking about several hundred U.S. Special Operations Forces, Rangers, and Navy SEALs joining thousands of Marines and Army paratroopers in deployment. The Post talking about a Pentagon preparing for weeks of ground operations in Iran. Does that feel to you like where we're going, or is this a deal that's about to be struck, as the president suggests?
I definitely don't think there's a deal in the offing. I don't even know that we've met indirectly, so to speak. What I think might be happening is that the president is serious, or he's seriously thinking about taking Karg Island. Right now, that's not my base case. I'm not sure or certain that he would. It might be just something that gives him options, gives him leverage, allows him to take an economic hostage if the Iranians continue not to cooperate when it comes time to reopen the strait. But yeah, I think he's making sure he's got the tools in place to do that if he feels like he needs to.
Well, when we think about the Iranian regime, which President Trump described on Truth Social today as new and also as more reasonable, I wonder if that matches your assessment. Mike, is this really a new regime, or is it just a cast of characters that has changed at the top of the same regime?
Well, it seems like the new boss is the same as the old boss. It's a hardcore element of the Iran is people that are good with the Islamic Revolutionary Guard, that are in good standing with the clerics. Maybe some of these newer people have some ability to compromise more, or maybe they're more pragmatic than others. But I think they're all hardliners over there. I think that they're as mad as a hornet right now as well. And so I don't know that the conditions are really set for anyone to earnestly put forward positions other than the ones so far, which have been totally maximalist, like get the United States out of the Middle East and you cease everything, Iran, including your ballistic missile program.
How important is it to you, and it does seem to be to the administration, whether part of a deal or we go in and get the 1,000 pounds of enriched uranium that's sitting somewhere, likely underground?
This would be one of the biggest operations, I think, in American history. It would be enormous.
In terms of scale or importance?
Scale.
Really?
It would be, it's not just the special operations raid, think Osama bin Laden or against Maduro. I think it would take, let's just guess here, 1,000 troops, set up perimeter for more than a day, at least,
start digging.
To use, earth-moving equipment and who knows what else to dig it out under fire. And then put it on an airplane to ship out again. I could see Karg Island happening sooner than I could this HEU. Although, one, you can't rule it out with President Trump. And I've heard generals say that if we've planned it well enough that we can do it. But it does seem a little bit daunting, and it's important and it's critical to do, but maybe there's other ways for us to neutralize it over time. People say, well, you know what, if we just stared at it over satellites, and if Iran ever comes close to where we think it's buried, we'll just hit them again. But it's another big question mark on how we might use ground troops.
But is that where we stumble into quagmire risk more substantially?
I think we're only in a total quagmire with ground troops is if we invade and try to hold territory.
Like Karg Island, for example.
For an extended period of time. And so I don't think we would be around Esfahan retrieving the HEU for an extended period of time. But yeah, I think if you're holding Karg Island, I have been persuaded by a lot of sort of the expert testimony that, you know what, it would be, they would hold us in harm because of the drones, proximity to drones, and the rest. So I think there's a lot to that.
You've talked to us about the taco trade before, which doesn't seem to be working for investors in quite the same way. John Author's writing on the Bloomberg about a different acronym. It's not taco, it's WACO. Will the Ayatollahs chicken out? And he says traders are concluding they almost certainly will not. Right. And so prices enter Holy Week under the worst pressure of this now month-old conflict. Nobody's going to want to go long into this long weekend for fear of what happens, Michael.
Well, yeah, I agree. I mean, the Ayatollahs, the regime this is obviously an existential threat. I mean, our targeting alone, but of course you add what Israel's doing there. They feel like they can use any tool in their toolkit. That's why they're taking shots at the Gulf Arabs. That's why they're taking shots earlier in the campaign at their energy infrastructure. That's, of course, why they feel so liberated to have threatened ships going through the strait. And so I feel like they are going to fight. Their back is against the wall, and everything for them is on the table.
Well, and then there's the proxies to consider. You already have the front that has opened up on the border with Lebanon and Israel as they go after Hezbollah. Now the Houthis also are launching drones and missiles at Israel. We all remember what they were able to do with commercial shipping, effectively cutting it off in the Red Sea back in 2023. How high is the risk that we could see that scenario repeating?
Oh, I think it's very high. I mean, people have been trying to figure out for the last few weeks why the Houthi was the dog that didn't bark. But, you know, they've started to engage a little bit more here. If they start not just targeting Israel, as you say, but beginning to target again ships transiting, you know, Katie bar the door. I don't know. Oil prices are going higher and higher and higher.
Markets are turning lower before our eyes here, by the way. I just want to mention the S&P is down 5 now. The NASDAQ is down 89 points after early gains. In our remaining moment, you spent time on national security, as we've already established, and whenever you visit in the George W. Bush administration, you were certainly gaming out any number of possibilities involving Iran. Are these options we're talking about for President Trump things that you had your eyes on, Carg Island, et cetera?
Carg Island, I think, has been on everyone's list for some period of time when we were thinking about sanctions and maximum pressure, because it was always, how do you get to the Iranian oil? And here's their choke point, if you will. By the way, the world's choke point, of course, is the Strait of Hormuz. Sure. This is their choke.
Did you game that out too?
What's that?
The Strait?
Yes.
You had these maps, you had these battle plans in front of you.
Oh no, I had a sort of a different role, more along the putting pressure on Iran in that particular office, and less the military plans. But no, I know that these two items have been part of military planning for some period of time, and I think this is something that we've got to figure out how to deal with, or else we've given the Iranians a lot more leverage than they had before this thing began.
Well, I know this is something that you've been very close to for some time. We'd like to stay close to you on this, Michael. Thank you for coming in. Michael Allen, Managing Director of Beacon Global Strategies. We'll assemble our political panel next for their take on this. Rick Davis and Jeannie Shanzane are on the way here on Balance of Power, only on Bloomberg TV and radio.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Stocks have just turned lower. The Dow higher, but the S&P, NASDAQ, they are both in the red. S&P down 7, little change, but giving up earlier gains, down 0.1%. Dow Industrials up 127 now. The Dow higher by 0.3%. NASDAQ down 95 for the NASDAQ Composite Index, a drop there of 0.4%. 10-year yield at 4.33% with a 2-year 3.82%. All of this against the backdrop of a VIX, the so-called fear gauge, closing in on 31 now. We've got spot gold up 0.7%, 45.24 the ounce, and West Texas Intermediate crude 103 a barrel, 103.60 now, up by almost 4%. Barrel of Brent back in the green, up 0.1%, 112.65 for Brent crude. Shares of mortgage finance giants Fannie Mae and Freddie Mac are clawing back part of a months-long decline after investor Bill Ackman called the mortgage finance giants, quote, stupidly cheap. Shares of both companies up by 35% or more. Freddie Mac is advancing now, by just about 39%. Fannie Mae also moving higher. Right now we've got Freddie Mac 37% higher, Fannie Mae up by 39%. Again, recapping here, stocks trading mixed, S&P lower by 0.1%, a barrel of WTI crude 103.60 up by 4%. I'm Charlie Pellet, Haley and Joe. That is a Bloomberg Business Flash.
All right, Charlie Pellet in New York, thank you so much. Meantime, here in Washington, it's fairly quiet in town, except for all of the spring breakers who have traveled here to see the cherry blossoms, visit the museums and the monuments on what is spring break for many across the country. It is also not spring break, but 2-week recess time for those who are not here in Washington. Members of Congress, both the House and Senate, out for 2 weeks, Joe, having left town without funding the Department of Homeland Security, which is now in a shutdown that is record long in length. We thought the Senate had reached a compromise. The House said, no, thank you. And we will see no progress until members return 2 weeks from now.
Yeah, the storyline.
Unless the White House calls them back sooner.
Well, I guess that could happen this week or next. The storyline late Thursday was we got a deal.
Yeah.
TSA, hang on. The paychecks are coming. And that part still happened because the president, of course, signed an executive order to pay TSA agents. We're told they're going to start getting paid today, Kaylee. Whether that helps to kind of unwind some of the issues at the airports. It still leaves FEMA and the Coast Guard, and I'm not sure why no one's talking about that. But of course, the President of the United States has his focus today on Iran and the latest here with this war that is now entering its 5th week. And we want to bring in our political panel for the latest on all of this with a new threat from the president on Truth Social that will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants. He even threatens desalinization plants. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Jeannie is, of course, our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick is our Republican strategist and partner at Stone Court Capital. Jeannie, the president says a lot of stuff, and it's not always factored in on a serious level. When you start threatening power plants, desalinization plants, he says oil wells in Iran, many have noted that these would be war crimes if the president followed through on them. How should we interpret this rhetoric?
Yeah, I mean, they are absolutely war crimes. They are a violation of international law. These targets are civilian targets. This is not unlike what Russia has done in Ukraine that we have spoken out viscerally against, rightly so. So for the president of the United States to sort of cavalierly put this on Truth Social with these threats is jarring. The reality is, and I think the president is well aware of this, is he is in a very tough bind, as are we as the United States, because at this point, Iran holds all the cards. There is no way for us to de-escalate at this point. They don't trust us to negotiate, nor should they, because the last 2 times we did, we bombed them afterwards. They have a threat to their entire nation state is under threat by Israel and the United States because we not only want regime change, we want to wipe them out. So they have very little incentive and they're holding all the cards right now. The longer this drags on, the more desperate the United States and the world economy gets and the more leverage they have. So it's a very tough situation. We need to find an exit, and the president, and I think his bluster and sort of bravado shows this, is searching desperately for one, but he hasn't come up with a game plan yet. And that's where we stand today, with oil prices shooting up, fertilizer prices shooting up, and the world economy literally on the brink unless he is able to figure out an off-ramp here.
Well, and Rick, as we consider the market forces here, what we're seeing in oil and commodities prices, what we've seen in stock markets, many are pointing to the timing of the statements we've gotten from President Trump and how he may be wary of that as well. Even the Speaker of Iran's parliament posted on Twitter, on X yesterday, heads up, pre-market so-called news or truth is often just a setup for profit taking. Basically, it's a reverse indicator. And what do we get a couple hours before the bell rings this morning, Rick? President Trump out on Truth Social talking both about great progress in negotiations and threatening Iranian energy infrastructure. Is that timing coincidence?
Well, you know, if it were just one message, then I'd say it wasn't coincidental. Because you'd be trying to bolster the price, you know, take down the price of oil or bolster the stock market. But when you deliver both those messages, it's like trying to figure out what the net effect on the markets are. It just, you know, I think just slumps everything. So, look, one of the things the president is desperately in need to do, and the polling data now that we've been in this over a month is starting to really firm up strongly, is that he's got to convince the American public that this escapade is worth its effort. You know, the public is coming in hard against this war. They're coming in hard against ground troops. They're unhappy that the price of gasoline has gone up to almost $4. I think it's $3.99 today. And so this now, the war in Iran, is second only to the cost of living, and there's some crucial connections between the two. And so I think the president has to start spending less time on the back of airplanes or Truth Social taking pot shots at the Iranian public or the Iranian leadership, and spend more time having a conversation with the American public as to why this is important to them. What does this mean for national security? What does this mean for their economic security? What does this mean for inflation? These are all questions that the public are raising, and they're not getting any discussion with the administration on this.
With still no formal address from the president. So we rely on the posts on Truth Social. Jeannie, what do you make of the first line of this post? The president clearly trying to convince people that regime change has occurred. He says the U.S. is in serious discussions with a new and more reasonable regime to end our military operations in Iran. Will this be a consistent talking point, you think, Jeannie? Because if you read this post, it sounds like objectives are being met.
Yeah, and that's absolutely what he's trying to say. Of course, when Marco Rubio was pressed on this over the weekend, he could not give a name as to who the new regime is. And what we do know is that the new regime is a son, the family member of the old regime, who is more hardline than his father, whose wife, child, father, and family members were all killed, and himself may have been severely wounded in that attack. So there is no sign here, and anybody who's familiar with Iran knows that this is a very deep regime. The fact is that if we go back to January, the Iranian nation, the Iranian regime is in far better straits today, and excuse the pun, than they were in January. They are economically in better shape. They no longer have sanctions because while we were bombing them, we have removed the sanctions to get the oil out in the market, which makes sense. They are more hardline. They don't have protests going on in their country the way they did. So this is a very, very difficult regime to destroy. That's why all the presidents before Donald Trump didn't take this view of Iran. And so this is where we are today. The United States is in worse shape and Iran is in better shape. The world economy is in worse shape. Iran is in better shape. That is not winning in anybody's estimation or definition.
Well, so when we consider what it may take to win, if indeed ultimately regime change or seizing the uranium or seizing Kharg Island are things that the U.S. might want to pursue here, Rick, that could very well involve ground forces. How do you think it makes a difference in the president's mind to make the decision to send ground troops in or not, knowing Congress is gone for 2 weeks and any kind of effort to exercise war powers authority would be on a break, presumably, until then?
Yeah, I think the president's pretty satisfied that after his initial attacks on Iran that the Republicans blinked on war powers. The leadership in the House and the leadership in the Senate basically fouled it off, saying that not necessary. They're the same leadership, so I can imagine they'd take the heat for the president if he put a ground invasion into Iran, basically saying that no resolution was necessary. It runs afoul of everything that's happened historically around these kinds of incursions. But this is a patent pending Trump Congress. They do what he wants to do when he wants to do it. There's very little leeway. Frankly, you could argue that the president wanted to scramble the deck a bit on the DHS side, and that's exactly what he got. At one point, he supported the Senate and then he supported the House, and you can't have it both ways. So at the end of the day, I think the president has a free hand here when it comes to being able to do what he wants to do with the war effort in Iran without Congress putting any shackles on his power.
Caroline Levitt, Jeannie, is talking about the TSA right now. She's just started at the White House briefing, which was a late add to the schedule. She says the president's found a way to make sure they get paid. He was honored to do it, but it should be an eye-opening moment for the American people. There she is now, for those of you with us here on Bloomberg TV. Jeannie, what do you make of this move? The president gets TSA agents paid, takes away the pressure point to potentially reopen the department. I don't know what it means for FEMA or the Coast Guard, but could we be in a world now where DHS goes unfunded for months or the rest of the year?
We absolutely could. And, you know, it is just, if any American needed another reminder how dysfunctional DC is, I mean, this is it. They jet off for a 2-week vacation. We're in the longest partial shutdown of a U.S. department. And we're doing this at a time of war. I mean, let's not forget, DHS was created post 9/11 to address terrorist threats. We are in a war with the Iranian regime. They are very good at using terrorist soft targets and others to attack. And we have let DHS go unfunded. It makes no sense. If the president could have paid TSA agents before, he's doing it now. He should have done it before. He's doing it now. But we need a Congress that functions. And this is quite literally a pox on both of their houses. Although Republicans in their infinite wisdom took something that Democrats may have been a little bit blamed for, and they hoisted it on themselves by making it now, you know, Republican on Republican violence, as we saw over the weekend as the House Republicans and Senate Republicans traded barbs. So this is a bad situation, and it's at a dangerous time for this to happen, and they could go unfunded if Congress doesn't act.
All right, Jeannie Shanzano and Rick Davis, our political panel today, Bloomberg Politics contributors, the both of them. Thank you so much. And I'm bummed, Joe, that we ran out of time there and we didn't get to talk about the fact that Senator Lindsey Graham of South Carolina spotted at Disney World over the
Chef
recess
Mickey's.
while DHS goes unfunded.
Yeah, I guess he was eating the tater tots with Mickey at Disney World. He said he was there for meetings, though. He was working.
Yeah.
So are we. This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. A rebound for the S&P 500 index has faded. We are now trading lower. The Dow higher, S&P, NASDAQ both in the red. Right to the numbers with the S&P down 0.2%, lower by 9. The S&P 500 index now at 63.58. Dow Industrials up 136, holding on to a gain of 0.3%. NASDAQ does remain lower by 0.5%. NASDAQ 100 index also lower by 0.5%, and the VIX above 30. The 10-year 4.34% now, with the 2-year 3.82%. Gold is up $26 the ounce to $45.20, up by about 0.6%. Major move higher for West Texas Intermediate crude, 103.45. A barrel of WTI up by about 3.8%. We did see Brent trade lower, but right now a barrel of Brent 112.88, up by 0.3%. But again, that WTI move bears repeating, up now by 3.8%, 103.48. General Motors will start operating a Michigan truck plant on Saturdays later on this year, adding overtime production to build more of its gasoline-powered heavy-duty pickups. GM shares, they're up by about 0.1%. Again, recapping, we got the VIX above 30, the 10-year 4.34%. WTI, West Texas Intermediate crude, 103.58 a barrel, up by 4%. S&P just about the low of the day, down by 0.1%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie, we do thank you. Charlie Pellet with the baseline on Wall Street. He'll be back in about 20 minutes' time with another read on the markets. We want to dig a bit deeper with Christine Aquino, Bloomberg's managing editor for the Markets Live blog. She's got her eyes on all the corners of the markets here with a lot of confusion, Christine, that we've been talking about politically. And, of course, that goes for the market as well, with the president speaking on two different tracks when it comes to Iran. If Washington can't figure out always what he's saying, how about Wall Street? What is the sentiment today as markets fluctuate from positive to negative? And investors just looking for some indication. Caroline Leavitt at the White House, I'll just mention now, she's at the podium in the briefing room, says that the Pentagon estimate remains the case. She's reiterating the timeline estimate of 4 to 6 weeks for the Iran war, saying that President Trump may be interested in Arab states paying for the war. Is any of this helping to soothe investors?
Well, Joe, I think we have reached this point in terms of markets grappling with the impact of the Iran war, where, you know, it's a little bit of a holding pattern. There aren't really any concrete developments either way, either toward a ceasefire or a major escalation. And so we are reaching this point where you do get a sense that there is a little bit of investor fatigue when it comes to investors pricing in the risks from the conflict. But today, of course, markets seem to be paying more attention to Fed Chair Jerome Powell, who did weigh in a little bit on the impact of that, primarily through the channel of inflation. And as you can see from both green and the screen for stocks and bonds, Powell has managed to soothe at least some of the inflation concerns that have been lingering for markets.
Well, yeah, looking at the 10-year yield down 9 basis points on the day, Christine, is this now a bond market that seems to be thinking that it's just an inflationary shock that the Fed will look to or look through, rather, or that this is going to turn more into a growth shock, hence yields lower?
Yeah, there's probably a little bit of both of those elements that you mentioned, Kaylee. I mean, in terms of the immediate reaction, it does seem like Fed Chair Powell very much emphasizing that they are treating the oil shock as a temporary inflationary impulse, and therefore not necessarily something that they're going to be responding to. And so accordingly, we have seen markets kind of put bets back on potential rate cuts. Not a lot, but they have shifted their tune from pricing rate hikes as recently as last week. And then, of course, that all feeds into their perception of the impact of higher energy costs on consumption and growth. As you mentioned, that is kind of the second order impact of higher oil prices eventually, right, is that it will just be difficult for households and consumers to afford energy, and therefore something that could crimp the rest of their ability to consume just in general.
Christine, Goldman Sachs sees capitulation here based on the number of heavy short sales by hedge funds. And I'm wondering what you make of this note, with hedge funds cutting global equity holdings for a 6th straight week, driven by short sales. In Europe, short exposure in macro products that trade broad economic themes is now at 11%, a 10-year high. Does that guarantee a snapback when this whole thing ends?
Yeah, I mean, potentially we could see a squeeze, Joe, because we have seen just an overwhelming impulse to sell by investors. But very interestingly, so hedge funds, of course, one part of the market, we have seen retail investors actually turning a little bit more optimistic when it comes to flows into ETFs. And so you do have a market that is functioning a little bit more in a two-way basis at the moment. And that's probably why, even though we have spoken about that level break last week, that was very key support for the S&P 500. It hasn't necessarily been a straight line decline, just because you are seeing these two-way flows from retail investors as well as institutional investors at the moment, Joe.
All right, Christina Kino, managing editor of the Bloomberg Markets Live blog. Thank you so much. Now, we're continuing to keep an eye on the briefing from the White House press secretary, Caroline Leavitt, who just told reporters that President Trump has declined to rule out an Iran ground operation. Of course, we know that the president has not been ruling out actually using ground forces, but she is just reiterating this. And we want to get into how popular or not that idea may be with the American electorate as we turn to Cliff Young of Ipsos, where he is U.S. Public Affairs Chair. He's also professor of Texas A&M University's Bush School of Government and Public Service, and is here with us in our Washington, D.C. studio. Welcome back. Well, Cliff, to Bloomberg TV and radio. If we indeed do see ground forces at some point in some form, how is that likely to sit with the American people based on your polling?
You know, first and foremost, Americans are not in favor of that. In a general sense, not just specifically with Iran, but in general. They've been against strong muscular interventions. They have the idea of forever wars in their head, and so they're not in favor. More specifically, a majority of Americans would be against interventions of that kind, and only 7% of Americans would be in favor of strong intervention with lots of troops on the ground. And so there's not a lot of support overall for such interventions.
Really interesting to put numbers on this, Cliff. It's great to have you back. More than a month into the conflict, you find at Ipsos more people disapprove than approve. 61% disapprove, 35% approve. But I'm curious about the trajectory that you've seen in the last 5 weeks. You point out President Trump's approval rating has declined 3 points since the strikes began at 40%. What does that mean?
He's bleeding support, ever so slowly. Trump and his administration haven't fallen off a cliff, but overall, Americans are beginning to feel it. I would say it's less to do with the abstract notion of intervention and much more specifically about price at the gas pump. Americans feel that. People feel that in general. And that's what's really eroding support in the short term.
So it's about the economics here at home, essentially, is what you're saying. We've known for a long time that affordability is the issue that seems to be top of mind for voters. Is it fair to say that this war is actually exacerbating the affordability concerns that were pre-existing?
Yes, and typically foreign interventions don't affect the home front, don't affect domestic issues. One thing is one thing, another thing is another, we often say. But in this specific case, obviously the price of oil is critical for everyone and for Americans' household budgets, and they're feeling it right now. And it goes against the primary issue of the midterms, which is affordability. And indeed, going into this conflict, we were saying that the Republicans are going to have a challenging year. Trump's party will have a challenging year. I think we could say even more so, given what we're seeing today.
Interesting. There are 3 numbers that you put on one page that say everything you need to know, Cliff, based on your findings. Americans unclear on goals, pessimistic about gas prices and security. The White House has been working overtime to try to delineate clear objectives here, but people still aren't always feeling it. 65% say gas prices will get worse. We're at $3.99 today, so welcome to $4 a gallon. 66% say the president has not clearly explained goals. This number is a problem for the White House. 29% believe U.S. involvement in Iran will improve U.S. security. How difficult will this be for the president if he can't get that number higher?
That's the trifecta, the trifecta of problems. Indeed,
we might be able to swallow high gas prices if we think this is making us safer,
yeah,
but we don't.
But even then, the number one issue is affordability. That will always weigh more in people's mind than security. And so it really comes down, obviously all 3 are important. Most importantly is how much am I paying at the gas pump? Can I make ends meet? Can I afford things to make my family go?
Well, so when we consider that those are the domestic concerns, this has been a president that has been much more internationally focused than you might have thought listening to his campaign speeches and his messaging initially when he came to office a second time. It's not just Iran, it's also been Venezuela. He's talked a big game about Greenland, even Cuba. Are any of those initiatives popular? You were talking about how this isn't just Iran, it's interventionism as a whole that Americans are disapproving of.
Yeah, it's an agenda that's misaligned with what people here in the United States want. Indeed, I would even double down and say misaligned with his base. The MAGA Republicans, the America First Republicans don't want forever wars, and we're beginning to see on the margins a winning away of that support. Indeed, he still has strong support among Republicans in general, but there are cracks and fissures in the foundation.
Biggest drops are on cost of living and the economy. It's almost as if we're not talking about a war. But you did ask about moral leadership in the world. What did you learn?
Well, Americans are highly critical of what we're doing. Once again, going back to forever wars, there's a high level of critique of what was done. There was a desire to change things in the last few electoral cycles, to change America's position vis-a-vis the rest of the world when it comes to our military might. And today, many Americans, a majority of Americans, believe that we're not the same moral leader that we once were. And Trump is confronting that today, and we see it in his numbers.
Well, and we talk about this as President Trump confronting this kind of grim reality in terms of public sentiment. But you were speaking a moment ago, Cliff, about how this was reflective of his party as a whole and Republicans who are going to have to stand for re-election in November. Looking at the midterms picture right now, how has this war changed, in your mind, the midterm outcome, or potentially exacerbated how extreme those outcomes could look like when we're talking about seats flipping?
Yeah, we already thought that the Dems were most probably going to take the House. Now the question is by how much? And if this sort of scenario persists, it doesn't have to persist until Election Day, but well into this year. That difference could be large. The victory gap could be large. Indeed, we are already, not just us at Ipsos, but in general, the market of pundits and forecasters are already reassessing the Senate. I think it's in play where it wasn't maybe a few months ago, maybe 50-50. We can debate that a bit, the specific point estimate. But ultimately, the administration and the party, the Republican Party, are in a bad place for today.
You look at history in your research, White House typically loses seats in the midterms. Everyone knows that. And you've put a number on it. The average is a 25-seat swing. We talked to Susan Delbene last week, who chairs the DCCC. They're going after Trump plus 13 seats around the country. They think that number could be in the 30s or 40s, Cliff. And obviously, a Democrat's going to speak that way at this stage of the race. Will the price of gas determine whether that's true?
Yeah, the price of gas and the sense of affordability. So it's not just gas, but that's a big driver. But how do people feel, how Americans feel in general? Are they able to make ends meet? And ultimately, I would not be surprised, we would, if we had a 30 or 40 seat swing. I wouldn't. We haven't redone our models at Ipsos yet, but the indicators, everything, approval ratings, generic ballot, they all are pointing in that direction.
Well, of course, we're talking about an election that is still just over 7 months away. Cliff, you said a moment ago that it's not necessarily about November, but if this goes on for much further, when's the crunch point where there's not going to be recovering if you are an incumbent in the Republican Party who is trying to stay in power in November? Where is there kind of no room for recovery?
I think June or July, that's sort of the point of no return. That said, it's much easier to go down in the polls and come back up. That goes to sort of approval ratings as well as a generic ballot. So anything they lose now, they might recuperate a little bit, but they won't get back to status quo ante. So overall, sort of the conditions are set. It looks like it's going to be a difficult year for Republicans.
You know, the president talks about the golden age and how this is the greatest economy in the world. It certainly was before we started striking Iran. You find out 68% of Americans do not believe the economy is booming. Only 30% believe that.
Yeah, and
That runs against every message that's coming out of the White House.
And that's an earlier poll, by the way, and we specifically put that in there. No, things were not good going into Iran. Things were not going into this moment already for Republicans. Americans do not feel like things are going well. Again, they see themselves as having difficulties making ends meet. It's about affordability. It's not about the inflation rate. The inflation rates have come down, but it's how much they have to spend to make the family go. That has not improved in their minds, and obviously, high prices at the gas pump do not help.
Wow. I'm sure there's going to be something good we can talk about one of these days, Cliff. I just know it. Cliff Young with Ipsos and Texas A&M University's Bush School of Government. Great conversation, fascinating numbers, Kaylee. It's not getting better for this White House.
No, and of course, we're hearing from the White House right now. The press secretary, Caroline Leavitt, says the U.S. is trying to figure out who's in charge of Iran. We'll see if we have an answer by 5 p.m. when we're back on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Live across Bloomberg platforms. Carol Masser, Tim Stenivek, live here on Bloomberg Business Week Daily. Yes, indeed, it's another week. A lot coming at us, including the jobs report on Friday. We've also got a war now in its 5th week between U.S., Israel, and Iran. And we do have stocks right now. Little change near our lows of the session. Treasuries, though, Tim, we did see rallying after Fed Chair Jay Powell said that the President Trump's sweeping tariffs resulted in a one-time price bump and that the central bank has little control over supply shocks, such as the war-driven surge in oil prices. He spoke earlier today at an event at Harvard University in Cambridge, Massachusetts.
Have tended to come and go pretty quickly.
Here too.
Monetary policy works with long and variable lags, famously. And so by the time the effects of a tightening in monetary policy take effect, the oil price shock is probably long gone. We will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be. But we'll certainly be mindful of that broader context when we make that decision.
Well, there you have it. Fed Chair Jay Powell at an event earlier today at Harvard University. Carol, what would you have done if the Fed Chair had shown up to your macroeconomics 101 class?
I would have loved it.
That was pretty cool.
Do you know, I remember being at a big Bloomberg thing in D.C. I think it was after the White House press correspondents dinner, and it was like all I wanted to meet was Alan Greenspan at the time. So that would be such a high.
The students asked some pretty good questions, too.
Yeah, exactly. Like in it, trying to understand, like you cross academia, right? What you learn in a classroom versus real life and what you can do or not. I just think it's pretty cool stuff.
Well, his comments moving markets, as Carol mentioned earlier, we did see yields move lower. This after Fed Chair Jay Powell said that those tariffs would be a one-time price bump.
Yeah, so listen, this is kind of similar from what we heard from Fed Chair Jay Powell at the latest Fed meeting. So what do we do in this next 60 minutes? We're going to talk about the latest on the war from the region. We're going to be heading to Jerusalem for an update. Also checking with retired Major General Mastin Robison on reading the tea leaves on escalation versus peace talks. I think it's kind of hard to tell, Tim, sometimes.
Yeah, plus market reaction and what global trades are telling us, including how the Hormuz situation is mutating from a military war to an economic war. Also, Tim Baker, Deutsche Bank's head of FX Research Americas, on petrodollars and the future of the greenback.
We got a lot going on this Monday, so stick around, everybody. First up, though, let's get a check on the trading day. Some of your top busy stories at this hour. Here is Charlie Pellet. Charlie, welcome back.
Hi, thank you very much. Indeed, right now we are looking at just about our lows of the session on the S&P 500 index, right to the numbers. Mixed market, Dow higher, S&P, NASDAQ, both in the red. VIX right around 30 now. The Dow up 156. That is a gain of 0.3%. The S&P lower by 10 now, down almost 0.2%. NASDAQ and the NASDAQ 100 index both lower by just about 0.5%. That VIX pairs repeating, now above 30. The 10-year, 4.34%. 10-year yields dropping the most since early February. As Jay Powell said, longer-term inflation expectations do appear to be in check. The 2-year, 3.83%. Spot gold is up 0.6%, $45.22 the ounce, while West Texas Intermediate crude just above $103 on WTI, up now by 3.5%. Brent crude, $111.97. Barrel of Brent down 0.5%. And Bitcoin at 66,860. Bitcoin up by about 0.5%. Looking at a mixed day for the oil major stocks. ExxonMobil up 1.2%. Chevron up 0.5%. ConocoPhillips down now by 0.7%. So again, recapping, we do have the Dow higher up 0.4, S&P down 0.1, the VIX above 30, and West Texas Intermediate crude 102.91 a barrel, up 3.3%. That, my friends, is a Bloomberg Business Flash.
Great. Charlie Pellet, thank you so much. Carol Master, Tim Stanovic, live here at Bloomberg headquarters in New York City. Definitely a lot going on, and President Trump did threaten to destroy Iran's energy infrastructure if no deal is reached to end the war there, while also hailing talks as productive. That's the back and flow, the ebb, or the back and forth ebb and flow. And then we also, I mean, the president's been out there on social in a big way.
Yeah, look, I don't know his strategy, but it seems to follow a pattern, at least talking about markets and talking about success when markets fall. He's out there in full force. Not only, and we're going to talk about this a little later, but having a short conversation with Anne-Marie Hordern of Bloomberg Surveillance a little earlier today. But yeah, that's right, out in True Social earlier today.
It's a really good point, though, and certainly thinking about, one eye on the markets, no doubt about it. As for what the president said on Truth Social, he said the United States of America is in serious discussions with a new and more reasonable regime to end our military operations in Iran. Great progress has been made, but if for any reason a deal is not shortly reached, which it probably will be, and if the Hormuz Strait is not immediately open for business, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells, and Karg Island, and possibly all desalinization plants, which we have purposely not yet touched. Again, this is President Trump earlier on social. We should point out more than 4,750 people have been killed so far, roughly 3/4 of them in Iran. So let's get an update from the region.
And let's head to Jerusalem and to our journalist there on the ground. Bloomberg News Jerusalem journalist Dan Williams joins us. Dan, this idea that the president is in discussions with a new and more reasonable regime to end the military operations in Iran. What do we know about who or whom he is speaking to?
We don't know much at all. In fact, that would appear to be by design, at least to hear the Trump administration tell it. You have Secretary Rubio being asked in a television interview today the identity of those interlocutors in the Iranian regime. Keep in mind that officially, when it comes to the known spokespeople of the regime, what remains of it, and enough remains to stay in control of the country, they've denied having direct talks, and they have openly scorned the various approaches made by Trump. So Rubio says that they cannot disclose the identity of those interlocutors for fear that they would face score settling within Iran. It's really hard to know what to make of this. It would appear, if this is true, that the Americans have found someone to talk to, someone to peel away from the main regime and perhaps create a post-war regime, or the makings of a post-war regime, a renegade within the existing regime. But then the question would be, can those people deliver? If they're renegades, if they can't be publicly acknowledged, and indeed if they're being publicly denied by the people we know publicly to be in charge of the country.
So many questions. I want to layer on top of that, Dan, Houthi militants launching ballistic missiles at Israel Saturday morning, so marking their entry into the month-long war with Iran that has already caused, as you know, so much chaos in energy markets and killing thousands, as we mentioned earlier. Feels like an escalation to me. And then you could layer on top of that, too, U.S. military and the troops that they've been sending to the region.
It does. The vector is definitely toward escalation. I would say when it comes to the Houthis of Yemen, with that not surprising entry into this war, they previously took part in this war. Indeed, they were firing directly on the U.S. Navy and were fired on in turn only about a year ago. However, this was a fairly muted attack with which to open up a new front with Israel. It was 2 missiles, one surface to surface, one cruise, neither of which hit home. And indeed, the Israelis seem to be at pains not to make too much of it, perhaps not wanting to serve them a propaganda victory in threatening retaliation, threatening escalation. That attack by the Houthis, to my knowledge, has not recurred since Saturday. Quite an odd development there. However, anyone involved in shipping in the Gulf, in the Red Sea, will be very worried about the potential re-entry of the Houthis. They've proven very able to disrupt maritime traffic in the past.
Hey, Dan, before we let you go, and we're having a little bit of connection issues. We're going to try to get that worked out. In Israel, where is the Netanyahu administration in terms of wanting to exit this war or being aligned with what we're hearing from President Trump? Is there daylight between them, or do they seem aligned with their messaging?
There is no daylight that can be visible. I guess that's the point of daylight. The Israelis, like the Americans, are saying they're in this to get the job done. However, there is a diminution of expectations when it comes to a toppling of this regime. It's worth remembering from the outset, both President Trump and Prime Minister Netanyahu described the potential toppling of the Iranian regime as a aspired to downstream effect of the primary objectives of this war, the primary objectives being defanging Iran in terms of a destruction of its nuclear and advanced military capabilities. So both sides said at the outset that they would prepare the ground for Iranians internally, organically, to bring down that regime. That has not happened. And it would appear that if there is a reassessment, it would be in the direction of making do with that destruction of Iranian capabilities and letting time tell in terms of a largely ruined country in disarray in Iran, whether in the coming months and weeks, perhaps, the Iranian opposition, such as it is able to seize the situation and rise up to topple the regime from within. If there is a review underway, the review would be on that downstream ambition, the ambition of a regime change internally.
Dan Williams, he is a Bloomberg News Jerusalem journalist, joining us from Jerusalem. Dan, thanks so much and stay safe. Now to a view on today's global financial markets.
Yeah, and we want to get into how the Hormuz situation is mutating from a military war to an economic war through one key weapon. We're talking about global energy inflation. It's something we continue to highlight here, but so too does our next guest. With us is Florian Ielpo. He is head of macro at Lombard ODA Investment Managers, typically based in Geneva, but here in New York. Lucky for us on this Monday. Welcome, welcome. Nice to have you here.
Thanks for having me.
There's so much to get to, and I want to get into your thinking about how this can mutate from a military war to an economic war. But I do want to ask you from your vantage point. I think we report on the war. There's certainly a U.S. perspective, or maybe through our lens. But I'm just curious, from when you're in Geneva, what are the conversations you folks are having around this war and the implications, short and longer term?
From our perspective, the first thing we think of course, is the human cost of the situation. Okay, and then we have discussion with our clients on what to do about the ongoing energy shock to protect their portfolio, to protect their savings, to protect then their pensions. Okay, the key message we came up with is that you need to make a very big difference between the source of your energy inflation. Is it coming from demand or is it coming from supply? And the kind of things you need to deploy in your portfolio is clearly not the same. Demand, well, you'll see an answer from your central bank trying to tame demand so that to normalize inflation. Supply, usually it's just frictions. So normally your central bank should be rather dismissive with it, saying it's friction, it's temporary, you just need to wait and I'll hold my rates unchanged, which is a very different type of situation. If it's coming from commodities, then it's probably an interesting asset to hold in your portfolio. Holding a direct exposure to, say, inflation linkers could be interesting. And rates volatility in that situation is very interesting.
So interesting in that it's hard to make the call right now, or your expectation is that global central banks will have to keep rates higher because we're going to have some kind of floor on our energy prices just because there is some destruction that is going to take time to reboot, particularly for European markets, Asian markets who are more exposed perhaps.
True. Now let's think of the Gulf War. I think it's an interesting example.
Yeah.
Right. It lasts for about 6 months with a peak in oil prices and a global peak in commodities and then the normalization. Okay. The US were actually exiting from a recession back then, and this spike in oil did not deteriorate the global economic environment in which the US were or Europe. Okay, one thing we've learned from last year is that if it doesn't bring you to a recession, there's no case for shorting the market. It's just a future entry point for holding more equities in the future. For now, we're in this wait-and-see situation.
You said for now. Is there an idea that this could bring the U.S. or other countries to recession this year if prices remain elevated for some time?
Our base case scenario is when you double up energy prices, which is a significant shock, okay, that the average size of any energy crisis we've seen so far, when something like that happens, it chops off about 1 to 1.5% of your GDP. In the US, just think of the current AI investment situation. This would more than offset already that shock. So our base case is really not a recession this year for the US or for Europe either.
We should say Brent, Carol, up 83% this year. WTI, the U.S. benchmark, up 80% this year.
Yeah, I also just want to, we're watching headlines and they, are constantly coming connected to the war, the corporate space, but we've got from CNBC, JetBlue Airways raising bag fees, and this is because of the fuel price hike. And so we're seeing certainly an impact in the share price. Let me just pull it up on my Bloomberg, and you've got shares of JetBlue. They've been down pretty much throughout the day, and there's a lot more going on with this airline fundamentally as well, but it's down about 1.8%. So in terms of strategy, are you advising clients to kind of sit tight at this moment?
Yeah, that's pretty
Or
much.
is it an opportunity to maybe, pick up assets or various asset classes because they've been depressed a little bit at a lower price?
There's a matter of what the market is already anticipating in terms of scenario. Now, if I can just step back, the way we think of investing is 40, 40, 20. Okay, we say there are three kinds of periods for investing: improving growth, 40% of the time; deteriorating growth, 40% of the time; and 20% of the time, which we often forget about, is inflation.
Yeah.
And we are precisely in this kind of shock. So when you create your portfolio for the longer run, just make sure you have enough hedges against inflation and against both kinds of shocks, meaning demand-driven, supply-driven.
But that 40-40-20 you can stick to at this point in this environment where we are on this Monday, March 30th, you can still keep that percentage portfolio allocation.
Especially with the level of valuations we've seen. Think of that. If you look at the break-even market, so the inflation expected within the next 12 months by market, there's a surge by 1.3% of expected inflation by year-end, which is not the scenario, dominating scenario for economists. Quite the opposite. They see 30 basis points.
Yeah.
So markets are already overpricing what economists are anticipating at that moment. So there's a balance to be reached between what's priced in, what's not priced in. We see momentum in the commodity market. It's interesting. We see momentum in the volatility of bonds, and you can monetize that very easily, actually.
The war and the energy crisis, as a result of the war over the last month plus, certainly a focus for investors. Separate from that, I would say the other big theme for investors, at least in the last few months, the last couple of years, would be AI and the effect on productivity, the effect on the economy, and the effect on traditional software equities. I'm just wondering how you're thinking about AI and the effect on productivity and the effect on the economy.
There are two elements that comes to mind. The first one is an economic element. If you remember, I remember part of the late 90s. Back then, we had this surge in productivity, which came along a moderation in prices. At that moment, at that point in time, it's a very important message. Looking forward to the next 12 to 24 months, which is the perspective of inflation. Productivity is an inflation killer, and that productivity boom is actually happening. Okay. First element to remember: your bondholders could be protected by that. The second element is when you buy a stock index, when you buy stocks, globally speaking, the thing you're buying is not investments, not capex. It's not the growth in the number of consumers they have. What you buy is their margin, their ability to deliver on margin, and those margins are guided by productivity. So there's a boom in productivity. Maybe the software sector is currently being a little bit, challenged, to say it nicely. We see very positive longer-term prospects in terms of margin generation. So think that now we're down 7% on your stocks, with a situation that should be momentarily something temporary. I'm sorry. At some point, we'll have a very interesting entry point, and we'll go back to that narrative. AI equals productivity.
25 seconds. So that margin improvement outweighs anything we might lose in terms of laborers and workforce? Or you think that'll balance out?
Outweighs, clearly. If you look at Europe, you do a correlation, you do a chart with population growth versus productivity, and you see that the leaders in productivity are those countries where the number of people are actually going down. It's a marvelous thing. When you have less people, you need to incorporate productivity. It's a very, very, very strong force.
Which is, go around the world in a lot of the developed or major economies, right? You do see less people. Florine, so great to have you in town. Thank you so much. Florine Yelpo, he is head of macro at Lombard ODA Investment Managers, joining us here in New York. When we come back, we get another view on the war from a former general. Stick around.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We're very close to session lows on the S&P 500 index, giving up earlier gains from the morning. But right now we've got the Dow holding on to a gain of 0.4%. The industrials up 169. S&P in the red, though, down 0.2%. NASDAQ composite and the composite index and the NASDAQ 100 index both down now by just about 0.5%. The VIX is above 30, so-called fear gauge. We've got the 10-year 4.34% with the 2-year currently yielding 3.83%. Gold now higher by $25 the ounce to $45.20 for spot gold. That's a gain of 0.6%. Energy closely watched. The big story: West Texas Intermediate crude right now gaining almost 3%, 102.58 a barrel. Interestingly, though, barrel of Brent is moving lower now. Has been fluctuating, but back in the red. Brent crude down 0.6%, 111.89 for a barrel of Brent. And Bitcoin right now up by 0.3%, 66,729 on Bitcoin. Apollo said to be near a $10 billion deal for KKR's Atlantic aviation business. Again, the 10-year 4.34%, the 2-year 3.83%, WTI 102.61 the barrel, up now by just about 3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Tim and Carol, that is a Bloomberg Business Flash.
All right, guys, thank you so much. Charlie, thank you. Well, we are now in our 5th week of the U.S. and Israeli war in Iran. You know that. Iranian ballistic missiles on Gulf targets have consumed at least 2,400 interceptors, a number approaching those countries' known pre-war stockpiles. And this is something we talk a lot. The Drain-on munitions has alarmed U.S. allies around the world as weapon systems and ammunition, Tim, have been pulled to support the campaign against Iran, another angle that we are looking at.
Back with us, Major General Maston Robison, Academy Security's Geopolitical Intelligence Group member. He joins us remotely. He served over 34 years on active duty in the U.S. Marine Corps, during which time he served in more than 60 countries. General Robison, always good to have you on the program. What is your read on whether this war, now in its 2nd month, its 5th week, is actually nearing an end?
Hey, Carol, Tim, great to be here. I think if you walk the dog back, so what's this all about? The end state has always been a non-nuclear threat, Iran. Then how do you get to that? So you either have to defeat a country, you have to surrender to a country, you have to find an off-ramp. And so I think we're still looking for a negotiated off-ramp. I don't think there's any intent at this point to say we're going to defeat Iran in regard to obliterate the nation or its capabilities. Certainly the desire for a supreme leadership authority transition. But the question is that something that can be done in the immediate future? Is that something that's going to be done down the road based on the Iranian people's reaction?
Can it be done without ground troops, without boots on the ground from the U.S. and Iran?
I don't think it can be done with ground troops. I don't see this being going into Iraq, with 300,000, 500,000 ground troops. I don't see that strategy being what we're pushing for. I see we've positioned sufficient assets to be able to apply additional pressure to create negotiation space to try to get the outcome that we're looking for.
So many questions, so many places to go. What I want to go back, though, is what you talked about, the mission of making sure Iran's nuclear capabilities were reduced, gotten rid of completely. Like, that seems to be the main reason, I guess we all assume, that the U.S. and Israel got into this. At the same time, we're reporting that President Trump's willingness to attack adversaries while rattling allies threatening to push the world into a new nuclear age, with governments debating whether they must get the bomb. The U.S. is assessing a return to atomic bomb tests. China and Russia are upgrading their arsenals. The Atomic Energy Agency, the International Atomic Energy Agency, warning that more nuclear weapons in more countries will not make the world more secure. Are we on the precipice of a new nuclear age, in your view?
I don't believe we are. I mean, I think actually the bigger immediate thing that we're on the precipice of is trying for this not to become a case where navigation of the sea and the Convention of High Seas and the rules of international law regarding high seas are completely thrown out of the window, which is sort of what's happened at the Straits of Hormuz. You go back to 1958 Convention of the High Seas, or the 1994, UNCLOS, which is in essence what established the fact that key shipping lanes like this, even though they may be within territorial water, it's illegal to prevent them from being normally used for global commerce. And that's kind of where we are right now. And that has certainly escalated things a bit away from the non-nuclear threat Iran objective to say, but at the same time, we need freedom of navigation globally, or the economy really is going to be massively impacted. That's not new for us. We've been doing that for decades. My first involvement of an situation like that was in the 1980s. Believe it or not, in an obscure location in the Mediterranean where a country is saying, hey, we want to claim this larger body as our own Gulf and control everything that goes through it. And we said, no. 12 miles is what you get unless you're on a key shipping lane, like Straits of Hormuz, blocking Straits of Gibraltar, etc.
Can the U.S. sufficiently, does the U.S. have the technology or the weaponry or the ability to protect ships without Iran's cooperation through the Strait of Hormuz?
That is a very loaded question, Tim, and I would say that's not what we're chasing. I think what we're trying to achieve here is enough leverage to where we have negotiation to be able to have Iran say, okay, we're going to stand this down.
But it seems like Iran has a lot of leverage right now with shipping traffic at a standstill.
Well, they have all the leverage, right, with this?
Well, I don't think they have all of it, but they certainly have more than we wanted to have, which is why we've introduced new assets into the theater to say we need more capability to tip the balance our direction in regard to the threat of what we can do. And that's where you get into discussions of, Carg Island and so forth of, can we take something away from you that's vitally important to you that causes you to say, maybe this isn't the road we want to go down.
Do you believe, Secretary Scott Bessent told Fox News the U.S. is going to retake the control of Hormuz, ensuring the safe navigation. President Trump has threatened to take Iran's oil. Is that bluster, or do you believe it?
I hope it's doable. I think that's the question that we're all sitting around watching and saying, okay, you have more tools in your kit bag now. You have more capacity and capability to influence Iranians' desire to come to negotiation. This is not the first time the Straits of Hormuz have been at issue. It's not the first time we've been at odds, not just us, but the world at odds with Iran regarding shipping lanes and the Straits of Hormuz. You can go back to them laying mines. You can go back. This is the first time it's gotten into this much threat of shooting. And of course, at the end of the day, there's the threat of shooting and sinking ships, but there's a large threat of the cost because of the cost of insurance and the ability for nobody would afford to go through these type of passages, whether it's Bab el-Mandeb Strait or Straits of Hormuz, because insurance costs just go through the ceiling.
General Robinson, one of the things, too, that I think about is what's life after? Maybe I'm optimistic that that'll happen sooner rather than later, and you can weigh in on your time frame. But I do think about, is this still, we've had folks say it's an Iran that is going to be even more hell-bent on making sure it has nuclear capabilities when it comes to military weapons. And so I just wonder, are we creating an enemy that is going to be even more difficult going forward, and it may take a few years for their rebuild? Or are we helping to create a Middle East with all of our allies in that region that's more positive going forward? Is that even, I'm just not quite sure which way this goes.
In my opinion, the results of what's happened over the last month has created more unity among not just Middle East leadership and Middle East population than we've had in the past. I think it was a strategic error on Iran's part, though they didn't really have a choice. I think they had preset targets, when the Ayatollah was taken out and the communication network went silent and the C2 architecture was dismantled for a while, they immediately turned to their in the box, these are the targets we're supposed to attack, and they attacked them. And a lot of those were targets that were not at government institutions, but at commercial institutions in their neighboring countries, which I believe played to our hand in regard to a more unified Middle Eastern population saying, wow, this Persian Iran really is a threat that is bigger than what we've even imagined in the past. So I think in that regard, it's improved the status of the Middle East and our relationship. Going to what you're talking about, have we really been able to knock down Iran's nuclear capability or capacity in regard to their development? Well, we certainly have set it back. I don't think we know yet just how far back we've set it, and I don't think we've played every card in the deck yet in how we would set that back.
What's an example of a card that you think what's an example of a card you think we still have?
I don't know that I would want to speculate on that. I'm not sure that would be helpful. I think the point is that both we, Israel, and now the Middle East, more than ever before, are saying this Iranian nation that we're looking at, this supreme leadership authority, is as unhelpful as we've ever had it. Therefore, how do we transition that to something that's more helpful?
So before we wrap up, I'd love to get your thoughts because President Xi is inviting the leader of Taiwan's largest opposition party to visit China for the first time in a decade, setting up a potential 1 month or meeting 1 month ahead of President Trump's scheduled summit in Beijing. It's just kind of interesting. You just watch kind of the jockeying that's going on around the world. Just interesting. Made us think about, with all that's going on, do you believe that the U.S. is sending messages to Russia and maybe to China especially in terms of their military might and what they are willing to do?
I think it's a fascinating thing that's going to develop. I really don't know how that's going to play out. I don't see Taiwan abdicating to China's demands. I don't think Xi will have any leverage to cause Taiwan to say, okay, we're going to be different. I think Taiwan is not looking for a fight with China, but Taiwan absolutely looking to have the maximum ability to defend the straits and defend themselves from a cross-strait attack.
And do you think, just 30 seconds, that the U.S. is willing to go to war to support Taiwan against China? Just quickly.
I think the U.S. is willing for Taiwan to go to war to take that option away from China, and would love to be part of facilitating Taiwan's capability and capacity to do that. I don't know that we're looking to be involved.
Yeah.
But the entire Pacific Rim, you know, has a lot at stake here.
Right.
And really, the worst scenario is China starting a war against Taiwan.
Always appreciate our time with you. Major General Maston Robinson, Academy Securities Geopolitical Intelligence Group member. We're going to talk currencies when we come back.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the S&P 500 index trading very close to session lows right now. The Dow is holding on to a gain, but the S&P, NASDAQ 100 index all in the red. S&P right now at 63.49. It is down by just about 0.3%, down 19 points. The Dow up 122, holding on to a gain of 0.3%. Both NASDAQ and the NASDAQ 100 index are now down by roughly 0.7%. The VIX holding above 30 with a 10-year 4.34% and the 2-year currently yielding 3.83%. Gold is up $21 the ounce. Spot gold at $45.15. Precious metal right now up 0.5%. West Texas Intermediate crude is rallying 3.6%, 103.24 on WTI. Brent, the global benchmark, right now at 113. Barrel of Brent up by about 0.7%. General Motors will start operating a Michigan truck plant on Saturdays later this year, adding overtime production to build more of its gasoline-powered heavy-duty pickups. GM shares are up by 0.1%. An Uber is acquiring the chauffeur booking app BlackLane, the company's latest move to court a high-end clientele. Shares of Uber up 0.5%. Rival Lyft down by 1.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pellet. Tim and Carol, that is a Bloomberg Business Flash.
All right, Charlie, thanks so much. A few things we just want to point out. The euro heading for its worst quarter since 2024 as war in the Middle East underscores Europe's dependency on energy imports and rattles the region's economic outlook. Meantime, you've got the U.S. dollar extending. It's up about 5 days in a row, while most G10 currencies are down on the day. We also, just talking about before we got started with our guest, Japanese yen, we're seeing some outperformance and outperforming its peers amid verbal warnings and verbal intervention from Tokyo. There's a lot going on.
Yeah, the Bloomberg Dollar Spot Index on path to have its best month since October of 2024 amid an energy price shock from the conflict in the Middle East. Back with a look at the FX market and what it's indicating short and longer term is Tim Baker, Deutsche Bank head of FX Research Americas, also macro strategist. He joins us here in the Bloomberg Business Week studio. Last time you were in here was January, and it was just after Venezuela, but before this current war with Iran. I mean, where do you begin from an FX perspective with a month that we've seen like this?
We had the AI shock in the middle of that all too, right?
We did,
like
yeah.
News. So quickly pivot to Iran and all things energy related. Where do we stand? Look, I mean, who knows with Iran, right? Everyone's going to have a view. None of us have great insight, certainly into Iran, maybe not into US policy. What we can say, observe how markets are reacting, kind of gets us ready for the other side of this if and when it happens. So a couple of things jump out. I mean, one is the dollar hasn't traded all that strongly. Now, you would have been forgiven for thinking euro dollar would be 112, not 115, 116, and dollar yen would already be up at 164. So I think that's probably the most interesting story, that the dollar hasn't done all that well. Maybe that's Asian countries, Middle Eastern countries offloading their dollar assets and saying, hey, we've got to like subsidize fuel or replace fuel revenues if you're a Middle East producer, or intervene in our currencies if you're an Asian country. So I think that's interesting. It's good for the dollar. Dollar's still up because they're an energy producer, but are people confident holding this much in dollar assets? That's the most interesting observation I think so far.
Can I bring up, you just came back from a trip overseas. Tell us what you were hearing.
Yeah, the views are very different. I've been to Europe and Canada recently. They're very worried about the war, oil shock continuing. This is just bad for growth. When does the inflation shock become a growth shock for everyone? American investors are more relaxed. So you can ascribe that to whatever you want, but American investors are more likely to think, there's probably a circuit breaker here. The administration doesn't want S&P 5-10% weaker than this, or US Treasury yields too much higher.
So in a sense, there's a Trump put.
Yes.
The U.S. believes that. Who's right?
Well, I live in America, so I kind of like that story. Look,
Are they more nervous that this is going to go on much longer?
The overseas investors certainly are. I guess what I'd say is, I mean, you can see this in polls, right? That Trump is, okay, he won the election, he's reasonably popular here, he won. Outside of America, they don't really like Trump. I mean, that's what the Pew surveys say, Gallup surveys say. So the rest of the world doesn't really like the administration's policy, maybe that colours how they see things. Maybe it's more clear-eyed in America, and you know that certain things matter to him, how the market reacts. So I kind of side with the American investors that there's a limit to all this, and Trump will declare victory. And okay, Strait of Hormuz is very, very difficult, but ultimately Asia and Europe depend on it, not America.
Which maybe explains some of the complacency. I don't know. Who knows? I want to bring up, though, something that, and we've talked a little bit about the dollar and the energy markets. It was out of Deutsche Bank London, a research note by one of your strategists there, who noted further fault lines in the petrodollar regime arising from the Iran war could have significant downstream effects to the dollar's use in global trade and savings, as well as its role as the world's reserve currency. We have heard this from time to time in terms about the U.S. dollar and its place in the world. Your view on this longer term?
Yeah, it's very interesting. I don't know if it's an outcome that's necessarily bad for the US. I mean, if that was to happen, the petro yuan, then it's because it's Asian producers in the Middle East, as we know, and America's a net energy exporter now. Do they need to be as involved? Maybe that helps RMB internationalization. Maybe that strengthens the RMB, and maybe the dollar can drop from what are still pretty overvalued levels. So I'm not sure that's necessarily bad for America. Maybe it's good for China. Maybe it's a rebalancing in global power. So I think that's entirely possible, because it's hard to overstate just how important it is that the US has become a net energy exporter just in the past 5 or 6 years. The only big region that can say that for decades and decades now. So yeah, maybe that's China's gain. The other pushback, I guess, on that argument would be, well, China is very reliant on Iran and Strait of Hormuz for oil, and now their partner is degraded. Swings and roundabouts, I guess.
Well, even despite the fact that the U.S. does maintain this position when it comes to energy, we are still affected by a global supply shock, like we're seeing out of the Strait of Hormuz. So we're not by any means spared from that. It shows that the energy market is very much a global one.
Yeah, and no one's spared. Some people are insulated. It's America, it's Canada, it's some of Latin America, it's Australia, it's Norway. So better to be in those areas. If you're thinking about the US, at least you do have I think it's an over-owned equity market, but it's a relatively safe equity market. Energy stocks are doing well, tech's somewhat insulated. You've got cyclical stocks elsewhere in EM. And if it's kind of a global shock and global growth's going to slow, Europe growth, my economists have already cut their growth forecast for Europe. It's not a bad environment for the dollar either. So the US being insulated seems to be the kind of outlook, and that plays to the administration's favour in terms of they don't need to pull their foot off the gas just yet.
Tim, what in terms of currencies, our currency team highlighting the Aussie dollar and how it looks, a great lens into kind of what global trading desks are doing in this environment. What is it telling you? And I guess because it's a marketplace where, before we got going, we look, gold trade has been interesting. Like there's been a lot of interesting trades as this war has continued to go on that all don't make sense. So I'm just curious, what do you look at within the currency markets or the market overall to kind of get a better understanding?
It changes every day, right? Even week to week you're seeing some of these variants. So I guess we're trying to look at what actually are the drivers here. This isn't a normal energy shock, not like 2022, right? You've got the Strait of Hormuz, you can hardly overstate its importance. So you start thinking about quantity shocks, not just price shocks. For somewhere like Aussie, performed really well the first few weeks, which makes sense to us. It tells us it's no longer beholden every day to risk appetite. It is that energy producer. The last week, people have been worried it could be a quantity shock, right? A net energy exporter that nonetheless imports gasoline. Yeah. I'm a bit more optimistic there. If you follow the news there, the Australian government's been talking to Asian partners saying, you keep sending us a refined product, we'll keep sending you the LNG. You scratch my back, I scratch yours. I think that makes sense. So I think there's a lot of market fear around that issue. My base case is that'll be okay. Something like gold just felt like a big positioning unwind. Gold just went up for years. If you kind of take the trend out of the gold price, de-trended gold did kind of follow emerging market equities and yields pretty well, but it ran way too hot January and February. Now it's rebased. I think it should perform a bit better from here, a normal geopolitical hedge. Investors we talk to have kind of pulled back and lighted up. So yeah, maybe gold can start to perform as you'd expect it to, I think.
Okay. Maybe there'll be some normalcy back.
45.18 is where gold is.
Don't hold your breath. Tim, thank you so much. Really appreciate it. Tim Baker, Deutsche Bank head of FX Americas, joining us. He's also macro strategist there. Hey, when we come back and check on equity trading and some of the stocks on the move on this Monday, you're watching Bloomberg.